Price a little bit weaker this morning, choosing to focus on the oil that is getting through either the Straits of Hormuz. Of course, much reduced volumes, but some of it gets through. The pipelines that are being explored in Saudi Arabia, in Iraq, through to Turkey, all of that in the market's thinking, rather than the market focusing on areas of escalation. And Tom, there are areas where we're seeing escalation, but the market is choosing to focus on things that paint to a slightly more benign picture and a weaker oil price. And that puts the futures on the front foot.
It does indeed. 3 straight days of gains now for global stocks, and European futures pointing high by 0.7%. That was the gain that we saw by the close yesterday on European markets, up 7 cents. Currently futures pointing in a similar direction today. FTSE 100 futures currently flat. Energy will not be playing that role that it did yesterday. That was the leading sector yesterday. DAX futures pointing higher by around 0.5%, looking to add 127 points over in Germany. Lizzie, what are you looking at?
Well, we mentioned Unilever said to be considering a potential separation of its food assets. Barclays analysts not liking that. They're saying, we don't think there's much investor appetite for another 18-month painful Magnum-esque exit process. So watch how that fares. BHP naming a new CEO in Brandon Craig, and Heidelberg Materials, one to watch, upgraded. Morgan Stanley seeing it as an entry point, gaining on Tradegate. Anna.
Yeah, so those individual stocks certainly will be in focus. And Tom's point, of course, valid, that we have a weaker oil price and London plays a different role perhaps then. Yesterday in session then, energy stocks were to the fore. If that turns around, if energy stocks are weaker, that plays out differently for the energy names listed in London. So let's have a look at where we are opening up this Wednesday morning across European equity markets. The expectation is that we will be broadly positive. That's what futures have been telling us, and we are expecting underperformance in London, and that is broadly at this very early stage what we are seeing. So the FTSE 100 is flat to negative. The Stock 600 up by 0.2%. So we'll watch those energy names, how much they're responding to the weakness in the oil price. It was more pronounced a few hours ago, but still down by more than 1% on Brent. So we'll certainly watch how that spills through into various markets this morning, how that changes expectations around inflation and where we head from here on central banking narratives, because that's a really big topic of this week, of course. The CAC 40 is up by 0.5%. The IBEX over in Spain up by 0.5%. Tom, what are you seeing in these markets?
Across the sectors, top of the list, travel and leisure is the biggest gainer right now, gains of 1.2%, followed by banks gaining 1%, that sector. Basic resources also getting a lift, up 0.9%, and tech is performing well, worth reflecting on a very, very positive session over in Korea, with the Kospi up on semiconductor optimism and some changes in listing rules there. So tech is up in Europe, currently 1%. On the downside, telecoms getting a bit of a knockdown, 0.8%. Utilities also softer by 0.5. Food and beverage weaker by 0.4. You've got about, what, six sectors currently in negative territory, most pointing and in positive territory, with travel and leisure at the top. Travel and leisure gaining 1.3%, followed by banks.
Well, Tom, you talked about some of that semiconductor optimism. Just to pick out some individual names, ASML up more than 2%, B Semiconductor, ST Micron, all in the green this morning, Infineon up 1.6%. Just going back to those stocks that we'd flagged earlier, Unilever is actually down 0.3% on this potential separation of its food assets. BHP named a new CEO, they're up 0.6%, and we're waiting for Heidelberg Materials still, Anna.
Yeah, so a lot being repriced this morning, it seems. A bit of a rotation from yesterday then. So yesterday we saw energy names at the top. Today we see travel and leisure names at the top. It seems the market flip-flopping in its perception of where the gains and losses might fall from what is taking place in the Middle East. 2 minutes into the trading session here in Europe, let's bring in our guest for the top of this hour, Sophie Wynn, Portfolio Manager and Strategist in Dynamic Asset Allocation at BNP Paribas Asset Management. Sophie, nice to have you with us. So let's think about where we are on the energy story and how much that is dominating your asset allocation or not. Are you able to look through what's happening with energy prices and invest around other themes, or is that still the dominant narrative 3 weeks into the war or into the third week of the war?
I think it's still the dominant narrative, and I think all rest on the duration of the conflict. So I think the SPR release, but the fact that the oil market was oversupplied before Iran is buying us some time. So I think a month or so. But the longer that conflict lasts and the longer the Strait of Hormuz stays closed, the longer, I think the more likely we could have an energy shock, which could translate into a growth and a recession, which is at this point totally dismissed by markets.
Yes, that's interesting. And I want to ask you about, we will no doubt talk about that in many different ways in this conversation, but I want to ask you about some of the other themes, because you point to, in your notes, something that we've talked about in the first hour of this program, and that is that analysts are not cutting their expectations of corporate profits just yet, and that's something that maybe is putting a floor under expectations and a floor under stocks. Do you think that's because they just haven't got round to cutting them yet, or that they're right to hesitate and say, hang on, this might only last weeks, let's not do anything just now?
I think it's basically that, as in when you look at the Strait of Hormuz, I think it's in no one's interest that it could stay closed. And the fact that you have, recently some tankers with Iranian taking some toll tax on the way or not, it's kind of giving a bit more confidence. I think what's different from 2022 is the fiscal leeway is very different. So it's in no one's interest that you've got oil price spiking at 150 or 200. So on that, the fact that markets are betting on a Trump TACO and a quick resolution or Strait of Hormuz reopening is making investors and at least portfolios not de-risking, just adding hedges, knowing that before Iran, the rotation we got on the equity markets already triggered some de-risking.
So we don't discount those earnings forecasts and those dividend expectations and say they're out of date. We trust them for now.
Still. Yeah, I think it's basically if Iran goes away and tankers go through the Strait of Hormuz, is the story we got is tax rebates in the US, fiscal spending that's moderately focused on infrastructure, defense. So all the story will come back with more or less worries about private credit.
You just wonder how TACO can remain the base case when, as many leaders have pointed out, Trump may have started this war, but he may not necessarily be able to end it. Let's say it does end. Let's say the Strait of Hormuz does reopen. How much would the dollar fall if that were to happen?
So you could have the Strait of Hormuz reopening without some clear resolution on the conflict. All I care about is whether you're going to have these 80 tankers going to the Strait of Hormuz in the next couple of days or not. If that's the case, I think the risk environment would be more favorable. But I think your point on the dollar is really interesting, because what we saw since the start of the conflict, so it's been going on for almost 20 days, the dollar didn't go up as much as expected. So it was much more an unwind of the very crowded longs versus dollar and some shorts in euro and Asian currencies that are basically the fragile kids that usually are kicked when you got some energy supply problems. But the dollar didn't rally as much.
It's really interesting to know what you consider not the end of the war, but the trigger to be back on risk on. And of course, we've seen lots of hedges that we would traditionally rely on not working, gold, treasuries. How are you thinking about protection from here? Now, as you say, we're entering the third week.
So I think what's interesting is the fact that gold didn't react to that. I think it has to do with exactly what you said, as in earnings expectation not revised, and market not pricing the left tail risk yet, as in because you're thinking about TACO. So there's been this ongoing positive correlation between equity and bonds, and gold, I think, suffered a bit on top of being high momentum. So there's been this liquidation of some of your high winners in your portfolio to protect the portfolio. But that I think at the end of the day, looking for portfolio protection, there might be some reallocation into commodities, but also currencies and equity markets that tend to be much more commodity exporters, which benefit from the AI spending.
Sophie, it's a big, big week, of course, for central banks. And when we think about central bank responses to the energy shock and the earnings story, what expectations have been factored in to earnings around the trajectory for rates? Essentially, if we get hawkish central banks, does that derail earnings expectations?
I think the repricing we got at the front end of the curve was pricing stagflation. But if you think about it, how much fiscal leeway broadly do we have this time compared to 2022? So I think it's a bit wrong in the sense that if we really have oil at 150 or 200, my guess is we're going to skip the stagflation and end up mostly pricing a recession because the fiscal support is not the same as before.
That's the second time you've said recession. So what do the equity markets do in a recessionary environment, given that you think they haven't priced that outcome? What are we talking like 10% downside? What are we talking about?
I think you could have more down. So what's really interesting, if you look at the equity risk premium, so like trying to look at the relative valuation between treasuries and the S&P, it has fallen since the start of Iran. So it's really telling you that treasury market is pricing something, but the equity market is also pricing another thing, when I think most portfolios have added so much hedges on that they are for now surviving and buying some time until we get a resolution. But if we really have recession being priced, I think that's where the asymmetry is, rather than Strait of Hormuz reopening and how much rally in risk assets you're going to have.
But recession is not your base case?
It's not.
No.
No.
So the base case still assumes short conflict and everything else flows from that?
Yes.
Yeah.
Yes.
And what are the assets that we have not mentioned, Sophie, that we should be mentioning that fit in with what you've just been describing? We've talked about how metals have not performed as expected. We've talked about the short end of the rate curve, talked about stocks, talked about energy markets. Is there anything that we're missing in terms of that whole narrative as it fits together?
I think the shopping list you need to have is basically, if we have energy prices kind of stabilizing, are we going back to AI spending? And the semiconductor part of the equity market suffered a bit because of worries about energy supply, how there could be force majeure declared on some of the semiconductor supply chain, but also on helium. So that's why the Asian equity market, on top of being high momentum, suffered the most, so Japan, Korean equities. But I think if you need to think about what's ahead, and if we have energy supplies back on track, is maybe in terms of EM reallocation, still go into Asia, which suffered more than the rest, go into LATAM, which continue to be commodity exporters. Europe remains to be seen because I think it's still going to be the problem on how fast the gas storage is going to be refilled during the summer month.
So you mentioned AI and tech, and we've seen a revival of kind of animal spirits, particularly when it comes to the semiconductors. Again, we're seeing that reflected in the Asian session today. Yep. What is your favoured? Is that a factor that brings you back into Asia, as well as the fact that it sold off most aggressively because of the energy impulse for Asia and the dependency there? How do you want to be playing the AI theme if it comes back with conviction?
I think it's still trying to favour the molecule, so that's why I think the Asian markets are very attractive, on top of super supportive corporate governance that we don't see anywhere else. So you have this double support, like amazing EPS growth for this year, on top of potential also some multiple expansion due to corporate governance. So I think, Asia is where you should be at this point.
Okay, Sophie, great to see you. That's Sophie Wynn, Portfolio Manager and Strategist in Dynamic Asset Allocation over at BNP Paribas Asset Management. Thank you. Let's check in on the core six now. How are they shaping up this morning? You've got LVMH up 0.8%. ASML on that semiconductor interest, Tom, that you've been flagging, up 2.5%. Schneider up nearly 2%. Behind Rheinmetall, Novo Nordisk and Nestle in the red. Let's check in on some of the individual stocks on the move with Charlie Wells. Charlie.
Good morning, Lizzie. So I am looking out this morning for some optimism kind of washing over from this big NVIDIA event, their largest event of the year, painting a picture of some positive forward momentum there at that event. That's spilling over here into Europe and a lot of these chip makers. You see ASML up well over 2%. You see a lot of other green on the screen. It's sort of a relief to sort of finally see a little bit of optimism in these markets. So we're starting to see some of that AI trade come through. Now, we've got an opposite story to tell when you take a look at sort of the kind of old type of tech, the old kind of consumer tech. You think about HelloFresh, right? This was a few years ago, this idea that consumers would use a lot of these startups to get services delivered to them. They delivered a disappointing outlook for the year ahead. They are down almost 7% here in Europe early in the morning. And one of the points that they were talking about was bad weather, literally how bad weather had just impacted some of the deliveries. You know, they deliver these meal kits, they deliver these food services, and look, we're down even more now in early trading, so really kind of having a negative impact and then having that outlook not look great. So that is a German meal delivery company. We're going to stay in Germany, but go to Heidelberg Cement here. They are up over 3%. Now, we had a really positive note for them coming out of Morgan Stanley, talking about cement and how effectively pricing there is sticky, because there's been concern in Europe and across the board about carbon pricing, right? Is that going to change the dynamics of how pricing has to work in cement, which is so crucial for buildings, so crucial for a lot of these infrastructure projects? We've been hearing a lot about infrastructure recently, and that research note talking about the stickiness, the importance of the pricing of cement. So that is Heidelberg. Let's flip and take a look as well at a little bit of the kind of infrastructure story that kind of brings in not just infrastructure, also a little bit of AI, a little bit of electricity. We've got Bolloré. So they're up nearly 15% this morning. They were talking recently about an extraordinary dividend that they could be offering. This is a company that does electricity storage, among many other things, an energy logistics company. We think about AI. What do we need? We need energy storage. So again, we're seeing optimism across the board when you get into that energy, that infrastructure, that space that is kind of coming from some of this optimism on AI.
Okay, Charlie Wells, a man who knows how to get Anna Edwards' attention as well. Cement, infrastructure, electricity.
Hey, I like
some
stories.
Anna Edwards' favourites.
I like stories I can see.
Some you can build on
world.
as well.
Yeah, very nice.
Coming up, it was bad, wasn't it? I can build better than that. Right, BHP announces Brandon Craig as its new CEO, as its mining giant. There we go, more commodities on top of our cement story. Sets its sights on copper. More on that next. This is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to fine sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it's happening. I'm Anne Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's
It's the world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back. This is the opening trade, 18 minutes past 8. So 18 minutes into a European equity market session that has European stocks going higher, up by 0.6%. And one of those, Lizzie, is BHP.
Yep, shares on the rise this morning, up a neat 0.6% after the London-listed mining giant named Brandon Craig as its new chief executive. Craig will replace Mike Henry, who's led BHP for more than 6 years. And for more on this, we're joined by Martin Ritchie, our metals and mining reporter out of Shanghai. Martin, what should we know about BHP's incoming CEO? He seems to have been at the company a long time.
He is. He's very much a BHP man. He's been there for more than a quarter of a century, and I think that, you know, this is a kind of safe pair of hands appointment. It's someone who knows BHP very well. He's worked, first of all, in the coal business. He's worked in sort of maintenance around the world. He's been head of the very important West Australia iron ore business, and he's been head of Americas, where copper features as a big asset with some of the biggest resources in the world there, and metal, obviously, that BHP is looking much more closely at. He was a press briefing this morning. Some of the notable things there was really real caution when it comes to M&A. The word discipline he mentioned 8 times. The chairman also underlining that they wouldn't go after any other assets unless they were exceptional, and they have a lot of options of their own. So a kind of continuity choice, I guess, in Brandon Craig.
Yeah, and so that's interesting, mentioning discipline a lot then, and M&A in the sector and overspending on CapEx are perennial fears of investors. What are analysts saying then about what this change at the top means for the mining giant, Martin?
Well, obviously, the broader context for any change in the top at mining is the shift from kind of the old traditional commodities, or so-called traditional commodities like iron ore, which BHP and Rio have, made a huge amount of money of over the past 20 years, to things like copper, which I just mentioned. And that was also a big theme of the press conference this morning, how they're going to grow in copper. And in fact, an interesting thing was a sort of more of a geographic shift almost that they flagged, a movement in the center of gravity of the business, I guess, from China, which has obviously been the big earner for a long time and will continue to be. But he did mention wanting to build stronger relations in the US, in Chile and Argentina, which all have up-and-coming big copper mines, where also governments are very focused on sort of building up supply chains. So that was another interesting kind of structural point there in terms of the focus going forward.
Well, Martin, as we talk about, good morning, as we talk about supply chains, if we zoom out, what is the Iran war doing to your world of metals?
Yeah, the most interesting one as a prism to look through the conflict in the Middle East is really aluminum, because that region accounts for about 9%, 10% of production. The most important thing to note is that these smelters in the Middle East, they cannot get raw materials in at the moment. They can't get the metal out, but the bigger problem is they can't get raw materials. And if they run out, they're not going to be able to keep producing the metal. So a lot of kind of ructions in the aluminum moment, especially around like how long, is it weeks or is it months that these producers can keep going? And if they can't, in the case of a long war, and it does look that we're heading in that direction at the moment, what does that mean for all the buyers in the rest of the world? We've seen negotiations, for example, to Japan. Suppliers already ramp up prices. We've seen premiums in Europe and the US. And overall, it's just that adds to the kind of headwinds for the aluminum market, which was already facing kind of disruptions and deficits this year.
Martin, thank you very much indeed. Martin Ritchie with that update out of Shanghai for us in terms of the broader impact of the Iran war on the metals space, but also change at the top, of course, at BHP. Martin, thank you. Meanwhile, to oil. Oil prices dropping this morning after Iraq signed a deal to resume crude exports via Turkey, avoiding the Strait of Hormuz. For more, let's bring in Bloomberg's energy reporter Anthony Di Paola joining us from Dubai. Anthony, how significant is this then, not just for Iraq and their revenues, but of course for the global oil markets?
Yeah, good morning, Tom. I think it's more significant for the first. This has been an issue for Iraq for a long time, trying to work out some of the kinks of their northern exports. It's been a problematic situation for years, really. They've had a pipeline dispute over pipeline fees with Turkey that stopped flows completely. Once they agreed to resume flows, then they had a dispute with the Kurdish region over payments and internal transfers of who would get the income for the oil and how that would go to pay for government services. So this has been a long process, and it comes at a terrible time for the global oil market now, because we do have the Strait of Hormuz completely blocked off. So we don't have any oil, for the most part, going through Strait of Hormuz out of the Persian Gulf, and that's impacted Iraq too. They've had to shut in about 3/4 of their production, so they really need that northern export route. At the moment, it looks like they're going to export about 500,000 barrels a day through that route. That's been the agreement, and that includes some oil from some northern fields in northern Iraq that are operated by the central government, and then some fields in the Kurdish region that are operated by international companies. So what will be really important to watch for the global oil market is if they can keep that agreement together and keep that production going. So they've had these issues of, again, as I said, payment disputes. The international companies in Kurdistan, in the Kurdish region, were declining to produce because they didn't have an agreement for payment from the federal government. There's also the security situation, because Iran or Iranian-linked militias have been bombing fields in the Kurdish region using drones, using missiles, and so that's caused also a shut-in of production there at various points as well too. So they need to keep the economics and the politics of that pipeline agreement and the payment agreement running, and they'll need to keep the security situation underhand in order for those producers to keep pumping that oil and keep getting that to the global markets, Tom.
Anthony, is anyone getting through the Strait of Hormuz at the moment? And if so, whose tankers are they, and what does that tell us?
Yeah, easy answer to that. It's Iran. So Iran has closed the strait effectively by its threats against shipping, by having hit a number of tankers inside and outside of the Gulf, just around the Strait of Hormuz. So that has effectively closed it off to tankers who are refusing to go through there. The vessel crews, the owners. However, we have seen some Iranian tankers passing through the strait and exporting some oil. So we had bombing of Karg Island, which is Iran's main export hub. That was over the weekend. The U.S. forces bombed that, took out some naval facilities there hit the airport, left the oil infrastructure intact. And in fact, the Iranians said that on Saturday they were already loading tankers from there and exporting from there. So we have seen a number of Iranian tankers go through. We did also see some other vessels, some vessels going to India carrying LPG, which is a vital cooking fuel for them, a vital fuel for petrochemical plants, and a tanker going to Pakistan as well.
Anthony?
Yeah, so some oil is going through, mainly from Iran.
Some are getting through. Anthony, thank you very much. Anthony DePaola, our energy reporter. Coming up, we speak to Vincent Rouget, the CEO of Unibel Rodamco Westfield. How is retail consumer appetite holding up right now? We'll talk commercial real estate. This is Bloomberg.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of Power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
This is the opening trade. We're 30 minutes into today's session, and we are seeing oil down today, but the energy shock still likely to hang over that Fed decision later on today. But it's giving us reason to be a little more risk on. Hence, the Stock 600 up 0.4%. The FTSE, though, the underperformer because of its exposure to energy. Tom, what are you seeing under the hood?
Yeah, lift the lid, and you're looking at banks outperforming. Interestingly, travel and leisure coming back as well. And on the downside, you're seeing some weakness for food and beverage. Across the breakdown of the Stock 600, there is that optimism more broadly. So you've got 410 stocks in positive territory so far this Wednesday, this trading session. On the downside, 181 stocks lower. Volumes are lighter, though, worth noting that. Currently down around 34% versus the 20-day average. So slightly thinner volumes. Let's flip the board and have a look at some of the leaders, and then we'll break it down for you in terms of the laggards as well. You have seen that momentum again in Asia when it comes to semiconductors and the trade there, and that really lifted the Kospi. A very powerful session over on the Kospi. The names like Samsung, SK Hynix getting a really strong lift as well. The view from NVIDIA remains very constructive in terms of the demand. So you're seeing ASML gaining 1.8% on that story. It seems Bolloré within the electricity infrastructure space. Look at that, big jump, about 14% on that company. Advanced the most in 5 years after proposing an exceptional dividend yesterday. In the cement space, this is an Anna Edwards favourite, up 3.4% after a double upgrade from Morgan Stanley analysts who now see an attractive entry point. On the downside, let's flip the board. Novo dropping. There's competition heightening. We've talked about the competitive threat, of course, to Novo. Rivals providing more weight loss treatments, including Structure Therapeutics. So Novo's down 2.2%. Logitech, interestingly, within tech hardware space, falling 5%. UBS cutting its recommendation to neutral from buy. And Unilever reporting, Bloomberg reporting, suggesting that they could spin off the food business, the rest of the food assets, currently just down 0.5%. Anna.
Let's talk about some of the other stories we're keeping across them this morning, Tom. PIMCO says that the mounting strains in the $1.8 trillion private credit market are giving investors a reality check. Lofi Karui, a multi-asset credit strategist, says he expects a deep rethinking from private credit investors on where they deploy capital and the liquidity risk. Several high-profile blow-ups and redemption pressures at some global private credit funds have added to investor concerns about loan quality. Iranian attacks on Israel and Arab states in the Persian Gulf continued overnight with a fresh wave of missiles and drones targeting the UAE, Saudi Arabia and Kuwait. The attacks followed Iran's confirmation of the assassination of its security chief, Ali Larijani, in an Israeli strike. And Japanese Prime Minister Sanae Takaichi says she's facing a, quote, extremely difficult meeting with President Donald Trump after the United States president criticized the country for rebuffing his demand for help securing the Strait of Hormuz. Takaichi's trip to Washington tomorrow is her first since winning a sweeping mandate and had been viewed by Tokyo as an opportunity to showcase the strength of the US-Japan alliance. Lizzie.
Anna, let me just bring you some breaking lines from the UniCredit CEO, Andrea Orcel, speaking at the Morgan Stanley European Financials Conference. Of course, earlier in the week, Commerzbank got that takeover bid from UniCredit. This was on Monday, and now Orcel is saying that Commerzbank offer was intended to break the stalemate here. He says they need face-to-face engagement with Commerzbank. They've been unable to engage with Commerzbank until now, and they need to put all the cards on the table in these Commerzbank talks. It's interesting because you were speaking to Bettina Orlock, the Commerzbank CEO, just yesterday, and she seemed to me quite baffled by this offer and what the intention was from you.
Yes, I wonder if this all comes down to whose move is it, you know, in this particular game of chess, because UniCredit clearly thinks that they weren't getting engagement from Commerzbank. Commerzbank says, well, you didn't present us with something to engage on. You didn't come to us with an offer, and so there was nothing to talk about. So, yes, we're still caught in that dance, I suppose, ahead of what could become a big M&A story, a big cross-border banking M&A story for Europe, or perhaps won't.
UniCredit up 0.9% so far in the session. Let's go for banking. From banking to what's happening in terms of retail with a company that has a very significant global footprint. Unibail Rodamco Westfield is one of Europe's largest commercial real estate companies and widely considered the world's biggest operator of shopping centres. Their network includes 66 malls in the US and Europe that contribute to the group's €49 billion asset portfolio, with retailers and developers assessing, of course, inflationary impulse from the war in Iran. We're joined now by Vincent Roger, CEO at Unibail Rodamco Westfield. Vincent, good morning. Thank you for joining us. Let's start on the story that is still dominating the headlines then. What is the potential inflationary hit, the squeeze on consumers that could be felt like by a business like yours? Are you starting to see any impacts as a result of supply chain challenges and higher costs?
Good morning. Not at all. We are seeing no impact on footfall and visits in our malls to this date. So we are in a position now, because of the investments we made in technology, in AI and data, to follow on a real-time basis the traffic in our malls store by store. And when we look at this data in 20 malls in Europe, which are equipped today, we see flat to marginally increasing traffics. So on par with a normal week, I would say, since the start of the conflict. So our business is doing well.
How much resilience is there in the portfolio and in the companies that operate in your malls to higher prices and inflation, if that does become a more sustained problem?
Look, I think historically, over many decades, we've shown in this business that we were able to capture inflation through our partnership with retailers. It's been a success for 50 years on some of those most dominant modes that we own in our portfolio, and this is the reason why we feel very comfortable, at ease with typical shocks like this, because we see that historically we always emerge stronger. So the business is doing well. That's what we've shown with COVID as well. Some of our top retailers had a fantastic performance over the years, if we compare 2019 to 2025, and that's why we keep on pushing on our platform for growth agenda over the next few years.
But what about retail investors? That's consumers, but you've got retail investors who've been holding on, real estate investors, I should say, holding on for lower rates. And it may be that they don't come because of this war and rates staying higher for longer, perhaps.
Maybe it happens. You know, as you know, real estate is a cyclical business, so there has been cycle on and off for quite some time now. And I think what's important is to drive growth and organic growth, and that's what we're focused on. We believe that prime retail real estate offers a fantastic value proposition. We have high yield, we have growth, we have inflation hedge, and that's the reason why we've been a success over the last few years, and why we emerged stronger after a few years of deleveraging that we concluded last year.
I think you'd been exploring partnerships in Saudi Arabia. Is that still the case, given the war?
Yes, absolutely. It's an industry first, so we are extremely proud to have made this deal with our partner, with the leading operator of shopping malls in Saudi Arabia. We see it as a growth market that is equipping itself. There are tremendous investments. We don't want to grow our balance sheet and grow our debt basis, so it's a fantastic way to keep on growing, add to the organic growth profile we have on our own portfolio in new markets, get to learn those markets, but also share the technology, the expertise and the know-how of our teams, which is extremely valued by leaders in their own market.
Can I ask you about your US portfolio then, Vincent? Because when the Westfield acquisition took place, you took on quite a lot of exposure to the United States, and the view initially was that you would want to sell those assets. More recently, you've maybe indicated you might hold on to some of those. So what's the latest thinking on US assets?
We confirmed we were staying in the US forever. I think
forever.
Forever.
That's a long time.
That's a long time. That's the time of real estate as well. When you own those fantastic piece of infrastructure, urban infrastructure as they call them, like these are generational assets, well-performing, long-term growing, fantastic. What we've done in the US over the last few years, under the pressure of deleveraging, we sold some of the regional modes very early on in the cycle, so we achieved good pricing, and in the end, we did the disposals in Europe at very good price. And at the end of those few years of deleveraging, what we realized was that we had retained some of our best assets, which were booming in the US. Performance is stellar in Century City, in UTC San Diego, and so on. And we felt like it makes total sense for us to operate on those flagship modes. We have a number of them in the US. They are fully part of the collection, and we're seeing a lot of potential in the US market and the US economy.
Vincent, can I ask you a big picture question about what you've learned about bricks and mortar retail and how it competes with digital, or how it embraces digital retail channels? Because we constantly see different parts of the economy being disrupted by digital technology, now being disrupted by AI technology. 20 years ago, we might have thought, oh, we're all going to buy things online, shops are going to disappear. Shops did not disappear. They just had to reinvent themselves. What have you learned through that long process of reinvention?
We learn, and I see that we've been constantly on the ball, adjusting our model, speaking with the right and teaming up with the right retailers that created desirability, attractivity, broad visits, footfall, and are at the center of the customer interest and obsession. I think what's extremely interesting for us is that flagship retail answers to a need from Gen Z generation. And we see it in the numbers. The proportion of Gen Z customers in our malls are basically 10 points higher than in general population. That's one of the key reasons why we've been successful over the last few years.
Is that it's about sociability? What is that need?
Exactly. It's human connection. I often say we are in the business of human connection. So we offer a proposition. Many people want to live in a cloud, in a dematerialized world. And we see that at the same time we go that direction, we see an absolute need for human connection, community, meeting people, meeting places, third places. Your headquarters here is an amazing example of that. I guess people want to work here.
Yes.
Rather
I get to meet these
remotely.
people every morning.
Well, the kids have got to take their selfies somewhere.
You know, my wife's from Los Angeles, and she as a teenagers, they spent all their time the malls were where they hung out.
In the Philippines, it's because of the aircon.
Yeah, well, whatever drives you, whatever takes you there, something takes you to that communal shopping experience. But you are a business that's embraced the digital side of things as well. Our colleagues were talking to us about how you've planned media revenues of 200 million, and this is to do with advertising, better data, informs more successful advertising. What's the latest on that revenue stream?
This is the part that is extremely exciting when you have those urban infrastructure. You can build on, you can create new levers and new areas of growth. That's an area we invested over the last few years while we were deleveraging in technology, AI-driven software that allows us to understand in a much better way the customer journeys in our modes. Point by point, store by store, the store which are visited before one visit, after, and so on. And it's going to develop those insights where we're going to craft a better game and improve the way we can drive further sales at our retailers. That's the recipe for success and long-term growth for us.
Was it $200 million that you were targeting by 2030 from the digital business?
Yes, exactly.
Are you on track for that? Could you top that? Is that conservative?
We think it's a pretty good baseline. I will remind you that we were generating roughly 25 million euros back in 2021 when we launched this initiative. And it's a great example of 10 years we will have created, together with the franchising business, with the first in Saudi Arabia, we'll have created 10% EBITDA over a decade, more or less, when we hit those targets. So this is the way we constantly reinvent ourselves. We constantly improve our footprints, our assets. And what's extremely interesting for us is that we can compete head-on with online, with those new data tools and new insights, because we're able to use those as levers to qualify our audience and to have the right discussion with retail partners in order to drive more business for us. This is the solution for the future and long-term growth.
I think you also develop offices and work conference venues, right?
Yes.
How is that going? Is it still something that we need in 2026 in the same way that malls are still relevant despite the e-commerce boom?
The very best ones, yes. It's a resolute yes. Convention exhibition, we've been following the same trend of recovery as in prime retail. So despite any scare whether this business still sustain, I think it's doing very well. We hosted the Olympic Games of Paris. It was a tremendous success, and we had great performance last year as a result of that. And what we see as well in offices, we have an amazing project that we're developing south of Paris, Tour Triangle, which is a new flagship, high-rise over there, which is quite rare. When you have exceptional product, the demand is there. Whatever the environment, we proved that basically in La Défense, in a very tough market during COVID, we fully let our asset at 50% premium to market trends because of the quality of the assets. So there's a market for that. We believe strongly in it.
Vincent, thank you very much.
Thank you very much.
Coming in. Vincent Roger, CEO at Unibail Rodamco Westfield. Coming up, Greek Prime Minister Kyriakos Mitsotakis says Europe will not join Trump's military efforts in the Iran war. We're going to hear from the Greek Prime Minister. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
the challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 60-65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. We are 47 minutes into a European equity session that is broadly positive. Even the FTSE 100 joining the move to the upside, up by 0.2%. They're held back a little bit by some of the food, beverage, tobacco names that are weaker, telecoms, healthcare. Those are the things that are weaker. To the upside, though, banks, construction materials, travel and leisure having a good day, moving higher as far as those sectors are concerned. Lizzie.
Meanwhile, in geopolitics, European leaders are standing up to US President Trump, saying that they won't help his campaign with Israel against Iran.
We are not a party to the conflict, so France will never participate in operations to free or reopen the Strait of Hormuz in the current context. However, once the situation gets calmer, and intentionally, this term is broad enough, meaning once the core of the bombing has ceased, then we are ready with other nations to take on other responsibilities, such as an escort system.
Now, the sharpening rhetoric is a high-stakes gamble for Europe, as the US president has threatened, quote, very bad consequences for NATO if he doesn't get his way. Here for more is Oliver Crook, Bloomberg TV's chief Europe correspondent. Ollie, good morning. This feels a little bit to me like Europe's Love Actually moment. Talk us through the calculus that has led to European leaders changing their position towards the US here.
I think despite all the efforts by many of these European nations, the ones particularly most exposed to the possibility of the United States pulling out of NATO, so the Baltic nations, Poland, Finland, we heard from Alexander Stubb yesterday, saying that we should be open to these ideas and these conversations about helping the United States in some way in the Straits of Hormuz has just been sort of overpowered by an overwhelming feeling in much of Europe and all of the sort of G7 members of Europe, and we should say the G7 members apart from the United States, saying that this is just a shade too far for any sort of active participation in trying to reopen the Straits of Hormuz. You heard it first from, the UK, from France. You heard it there from Emmanuel Macron. You heard it very interestingly and notably from the Germans, who at the sort of outset of this war, when the bombing began on that Saturday, had been very encouraging of the U.S. military action. It really was on side, but then, came out this week very clearly saying that this is not a conflict for Germany and they don't have any sort of active role in it and they won't take any active role in it. Now, the French did say, as you heard there from Emmanuel Macron, that they could support in some way once things calm down, that they could, join a mission to help sort of the flow of cargoes through the Straits of Hormuz. But again, that will come after the sort of war ends in all kind of substantial ways. The other thing that I think is important and something that we should pay attention to that is happening tomorrow is that the European Union will vote and move forward on ratifying their trade deal to the United States. So maybe an effort from the European Union to give something in return for basically withholding that support on the Straits of Hormuz in Iran.
Ollie, Ukraine and its role in this, how it's positioning around the conflict in Iran, given, of course, it continues to face the aggression from Russia, particularly when it comes to drone defense. What role is Zelensky, what role is Ukraine playing?
I think it's really interesting, Tom, because, you know, Zelensky is kind of the master of turning really terrible, very difficult situations into something of an opportunity. And we saw that, obviously, in the beginning of the Trump administration when you had that catastrophic meeting back in February in which, you know, J.D. Vance was saying, you know, have you even said thank you? Have you shown any sort of gratitude? So there was this idea that was being projected by the early Trump administration that the Ukrainians are just takers. What the Ukrainians are trying to do now and Zelensky is trying to do now is saying, no, we actually can be givers. We can be active partners in dealing with the drone defense. There's been a lot written about the huge amounts of money that has been spent to shoot down some of these very inexpensive drones with things like Patriot missile systems across the Middle East. And Zelensky has now deployed apparently 201 experts across the region after a number of Gulf nations have asked for the help to try to take down these drones because they can do it at much lower cost. They can make 2,000 anti-drone interceptors every single day. Half of those, they say, they're willing to export to partners. So that is something that the Ukrainians are really trying to sort of trumpet. You heard it from him in front of UK Parliament yesterday. He will go to Spain a little bit later today. But I also think it's an opportunity for him diplomatically to lend a hand to the Gulf nations who have been very ambivalent about Russia and its invasion of Ukraine, have been sort of hedging the sort of either side of it. And for the Ukrainians, this is an opportunity to say Iran equals Russia, Russia equals Iran, to try to keep them on board. Of course, now the big challenge will be keeping the Americans on board, and we really don't know how that is going to unfurl, particularly after the Europeans have stepped back from any involvement in Iran.
Oliver Crook, Bloomberg's Chief Europe Correspondent, with an update. Ollie, thank you. Let's get back to the markets and bring in Skylar Montgomery-Koenig from our Bloomberg MLive team. Skylar, I look at the equity markets this morning. We're done. We're moved on from the Iran war. We're focused on other things. What's going on?
Yeah, I mean, I think it's a couple of things going on. The first is you definitely have had a positioning adjustment, but it's not been an outright reorientation of absolutely everything. So you'll see, for example, that the leverage communities move very quickly to adjust to higher energy prices, but kind of slower moving real money isn't moving as quickly, and they're preferring to hedge in options rather than changing positionings outright. And so I think we're waiting to see whether or not energy prices stay elevated enough to really feed into that earnings downside because of growth coming down. And we're also just waiting for the central bank response, as in that could be a really big input into how the economy behaves. Yes, we know that higher energy prices are stagflationary. It's the worst kind of mix of lower growth and higher inflation. But do central banks take that on board and go, well, I think it's transitory, and so I'm not going to be as hawkish as the market's pricing. Maybe equities get a little bit of a boost in the short term, but then you have longer term inflation worries to consider.
So it's almost as if the markets have adjusted to the idea of a short-term war. A longer-term, more protracted conflict would perhaps provide something different and repositioning. Let's think about these central banks then. The Fed, of course, in focus today, Skylar. What are you going to be watching for critically? Or is anything Powell says just going to be discounted because he's not going to be in charge for that long? The future reaction function looks a bit opaque.
Yeah, I mean, there's two main things I'm watching for is how do they treat what we've already digested? As in, we've had 2 labor market reports this year. One was very strong, but then we got a very weak one. So are they interpreting that as a weak starting point? That means that maybe you won't get as much of an inflationary pressure. And then the second point is, where are those dots going? So what are the expectations for how inflation feeds into those dots long term? And I will say this is one of those places I think there are more hawkish ranks than other central banks, because the 2026 dot already has one cut. That's what the market's pricing. So it's the least out of line with market pricing from that perspective. And you could see that shift up more so, I think, than other places. And that's very in line as well with what I expect in relative markets, in that U.S. fixed income has outperformed on this kind of yield upside, and so that means there's room for it to underperform as we go through these meetings.
Skylar, thank you. That's Skylar Montgomery-Koenig, setting us up nicely for that Fed decision later. Skylar, of course, from Bloomberg's MLive team. Well, let's look ahead to what else we're watching throughout the day. Before we get that Fed decision, at 12:30 p.m. London time, we have US PPI numbers. Then at 1:45, we have a Bank of Canada rate decision. At 5 p.m., we have the Disney AGM, Josh D'Amaro becoming CEO. And then at 6 p.m. is that Fed rate decision, followed by the press conference. And finally, at 9 p.m., we'll have Micron earnings as well.
Micron. You know, it's now a $500 billion company, so it crossed $500 billion by the end of the session yesterday, and this is a company that's exposed to the memory story. We know there's supply tightness, and we know there's higher prices, between 30 to 40%, high bandwidth memory. Their chips are going to be embedded into NVIDIA's platform, the Vera Rubin platform. So that is a really interesting story for us. As we see again today in the Korean session, massive gains again for Samsung and SK Hynix.
And it's really interesting, isn't it, on Micron, to think about how much the business and also investors in the business are big fans of higher prices and pricing power, but how much do they want to sacrifice volume, or how much do they want to see Micron investing into that increased demand, which of course risk bringing down prices, but the environment just so hot right now. Maybe they just want both.
Yeah, and speaking of the volume thing, and what you risk to keep your clients, Samsung weighing those multi-year deals to ease the memory chip crunch fears, but it's just so unusual to be committing for such long contracts. But it's clearly the market liking it, and as you say, that along with SK Hynix helping to push the cost be up 5% at the close today.
Jensen Huang says he has the licenses now to supply H200 chips into the Chinese market. That opens up a new revenue stream for NVIDIA in the Chinese market. Right now, China's obsessed with OpenClaw. Jensen Huang also said that OpenClaw is the next ChatGPT moment. And OpenClaw and that story has powered Chinese AI companies.
Finishing the program with this conversation feels very much like things we did in February and January, doesn't it? And the cost be up 5% in session feels like that. Feels like that narrative is trying to work its way back onto our radar. I should just tell you that we will have a surveillance Fed special, of course, 5:30 p.m. London time. Remember, everything happening an hour earlier European time. The Pulse is next. This is Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini.
We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Iran vows to revenge the killing of its security chief and launches a fresh wave of missile and drone attacks across the Middle East, while U.S. President Trump says war could end in the near future. Iraq signs a deal to resume oil exports via Turkey to avoid the Strait of Hormuz. Energy inflation remains a key topic ahead of the Fed decision later today. Plus, Howard Marks, the co-founder of Oak Tree Capital Management, says investors are underestimating the impact of AI. We discuss what it means for the jobs market with the chief executive of talent company Randstad. Now, the market's a little bit more optimistic over the last two trading sessions that they have been in the last 2 weeks. Stocks are rising, oil dropping again in the run-up to the Fed meetings. I'm looking at Europe stock 600 as well, touching its highest level in more than a week. Asian shares are rising, and it's actually South Korea's Kospi that is leading a lot of the gains. Again, I think traders are just awaiting the Federal Reserve meeting, and markets remaining still on high alert on the Middle East conflict. The risks that a near closure of the Strait of Hormuz stokes inflation is in focus, but they're focusing on the positives rather than the worries that we've had so far. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. President Donald Trump has given up on efforts to recruit partners for the war with Iran. Germany, France, and Norway are among those that have explicitly ruled out participating in the U.S.-Israeli operations, while Trump scolded allies who openly rejected his appeals.
So, I think NATO's making a very foolish mistake, and I've long said that, I wonder whether or not NATO would ever be there for us. So this was a great test, because we don't need them, but they should have been there. The other thing is, and I think, very important, we didn't have to be there for Ukraine.
Well, for more, we're joined by Bloomberg Horizon's anchor, Jumana Bersetchi. Jumana, there's little sign that Europe and Asian nations are willing to join the fray. So where does that leave Donald Trump?
No, absolutely not. To your point, we've had categorical rejections now from Germany, France, Greece, and of course you spoke to the Prime Minister there yesterday. Canada, Norway, the list of countries saying that they don't want to participate in this maritime mission or indeed one step further to get involved in the war grows. And President Trump has not taken it lightly. You just played some of his comments there saying that this was a test for NATO, but he doesn't need them. He also put up a post overnight also insinuating that he doesn't need the help of Asian nations too, specifically referring to Japan, South Korea, and Australia, who have all expressed their own reservations. But interestingly, he didn't mention China there, and as we know, the summit between President Xi and President Trump has been pushed back. But essentially what we're seeing here is perhaps a pivot in terms of the U.S. administration's approach of trying to get that strait to reopen. One country, though, that I will flag as sort of throwing its name into the mix is potentially the UAE. We heard a senior diplomatic advisor to President MBZ yesterday. He was asked about it in a think tank event, and he said that the UAE are actually considering options to help secure the strait. So maybe there could be an avenue for Gulf states to help with the U.S.'s efforts. But what we've seen in the last 24 hours is not that the strait is effectively closed, but it is effectively being controlled by Iran still. They've allowed the safe passageway of about 12 vessels coming through, most of them tankers directed towards China, India, Pakistan. But since the beginning of the war, at the same time, around 24 tankers have been targeted. So still just underscores the risk from a security perspective and danger perspective for any tankers looking to cross through, which is really what is keeping them away. And ultimately, Francine, is still putting upward pressure on these global energy markets because of the inability of these many OPEC producers and key energy producers to get their products out to the rest of the world.
Iran has confirmed the country's top security official, Ali Larijani, was killed in an Israeli airstrike. What does this do for the hopes of peace?
Yeah, well, this is another very prominent assassination, the first one being the taking out of the supreme leader alongside senior commanders on the first day of the joint U.S.-Israeli military operations. Now confirmed overnight that they've also succeeded at assassinating Ali Larijani. He was the chief of the National Security Council, would have been responsible for many of the political and strategic decisions inside Iran. and also played a very key role in the brutal crackdown of those demonstrators back in January. But at the same time, some analysts are saying that this removes one of the political voices that the U.S. could have spoken to should they wanted to open the diplomatic channels. But the Iranian regime continued to be defiant, and we've heard from the IRGC commander overnight. They said they're going to retaliate, and indeed, the evening has been very, very busy in terms of incoming projectiles being targeted at many Gulf states, including Saudi Arabia, intercepting many drones, another attempted strike on the U.S. embassy in Baghdad, more drones being intercepted by Kuwait, and over here in the UAE, we've had multiple missile alerts overnight as well. So really no signs of things letting up.
Jumana, thanks so much. Bloomberg's Jumana Bersetchi. Now, the Greek Prime Minister says Greece and Europe will not take part in military operations in Iran. It comes in response to President Trump calling for help to secure the Strait of Hormuz. Well, Kyriakos Mitsotakis told me there's no appetite for such a mission.
We will not engage in any activity in the broader area as long as there are military operations. We have been very clear from the beginning. We strengthen our defensive posture. Of course, we have a strong interest in the freedom of navigation. We have amongst us, leading Greek ship owners who are very concerned about what is happening in the broader area. But unless there is, and I think it's clearly not in the cards right now, unless there is a European endorsed mission, Greece will not participate on its own. And I think the likelihood of such a mission right now is very low.
Do you think the longer this conflict lasts, the more likely it is that Europe will be drawn in?
I think that Europe will not be drawn in militarily, but Europe certainly needs to focus on the economic ramifications of the crisis. We will have a very important European summit. I'm sure you'll ask me about that starting in 2 days. And we need to manage the economic and energy consequences of what could be, I hope it's not going to be the case, a protracted war. It's going to be a different story if the operations, if the military activity ceases in weeks, and it's going to be a different story if this war drags on for months. As far as Greece is concerned, we've been working actively for rapid de-escalation. We don't believe that the structural problems of the Middle East can be solved through military operations. At the same time, of course, we fully acknowledge that Iran cannot have nuclear weapons and cannot threaten its direct neighbors. But right now, the focus of my European colleagues is to manage the economic consequences of what could be a very significant energy shock.
Well, that was the Greek Prime Minister Kyriakos Mitsotakis speaking to me yesterday. Now, investors are on alert ahead of the Fed decision later today, with central bankers having to grapple with rising energy prices amid the war in Iran. Now, for more, I'm joined by Isabel Mateo-Silago, Group Chief Economist at BNP Paribas. Isabel, it's so good to speak to you. As always, look, the market is priced in for encouraging news. I'm not sure what they're looking at.
Good morning, Francine. Yes, so I think what the market is looking at, and that's just a guess because we don't know, and different parts of the market in some ways are also pricing different things, but I think the market is looking at the fact that we're getting closer to President Trump unilaterally declaring victory. And that's because of, well, a number of signs from both domestic politics in the U.S. and the evolution of the situation on the ground. And we know that at that point, risk assets will rebound, and nobody wants to caught off guard or too far away from that position. Whether there is any objective reason to think this is about to happen, I'm less sure, particularly because Iran has agency, Israel has agency, and may decide that the conflict needs to go on further. But clearly, the closer we are to a ceasefire, at least I think peace is a distant prospect, but a ceasefire, the more people will want to be ready to jump back into the market.
Isabel, I mean, what are central banks thinking right now? Because they can't. I mean, it's very difficult to call because you don't know how long this lasts. You don't know if actually. I mean, if we stay at these levels, and then I don't even know what ceasefire means to the price of oil, and so how do they even model what it means to inflation?
Well, exactly. I think the message we're going to get from the 18 central banks meeting this week is wait and see, because they don't know anything that we don't know. And like the rest of us, they have to make scenarios without knowing the probability of any of them and, trying to assess what it means for them given their initial conditions. I think what all of them will be very careful to do is strike a balance between showing that they've learned the lessons from what maybe happened in the wrong way in 2022, but also not fighting the last war, because there are elements which are helpful today that were not there in 2022. The fact that labor markets are much less tight, the fact that inflation is much closer to target. I mean, back in 2022, it was at 5%, so, much worse starting point. So I think that's this kind of balancing act. Yeah. But of course, exactly where they land is going to depend on every central bank.
I mean, let's say, and I know this is difficult to do, but you're a great student. I mean, you'd be a brilliant central banker, actually. So let's say that inflation, stays up, but you have a depressing, of course, this depresses economics. I'm not sure even for the ECB whether they would hike or whether they would cut at this point. I mean, is it tricky also in 5-6 months when you have a better picture of inflation?
So, this impact of, higher risks to inflation, downside risk to growth, this is the same for every central bank. But then they have a different mandate. The ECB has a strict mandate focused on inflation. Yeah. Now, that doesn't mean that it's going to completely disregard the impact on growth. But I think in the ECB's thinking, they're going to think, well, what we don't want is for inflation expectations to get out of hand, and then we have to hike into possibly a recession. And I think from the way they look at it, makes a lot more sense to signal vigilance, signal even hawkishness at this stage, and hope that they don't need to act. And if they do need to act, if they do it early, then they can have a fairly limited move and not stay there for very long, which I think in terms of the ultimate growth impact would be the best scenario. But I don't think they will signal anything very strongly tomorrow, because the reality is nobody knows and they don't know either.
Isabel, when it comes to the Fed, I mean, were the markets just ahead of themselves in terms of expecting 2 or even 3 cuts this year?
Well, markets are expecting cuts from the Fed and hikes from the ECB. This is very strange, in reaction to the same shock. And even though inflation is almost 100 basis points lower in Europe, this is very odd. So in our view...
But what does that tell us? I mean, does it tell us that the market prediction is wrong, or is it a different kind of investor that are taking different bets?
I think it's telling us that one of these 2 predictions is wrong, yes. Right. I mean, possibly both of them. But no, I mean, look, prior to the war in Iran, the way we were looking at the U.S. economy is that the growth momentum was pretty strong, that the labor market was in balance. You could call it a fragile balance, but nevertheless in balance, and inflation still too high, quite some distance from the Fed's target for the 6th year running. And so in that context, for us, the Fed was not going to be in a position to cut anyway. And now with risks to inflation having gone up, we still see that they don't manage to cut this year. There is even a risk, I don't think it's going to happen, but there is even a risk that they signal a symmetric stance tonight, where they say, look, if this shock is bad enough, maybe we even have to hike. Certainly, some of the members of the FOMC were already in that mindset at the last time. Will it be a majority this time? I don't think so, but that's an outside risk.
What happens to dollar?
Well, dollar, interestingly, hasn't rallied nearly as much as you would have expected, given the size of the energy shock. And almost certainly that's in large part because of the front-end rates having been so dovish in the case of the Fed, whereas everywhere else they've moved more or less as you would expect.
So, Isabel, I mean, overall, if you were to take a calculated guess on what kind of economy we're left with by the summer, I mean, what's your bet on? Like a much worse economy, or could things stabilize?
So by the summer, we'll know if it's going to be, a protracted shock or not. Hopefully, and I think that's still the most likely scenario if you believe what President Trump is saying, that he seems to want to wrap things up, in the next few weeks. The economy can hold up. This is what we're hearing from clients. This is what, unless you're directly impacted by shortages, and most companies are not, right now they're staying focused on their long-term plans. In Europe, there's still a lot of investment in defense going on. Everywhere there's a lot of investment in AI and tech going on. That's going to continue to power the economy. But of course, the longer this shock lasts, the more you're likely to see an adverse impact on the consumer, and consumer is everywhere the driver of growth. If the consumer stays at home, that's going to be a problem.
Isabel, thank you so much. As ever, Isabel Mateo-Silago, Group Chief Economist at BNP Paribas. Now, coming up, we'll be speaking exclusively to Sander van Noordende. He is the Chief Executive of the talent company Randstad about a critical shortage of workers that could stall AI growth. We'll talk about that next, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We've been licensed for many customers in China for H200. We have received purchase orders from many customers, and we're in the process of restarting our manufacturing.
And the NVIDIA chief executive, Jensen Huang, they're on starting manufacturing for AI chip orders in China. Now, while many investors are still debating the long-term utility of artificial intelligence, the Oaktree Capital co-founder, Howard Marks, believes the market is missing the immediate scale of the shift.
Well, I think most people are underestimating the impact of AI. Roughly 18 days ago, on a Friday, that a company called Block, which had 10,000 employees, announced that 4,000 of them were out. 40% of the workforce gone in one day because AI could do the work cheaper and faster.
Well, that was Oaktree's Howard Marks speaking to Bloomberg. Now, the AI boom is also fueling a massive surge in demand for skilled tradespeople needed to build and maintain the physical infrastructure that the technology requires. However, a critical shortage of these workers threatens to stall growth. Well, that's according to my next guest, Sander van Noordende, the chief executive of talent company Randstad. So thank you so much for joining us, sir. Explain to us what this actually means. If we don't have enough skilled workers going forward, where, are we able to roll out the technology AI and actually try and access its full potential?
Yeah, I would say, Francine, and thank you very much for having me. AI cannot build data centers or electric infrastructure or chip factories. So skilled trade workers, as in electricians, plumbers, welders, engineers, are in high demand. Their job growth in that category is going to be 2x the growth of the general market, I would say. Many people in the skilled trade today are nearing retirement. And frankly, maybe the most concerning bit is that there are more people, younger people, leaving the skilled trades than there are entering the skilled trades. So something needs to be done urgently, I would say.
So what's your take on what AI takes the most jobs? There's a big debate on whether it's actually entry-level jobs in white-collar industries like law, consulting, tech, and finance. Is this where you're going to see the most job losses?
That topic, I'm an AI optimist. I'm an AI optimist. I think the world needs a productivity boost. The number of jobs impacted by AI, the research that we have seen here at Randstad is roughly 7% over the next 5 to 10 years, with a higher end case of roughly 12%. So that's massive, but not the massive scenarios that some people would like you to believe. So this will take a bit more time, and it will go over time. Obviously, the roles that are most under pressure are clerk type of roles, admin type of roles, call center, customer service, software developers is a category. So those jobs will be under pressure. But also the World Economic Forum is saying there's going to be 70 to 90 million new jobs over the next decade. So I think this will be a manageable transition, but we all need, companies need to work on it, and we all need to work on reskilling our workers. And we need to, I would say, solve the skilled trade conundrum, because that's where real urgency is. The median salary for skilled trade people is now 60,000. With on the high end, good electricians or HVAC engineers can make 6-figure salaries. So you can see there's going to be a lot of demand there, and that needs to be filled urgently.
I feel a lot of anxiousness amongst workers across the board. How would you describe the labor market in one word?
I would say the labor market today, in one word, is still stuck. There's not a lot of hiring going on. There's not a lot of mobility. There's not a lot of quits. So this needs to get unstuck by, I would say, more certainty in the overall economic environment. And obviously, the developments out of the recent weeks with the Middle East situation do not help, therefore, our clients to get that certainty.
So is the Iran war getting companies to rethink expansion or rethink hiring in Dubai?
We have no business in Dubai, so it's hard for me to say that. But in general, I think companies have been very reluctant to hire across the globe. And that continues to be the case. It's more driven by the overall economic uncertainty out there than by the particular regions. But obviously, the world and our clients will be better off if this situation in the Middle East gets put to rest over the next couple of weeks.
Yeah, so you say the labor market's stuck. Are there any pockets of labor market which are actually quite healthy? Are there services, for example, in healthcare or elsewhere that are needed?
Well, that's the skilled trade we just mentioned. Of course, that's a hot area. The other area that is in demand is healthcare, of course. If we look at our business, logistics has been very in demand over the last couple of years. And then there are, the industries such as, the high-tech industry, but also life sciences, where there's still strong demand for talent.
But do they need a catalyst? I don't know whether it's an interest rate cut or something like that, or do you think, are those pockets actually moving along fine?
Yeah, well, I think, let's say, a catalyst is always welcome, but I would say, by and large, more certainty about where the economy is going and where demand is going for services and goods of our clients. That is what clients are generally looking for. They need that confidence that they can make that investment, whether it's in infrastructure, whether it's in technology, or whether it's in talent, and that's hiring.
Do you worry about your own company or your own services? Does AI also make recruitment services more difficult to hire?
No, AI is a tremendous opportunity for us at Randstad to do a better and faster job for our clients and talent. AI enables us to be better in touch with more talent, and that's what our clients are looking for, so we can serve them in a better way with the help of AI and our platform, of course, than we could before. So I think AI is good news for us.
You've said in the past that the traditional university-to-office model is actually broken or breaking down. Has higher education become less relevant now?
Well, I think in general, education is as relevant as ever before. But the notion of okay, you graduate from high school, you go to college, and you go do something in an office. I think that path is not as straightforward anymore as it used to be, and it doesn't have to be, because there are great careers in skilled trade. And actually, what is very interesting, there's a convergence between, I would say, traditional blue collar and white collar. Because if you're in the skilled trades, you need technology skills. Yeah, because all equipment, all machinery these days is connected. There's monitoring going on. There's maintenance going on based on what the monitoring says. So the technology skills in the skilled trades have actually become a lot more important, and that has made the career track also more interesting.
What does the workforce look like in 5-10 years? How different will the workforce look like than it does now?
Well, I think if you look at these trends, skilled trades will become more important. Healthcare will become more important. I would say logistics will become more important. Engineering is definitely in demand in terms of course, AI infrastructure, but also energy infrastructure. Let's not forget AI requires a lot of energy. That means power grid infrastructure. And then you go back to regular infrastructure. In all major markets, we need more homes. In all major markets, we need more infrastructure for the public. Climate change, and we need green infrastructure. We need to protect our country. So engineering, I would say, is also a very important trajectory.
Thank you so much for your time today. Sander van Noordende, the Chief Executive of Randstad. Coming up, we'll discuss the widening geopolitics and the implication of the Iran war with Charles Litchfield and Daniel Tannenbaum. That's coming up next, and this is Bloomberg.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemima Bersecci in Davos, Switzerland, and this is Bloomberg.
Breaking news
news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of Power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Iran vows to revenge the killing of its security chief and launches a fresh wave of missile and drone attacks across the Middle East. Well, U.S. President Trump says the war could end, quote, in the near future. Iraq signs a deal to resume oil exports via Turkey to avoid the Strait of Hormuz, while energy inflation remains a key topic ahead of the Fed decision later today. Plus, Howard Marks, the co-founder of Oaktree Capital Management, says investors are underestimating the impact of AI. So Iraq has signed a deal to resume oil exports via Turkey that avoid the Strait of Hormuz. It comes as the U.S. steps up efforts to force the reopening of the vital passage. So let's bring in Bloomberg's energy reporter Anthony Di Paola in Dubai. Anthony, thank you so much for joining us. So first of all, will the rerouting of Iraqi oil have actually much of an impact on supply concerns?
Good morning, Francine. Yeah, everything is a help. It will add some oil back to the market, but clearly not enough to make up for what we've already lost because the Strait of Hormuz is shut. So this will be some oil that's produced by the Iraq State Company as well as private companies in the northern Kurdish region. That will bring about 500,000 barrels a day of oil back to the market if things go ahead as planned. That's against a shortfall of something about 15 million barrels a day that we're losing with the Strait of Hormuz being shut. Simply, Gulf producers cannot get oil on tankers and get it out of Hormuz, so it's not moving. We've seen lots of producers already shutting in production. Iraq, for example, about 3/4 of its output is already shut in. So they're trying to revive some of that and get at least some oil moving through the north. But that's been a problematic pipeline for them in the past because they've had, over the last several years, it's been largely halted because they've had payment disputes with Turkey about pipeline fees. They've had disputes on revenue sharing with those private companies working in the Kurdish region. So it's a big dispute, and it's been a big problem for them. So what they really need to do is focus on getting those details sorted out, at least for the short term, to keep that oil running for now, Francine.
But Anthony, the oil market's focus, of course, remains firmly on this choke point. But where do you see oil going the longer that Hormuz remains effectively closed, that there are no ships passing?
Yeah, at the moment we're around about the $100 point. Traders are really watching to see how long that closure remains, how long Hormuz stays shut. And then they're also looking to see, are there any damages in production, in export facilities within the Gulf? The longer it stays shut, the longer it takes for things to get back to normal once we do have an opening. So if there are fields shut in, it becomes more difficult to bring them back to full production quickly. Refineries as well will need to be repaired or potentially refurbished, depending on if they're damaged. So it really depends on how long we're shut in and if there is any real damage to facilities as this conflict goes on. So that's really what traders are watching, and with the idea that the longer it goes on, the higher the price potentially goes, Francine.
Anthony, thank you so much. Anthony Di Paola there, Bloomberg energy reporter. And let's get more on the geopolitical risk situation and discuss White House military and economic strategy. With me now, Charles Litchfield, Director of Economic Foresight and Analysis at the Atlantic Council think tank, and Daniel Tannenbaum, Partner and Global Anti-Financial Crime Practice Leader at Oliver Wyman. So thank you both for joining us. Charles, I mean, first of all, you know, I had a couple of conversations in the last 2 days with the President of Finland, with the Prime Minister of Greece, and they're worried about the inflation, of course, impact, but they're not ready to commit European troops or you know, anything to try and basically put the safeguards around the Strait of Hormuz. Like, how can we weigh the economic impact longer term?
Well, first of all, I think the Europeans are unwilling to commit anything for now because, first of all, they're not aware of what the U.S. plan is. And even if they commit ships, convoys, simply to help ships get through, and they say this to the Iranians have said it very clearly that they consider any U.S. ally to be a problem. They'll allow non-U.S. allies through, but it's the Iranians who can decide who can come through the strait or not. So they need to know what the U.S. plan is before they commit anything, irrespective of the consequences for inflation for the next few weeks. There's a little bit of slack in the markets, and people are trying to figure out first what happens. And so if we have a few more weeks, I think, before there's a big problem on inflation, but the consequences for Europe will be huge. I think they might be even bigger for Asia.
How long? I mean, again, the problem is that we don't really know the timeline. Is that the market today is positive, Dan, but actually we don't know when we know about the U.S. plan and what the consequences will be.
Well, that's right. And to Charles's point, we don't know what the objectives are. Is it regime change? Is it eliminating the nuclear weapons program that was supposedly eliminated last summer? What are we trying to accomplish here? I mean, President Trump is exceedingly good at changing the subject and at least getting a decent chunk of his base to follow. But let's be clear, this is a deeply unpopular situation in the U.S. with 13 American service members killed already, some in accidents that had nothing to do with kind of enemy situations. If this continues, especially with the threat to put boots on the ground, I mean, this will have some significant political impact on the president and his party.
But so is this, and this is, you know, a line of thought that actually gasoline prices hit $5, that's when the president backs away?
It's true, but I think we've witnessed over the past 14 months that Trump has been in office that markets think they can discipline him, but he also thinks that because the markets think they can discipline him, their reaction is actually quite soft. Most people are saying at this point that markets are being complacent, and yet here we are today, they're positive. But because they think they can discipline him, their reaction isn't as big, and therefore he thinks things are fine for now. I think $5 is a big psychological barrier, but I also wouldn't underestimate his willingness to see a result in Iran that he can sell as a victory. So there's another sort of view out there that Trump will simply declare victory and leave. But it's not only his decision, and when there are clearly still U.S. allies and U.S. partners being bombed by Iran, it's very difficult for him to declare victory.
I mean, how does he sell this at home?
I mean, that is the issue. I mean, he's talked about this imminent threat, but you saw with the NCTC head resigning very spectacularly yesterday, saying, and he was a true MAGA supporter, there was no threat from Iran. I don't know if he does sell this at home. The other issue that adds complexity is he tells Americans to tolerate pain at the pump related to Iran while granting license and relief, bringing $150 million a day to Russia through sanctions relief, which that's also an unpopular conflict, although not nearly in the press as much in the U.S. So there's a lot of mixed messaging that I think even someone who's not following politics can't really understand what the president's trying to do here.
I mean, again, he needs a good economy. The president does, if you look at the midterms, which frankly are like, what, 5-6 months away. So how difficult is that going to be to be achieved?
If his only objective was winning the midterms or minimizing his losses, he wouldn't have started this war, and he would have had a much more tepid approach and a soft approach to tariffs. So you have to assume that Trump, while winning the midterms, will be important, and as we get closer, he'll start scaremongering about everything the Democrats might do when they take back a bit more power. But I don't think this is his priority. He actually cares about his impact on the world, and he's been convinced that this was a good idea. He might be a little bit fearful of what he's unleashed, but that's never what he says publicly. And so this is his focus for now, not the midterms.
But what do you understand this to be? So was it just, you know, trying to get a bigger hold on the reserves like he did in Venezuela and Iran? Or it's difficult to 100% understand what he was hoping to achieve.
I agree with that. I think Venezuela is a key factor, a key point, a key part of the context. The success in Venezuela, although he was told that this would be very difficult, the same people were briefing him, this is a risk, Mr. President. You know, these are the things that could happen. And yet, on his own terms, Venezuela was a huge success, and he actually did gain some control over oil that comes out of Venezuela, and that the U.S. now controls, although some of that money will make its way to Venezuela. I think it's important to add that. So that was so successful that he thought he could do it in Iran again, without the objectives being correctly set out, and also without correctly considering everything that could happen in the Strait.
Dan, I mean, one of the things that we've been trying to understand is, can Europe, so Europe is largely going to abandon any kind of connection to Russian oil by 2027. Can they really afford to do so at this point?
I think they're really feeling emboldened, especially now with this line between the U.S. and Europe. I mean, they're not going to turn around on this, although you've seen a few world leaders saying, like, how can we totally abandon Russian energy? But I think the overall consensus, other than a handful of outliers, is they will hold to this plan. And I think they'll do it for the very right reasons that the U.S. used to be looked to from a policy standpoint that I think we've ceded over the last few years. So that creates a real divergence. It is important to note, I mean, President Trump has only imposed sanctions in the form of 2 designations since returning to office, as opposed to thousands of designations under Biden's term and additional by the EU and UK.
They were 2 big designations.
They were 2 big designations, but I mean, he's used the sanctions quite sparingly. So I do think that divergence creates a problem. There's also things that are now legal in the U.S. that are illegal in Europe. So there's a potential for a conflict of law issue there as well.
I mean, to the point that we were making on oil when you both sat down, we have a live blog, of course, on everything that's happening in the Middle East. And we understand now that Iranian oil is moving through Hormuz largely undisturbed. How was it underestimated, the power that Iran had in terms of those small but deadly drones?
Well, I think the point one that Charles made is the Venezuela bit gave this administration a lot of confidence in killing a handful of Cuban security, and kidnapping Maduro and his wife is nothing like toppling the Iranian regime that's had 3 generations to prepare for this moment.
After strikes last year as well.
After strikes last year. It's ironic now that the West needs Ukraine to help with drone interception technology, which is now being used in the Gulf to fend off the Iranian Shahed drones. So it is a bit of a threat, and that's been the calculus. The cost of this war is so significant. Firing millions of dollars in missiles for $30,000 drones just economically makes no sense. So it is ironic that now the cards are somewhat with Ukraine, who is being called in to help, despite the fact that the U.S. is providing extremely limited aid to Ukraine right now.
Yeah, but this was never about the money.
Yeah, I mean, first of all, on Ukraine, they have to be quite careful in how they use this new leverage. I absolutely agree that it is leverage. But going to Mr. Trump, and saying, look at all the cards I have now, Mr. President, would probably provoke him. They have to be very careful in how they calibrate this new leverage that they have.
Zelensky was careful yesterday, but I was with a group of Ukrainian parliament members last night, and they were a lot less careful with their words in terms of saying the things that I think Zelensky wanted to say. But there's a very strong view of just this bizarre imbalance at present.
So Ukraine's a lively democracy, and that's why we support it, at least at the Atlantic Council. The point I was going to make on the money is it's very important, and even for the US, though, its resources are finite. We're already seeing it in terms of air defense, that the resources are finite. There's a 10-year waiting list, or was a 10-year waiting list, even before this war, for a Patriot missile system. And so you're seeing even US resources being redeployed from Europe and also from Asia. We were meant to have a pivot to Asia, already started under President Obama, but Trump also cared about this, and some important advisors in his administration also cared about it. But even for the U.S., though sometimes it appears that the U.S. budget is unlimited and the dollar also provides the U.S. with these resources, even for the U.S., resources are finite.
Charles, is there a worry that actually, the U.S. can't really go to Putin and say, stop this war, because they're doing the same in Iran?
No, I think that's a very important point, that the U.S. doesn't have much of a foot to stand on anymore. I mean, it is obviously more complicated, and the Ukraine didn't represent a threat to anyone. Iran did represent a threat. It's important to say that, and the IRGC was considered a terroristic organization by the U.S., but also most recently by Europe. It had been added to the European list. So let's not minimize the threat that Iran represented. But the Russians are very good at reversing and inversing arguments to make sure that the U.S. comes across as hypocritical. That's one of their big specialities.
I mean, what do we know about also this intelligence sharing between Russia and Iran?
I mean, there's more reports of what type of satellite data and munitions data is being shared between Russia and Iran, and still there's talks of deals. Dmitriev was in the U.S., in Miami last week with Witkoff and Jared, trying to hammer out a deal. I mean, as a reminder, Witkoff hasn't even been to Ukraine once since he's taken on this appointee role. So it's sounding very real that this intelligence sharing between Russia and Iran is there. And it makes it all the more confusing when you look at the sanctions relief that's going towards Russia right now.
Charles, I mean, there are 18 central banks this week that have to make a decision on what to do with interest rates. I mean, we're expecting, by and large, all of them to stay put. But, I mean, is there a real risk of a policy mistake, given that even if you hike rates, it doesn't have that much of an impact on a supply shock from oil that could feed into inflation.
Yeah, I mean, this is the perennial problem for central banks, trying to differentiate between demand-driven inflation, supply-driven inflation. We had that problem during COVID. But you're absolutely right that this new crisis prevents them from continuing on a cutting cycle. And so now the decision is between staying put or increasing interest rates. I think at this point it's pretty clear that most of them will stay put. But depending on the duration of the crisis, we may have to embark on some increases, which is exactly what they did not want to do.
All right, thank you both for joining us. Charles Litchfield, Director of Economic Foresight and Analysis at the Atlantic Council think tank, and Daniel Tannenbaum, Partner and Global Anti-Financial Crime Practice Leader at Oliver Wyman. Coming up, we'll get more insight on the White House strategy with Douglas Redeker from International Capital Strategies. That's next, and this is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
When the board made the decision to appoint me into the CEO role, my chair at the time sat down with me and said, succession starts now. And it was made super clear to me that one of my biggest accountabilities was developing that next generation of leaders. So that's always been front and center. You know, the other part of your question, so Francine, was, well, what's the right time to go? It's, you know, if for those of us, if you have the luxury of making that decision on your own, because there's plenty of CEOs who don't make the decision, it's always hard. It will, you know, I'm sure when that day comes, it'll be a combination of personal perspective, but also what we believe is right for the business.
Well, that is Mike Henry, the outgoing chief executive of BHP Group, talking to me in January about succession and when to step down for Leaders with Francine Lack with a podcast. Now, Henry will hand over the reins to Brandon Craig as CEO in July. We found that out about 14 hours ago. Now, Josh D'Amaro will take over as the Walt Disney Company's chief executive today, succeeding Bob Iger. The move comes as Disney transitions from traditional TV viewing to the streaming era. D'Amaro formerly headed the theme parks, cruises, and consumer products unit, and Iger will stay on the board as a senior advisor until his retirement on December 31st. Now let's return to our story on the conflict, of course, in the Middle East. President Trump appears to have given up on efforts to recruit allies to help secure the Strait of Hormuz. Meanwhile, investors are looking ahead to today's Fed rate decision, and Jay Powell's comments on the risks to the economy from the Iran war will be in the spotlight. Well, joining us now is Douglas Redeker, managing partner at Washington-based consultancy and advisory firm International Capital Strategies. Doug, thank you so much. I'm so happy to have you in London, especially as we try and figure out exactly what the White House is thinking. So, I mean, was this a mistake? Was it because they didn't understand the consequences of Iran? And what, I mean, when does this end?
Well, that's a
big
lot of
question
questions.
in 2 minutes.
Okay. Was it a mistake? I think abjectly over time we're going to find the answer is yes. I think that's already the case. I don't know if they would admit that. But yes, what were they thinking? I think the they is a problem. The thing is, what was he thinking? This is not an administration that actually has a robust interagency discussion where things are, hashed out and then decisions are taken and then signed off on. The president made this decision himself. By all accounts, he was warned by the intelligence community and by the chairman of the Joint Chiefs of Staff that some of the risks we're seeing play out in the Strait of Hormuz and elsewhere were actually, very likely to happen. He said, I'll take that risk. I'll take those risks. And now he's paying the price, or at least those are the consequences. How does this end? I don't think we know how this ends, and I don't think anyone knows how this ends, because I don't think there's an easy way to square the circle right now. 5 years ago, we talked about Russia and Ukraine, and people said, how does this end? And some of us said, I don't know how this ends. It could go on for years. I'm not sure this is going to go on for years, but it's certainly not going to go on for the days or weeks that President Trump originally promised.
But Doug, there seems to be a belief in the markets, which is why a lot of stocks are up, that President Trump in a couple of weeks says, guys, job done, we've secured, we move on. I mean, is that even something that can be done, or will the Iranians continue attacking?
I think the idea of redefining mission accomplished and finding an off-ramp is clearly one the markets believe in and one that President Trump is increasingly going to be looking for. I'm just not sure the Iranians and the Israelis, as well as the other Gulf states, are going to be on the same page. So if President Trump decides to decide that the new supreme leader, either the one who, Moshtaba Khamenei or someone else, is suddenly an acceptable party to deal with, I'm not sure the Israelis are going to go along with that. And I'm not sure keeping this regime in place is something that the Gulf states are going to be happy with, because their status quo has been blown up and they're not going to put those pieces back together again. So even if President Trump decides to declare victory and withdraw, he's leaving behind a terrible situation, which is going to make him look bad and not provide that let's move on moment that he's hoping for.
Where's Congress in all of this?
Yes, good question. There was a War Powers Act resolution that was put forward a couple of weeks ago. Both the Senate and the House rejected it. That is the least Congress could have done, because it would never have been signed off on by the president anyway. So it was just a symbolic objection, and they did not do it. Now, things have gotten worse since then. So whether Congress starts to raise its head, we'll see. But at this point, Congress is absolutely absent. Congress right now is focused on the SAVE Act, which is the voter ID citizenship legislation. That's what they're focused on. Opening DHS. They're not focused on this.
But do you? So what is? I mean, what is the counterbalance actually to President Trump? Is it really the markets? Is it the price of gasoline? Is it the price of oil? Or is this an administration that's unhinged?
I would argue that this is an administration that you could argue is unhinged, but I'm not sure that that answers your question. I think that the check on this is reality. The reality is going to be loss of American lives if President Trump continues down the path of escalation, which is what he's doing. The markets believe this is a guy looking for an off-ramp, but we have seen no evidence of that in terms of bringing in a Marine expeditionary force that's up to 5,000 men and ships that could, it is rumored, to be ready to take on a role on the ground on Karg Island, which interestingly, a Republican congressman was on Bloomberg yesterday saying that that's not actually boots on the ground. Boots on the ground is if they're in Iran proper, not if they're on Karg Island. All right, I would argue it's boots on the ground. There's going to be casualties, there's going to be loss, there's going to be risk. I'm not sure what the pain threshold is for President Trump, but there's going to be a moment, whether it is markets, whether it is oil prices, whether it is loss of life, that is probably going to make him seek that off-ramp. I just don't know if the Israelis, the Iranians, and others are going to give it to him.
I spoke to the president of Finland on Monday. I spoke to the prime minister of Greece yesterday, and both of them were very reluctant to actually support the U.S. in what he's doing in the Middle East. Will Europe have to be drawn in?
I think Europe has made it very clear they are not likely to be drawn in, and President Trump has, with great anger, apparently, according to Lindsey Graham, accepted that, even though he's going to continue to argue against it. I think Europe is smart enough. There was a French general yesterday who said this is like being invited for dinner and dancing on the Titanic the day after it hit the iceberg. It's hard to accept that invitation, and I think Europe is smart enough to try and keep arm's length.
But if the price of oil continues, I mean, even if it stays at these levels, or let's say it goes to 115 for a protracted amount of time, it's probably, I mean, it's bad news for the world economy, but possibly a recession.
Yeah, I think stagflation is a risk. So we're talking about an economic and financial landscape that in March 2026 is fundamentally different than we thought it was going to be even in January of 2026. And yes, I think that we are looking at major global systemic economic risks, and I'm not sure the president has it within his capacity to actually undo the damage that's been done.
Doug, you had a high-profile also resignation in the U.S. yesterday because, the war, in his eyes, didn't make sense. Does that make a difference to the American psyches? Like, are voters engaged in this war?
Voters are not engaged in this war very much yet, and I don't think that Joe Kent's resignation will resonate yet. I also think that Joe Kent was a controversial guy, so his resignation, while it is meaningful, there are those who are pushing back on the narrative that he's standing for all the right things. There's a lot of nuance to Joe Kent's background on this. But I do think it is the beginning of the headlines of public dissent within the administration. That goes back to your question with Congress. Will Congress start to raise its voice and say, wait a minute, hold on now? I think we're starting to see that, but it has yet to accelerate.
What does it mean for the midterms? I mean, first of all, are we sure that they happen and that they're free?
No, we're not sure. I think that, first of all, if the midterms were free and fair, just based on where we are now, I think it is likely the Democrats certainly take the House. There's a better chance than we thought that they could take the Senate. President Trump is well aware of that. He has publicly stated that there are issues with ballot integrity that he finds troubling. I think most of those are manufactured. But whether it is an attempt to use the Insurrection Act to put the military in place, whether it is using the SAVE Act, which is pending before Congress right now, which is the citizenship requirement that will likely fail, but he could then use that to deem the elections illegitimate. There are a lot of conspiracy theories about President Trump's efforts to make sure that those elections are not free and fair. I don't know whether that's going to play out that way, but it's too early to know, but I do think you can't rule it out.
Doug, thank you so much. Douglas Redeker, they're a managing partner at International Capital Strategies. Now, again, there is quite a lot going on in the markets today. For the moment, look, of course, there's the Fed. There's 18 central banks that will come out this week and have to decide what they do with interest rates. For the moment, stocks are rising, oil dropping, again, in the run-up to the Fed meeting. And you can see Dow Jones futures gaining some 0.5%. In fact, Europe's stock 600 touched its highest level in more than a week. Up next, Bloomberg surveillance, and this is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars, Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
There's downside risk around labor, but then you also have to acknowledge that there's some upside price risk.
This oil price shock is another headwind to the labor market expansion.
The Fed will have to increasingly acknowledge the two-sided risk from this.
For now, the Fed is going to be cautious.
The Fed is going to be on pause. They do not want to preemptively react.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, it's decision day. Fed Chair Jay Powell confronting a major energy shock in the Middle East as the industry is searching for workarounds to get crude flowing once again. Iran is vowing revenge following the loss of its security chief. That country isn't backing down.
And frankly, the killing of the national security chief, Ali Larijani, it seems to only muddy the waters further because he was believed to be the sort of next potential real leader that could coalesce power. If he is not available, who do they negotiate with? Who is going to be feasible to really put forward some sort of solution? And without that kind of solution, how exactly do you get oil and other commodities flowing through the Strait of Hormuz?
It's incredibly hard right now to get oil commodities flowing through the Strait of Hormuz when you have the Iranians saying, basically, the Strait, quote, won't return to its pre-war status. We need to design new arrangements. That's what the Iranians saying. Their oil is getting through, but for anyone else that wants a pass, there's going to be a new arrangement. And this is the big problem this White House and Western allies have right now in the region.
Which is why we're holding on to triple digits on Brent crude once again at 103.40, and that's the problem for the Fed Chair Jay Powell and the committee later on this afternoon. Not much has changed. Unemployment the last time they met, 4.4%. Unemployment now, 4.4%. The major change, one thing, the price of crude. Going into the last meeting, WTI was in the low 60s, and now it's $30 higher than it was back then.
Yeah, Brent's closed above $100 a barrel for 4 straight sessions, and we haven't really heard from Fed officials since this war really kicked off and gained steam, which is notable given the fact that it's been the quiet period. So we haven't gotten any indication about exactly how they're going to view this. Are they going to treat it hawkishly? And some people are worried to the point that you've been making. Is this going to be the classic central bank mistake where you see an oil price shock and you hike into it to curtail growth, or is there going to be a sense of patience and a sense of prioritizing any kind of weakness that you're seeing in the labor market?
A bigger question perhaps for the ECB, their meeting coming up tomorrow alongside the Bank of England and the BOJ. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research, with stocks looking to build on 2 days of gain. Stephen Cook of the Council on Foreign Relations as more strikes erupt across the Middle East. And Neil Datta of Renmark ahead of the latest Fed rate decision. We begin this hour with our top story. Iran firing a fresh wave of attacks across the Middle East as supply chains scramble to reroute crude from the Strait of Hormuz. Joining us now for more, Bloomberg's Jemana Basechi, leading our coverage out of Dubai. Jemana, welcome back to the program. Let's just start with energy and the rerouting, the offset, the attempt that people are making to try and take away some of the pressure out of the energy market in the Middle East.
Yeah, well, at the end of the day, you still got oil trading triple-digit territory here, despite the U.S.'s best efforts to ensure the safe passage of vessels through the Strait of Hormuz. I thought it was interesting that yesterday evening, the Iranian Foreign Minister, Abbas Araghchi, actually gave an interview to Al Jazeera where, to what Anne-Marie was saying, he was describing that in future there needs to be a new protocol. This is the exact word he used, vis-a-vis the safe transiting of ships throughout the strait. They clearly recognize that they have a lot of leverage with this choke point for global shipping and for global energy markets, and it is a point of leverage that they are not going to back down on. And if anything, they have been energized overnight. Post the killing of Ali Larijani, this was a key figurehead. As we spoke about yesterday on the show, there's now confirmation from Iran that he was indeed assassinated. So more decapitation right at the top of the political structure. And they have vowed retaliation for that. And the retaliation has indeed come overnight. Around the same time as they announced that he had been killed, they launched a series of attacks, once again on Gulf states. Over here, I can tell you in the UAE, we received multiple missile alerts on our phones overnight. There was even damage sustained by an Australian military base overnight too. The interception rate continues to be quite high, but at the end of the day, they continue to target many of the military bases and even civilian infrastructure within the UAE. Also, renewed attempts in Saudi Arabia, the diplomatic quarters there, they intercepted some missiles. On the eastern oil fields, another attempted strike on the U.S. Embassy in Baghdad, and also attempted strikes on diplomatic areas in Kuwait as well. So the backlash continues, and then also reports out of Tel Aviv that there have been 2 announced deaths from these strikes that took place there too. So no signs really of things letting up. It is day 19. The Iranians continue to retaliate, and they continue to put pressure on that key choke point for global shipping and energy markets, and that is the Strait of Hormuz. And unclear at this point whether the U.S. can actually get together the coalition that it needs to ensure the safe passage of vessels through the strait, and whether even that's feasible technically.
Day 19 and no visible off-ramp. Jumana, always good to see you. Jumana Basechi out of Dubai, leading our coverage out of the region. Just to pick up on that line from the Iranian foreign minister, Amri, to go over this again. We need to design new arrangements for the Strait of Hormuz and the way ships pass through it in the future. At the moment, the path of transit and the flag on the vessel, highly conditional at the moment.
Absolutely. Iranian crude is getting through, and 90% of that is going to China, some Chinese vessels. There have been also pockets of some Indian vessels and Pakistani vessels getting through. If they are in advance communicating with this regime, not a single Western vessel is able to get through. And to be honest, what CEO is going to okay that, given the fact that the strait is not safe right now? Now the Iranians are talking about, we own this. They do not view this as an international body of water anymore. That is why the strait is not closed. It's controlled.
Brent crude right now, 103.40. Here's the view on Wall Street this morning. Ed Yardeni of Yardeni Research writing, sentiment heading south usually increases the likelihood that we'll get a good buying opportunity. It's worked very well for me in the past, but it may not work now. Ed joins us now for more. Ed, welcome to the program. That's an interesting line from you, so let's build on it. Why is it different this time?
Well, in the past, whenever the bull-bear ratios took a dive, that was a great contrary indicator that it was time to buy. And usually in the past, when the bull-bear ratio took a dive, it was because there was some sort of crisis that there could be a response to by fiscal and monetary policy, trade policy. In other words, there were policies that the government could implement that would relieve all the concerns, relieve the crisis. And more often than not, what we've seen in the past, it was a credit crunch that spooked the financial markets, and sure enough, it led to a recession, and sure enough, it led to fiscal and monetary stimulus, which reversed the whole situation. So we saw that back in 2009. We made a bottom when the Fed came in. We saw that with the pandemic when the Fed came in. So we've got plenty of examples of the Fed put and the Treasury put and so on. The problem here is who's in charge, who's in control, who can respond to this latest Middle East crisis? And the answer is nobody. It's kind of ambiguous about how this thing gets resolved. I think the markets have taken a pretty optimistic view that this isn't going to last very long, and that markets will adjust, that there will be oil, and maybe it won't be a 20% cut in global oil as a result of the Persian Gulf War, but more like 10%.
The conclusion seems to be, Ed, from the bull case at least, because we hear it all the time on this program, is that the earnings profile of the S&P 500 is still pretty decent. The tailwinds coming into this year are pretty strong, and that we can withstand the pressure coming from international waters, coming from the Middle East. Ed, do you not think that they can stand up to those kind of forces?
Well, I have been pointing out that the market has been amazingly resilient. I think we all have. And the explanation for that is that increasing concerns about a possible recession resulting from all this have in fact weighed on the forward PE of the S&P 500. But on the other hand, the industry analysts that cover the S&P 500, guess what? They didn't get the memo that there's a problem in the Middle East that could depress earnings. And so what we're actually saying is earnings expectations are going up for this year and certainly for next year. So, I think the analysts are probably right. This isn't going to last for more than a few more weeks. And if you look out to 2027, the outlook is actually pretty spectacular for earnings for all sorts of reasons.
How much is the earnings outlook going forward predicated on the idea of credit markets remaining open and, frankly, relatively easy in terms of financing conditions?
Well, I think the issue here in terms of there's sort of layers of risk here. I wasn't particularly concerned about the private credit markets. I saw, like everybody else did, that there's cracks in the private credit markets, and through those cracks, Jamie Dimon, the boss of J.P. Morgan, said, hey, you can see one cockroach, and if you see one, there's probably a lot more behind it. And sure enough, there have been more cockroaches in the private credit market. But I think it's not, the problem is not the nature of what happened in 2008. However, if you lay on top of that uncertainty about how this war goes and whether it will, in fact, create a stagflationary shock that could come back to create more cracks and more cockroaches in the credit markets, then you got a problem. So, about a week and a half ago, 2 weeks ago, I raised my odds of a recession or just all sorts of possible problems from 20% to 35%. Market didn't care. It's held its 200-day moving average. It's actually pretty normally. And look, I view corrections as buying opportunities, and the market's not giving us much of a buying opportunity, quite honestly.
Ed, if we do get a hawkish tone from the Fed today, given what you just talked about with the response and what borrowing costs do in the face of what could potentially be a stagflationary shock, could that potentially create some real downside, given the fact that it would introduce this possibility of more cracks ahead?
Well, Lisa, you know what I wish the Fed would do? I wish they would put out a statement and say, folks, there are just some things that we can't solve. Monetary policy can't do everything. And this is a geopolitical shock. We can't do much about that. We're going to have inflation surge here for the next few months. First, we got energy prices up, and then we got a shortage of fertilizer, so food prices could go up. And there's really not much we can do about that. Raising interest rates isn't going to make those problems go away. It will create another problem, which is an even weaker labor market. So I wish they just, not be hawkish or dovish, but be honest and say, folks, we just, this is a problem created by geopolitics. Fiscal policy hasn't been very helpful on the inflation front and the debt front. And all we can do is leave the rate right here and see how things unfold.
Ed, that's what you want them to say. What do you think Jay Powell's going to say?
Well, I think they might say something kind of a toned down version of what I just said, and that, they're going to have to just wait and see. They're data dependent. They have to see how this plays out. I guess if they want to go Volcker on us, they would say, look, we've got a problem here with rising risk of inflation and rising risk of unemployment. Eeny, meeny, miny, mo, we choose to be more concerned about the risk of inflation because we don't want to monetize inflation the way we did in the 1970s. And then Volcker had to come in and slam the brakes to get a recession to bring inflation down. We don't want to go down that road. So we're kind of inclined to think about the possibility of raising interest rates, which is something the markets, nobody really expected to be on the table prior to the war. But again, I think they're going to just say we're going to keep the pause going for a while.
Well, Chair Powell, definitely. Ain Volker. Ed, good to see you, sir. Thank you. Ed Yardeni of Yardeni Research. This Fed has missed its inflation target every year since the pandemic. I don't think that's going to change anytime soon.
It's been more than 5 years. It would be interesting if suddenly it mattered that much more at this moment. That said, there is a specter of discomfort that you're feeling across Wall Street, where this dip doesn't feel like enough of a dip to offset all of the concerns that Jay Powell has to respond to, whether or not he's there in a couple months' time.
That decision this afternoon, 2 p.m. Eastern Time. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Good morning, John. Iran vowing revenge for the killing of one of its top leaders. Iranian state media confirming that Ali Larijani was killed in an Israeli airstrike on Tuesday. He was the most senior Iranian official to be killed since Supreme Leader Ali Khamenei on the first day of the war. Meanwhile, Brent prices eased earlier but have turned higher again. It pulled back after Iraq signed a deal with Turkey to resume oil exports through their territory, allowing it to avoid the Strait of Hormuz. Iraq will relaunch a pipeline known as the Iraq-Turkey pipeline, connecting Kirkuk to Turkey's Ceyhan port. And Japan's Prime Minister Sanae Takaichi warning she's facing a, quote, extremely difficult meeting with President Donald Trump tomorrow. Her comments coming after President Trump criticized Japan for rebuffing his demand for warships to help secure the Strait of Hormuz. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara later on this morning. Up next on the program, Come and Get a Loan in the Gulf.
We don't need too much help, and we don't need any help, actually. In fact, we just put out a notice. So this was a great test, because we don't need them, but they should have been there.
Up next, we'll catch up with Stephen Kirk of the Council on Foreign Relations, live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Back-to-back gains on the S&P 500, the first two-day winning streak on the S&P since this war started. For the month of March, equities add to those gains, up by 0.5% on the S&P, on the Nasdaq up by 0.7. Brent and WTI shaping up as follows. Brent crude holding above triple digits, 103.40, and just about unchanged on the session so far. Unique yesterday, the crude still inched higher and equities did okay.
It seemed like it was the volatility in crude that was more important than necessarily the absolute level. We've survived $100 a barrel before in the United States. We saw that on average from 2011 to 2014, around that level. The fact that you could get some calm is enough for people to say, maybe it's a buying opportunity.
A bit of relative calm so far this morning. WTI 94.71. Under surveillance this morning, Go and Get a Loan in the Gulf.
We don't need too much help, and we don't need any help, actually. In fact, we just put out a notice. I was watching over the last couple of weeks, and all of our NATO allies were very much in favor of what we did. So I think NATO's making a very foolish mistake. So this was a great test, because we don't need them, but they should have been there.
So here's the latest this morning. The president slamming NATO allies after failing to get their support for a coalition to reopen the Strait of Hormuz. The president saying the war will end in the very near future while threatening more attacks on Iran's oil-rich Karg Island. Bloomberg's Tyler Kendall joins us from the White House for more. Good morning, Tyler.
Hey, John, good morning. Well, President Trump appears to be abandoning his call for allies to help secure the Strait of Hormuz after many appeared wary of his demands to send naval escorts. When asked directly whether any countries are going to send assets to the strait, I think it's fair to say President Trump sidestepped the question, instead touting bilateral relations between the U.S. and countries in the Middle East before going on to say how disappointed he is in the NATO alliance. In fact, it's really highlighting what's been past strained relations between the Trump administration and traditional allies when it comes to defense spending, as our own analysts at Bloomberg Economics say that for our European partners in particular, they're caught right now between constraints when it comes to capabilities and politics, but also this concern that the White House could disengage when it comes to the conflict with Ukraine if they don't engage when it comes to the conflict in Iran. In fact, yesterday, President Trump multiple times brought up unprompted the conflict in Ukraine, at one time saying, quote, "We've helped them in Ukraine and they won't help us in Iran," comes after new yesterday the French President Macron confirmed that his country will not be sending assets to the Strait of Hormuz, but says that France remains ready once the situation is calmer. It appears a ceasefire is going to need to be in place in order for this coalition to be formed, as many allies have said that they're not a party to this conflict, and NATO in particular is a defensive alliance. But John, as you well know, of course, President Trump's call has extended beyond NATO countries to China, to Japan, as we get ready for tomorrow when Japanese Prime Minister Takaichi is expected here at the White House. This trip was planned well before the conflict in Iran started and comes as big oil refiners in Asia start to look to import crude from elsewhere outside of the Middle East, as it seems that disruptions show no sign of slowing.
And that meeting could be awkward heading into the weekend. Tyler, thank you. Tyler Kendall with the latest from outside the White House. Stephen Cook of the Council on Foreign Relations writing, the U.S. still does not seem to have an answer for the Strait of Hormuz. What seems to be shaping up with a full-on military effort to open it will take weeks. Stephen joins us now for more. Stephen, welcome to the program. Let's take a step back and talk about the operation's goals. They've been through this a few times. Take out any potential nuclear capabilities, missiles, the Navy, the industrial base that underpins it. How much progress have we made, and what phase of this operation are we now in?
That's a great question. And when you talk to military professionals and professional military analysts, they will tell you that despite all of the noise and sort of doom and gloom that you get in Washington over a situation like the Strait of Hormuz, the United States has made a fair amount of progress in degrading Iran's military capabilities, and which will have a lasting effect on Iran's ability to project its power. The problem remains that there is still a drone and missile threat to America's partners in the region. Just yesterday, the Israelis took a fair amount of fire in response to the killing of Ali Larijani. And after a lull, Gulf states were getting hit as well. So there are still threats out there from the Iranians. There is a timeline. The military has a timeline. The Israelis have a timeline. It is 4 to 6 weeks for them to get through their target list and all the goals that they'd like to achieve. Yet the president is out there once again saying that this could end very soon.
Well, Stephen Cook, last night, CENTCOM employed 5,000-pound deep munition bombs on the coast. At the same time, we have the USS Tripoli, which is an amphibious Navy ship with tons of Marines heading to the region. What do you think the president plans to use this group of individuals for?
Well, part of what's shaping up is that the president threatens military force, or actually uses military force, in an effort to intimidate the Iranians. Thus far, the Iranians have not been intimidated. So this movement of U.S. Marines to the region may be, in fact, part of this effort to intimidate the Iranians. But they can be used to capture Karg Island or to capture the shoreline along the Iran's shoreline along the Strait of Hormuz. That is something that has become more openly discussed in recent days as the Strait of Hormuz has become more and more of a problem for the United States.
If the United States was to capture Kharg Island, what would that mean for the regime? Because that basically cuts off their entire economy, no?
Yeah, I mean, the Kharg Island is obviously a lifeline for Iran. Iran has a bigger economy. It's not just an oil-based economy, but with the Emiratis moving, or at least discussing the possibility of cutting off all of Iran's assets in Emirati financial institutions, and then if the United States were to take Kharg Island, you would really cut off the regime. The problem with that is, of course, is that the Iranians would be expected to retaliate, not just to try to push the American presence from Kharg Island, but would clearly try to attack oil infrastructure, production facilities, storage facilities, refining facilities, export facilities throughout the Middle East, which would extend the crisis and raise the prospect of a prolonged period of elevated levels of oil and gas at the pump for Americans.
Stephen, do you think that NATO is going to survive this period?
Well, this is, I think, a real test, and one has to question. I think that the fact that the NATO allies who are not consulted on this conflict, don't support this conflict, and have resisted the president's entreaties to help ensure the freedom of navigation through the Strait of Hormuz is going to put a lot of pressure on NATO. It will reinforce the narrative of the president, the people around him, and people who are supporters of Make America Great Again, that the United States wants partners, but it wants capable partners. And I think this will once again make the case for the president and the people around him that the Europeans are not strong allies, and that the United States should look for capable partners outside the alliance.
Stephen Cook of the Council on Foreign Relations. Stephen, good to see you. There's no right answers here, obviously, clearly. A really difficult position to be in. The problem I think the US has with their allies right now is that this is something, if the regime collapses, that all of their allies will benefit from. But none of their allies wants to have anything to do with this, which is why it's festered for years and years and years.
There's been a complete realignment of the power dynamics of global relationships, and Europe has been on the losing end of this. A real question of what it looks like on the other side, and this is really a catalyst type of moment.
Coming up on the program, we'll catch up with Dan Pickering of Pickering Energy Partners on the risk of $125 crude. Plus, Yahira, how's your morning movers? Memory stocks jumping on AI optimism. More on that in just a moment.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Back-to-back gains on the S&P 500, adding to them this morning. We're up by 0.5% on the S&P, on the Nasdaq up by 0.7. We'll get to the tech theme in just a moment with some single names. But let's turn to crude, because these gains built up yesterday, even with the crude rally extending. Brent crude 103.50, just about unchanged on the session. WTI around 95. And interestingly, yesterday, leading the pack on the S&P 500, discretionary and energy. Make sense of that. Okay, that's the stock market, that's crude. Let's turn to the bond market. 2s, 10s, and 30s. Going into the Federal Reserve decision later on this afternoon, yields backing away, retreating from the high of the year, the high range of the year, high end of the range of the year, 430, those kind of levels, up in the upper 420s over the last week, back down to about 418 going into Chairman Powell later this afternoon.
There still is a sense that there will be an open door to at least one rate cut. That's at least is what's priced into the market. There also is a reassessment. And how many people have come on this show and said, either way, buy bonds, because either the Fed's going to get this wrong and they're going to keep rates too high or even hike them, and that's going to cause a crash, buy bonds, or they're not, and the oil shock's going to be transient, and essentially it will be washed out and it will be transitory, so buy bonds. And that's essentially why you're getting this incredible bid with a 20-year auction yesterday that was incredibly strong.
We've heard that from Neuberger Berman, we've heard that from JP Morgan. On this show, we've heard it from so many others as well. As we can't get you down to the opening bell about 3 hours away, let's get those single names in that tech theme. Yahara has more. Hi, Yahara.
Hi, John. Well, we start with Alibaba. Their ADRs are up 3.6% after a string of AI headlines overnight. First, the company is consolidating its AI operations under one roof to drive faster profits. Plus, it said it is hiking prices on some of its key AI services. All of this suggesting strong demand, plus a clear path to monetization, something investors have been quick to reward since these companies, these tech names, have been spending so aggressively on AI, and investors want to see a return. Meanwhile, take a look at this board. These are some of the best performing stocks this year, and they're all higher this morning. Micron, SanDisk, Western Digital, all higher as they ride this wave of surging demand for memory chips due to AI. But the real test comes later today when Micron reports after the bell, and with the stock up nearly 60% year to date, it will be all about whether it can deliver. And we end on a mover to the downside, and that is Lululemon. Shares are down nearly 2% in the pre-market after forecasting a second straight year of profit decline. Sales also missed as shoppers reached for markdown items instead of full-priced ones, and they did not deliver the CEO announcement that many were anticipating, so still without a permanent leader. John?
Yahara, thank you. More from Yahara later on this morning. Some comments, some headlines coming from the Israeli defense minister in the last 20 minutes or so. They say this, that the Iranian intelligence minister has been killed, going on to say that the IDF is authorized to kill any senior Iranian official. And the headlines on that front keep building.
They keep building. This is another massive blow to the regime this morning. Yesterday was a huge one with the security chief, Ali Larijani, an individual that has touched almost every part of Iranian society, and now the Intel chief. Reportedly, the Iranians are saying, the Israelis are saying that they killed this individual. This was a very close ally of the former supreme leader, Khamenei.
That's the latest coming from the Israeli side this morning. On our radar this morning, the president blasting NATO allies after failing to get international support for opening the Strait of Hormuz. Trump saying the countries are making a, quote, very foolish mistake and the US doesn't need their assistance. Elsewhere, the president confirming his planned summit with China's Xi Jinping has been postponed as the Iran war stretches on.
It looks like it'll take place in about 5 weeks. I look forward to seeing President Xi. He looks forward to seeing me, I think. But I do look forward to seeing him. We have a good relationship with China.
The president did not announce a date for the meeting. And finally, Oaktree's Howard Marks saying markets are underestimating the true impacts of AI.
A company called Block, which had 10,000 employees, announced that 4,000 of them were out. 40% of the workforce gone in one day because AI could do the work cheaper and faster.
You might recognize the individual sitting alongside Howard Marks there. Bramo, how was the conversation?
It was actually fascinating. There were 3 things that I took away from it. Number one, no one at that meeting, and Howard Marks, was not talking about the war. And when I asked him offline about the war, he said, I've got nothing intelligent to say about it. And sometimes the most intelligent thing you can say is, I don't have anything intelligent to say. No one can predict anything. What everyone's asking about very much is credit markets. And what we're seeing in software, is this endemic of something else? He went to say, ultimately, it does feel pretty complacent right now, even with some of the kinks that we're seeing in private credit. He's saying, how can you game out the uncertainty of a truly revolutionary technology that people are underestimating at this point? And he went on to say he'd rather own the equity than the debt of these companies because you don't have any upside. You just get your money back if you're lending. He doesn't understand the idea of a 100-year debt to Google. He doesn't understand if you're a 40-year or 30-year debt. How can we understand what's going to happen in the next 5 years?
That's quite a statement from the legend of a credit market, right? Which is basically, I see the opportunity outside my asset class.
Not only that, but he was talking about how we haven't seen a credit cycle in a long time, and credit cycles don't die. And he was talking about incredibly frothy opportunities, spreads that look pretty historically tight. And he said he remains cautious until people start to really feel fearful. And right now is not a time of fear. And I think that that's a really important kind of reckoning and a reason why people are so uncomfortable right now with buying the dip blindly.
We've heard something similar from Apollo as well. If you want to watch the full exchange, available, of course, on Bloomberg.com and on the Bloomberg terminal. Let's turn back to energy. Crude sitting in the triple digits as the industry searches for workarounds to get crude flowing once again. The president maintaining lower oil prices are on the way.
As soon as that war is over, which will be soon, your prices are going to drop like a rock. You watch.
Dan Pickering of Pickering Energy Partners writing, if the US just stops, then Iran holds the keys to chaos by threatening future straight shutdowns. This would create a perpetual risk premium on oil prices. Dan joins us now for more. Dan, welcome to the program. Let's build on that last line. It's important. Do you think this is regime change for the price of crude?
It's certainly putting a lower floor in on crude, and it really does depend, as Anne-Marie was saying, it depends on things that are very difficult to understand and predict. And so if we end the war in Iran without some sort of definitive action that controls the Straits of Hormuz, there's going to be a higher price to crude. Is it going to be triple digits? Not necessarily, but it will certainly not go as low as it's been recently.
Dan, we've watched the dominoes fall over the past 2 weeks. As the energy couldn't move through the Strait of Hormuz, production started being cut, and now we're in a different phase. They're finding workarounds. First it was the pipeline, the East-West pipeline in Saudi Arabia. Now there's other workarounds too. What phase are we in at the moment?
Yeah, as the market tightens, everyone looks for alternatives. Sooner or later, you can't tweak around the margin, and the problem remains. 15% of global supply is offline. You draw down inventories, you try to reroute pipelines, but that's just too much oil to work around. And so at some point, and that point is months, not quarters, at some point, price is going to have to solve the supply-demand equation. And that price isn't where we're at today with WTI near 100. It's going to be 20 or 30% higher.
So what is the oil market right now pricing in, given the fact that there is a high likelihood that this conflict is going to go on for at least another couple of weeks?
Yeah, I think in a couple of weeks, I stopped looking at the front month or the near-term spot prices because those are wildly volatile and move with news flow. I look out to the 2027 and 2028 crude futures, which have moved from, call it $60 a barrel WTI up into the sort of high 60s, low 70s. That tells me that the market's decided there's $5 to $10 longer-term premium that's coming in because of potentially how this situation winds up.
There are two schools of thought, Dan. On one hand, some people say there will be a higher long-term price simply because there'll be hoarding and a premium on some of these physical goods. Other people say that if the short-term situation, if the short-term conflict does get worse, escalates and creates really high energy prices, that actually will drive prices down incredibly low on the back end of this conflict. Where do you stand on that?
Yeah, the issue of the higher it goes, the more demand destruction you have, the longer it takes to recover from that. So the higher it goes, potentially, the lower it falls. Where I stand on this is that it is all about the duration. If the straits are closed for 6 months, we're going to have $125 oil for quite a period of time. We're going to have economic issues, probably a recession. If we solve this in the next couple of weeks, we probably come back down to the 70s. Gasoline prices come back down to reasonable levels. And we're sort of back to a new normal where gasoline and oil are a little bit more expensive, but not dramatically more expensive.
Dan, what's the gap right now between the physical market and the futures market? Because I'm looking at Oman and Dubai crude, and they're $55, $60 higher than where Brent is trading.
Yeah, if you have to own the physical barrels, you are paying a significant premium over the financial markets to get them. I think the financial market's 10 times bigger than the physical market. So financial markets pricing where you can trade paper barrels, if you are trying to get a barrel in the Middle East, you're paying more. You know, same story with jet fuel and other products. So there are signs of physical supply tightness that is not being reflected in the financial markets. That has happened historically as well. So it's not unusual, but it does say that the physical market quite tight.
If we have a prolonged shut, or the Iranians continue to control and not allow most vessels to go through the Strait of Hormuz for a prolonged period of time, will the physical market, or the futures market rather, catch up to the physical market?
It'll certainly drag the financial markets higher. Right now, you're pricing out demand in isolated instances with that $150 crude in the Middle East, for instance, on the physical market. The financial market's going to move up to the same spot and pull basically prices worldwide that direction. And if that happens, then we will start to see, we will price out the 5, 10, 15 million barrels a day that we are not able to get through the straits.
Dan, what would happen if Iran turned around and said, any vessel with a Chinese flag on top can come through, no problem? Would that change things materially?
I think what we'd see a lot of Chinese flag vessels moving through the straits. And I mean, the market's efficient. It will move quickly to have China be the source of shipping through the straits. But I do think we'd see near-term prices drop. And I'm a believer that when this conflict ends, regardless of how it ends, near-term prices come down because more oil will flow. So whether it's Chinese tankers, a U.S. flotilla, protection, regime change, et cetera, however it ends, prices come down, more oil through the straits, prices come down. The question is, come down to what?
Well, Dan, this is what I'm trying to work out, though. Where's the pressure point and who holds the keys? And ultimately, it feels like the pressure point is going to be in China. It's not going to be here in the United States, and they hold the keys. They can get the Iranians to come around. Now, am I reading it wrong? Are other people reading it wrong? Is there a path there to reopen things?
Yeah, so China and India both approached Iran and said, let us take tankers through the straits. That's another gambit in the strategy. The question is, how long does that last, or does the U.S. allow that? Ultimately, are you going to feel comfortable with Iran in charge of the straits and allowing some vessels to come through, but not all? Do we wind up with this uncertainty premium that creeps into the market, even if barrels do start to flow to Asia?
Dan, it's good to see you. Thank you, sir. Dan Pickering there of Pickering Energy Partners. I think there was a hope going into the weekend and initially coming out the other side of the weekend that was the direction of travel. I'm not sure if that's misplaced hope or not.
To your point, Regardless of the political backdrop and what ultimately happens in terms of who controls the strait, in the near term, if Chinese barrels can get through in a real way, that could lower the prices and then allow this conflict to continue at the level that it is without necessarily disrupting the oil trade on a mass level. I mean, this is sort of one question that people have as people try to look through this as much as they possibly can in markets.
The only other issue, of course, is that it's not just Iran. Oman and the UAE are also bordering the Strait of Hormuz. And the UAE certainly doesn't want this to become Iran decides who goes through and who doesn't. And Dr. Anwar Gargash spoke to Ethan Brahmer, our Israeli bureau chief at the Council on Foreign Relations, as he said the UAE may be willing and wants other nations to join this coalition because they want this to remain an international body of water. They do not see a future where Iran decides who gets to go ahead and who doesn't.
Multi-dimensional geopolitical chess right now in the Middle East. Let's get you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump abandoning his efforts to recruit partners for the war in Iran. The president criticizing NATO allies for their lack of military support to reopen the Strait of Hormuz. Most countries showed little willingness to join the mission, which military analysts say would be risky without a ceasefire. The Pentagon is working to develop alternatives to Anthropic's AI tools. A senior U.S. defense official telling Bloomberg the move comes after the Trump administration's decision to declare the company a supply chain risk in a feud over safeguards governing military use of the technology. And Boeing signaling that several performance issues will weigh on its first quarter results. The plane maker saying it's delivered fewer wide-body aircraft than planned. It also said wiring defects on the 737 MAX are a headwind for this year. Boeing is now pushing back by a year its goal of generating positive margins at its key commercial plane unit. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. Up next on the program, facing new risks.
There's downside risks around labor, but then you also have to acknowledge that there's some upside price risk. So it makes it very difficult for the Fed. It's a little too soon for them to really come down on one side or the other.
Up next, Neil Dutta of Renmac, live from New York City. You're watching Bloomberg TV.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Could be a long day in financial markets, and that news conference later on could be an absolute snooze with Chairman Powell. I can tell you, journalists will do their best to make it interesting. He has got one mission, one goal, to make this very boring later on this afternoon.
Journalists, meaning us, we're going to be right here trying to listen to any kind of clues. He's going to be trying to be boring at a time when this market is anything but, this economy is anything but. And it's a real difficult thing because on one hand, people are looking for a policy response, and the Fed is ultimately going to tell us we don't have one for you. Ultimately, we cannot be the person who steps in and provides any comfort. So it has to come from the White House. It has to come from conflicts. And right now, people can't price that in, so they're just ignoring it.
Just to clarify, our show is going to be great.
Of course.
The news conference is going to be boring.
We're
And the journalists in the news conference will try and make it interesting.
You know, John and Tom are going to be doing a duo, a tap dancing duo. You should stick in. It's going to be to the Fed dot pattern, and it's going to be absolutely
Stop
wonderful.
pretending TK watches the news conference.
What does he do during that? Does he go out for like a drink or something?
TK is somewhere else. Right now, equity futures on the S&P firmer by about 0.5%, on the Nasdaq up by 0.6%. Under surveillance this morning, facing new risks.
There's downside risks around labor, but then you also have to acknowledge that there's some upside price risk. So it makes it very difficult for the Fed. It's a little too soon for them to really come down on one side or the other. That's one way they can kind of communicate almost a little bit of a dovish bias, because they're saying, yes, there are some, more upside inflation risk, but we're not really taking away the cut that we have in later this year.
Here's the latest this morning. The Federal Reserve set to deliver a rate decision and new set of projections while facing triple-digit crude prices. Neil Dutta of Renmac writing, we're on track for 3 poor core inflation prints in a row ahead of a shock to oil markets. I think it's more likely that a cut is erased altogether. Neil joins us now for more. Neil, welcome. Was looking forward to this. So let's go from the top. 2 p.m. Eastern Time, projections drop. What changes?
Well, I mean, I don't think that the Fed will be as dovish as they have been if you judge it based on the summary of economic projections. I mean, if you just think about this in terms of mark to market and you're a forecaster, it's more obvious that they need to revise up their core inflation forecast. I mean, core PCE is basically tracking above 3% as of this meeting, and they expect it to go to 2.5% by the end of the year. In order to hit that bogey, you basically need core inflation prints, I think around 0.2% for the rest of the year. That's a pretty tall order, all things considered. I mean, we haven't even seen the flow through of energy into core inflation, and some of that will bleed in, not a lot, but that's going to happen. And so, if you're looking at this objectively, I think you just have to say it's much more likely that they'll be revising up core PCE inflation. It could be as much as 0.3%. Then revising up the unemployment rate estimate, which basically stays at 4.4%. So you put that into a simple Taylor rule model, John, and I think 30 basis points higher on core inflation, that's probably good for enough of them to take a rate cut off the table.
Neil, you've been pounding the table about the labor market and saying that it is much weaker than people are currently giving it credit for or lacking the credit of. I'm just wondering, what do you think the consequence of a Fed remaining on hold is for the economy?
Well, it's not good. It's not good. I mean, it reinforces the downside risk to the job market. Ultimately, if the unemployment rate is going up and the Fed isn't easing providing some kind of shock absorber to that, it just reinforces the upside risk to the unemployment rate.
Do you think that it increases chance of recession this year, which ultimately no one is really pricing in?
Yeah, I mean, I think that the risk of recession is higher than the markets believe. Of course, I've said that for some time now. But look, at the end of the day, the economy is not in the same place it was in 2022, which is why drawing parallels to that period, I think, are misplaced. I mean, back then, the labor markets were strong, real incomes were rising. Today, that's not the case. Real incomes net of transfers are running basically 0.5% over the last year, and that was true even before this latest inflation shock. Of course, back then, we had a massive pile of excess savings that consumers were able to draw down. Again, that's not the case today. The savings rate, if anything, has already been drawn down. I mean, that's one of the reasons why consumer spending has been as strong as it has been over the last 12 months or so. And even then, consumption has been slowing despite that drawdown in savings. So I think that the consumer here is on not as strong footing as was the case a few years ago. And it's encouraging to see oil prices moderate somewhat today, but ultimately we're on a glide path nationally to $4 a gallon gasoline. I mean, that's likely to happen at some point in the next week or two. So that provides some sticker shock, I think, to consumers. And one thing we're not talking about? We're not talking about tax refunds anymore. So a lot of the enthusiasm that people had going into the year, I think, has been effectively neutered as a result of this.
Well, Neil, in some states, we're already above 4. In the president's own Florida, we're at $3.93 when it comes to a gallon of gasoline. You said going into the weekend, the 2 core pillars of Trumponomics are rising equity prices and low energy prices. Are we at risk of losing both of these at this moment?
Well, I mean, I think we're losing for households, of course, the main issue is that, even though America is a large energy producer now, the money doesn't recycle back into the economy quickly. So consumers will spend less than oil producers will spend more, at least in the short run. So I think that's something that people need to think about here is that, the sort of the elasticity of the spending. It's not like oil producers are going to take their newfound income windfall and go out and spend in a bunch of mining rigs. I mean, in fact, to the extent that people are saying this is going to be transitory, they may be less inclined to do that. So I think the growth shock is actually that much more material, at least up front. But with respect to equities, look, equities are hanging in there. I mean, there's some, there was probably some anxiety before all this. So even if you get a quick resolution to this, I mean, I don't think we're sort of like raging back to new highs. But for now, I mean, the stock market is, for lack of a better phrase, trusting in Trump.
Neil Dutta, it's good to see you, sir. Neil Dutta there of Renmac on the trust in the president right now in this equity market. An equity market is still very, very close to all-time highs. Coming into this year, we're going over old ground here, I know, but we were set up quite nicely. Lots of tailwinds coming into the new year. Reasons for consumer confidence to inflect, to bounce, to pick up a little bit coming into 2026, into spring selling season in the housing market with mortgage rates coming down. Now anxiety starts to build for different reasons, and you wonder to what extent this move in crude does upend the year ahead.
And the reason why people aren't necessarily leaning into the idea of this being totally disruptive is because they've seen this movie before. Remember Liberation Day in April? Oh, the world is falling. Oh, wait, it's not. It's actually an incredible buying opportunity. And there's so many people seeing more parallels with that than, say, a 1970s type of scenario.
Conditioned to buy.
Yes.
Equity futures right now up by 0.4% on the S&P in the next hour. Priya Misra of JP Morgan, Seth Jones of CSIS, Jeff Curry of Carlyle, and Brad Rugoff of Barclays from New York City. You're watching Bloomberg TV.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
You don't think the court was hurt by the perception that it was political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of Power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Trying to forecast the path of this Middle East conflict is incredibly difficult.
Investors still have risk appetite. If you're selling equities today, there's a real chance you could get whipsawed.
Trying to gauge what the trigger points will be is very difficult.
We don't have a lens on when this is going to end. Nobody does.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. The price action of scores look like this. Equity futures on the S&P holding high, holding steady, up by 0.4% on the S&P 500. On the NASDAQ, up by 0.6%, adding to back-to-back gains on the S&P 500 in the previous 2 sessions. In the commodity market right now, Brent, WTI look like this. 103.84 on Brent. 4 consecutive sessions north of 100 for Brent crude. Can we make it day 5 up by 0.4%? Heading into this event later on this afternoon, a Fed decision, a statement, projections, and news conference with Chairman Powell at 2:30 Eastern Time.
Here's my proposal. I think that they should have a dartboard. They should have some darts. They should have some potential targets for inflation and growth, and they should just play a game because ultimately they don't have any edge on what is unknowable right now. They haven't spoken since the war in Iran really did pick up, so they can't really comment necessarily. They haven't been commenting on oil prices, a sense that we won't get back to lower pricing in oil unless there is a ceasefire. And frankly, Jay Powell is not going to be answering questions on when the ceasefire is going to happen. In fact, he's not even going to be answering questions about his own future.
So the news conference is always, to me at least, about emphasis. Where is the emphasis going to be? Does he place more emphasis on the labour market data recently? That labour report was ridiculously soft. Or does he put more emphasis on the inflation risk that's on the horizon? One or the other right now is going to indicate to this market where the committee's leaning at the moment.
If he came out and he said history typically hasn't been kind to central banks that raised rates into an oil price shock, this market would say hallelujah, and it would rally tremendously. If he comes out and he says CPI, core PCE, has been above target and is inflecting in the wrong direction, we are very concerned. This oil price shock only adds to those concerns. It does raise the prospect of two-sided risks, either a rate cut or a rate hike. This market will freak out, and that is ultimately what you are dealing with later today.
This market's not freaking out right now. 103.80 on Brent crude, around 95 on WTI. The focus on the pressure points in the Middle East and the release valves. We've talked a lot about these pipelines and some of the shipping that is making its way through the Strait of Hormuz. It's just little headline after headline continuing to build.
It's certain individuals, and as you've been rightly talking about, it's certain vessels that have certain flags, Chinese flags. Obviously, Iranian crude is being let through. Some Indian vessels are being let through. Some Pakistani vessels are being let through. Maybe 1 or 2 Turkish vessels being let through. But it's small, and it's not enough to impact the price of oil right now in terms of trying to depress where the price is right now. Until the Strait is fully opened and not controlled by the Iranians, we will not have that release valve. And what the Iranians are saying right now, the foreign minister gave an interview last night and says, we need a new protocol for the Strait of Hormuz. We are not seeking a ceasefire. The head of the Speaker of the Parliament said yesterday we are not going back to normal when it comes to the Strait. And this is why you see the administration and the Israelis continue to attack their military targets.
And why crude is still around, triple digits. Big hour coming up. Coming up on the programme, we'll catch up with Priya Misra of JP Morgan as equities bounce, Jeff Curry of Carlyle on the real cost of the Hormuz shock, and Brad Rogoff of Barclays as Wall Street eyes a Fed rate decision later on this afternoon. We begin this hour with stocks chasing a third day of gains. Priya Misra of JP Morgan writing overall markets are pricing in 2 assumptions. The shock to energy will be short-lived and underlying economic fundamentals are solid. Priya joins us now for more. Priya, good morning.
Morning.
Are those 2 assumptions misplaced?
I think they're a risk. They're both a risk here. We don't know the off-ramp. We don't know the end point. So around the energy price shock, I think that's a big question that the market's hoping that this is short-lived, that the end point is actually, $50, $60 oil prices. And then the underlying fundamentals. I would still highlight, you talked about the last payroll report. That was weak. Now, the previous one was strong. So what I'm hoping to get from Chair Powell is not his view on the off-ramp or the end point, or forecasts around the war or the economy. We really don't know. It's about the reaction function. How is he going to respond to a slow rise in the unemployment rate if inflation remains sticky, which it's been sticky? I think the market's pricing in more of this inflation shock. There's a growth shock that's coming at a time when the consumer is fairly vulnerable and the labor market's very vulnerable. I mean, in terms of hiring, the hiring numbers are weak, and I'm not really seeing signs of that picking up. So I think that what we're looking for is that reaction function. I think he's going to want to come out of this press conference without any movement. I think the forecasts are not going to move a whole lot either. They have to mark to market the inflation numbers. They probably have to mark to market the growth numbers lower and the labor market, or the unemployment rate slightly higher. So this divided Fed is going to look even more divided because, the dual mandate is sort of pulling them in different directions. So I think he's just going to say data dependent, I think he's going to acknowledge the war, but say that they sort of remain uncertain.
This isn't Operation Epic Fury, it's Operation Make It Boring for Chairman Powell later this afternoon.
I think so, yes. And I think he's going to be asked about his future. I don't think we're going to get much from that. I think he's going to say the Fed remains singularly focused on their dual mandate. They'll respond as the data comes out. But I think history has suggested, there was an excellent sort of Bernanke paper done in '97 that talked about why do oil price shocks result in recessions? It's because the central banks hike. I don't know if he's going to highlight it. I hear your discussion earlier. I think if he's going to highlight it, inflation expectations might start to rise. But I think if we get a sense from them, what are they looking for? I mean, we know headline inflation is going to be higher. What is the pass-through into core inflation? What's the pass-through into wages, inflation expectations? If he highlights that, that's the reaction function, reading between the lines that I'll be watching for, to get a sense that this Fed is not going to be driven by the Taylor rule. They're going to look at the fact that, what's driving underlying inflation higher. And our sense is underlying inflation. We look at service inflation, look at shelter, look at wages. We're not seeing signs that that is reaccelerating. So I think the Fed should be able to look through it. I don't think we'll get a very clear read from them that they're looking through the oil price shock. But let's see what does he highlight as what the Fed is looking for as they figure out if they can look through this oil price shock.
There's a new Fed chair right now that we're seeing in the market, and it is the 10-year bond yield. And what we're seeing is the 10-year bond yield is saying ultimately, either way, inflation is going to come lower. And the question is just how much lower in the long term as a result of this oil price shock. You've been talking about how you're starting to find duration somewhat attractive. Do you think that 10-year yields, Fed chair 10-year, is going to ultimately express even lower inflation in the weeks ahead?
So I think the bond market is an extremely important, there's a put from the president, and I think the Fed will look at, so I don't know if it's Fed chair 10-year rate. I like that analogy. I think it's a very important indicator of financial conditions. To your point on the 10-year, I think the bond market really looked at this and said, this is an inflation shock. The growth shock is sort of missed, I think, because the bond market thinks this is short-lived. I do struggle if it's that short-lived. Is it as much of an inflation shock? So I think the bond market just focused on that spot price of oil. That's going up. That's inflationary. Look at the fact that we're at 3% core PCE, and that's why I think rates rose. In my view, the starting point suggested that people were long duration. Duration's been working as a hedge to risk assets now for the last 6 months. And so I think people were just long. They were long in Europe. They were long in the UK. They were long in the US. They had these relative value trades. I think what we've seen is an unwind of that. The collateral damage of, the VAR shock has been people have sold treasuries. It's also the most liquid asset that you can sell, if you're trying to just raise cash. Now I think value has been created in the bond market where we've priced out a lot of the cuts this year. I do think if the Fed starts to cut later because they're concerned about inflation, they're concerned about that second order pass through into core inflation, they'll have to cut more. The earlier they can start, I think they end up doing less. If they are starting to cut rates later this year to respond to the rise in the unemployment rate, they might be cutting more. So I think, yes, I think the curve is tricky because it depends on when they start to cut rates. But owning the 5-year, that's only pricing in 40 basis points of rate cuts. I think it provides you protection for that growth shock, as well as if we get any sort of credit concerns. That's also lingering AI disruption to the labor market. That's there at the back of our mind. I know we have PTSD from 2022 and we're seeing an oil price shock. But I think if those issues come back to the forefront, I think duration will be your friend.
Is it a time to buy duration, to buy long-term bonds, and to sell riskier credit simply because there's risks that are percolating? We saw yesterday a software company failed to be able to raise money in the debt markets, in the bond and loan markets, because frankly, people just were not interested in them. How much do you see this really starting to break in terms of some sort of credit cycle?
I love that you bring up the credit market because I think that's so important to sort of keep risk assets where they are as well. I think it is going to come down to the balance sheet. I mean, you talk about the software company, and then we look at Amazon that was able to issue a large amount at barely any concessions. So I think the market is becoming discerning. We're seeing dispersion within the high yield market, within the investment grade market pick up. I think people are looking at the borrower. They're looking at the underwriting standards. They're looking at how liquid, how quickly, if I want to get out, will it be easy to get out? At the same time as there are these massive structural changes to business models. So, I think, you talk about riskier credit. Yes, I think risk premiums should be higher, particularly if you're in a business model that might be challenged with AI. You might want to be paid more for it or try and understand who the winners and losers there will be. But for high quality credit, we still see value. In fact, some value has been created there. Those spreads have not widened as much, but look at the balance sheet of a lot of those companies. So we like owning credit and we like owning duration because what if the economy, the consumer that's been so resilient through high interest rates, now, there's high oil prices. If the consumer starts to break, I think duration will give you that hedge to those, risks. Even if you have less risk, you do have credit risk as, it's giving you income. I think that's why we're seeing inflows into fixed income, into bond funds. Higher quality credit, I think, where you have good balance sheets and good underwriting, I think there's still value there, but just own that hedge.
Priya, back to the Fed this afternoon. Do you think Powell's actually a lame duck at this meeting?
I don't think so, no. He's still in charge. I think the committee has been rallying behind him.
Do you think it's his second to last meeting?
It is likely. I mean, that's a tough one.
That's what I'm really getting at.
We don't know. I know. I was trying not to answer that question. I mean, let's hope that there is, some resolution with the DOJ and the fact that, Senator Tillis actually gets a new Fed chair. But I think the committee, there may be dissents. I do think there'll be a few dissents. And it is a divided committee. And I think Chair Powell's done an excellent job of giving the view of the committee, allowing dissents when there's the economic situation right now. I can totally see where the dissents are coming from. I don't think this is a political Fed at all. They're just dealing, like all of us, with lots of unknowns, and they're trying to do the best thing that they can. So, no, I think, and if he's still the Fed chair or not the Fed chair, I think this Fed will continue to just focus on the dual mandate.
Excellent job of not answering the question, Priya. It's good to see you. A professional as always. Priya Misra there of JP Morgan. Nobody knows the answer to that question right now.
Maybe even Jay Powell. Ultimately, we will have to see exactly how these things transpire. We don't even know if we're going to have a replacement to him as Fed chair come later this year. So a lot of questions still.
Things can get messy in a few months' time. Let's give you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump is abandoning his efforts to recruit global partners for the war in Iran. The president's criticizing NATO allies for the lack of military support to reopen the Strait of Hormuz. Most countries showed little willingness to join the mission, which military analysts say would be risky without a ceasefire. Meanwhile, Oaktree co-founder Howard Marks saying AI is making the world more unpredictable than ever before. Marks spoke to our own Lisa Abramowitz at the Capital Markets Industry Conference in New York.
Well, I think most people are underestimating the impact of AI. Roughly 18 days ago, on a Friday, that a company called Block, which had 10,000 employees, announced that 4,000 of them were out. 40% of the workforce gone in one day because AI could do the work cheaper and faster.
Marks adding investors are probably better off buying shares of an AI-focused company rather than lending it money. And we are seeing shares of the retailer Macy's up nearly 7% in the pre-market. The department store chain reporting fourth quarter results that beat Wall Street estimates. As for the forecast, its comparable sales and profit came in below expectations, with Macy's saying its guidance is, quote, prudent because of macroeconomic and geopolitical factors. That's your Bloomberg brief, John.
Yahara, thank you. Get set to hear more of that in about a month's time, when a company sees something they don't like.
Yeah.
Geopolitical factors.
100%. And frankly, a lot of people might give them a pass. Although, do they have to offset it with the strength that we saw from Delta and from American in order to get a pass from this market?
Got the weather in January, February. Got the geopolitical factors. Just like all lined up there, ready for a CEO to talk about on the call.
I feel like there should be buttons. Currency differentials, weather, geopolitics.
We didn't execute well this quarter. What have we got? We've got the weather.
It's a menu.
It should be a roulette wheel.
Ulta Beauty?
When the currency's going against them, we've got the currency.
I mean, lip gloss? Really?
Right, come on.
Wind.
Right. Up next on the program, claiming the upper hand in Iran.
We did a little excursion, and we're way ahead of schedule. We knocked out their Navy, their Air Force, their anti-aircraft equipment, their radar, and their leaders.
Up next, we'll catch up with Seth Jones of CSIS from New York City this morning. Good morning.
Is about to start.
And you're already looking for that edge.
The Opening Trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your Opening Trade.
Only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the Opening Trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
It is Fed decision day. That decision later on this afternoon. Heading into that, the scores look like this. Equity futures on the S&P positive by 0.5, on the Nasdaq up by 0.6. Equities doing okay, back-to-back gains and adding to them so far this morning. In the commodity market, Brent and WTI. Brent crude north of 100 once again, 103.65, and up by just 0.2% so far this morning. And the Savannah's this morning claiming the upper hand in Iran.
We did a little excursion, and we're way ahead of schedule, as you probably noticed. And we've had, we knocked out their Navy, their Air Force, their anti-aircraft equipment, their radar, and their leaders. It's been amazing militarily, but it's something that had to be done.
And the hits keep on coming. Here's the latest this morning. Israel claiming the elimination of another top Iranian official. The U.S. ramping up efforts to reopen the Strait of Hormuz, dropping 5,000-pound bunker busters on Iranian missile sites. Bloomberg's Tyler Kendall joins us now for more. Hey, Tyler.
Hey, John, good morning. Well, there's no sign that there is a let-up in the conflict, as President Trump yesterday confirmed that the U.S. has hit more than 7,000 Iranian military targets. And now this White House is threatening to expand that list of targets to energy infrastructure if disruptions in the Strait of Hormuz continue. President Trump yesterday reiterated his threat that oil depots on Karg Island could soon be hit after the U.S. went after military targets on the export hub Friday, but spared its energy infrastructure. Just for context here, Karg Island ships out about 9 of every 10 barrels of Iranian crude, but imagery analyzed by Bloomberg News shows that for the most part, those loadings for the moment have continued unabated. This as President Trump appears to abandon his call for allies to help to secure the Strait of Hormuz after many were weary of his demands to send naval escorts. Now, on Iran's end, we've also seen this escalation as they continue to go after energy infrastructure. Earlier this week, setting ablaze an oil gas field in the UAE and continuing strikes on regional countries, including Saudi Arabia and Kuwait overnight. Plus, we should keep on the radar that Israel is now upping its offensive in Lebanon as it goes after the Iranian-backed Hezbollah militant group. John, amid all of this escalation, President Trump yesterday still maintained that we could see an end to this conflict in what he called the, quote, very near future, but also went on to say that at the moment, he's not ready to let up operations quite yet.
Tyler Kendall with the latest outside the White House. Tyler, thank you. Seth Jones of CSIS with this to say, writing, the brutal truth is that while the U.S. military may succeed in degrading Iranian capabilities, it has dug itself a large hole in responding to other global conflicts. Seth joins us now for more. Seth, good morning.
Good morning.
Where and how is this making the U.S. more vulnerable?
Well, I think the reality, as the U.S.'s own national defense strategy and national security strategy note, that the U.S. priorities are elsewhere in the world. China in particular, but also the U.S. notes Latin America. There's an ongoing war in Ukraine with the Russians right now. And the U.S. is already running low. It was already low before this war started on key stockpiles of both offensive long-range munitions, like the JASSM and the Tomahawk, and also on defensive munitions for Patriot and THAAD. So as those stockpiles run low, there's a big question with the Chinese pretty active in the Taiwan Straits and the South China Sea, how much the U.S. is going to have left in its bins for the future.
Lots of reporting, too, as well, that China is keenly focused on this to understand how the U.S. military works. What are they learning from our offensive right now in the Gulf?
Well, I think they are seeing, to be clear, they are seeing a U.S. and an Israeli military that are superb at precision strike. They are also superb at air defense. I mean, we are shooting down a large number of Iranian drones, cruise missiles, ballistic missiles. We're also striking with precision, the leadership, command and control bases. But you also see the limitations of the U.S. military, its stockpiles of munitions, and you also see the asymmetric challenges that the U.S. faced in Iraq and Afghanistan. We're seeing now in the Strait of Hormuz, which is the threat of mines. It's not a big conventional force that the Iranians have, but it's those asymmetric challenges that do pose a threat.
You touched on it when you're talking about the Chinese vessels that are in the Taiwan Strait. Would this be an opportune time for Xi Jinping to do something when it comes to Taiwan? I
mean, it's possible. Anything's possible. The big challenge for the Chinese at this very moment is they have obliterated their leadership. Within the last 2 to 3 years, they've gotten rid of over 100 senior PLA, People's Liberation Army officials, including of their top committee, the CMC. So the Chinese are not really in a position from all levels, the strategic down to the tactical level, operators, to make a move at this point. But we do see them. I was up in an aircraft, U.S. Navy P-8 in the South China Sea last year. The Chinese are everywhere. They are conducting exercises on a regular basis around the Taiwan Strait to simulate a blockade. So they're certainly thinking about it. That I don't think now is the ideal time for them just because of what they've done.
There's a question about just the munitions and what type of resources the United States has. There's also a question of alliances and where they lie. How do you see them really shifting in the wake of and perhaps accelerated by this war in Iran?
So, I mean, on the alliance structure, I've talked to a couple of senior European defense officials, including Minister of Defense the other day of one of the U.S.'s NATO allies. I think the challenge there, they were never briefed on this war to begin with. They were asked, once the U.S. struggled along those lines, to come in. The same was true with U.S. allies in Japan, South Korea, Australia, all of which have been hesitant to jump into the war that the U.S. and Israel started. So I think the U.S. position with some of these allies has been very transactional recently, and I think at some point there has to be an effort to bring them more closely together. But they are very concerned, the ones in Asia, about the growth of the Chinese, and the ones in Europe very concerned about the Russian military.
Seth, just to finish on China, have we, the U.S., learned anything about Chinese capabilities in places like Iran, in places like Venezuela, and deficiencies specifically?
I mean, on the Chinese side, the reality is the Chinese have not fought a war since the 1970s, and they weren't particularly effective. But what they have done is they've provided components to the Russians in the war in Ukraine. They've also provided components and various types of assistance, including intelligence, to the Iranians, not just now, but over the last several years, including to some of Iran's partner forces, including the Houthis in Yemen. So they've also put contractors and intelligence officials on the ground to learn how to conduct these kinds of wars. So they are taking notes.
How flawed is that experience, though, given how clean the operation was in a place like Venezuela? We've heard all things like they've got the defense systems that were sold to them by the Chinese, and ultimately none of it stood up against U.S. capability.
Yeah, I mean, it really shows in some ways, actually, and I know there have been some comments last year about the expense of, say, the F-35 stealth aircraft, which is in the billions of dollars. But the benefit of a fifth-generation stealth aircraft that Lockheed Martin makes is that it's hard for radar to see it. So one of the things I think that even those Chinese and Russian air defense systems are finding out is that a fifth generation, and the U.S. is now working on a sixth generation aircraft, they are tough to see.
Seth, it's good to see you. Thanks for breaking it down. Some real knowledge there. Seth Jones there of CSIS on the on-the-ground operation that we're seeing turn out day after day.
And when it comes to those stealth fighter jets, there are reports that they're actually flying very close or even in Iranian airspace right now, and there's really nothing the regime can do.
Up next on the program, we'll catch up with Jeff Curry of Carlyle on the forces reshaping the energy market. Plus, Yahara has some morning movers. AI optimism pushing memory stocks even higher. That rally makes a comeback. From New York, you're watching Bloomberg TV.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Stocks just retreating from session highs, still positive, but pulling back just a little bit in the last few minutes. We're positive by 0.25% on the S&P, on the Nasdaq, up by 0.4. This crossing just moments ago from Iranian state TV that part of the South Pars gas field has been attacked. This is from Iranian state TV. Part of the South Pars gas field has been attacked. If you're not familiar with that, it's a very large gas field offshore in the Persian Gulf, and a notable strike, if that's the case. That headline crossing just moments ago.
So a lot of questions about this strike. Has this come from the United States? Has this come from Israel? But as you mentioned, in terms of energy production, this is a massive offshore natural gas field. So there's going to be a lot of questions right now, and individuals, and you can already see gas futures in Europe spiking on the news. There's going to be a lot of individuals that will want to know exactly the damage that was done to this offshore field.
And who did the damage? Because initially, so far, there's been limited damage to infrastructure in the Middle East, to energy infrastructure specifically, damaged by the US or by Israel. There have been some exceptions, but limited so far. That would be a severe escalation if that was intentional and from their side.
And particularly for this gas field, given the fact that it's shared between Iran and Qatar accounts for about a quarter or more than that of the world's liquefied natural gas. It's the reason why there is a response in European markets. If that becomes fair game, how much of the world's supplies are suddenly put in the firing line?
We'll keep tracking that headline for you. It comes from state TV. Iran saying that part of the South Pars gas field has been attacked. Equities pulling back just a little bit on the S&P 500. Let's get you some single names. A few hours away from the opening bell. Yahira has more. Hey, Yahira.
Hi, John. Earnings are in for Macy's, and it was a bit of a mixed report, but as you can see, investors choosing to focus on the good with shares up 8.7% in the pre-market. It was a beat on comparable sales and profit in the last quarter, but Macy's struck a cautious tone when it came to the guidance, calling its outlook prudent, citing both macro and geopolitical risks to spending. Meanwhile, we are seeing Applied Optoelectronics, Lumentum Holdings all soaring in the pre-market, saying demand momentum is growing at an industry conference. But if you're wondering what these companies do, well, they make the components that move data between AI servers, and they've been on a bit of a wild ride recently. That's because NVIDIA CEO Jensen Huang at the GTC conference made some comments on optical connections, saying that it won't go all in on that. Instead, it will continue to also use copper. So that just raising questions over how much demand can really scale. But these companies having a good day this morning. And we end on shares of microchip stocks. These are the best performing stocks this year. Micron up 2% in the pre-market as they ride a wave of surging demand for their memory chip products. But now comes the real test with Micron reporting after the bell, and with that stock up nearly 60% year to date, it will be all about whether it can deliver. John?
Yahira, thank you. Thanks for the update. More from Yahira later this hour. On our radar this morning, Iran launching more missile attacks overnight, targeting the UAE, Saudi Arabia, Kuwait, and Tel Aviv. Tehran vowing revenge following the assassination of their security chief. Elsewhere, the Pentagon planning to mass-produce one-way Lucas attack drones. The drones were created by reverse engineering Iran's cheap and deadly Shahed system and are being used in the war in the Middle East. And finally, Japanese Prime Minister Tanae Takaichi saying she's facing a, quote, extremely difficult summit with President Trump tomorrow. The statement coming after Tokyo's refusal to send warships to Hormuz. Takaichi citing Japan's pacifist constitution.
Yeah, and part of the issue that Takaichi is presenting is the lack of capabilities that they have to really support U.S. troops, which is something that NATO allies have highlighted as well. She said, I intend to convey these points clearly, and I'm sure the U.S. side understands these laws in terms of the pacifist laws. Given our history, either way, it highlights how difficult it is for international leaders to come to the White House and have any kind of discussion with President Trump, given some of the domestic pressure that they are all facing.
Two things I imagine the White House is going to bring up. After World War II, and obviously Japan has this pacifist regime in place, they did send minesweepers to the Middle East after Operation Desert Storm, and in 1991, when the U.S. wrapped up the Gulf War. That's the first point I think the White House will say, well, can't you just send a minesweeper? The second point, I imagine this president, because he's insinuated in the last few days, is going to go through all the countries that refuse to help the United States right now. How many U.S. men and women are stationed in those countries right now as a force of deterrence? Japan has some 55,000 and counting U.S. service members, and I imagine that's going to come up in the meeting.
And they are very exposed to what's happening in the Middle East, given how exposed they are on the energy side. Jeff Curry of Carlyle writing this: the cost of rebuilding and recovering from the Hormuz shock will be enormous and underscores the regime change towards physical assets. Jeff joins us now for more. Jeff, welcome to the program. It's always good to catch up with you, sir. Fluid environment, so allow me to go through the headline of the last 5 or 10 minutes or so. One headline, one report coming from Iran that their energy assets have been struck. Now, I have limited information beyond that, but Jeff, from your standpoint, in the week since we last spoke, has this got worse or better?
Worse. I like to call it molecular contagion. You know, last week we were talking about shortages in Singapore. You know, prices of jet fuel spiked to $230 a barrel. This week, you know, it's in Rotterdam. Rotterdam's $220 a barrel. Thailand, Philippines, New Zealand, Australia. So this thing's going intercontinental. And then, you know, so you look at Singapore, Rotterdam, the spread, there's no more price spread, there's no more spare barrels, there's no policy fix, and it's just physics at this point. And I want to emphasize, these are physical supply chains, and that the idea of around financialization and the ability to print money doesn't apply here. And I think the title of that piece says it all. You can't print molecules.
Jeff, with that in mind, where and how do you think we're underpricing this risk still in financial markets?
That's the peculiar thing about this, is that you look at the paper markets, they've entirely disconnected from the physical markets. Crude oil on an Oman basis, you know, on the other side of the strait, the side that's free, spiked to $173 a barrel yesterday. Crude delivered in Asia is a blend of Dubai and Oman, which is trading somewhere around 130 and 170. And today, this morning, they're call it 120 to 150. So you're delivering crude into Asia at somewhere around $130 a barrel. Product prices are spiraling above $200 a barrel. So the disconnect is between the paper market, which is sitting around 100, and the physical market, which is showing a very different environment.
Jeff, some people have speculated that's because of certain types of manipulation in the futures market, and that's the reason why you have seen this gap blow out. Do you think there's credence to that?
You know, you could argue that Monday last week, you know, there was a mysterious 11 million barrel seller. I don't want to get into that. It's not enough to really change the dynamic. I think that the bigger factor that was likely driving WTI and Brent and staying lower is the price of Urals, Russian crude oil. It's rallied $65, $70 a barrel once they took off the sanctions. So WTI and Brent were the high-cost barrels. The Russian was the cheap. What happened? You closed that gap. And now that you've closed that gap, you don't have any more spare barrels in the system, and this rest of the complex likely to start to rally. You know, I go back to the point that, you know, John started with is, you know, we're dealing with an enormous supply shock. By the way, the supply shock is almost equal to the demand shock during COVID. And we know what that did to global supply chains. So I think, you know, at $100 a barrel, this thing's mispriced, even against the physical market.
There is a sense, though, that this time is a bit different than, say, the 1970s in terms of the world's reliance on oil, especially China, how much they've diversified to electric vehicles, to nuclear energy, and other places as well. How much do you think that that is going to be the growing trend, to diversify the sources of energy in myriad ways beyond what we were doing, even during the so-called Green Revolution, as people try to avoid these types of shocks?
Well, I absolutely argue that, you know, the renewables, nuclear power, are born out of the 1973 energy crisis, and this is going to unleash an enormous amount of investment into renewables, nuclear power, and other localized energy sources. The problem, though, is we call this the new dual order. The problem is that we haven't got to that transition where we have electrified everything, localized it, and the type of oil consumption that's left in the global economy is critical. And so if you pull those barrels out of the system, the rippling effect or the cascading effect through global supply chains is going to be significant. You go from gas to urea, urea to fertilizers, fertilizers to the dinner table. Or you go from LPGs to synthetic fibers to cotton. You switch out of soybeans and corn into cotton. By the way, I think the best sector to try to get value in right now would be agriculture, because it hasn't priced it in.
Jeff, when it comes to barrels coming off the market, this came from an industry consultant in terms of China. They're looking at potentially a drawdown in commercial and operational stockpiles amounting to as much as 1 million barrels a day. That can happen over the next 4 to 6 weeks. What would that mean for the price of crude?
I think the key point is once you exhaust those inventories, there's nothing left. Think about it this way. You have demand up here, supply down here. Once those inventories are exhausted, boom, you have to bring demand down in line with supply. And to do that, you're going to need prices far higher than where we are right now. I like to do the mirror image of COVID. Let's go back to COVID. It was the exact opposite. You had a situation which you had demand up here and, or excuse the other way, you had supply up here and demand down here. And so what happened? The demand collapsed. Eventually you filled all the inventory capacity in the world and you had to bring supply down and demand immediately. What did that require? A minus $37 a barrel price to create that rebalancing of supply and demand. Now we have the exact opposite environment. So just imagine what it's going to do to require that reduction in demand to bring it in line with supply if it took a minus $37 price to create that rebalancing back in 2020.
So, Jeff, I'm going to ask you the question. What would it take? What's the opposite?
I'm going to stick to the same answer I gave you last week. You get long, buckle your seatbelt, and hang on for the ride. We'll know when we start to get to that point where the system starts rebalancing. But I want to emphasize, don't underestimate the type of volatility. If you take European gas in 2022, we saw Russia cut it. And by the way, the market ignored it in June of 2022. By August and September, you were at $300-400 a barrel. Do you know where prices were in December of that year after you destroyed so much demand? They went negative. So I'm not going to say oil's going negative, but what I'm trying to tell you is it's going to be a really bumpy ride. You've seen no evidence of demand destruction that rebalanced this market yet. So we haven't even really started the rebalancing process yet. So the upside here, I would argue, is substantial. Again, we want to be long. And I look at the market. It's shorting energy stocks and getting long everything else that is short energy. I think you're picking up pennies in front of the steamroller right now.
Jeff, we buckled up. That's why we have you on again this week. Can you give us a range of how high, though, prices could go? I know you don't want to give us an exact definition of where you think Brent oil is going to hit, but give us a range of when you say get long. I mean, how long are we talking?
But look at Oman's already traded at $173 a barrel. Jet fuel in Rotterdam is $220 a barrel. In Singapore, it was $230 a barrel. And we haven't started the rebalancing process. All we have seen is what happened in places like Thailand and China hit export bans that then create ripple-on effects and shortages. Then you have the hoarding that begins to take place. You're $8 a gallon gasoline in Los Angeles right now. So, you know, the upside here, again, I don't want to speculate on how high, but you've already witnessed something like 173 in the physical market. So that's my point here. There's a massive disconnect between the physical world and the paper world. And the paper world includes the financial world. You know, I like to point out it was in January of 2020 when COVID hit. I remember I was looking at the what was going on in China. It was the second largest economy in the world just shut down. stock market rallies, oil is hanging in there, not selling off. And I'm going, guys, we got to get short this thing. You can't hit the global economy with a shock of that magnitude and not expect bad things to happen. And we have the exact mirror image of the same similar size shock hitting the world right now. And the market on the paper and financial side is not keen off the signals that it's providing at this point in time.
So, Jeff, at some point it gets real for the market. And with COVID, it was when the northern Italian cities started to shut down. There was a sense that this was getting real, that it was spreading beyond China, it was hitting Europe and could hit the US as well. What makes this get real? What closes the gap between physical and paper markets?
I think it has to be visual images of real shortages in the United States and in Europe. Now, the U.S. will be hard, particularly if they do export controls on that. Europe will likely be the first one to hit. And I think the implication here is the U.S. believes it's safe because of energy dominance. And this is the point I made it last week. From an equity market perspective, that equity market in the United States is a global market. All of those Mag 7 companies earn their earnings in Europe and Asia and all over the world. So when this energy crisis begins to hit places like Europe, it's going to impact the earnings of those companies that sit inside the U.S. because the U.S. equity market is not a U.S. domestic market. It's global, so it'll feel the impact. And I think that if the Americans are going to feel it first on the wealth impact before they'll ever feel it in the at the income cash flow level. The Europeans, unfortunately, they're likely to feel it at both sides relatively soon.
Jeff, it's good to see you. Thanks for making time for us again. We'll catch up soon, no doubt. Jeff Curry there of Carlyle. A few headlines there, of course. One, you cannot print barrels. And two, even at 100, this is not pricing the shock that he sees playing out.
Yeah, he sees it in the physical market, and he says that it's only going to get worse until you get lines lining up to get energy. That's going to be a problem. He also said something about agriculture, and I think that we cannot overlook this. The idea that 40 to 50% of the world's urea, which is a key ingredient in fertilizer, is being withdrawn from the market right at the same time that you would have a planting season is a reason why I think a lot of people are watching with concern the world's food supplies.
Jeff Curry is a breath of fresh air for the people who continuously message me, and that is why I bring up Oman and Dubai grades, because they are $50, $60, $70 north of where the financial markets is pricing in Brent crude. That is this massive gap. Second point, he mentioned unless the U.S. does export controls. That is something, and I don't know what level it is on the menu.
Up, doesn't it?
I don't know what level it is right now on the menu for this White House, but it's certainly on the menu.
Let's get you an update on news elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. A top U.S. counterterrorism official resigning over the war in Iran. Joe Kent saying he, quotes, cannot in good conscience back the Trump administration's war. In his resignation letter, Kent writing, Iran posed no imminent threat to our nation, and it is clear that we started this war due to pressure from Israel and its powerful American lobby. Meanwhile, NVIDIA CEO Jensen Huang says the company is firing up H200 chip production for customers in China. The chip maker has been working to reestablish sales of its AI processors in Beijing after the market was virtually closed by U.S. export restrictions. NVIDIA continuing to hold off on including any China data center revenue in its financial forecasts. And Arizona is filing criminal charges against Kalshi, accusing the prediction market exchange of operating an illegal gambling business. Kalshi is already facing legal challenges in about a dozen states, but Arizona is taking a step further, becoming the first to file criminal charges. A spokesperson for Kalshi telling us here at Bloomberg the company is subject to federal jurisdiction. That's your Bloomberg brief. John.
Yahara, thank you. More from Yahara in the next hour. Up next on the program, waiting for the data.
The Fed is going to be on pause. They do not want to preemptively react to either inflation moving up or growth moving lower. And with policy being close to neutral, they feel like they're well positioned to essentially wait and see the data.
Up next, Brad Rogoff of Barclays from New York. You're watching Bloomberg TV.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Live from New York, welcome to the program. Equities just about positive on the S&P 500, up by 0.3. On the S&P, on the Nasdaq, up by 0.5. Earlier on this morning, about 20 minutes ago, 30 minutes ago, we got this from Iranian state TV that the South Pass gas field has been attacked. That's an offshore gas field in the Persian Gulf. It's the only headline we've really got to go on at the moment. Off the back of that, you did see a move in gas prices, gas futures picking up just a touch.
So it's a field they share with Qatar. It's a massive field, and if this attack is confirmed, would mark the first time Iran's upstream oil and gas facilities have been targeted in the war, which is why you're going to see a little bit more risk premium moved into not just gas futures, but also potentially as well Brent oil.
We'll stay on top of that story for you throughout this morning. Heading into this a little bit later, the Federal Reserve meeting under surveillance this morning, waiting for the data.
The Fed is going to be on pause. Why? Because they do not like this type of stagflationary environment, and they do not want to preemptively react to either inflation moving up or growth moving lower. And with policy being close to neutral, they feel like they're well positioned to essentially wait and see the data. They're going to be very data reactive, and they're going to wait out to see how this plays out.
So here's the latest this morning. A Fed rate decision due at 2 p.m. Eastern Time. Traders expecting the central bank to leave rates unchanged as policymakers weigh the economic impact of the Iran war. Brad Rogoff of Barclays writing the market now expects no Fed cuts in 26. We continue to expect 2. Brad joins us now for more. Brad, good morning.
How you doing?
Good to see you, sir. So let's go through the expectations. Markets at none. Fed's at 1, you're at 2. How do you get to 2?
Well, we're at 2 if you move into early next year, really, as well, right?
Okay.
One this year. We changed that call at the end of last year, end of last week. So we moved back from June to September in terms of the first cut, and then we went into early next year for the second. You know, how do we get there? I mean, look. Obviously, there's a lot going on, as you guys have just been alluding to, over in the Middle East, and the Fed's got to weigh both of those things, right? The inflationary impact and the market, and certainly the rates market so far is definitely weighing the inflationary impact much more than the growth impact. And you know, if this comes to a close in some way in the short term, then the growth impact, you know, probably is not as large. But if we see the oil prices that you guys were just talking about with someone, that's going to have an impact on the consumer. There is going to be concern about growth. We're also probably going to have a new Fed chair. We're going to have a little different complexion of the board. We think that could get you there by September, not June, which we had been thinking.
Let's get to all first. So Jeff Curry of Carlisle comes on. He's talking up much, much higher prices. He's uncomfortable with how this market is pricing this story. Are you more comfortable?
I wasn't thinking some of the numbers that he put out there, but we had been saying as soon as there was activity that the market felt too low to us, we're getting closer to levels that do make sense. Look, I think if we're talking about the U.S. economy, I think there was also a good point made whereby I don't know if we'll go to export controls, right? But we are an energy superpower, right? We produce plenty of oil here, and the U.S. does have better flexibility. It should, lead to the U.S. holding up better from an economic standpoint relative to a lot of other places in the world.
Does it make you nervous that there isn't fear right now, really, in markets? The capital markets are still completely open. Companies can sell debt for the most part unless their industry is challenged. And everyone's looking to buy the dip, not exactly get out screaming.
Well, that's been the right trade for a while now, Lisa, right? So I didn't answer the question if it makes me nervous. It does make me a little bit nervous, right? But I also understand that. And look, we're still in, you look at credit spreads, right, to your point, we're still in the bottom quartile, right, that we've been in historically. But investment grade spreads backing up from what were historic tights by 20 basis points, that's a pretty big move when you're starting in the 70s, right? And so there's something coming through markets. Credit markets have actually underperformed their normal beta versus equities, so we're probably supposed to look a little bit towards equities if we worry about more of our concern there.
Well, Howard Marks yesterday was talking about how essentially he wouldn't be a buyer of 100-year debt from Google because he doesn't understand why you would want to be a fixed income investor in some of these tech names when there's limited upside and a lot of downside given some of the changes ahead. Are you seeing any pushback in financing the capital plans of some of these hyperscalers, which is the benchmark for why people are so confident about the U.S. economy?
Yeah, look, I think you could say that about 100-year bonds of probably any company, if we're being honest. But to answer your question, pushback a little bit in the sense of the new issue concession that people are demanding in IG credit markets where a lot of this hyperscaler financing is occurring. It's definitely larger than we've seen. But can you still get huge deals done like we just saw Amazon get done? We had record issuance week in high grade last week. So yes, some pushback in that people are demanding a little bit more spread, a little bit more yield for it, but you can still get it done.
Brad, it's good to see you. Thanks for being here. Brad Rogoff there of Barclays. Capital markets still open.
Very much so, except for a couple companies. And there was this one company, a software company, that focuses on making online polls, and it was not able to raise more than $5 billion in the loan and bond market.
Focused on all the wrong things right now.
Well, I mean, arguably, some of the online polls that you get, how do you feel about this cloud? You are an introvert. I mean, it's a question of whether, potentially Claude could do that too.
Is that what they do? Do you play those games? It's not what you do.
I don't want to talk about it, John.
All right.
I'm introverted.
You spend some time on that.
I spend lots of time. That's how I prep for this show.
What do you see? Pictures and stuff like that?
I see my mom.
We should talk about this.
Let's not. Let's move on.
Coming up on the program, Peter Chi of Academy Securities, Steve Richardson of Evercore, Aditya Bave of Bank of America, and Kelly Kowalski of MassMutual. The third hour up next.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
I met him 1988 after my first restaurant opened. He asked me to come to open a restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know what he doing because I never watched the movies. I was traveling the busies. But of course, after people, hey, Nobu, so you must know him, and then I understand.
How is he as a partner?
He's for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So, example, Nobu Hotels idea come from him. He said, "Hey Nobu, so we have a lot of new restaurants coming in somebody's hotel." For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Welcome to Bloomberg This Weekend. I'm David Burke.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
There's downside risk around labor, but then you also have to acknowledge that there's some upside price risk.
This oil price shock is another headwind to the labor market expansion.
The Fed will have to increasingly acknowledge the two-sided risk from this.
For now, the Fed is going to be cautious.
The Fed is going to be on pause. They do not want to preemptively react.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P elevated following back-to-back gains on the benchmark. We're higher by another 1/4% on the S&P 500. In the commodity market, check out Brent, still north of 100, holding on to triple digits, 104.30, up by 0.8%. Heading into the big event later on this afternoon, Operation Make It Very Boring for Chairman Powell in that news conference at 2:30 Eastern Time.
It's going to be difficult for him to make it boring, and not just because we're hosting the Fed Decide starting at 1:30, tune in, but also because they have to come out with their statement of economic projections. And regardless of how much credibility you can put into that, given the fact that we're all just throwing darts at a dartboard, people are going to take that as signal. What is their reaction function collectively to the idea of an oil price shock? Is it to prolong keeping rates where they are, or is it potentially keeping an open mind even to whether it's a rate hike or a rate cut going forward?
Needless to say, it's a super fluid situation on the ground in the Middle East right now. Moments ago, a headline crossing about damage being done to energy assets in the region. That reporting coming out of Iran, and we're looking for further verification from elsewhere.
Right. We want to know exactly what kind of strike this was, the damage on this facility. One is the South Pars natural gas field that they share. This is a huge facility that they share with Qatar. Another is a nearby oil and petrochemical facility. So this would mark the first time that Iran, in terms of upstream oil and gas facilities, have actually been targeted. The question is, who is targeting this energy infrastructure? The president has notably a number of times talked about the fact they went after military installations and facilities on Karg Island, but didn't touch the energy infrastructure. So that's a big question this morning.
This statement from the president as we speak just moments ago. Remember, for all those absolute fools out there, Iran is considered by everyone to be the #1 state sponsor of terror. We are rapidly putting them out of business.
Two things could be true at the same time. The Iranian regime has been reaping terror, frankly, across the region, and a lot of the people who are being targeted have been the leaders of direct oppression on a lot of people, rank and file citizens of Iran. That said, there is a bigger question about the goals of this conflict as well as the duration of it. Those two things are coming into conflict at the same time. So regardless of what the regime did or who it represented, a question of what this war accomplishes and what this administration would like to see out of it, those two things are what people are trying to grapple with.
Off the back of these headlines, gas prices bouncing just a touch, crude holding on to gains, Brent at 104. Earlier on, Jeff Curry of Carlisle, about 30 minutes ago, making the case that even at 100, this is not pricing in the risk he sees developing in the Middle East.
You cannot print molecules. He thinks this is an entire regime shift for the energy complex, and that the paper market, what is going on in terms of what you see on your Bloomberg terminal across the screen, is not really what is happening when it comes to the physical barrels on the market. And he looks to places like the Oman and Dubai grades, and they are north of $50 to $70 a barrel than you are actually seeing in futures. And that's what Asian countries are taking on right now, which why he says this has a lot more to go in terms of how high prices can get.
Equities struggling to hold on to gains, positive here by about 0.2% on the S&P. Coming up this hour, we'll catch up with Peter Chia of Academy as stocks record back-to-back gains. Aditya Bave of Bank of America reacting to the latest inflation data, and Kelly Kowalski of MassMutual counting down to today's Fed decision. We'll begin this hour with stocks higher as President Trump reiterates the conflict with Iran will end soon. Peter Chia of Academy writing the following: increasingly, the patience with waiting seems to be dissipating as the markets are looking for results. Pete joins us now for more. Pete, good morning.
Morning.
You are uniquely positioned as a firm to talk about this. We often say they're stacked with military experience over at Academy. Can we talk about the facts on the ground at the moment? Do you see the US and Israel making progress? Are we making progress?
Yeah, I think we're making progress. We went through a list of all the things that we want to attack and bomb, and we've been going through those, I think, successfully. Now, I think when we look at the Strait in particular, the big difference there is when we're talking about this at Academy with a lot of our generals and admirals is when Iran is firing missiles at Israel, various places, right? They travel for a long distance. There's half an hour, there's an hour, there's time to scramble. The Strait of Hormuz is 21 miles at its widest, right? So there's the ability, if they are launching from close to shore, there's only minutes before that drone hits. And so I think that's the next wave of this is kind of eradicating their ability to target ships from close to the coast. But that is going to be very difficult. General Bellin, she said one thing. This was more about the Houthis. It's kind of rude, but I think it's very true. She was talking about them. It's hard to bomb someone in the Stone Age when they already live in the Stone Age. So these are people who are prepared for this sort of fighting, shoot, hide. So that's where it gets difficult, and I think that's why this is dragging on.
We're conditioned to buy in the equity market. We being investors, Wall Street market participants, conditioned to buy an equity market whenever it dips. We've seen that repeatedly, largely because when things get tough, there is a belief the president backs off and changes his approach to things. Does he hold the keys to the outcome of this?
You know, it does seem like we are winning, but to me, there's this race, right? It's us winning, trying to make progress towards some sort of regime change. At the same time, Iran's ability to keep oil prices higher. And to be honest, oil is probably the third or fourth most important thing that we talk about lately. We're much more focused, I think, on liquid natural gas. LNG is a problem. And I think when we look at this, the U.S. is somewhat, comforted because we have our own supply. China has their stockpiles. I think this is becoming very important within a week for Asia ex-China. You're starting to see, I love going on to NIChem and searching force majeure. It's like kind of a cool word, but it's dangerous, right? And you're seeing more and more force majeure. And again, one of our other generals who spent a lot of time actually ran BP Anglo South American oil business. He's reminding our clients, when you turn these sorts of facilities off, it's a 1 to 3 week startup process again. So this is starting to me, I think if we're still talking about this next week, Asia is in trouble.
This headline from Axios Crossing just seconds ago, getting some further details on what's happening here. They're reporting that Israel struck the largest gas processing facility in Iran. Looking for further details, the Israeli strike was carried out with approval of the United States. That's coming from Axios just moments ago.
So the second part of that headline is, I think, what I find a little bit confusing, because this administration definitely does not want to see an energy shock, definitely wants to try to make sure that consumers aren't the ones vulnerable for what Trump would call an excursion, this war in the Middle East. So it would be interesting if the White House gave it a basically green flag to strike a huge gas processing facility within Iran.
Reporting from Axios, Pete, from a senior Israeli official, the Israeli Air Force struck the largest natural gas processing facility in Iran, located in the southwest of the country. The strike was carried out in coordination and with the approval of the United States.
So when we've been kind of wargaming and playing this out internally, I think that Trump obviously likes maximum leverage, right? And the problem I think we're running into right now is maximum leverage requires, hitting their oil fields, hitting that, whether it's on Carg Island or elsewhere, and kind of reducing their ability to generate income. The flip side of that is everything that we do that puts maximum pressure on them probably puts maximum pressure on us in terms of disrupting oil. So I think this is a real delicate, balance. I don't know which way it swings out in the end.
At the same time, people are saying the U.S. is less sensitive to higher oil prices, and ultimately this is a problem for Europe, not necessarily the United States. Increasingly, the U.S. and assets here are considered havens once again. How far does that go? I mean, do you think that the market is being overly complacent about how much the U.S. economy could get hit?
Yeah, so one thing I do want to say is I think we should maybe temporarily suspend the Jones Act, and that's the act that forces U.S. ships to go from U.S. ports, and that's one reason we ship a lot of gasoline out of the south and we import a lot into the north, so I think we could do some things like that. Having said that, I think this is really coming down to the supply chain. It's going to be fertilizer, it's going to be plastics, the thenes, the polyethylene, benzene, right? As you start seeing those slow down, especially in China or Asia, it becomes our problem, right? What happens when someone who's trying to make a phone, for example, in India, can't make it because some components not being produced in India because of the plastic. So global supply chains, I think that's one thing we learned so much from COVID, right? They're very intricate, they're very fragile in many ways, and I always go back to what the CEO of Whirlpool said. A washing machine that's 99% done is not done. And I think that's the growing risk here, is little disruption to the supply chain that no one would think about, and all of a sudden we have problems down the road. I think we're not there yet, but again, I'm increasingly nervous the market's not pricing this in a week we're going to get this, ooh, shoot, we are in deep trouble and we're 5% down.
Well, so listening to Jeff Curry and listening to yourself, I'm ready to sell everything and go to cash and ultimately hide in bed. And at the same time, Delta and American Airlines come out and they talk about how consumers are spending so much that it offsets the losses that are felt in higher costs from some of these supply chain disruptions. How far do these disruptions have to go before the momentum in the U.S. consumer isn't enough anymore to stave off a true downturn?
So I think on this side of the equation, it has to start disrupting our actually good supply chain. So you have to actually see final goods having problems. So it's not just the oil and gasoline, it's going to be plastics. It's going to be shortages of something where people are like, ooh, wow, so-and-so's not going to make their quarter because they're not getting their goods finished. Again, we're not seeing that yet. I think that comes down the road. The flip side of this is what's happening in jobs, right? Because of this attack, no one's talking about the worst job report we've had in a long time, NFP, right? So there's weakness there. You're seeing, I think, a credit pullback, and I'm fairly comfortable where credit spreads are right now, but I think credit's getting tighter, right? Credit is an integral part of keeping this economy rolling. So if you start seeing companies not get access to credit, you got to slow down there. I think individuals, we're seeing some of that again as well, where we've been talking about this for a little while, but the working poor, there seems to be an increasing number of people who have jobs and are still struggling to make ends meet, and that's a very unique situation. We've never really had a recession kind of caused by that, so I think these things are all adding together, and if I'm the Fed, I'm going to try and be more dovish. I don't think they will be, but I think there's risks from all sorts of things that are hitting us right now.
Peter, you mentioned the Jones Act. That waiver is the first lever for the administration to pull, and we have reporting that that's coming within days. What else do you think they're going to do? Because I keep hearing that there, minimum, is a discussion about an export ban when it comes to U.S. fossils and fuel products to the rest of the world.
Well, to some extent, I think you almost need the Jones Act to be repealed temporarily to do that, right? Because otherwise you can't take the oil and gasoline that we have sitting in the southern ports and bring them to the Northeast. So I think that's a step in that. Yeah, I think this is, again, I'm going to go back to what we've been discussing now for a year. I try and mention every second time I'm on. PROSEC, or Production for Security. This has just been a giant wake-up call that everyone has to produce more of their own stuff. And I think anything that's integral, if it's electricity production right now is one of the most important things, probably always has been. Every country has to be re-looking at where they're generating their electricity, how they're doing it, and making sure they're less dependent. Again, I think the president was in Scotland the other day. I don't always agree with everything the president says, but he kind of gave them a lot of grief for not using their own oil in the North Sea. Like, yeah, why aren't you doing that?
Pete, what happens to states like California that are highly dependent on Asian imports?
I think this is, again, you're going to see even within the U.S., some states do much better than others. Again, those who are adopting this, those who are really willing to do make this smelting, refining, they're going to see this shift, right? And they're going to pay a price for that. So again, I think everything has a cost right now, and regulatory environments went one way, and now you're seeing kind of the problems that are caused by these bottlenecks.
Pete, it's always good to see you. Thanks for dropping by. Peter Chair there of Academy. This from Axios just moments ago, just to recap the news for you, from a senior Israeli official. They're reporting the Israeli Air Force struck the largest natural gas processing facility in Iran, located in the southwest of the country. The strike carried out in coordination with and with the approval of the United States. Now, limited information from the US and Israeli side on the record at this point. I think we need that additional clarity to figure out whether we just opened up a new front in this war.
And also, if that means a new front is opened up, what comes next? Does this mean the president is willing to go on Karg Island and really take over the energy facilities there, which means the regime is completely cut off for the lifeblood of their economy?
Makes you wonder where this is going next, Bremo.
Yeah, and whether they're going after the cash flow into Iran. This particular facility is really key and critical to Iran's gas exports. It also provides a lot of the domestic gas usage. So a question of winning the hearts and minds of Iranians, as well as attacking some of the financial resources of the Iranian leadership.
Futures struggling to hold on to gains here in the equity market, just about unchanged on the S&P 500, with an update on stories elsewhere this morning, including an update on that. Your Bloomberg Brief with Yahara. Hey, Yahara.
Exactly, John. Israel striking the largest gas processing facility in Iran. Axios reporting Israel carried out the attack in the southwest of the country with the approval of the U.S. It marks the first time Iran's upstream oil and gas facilities have been targeted so far in the war. Meanwhile, President Trump confirming his planned summit with Chinese leader Xi Jinping has been postponed as the Iran war stretches on. Trump saying his visit to Beijing should happen in about 5 weeks without specifying an exact date. The president going on to say he believes the U.S.-China relationship remains in good standing. And in sports, Venezuela is the winner of the 2026 World Baseball Classic after a 3-2 win over Team USA. It marks Venezuela's first ever tournament championship, and for Team USA, it's the second straight runner-up finish. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara later this hour. Up next on the program, the morning calls, plus we'll catch up with Steve Richardson of Evercore, with U.S. oil majors hovering near record highs. That conversation up next, live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of Power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
dealing with an enormous supply shock. So I think you're at $100 a barrel. This thing's mispriced. Get long, buckle your seatbelt, and hang on for the ride. We'll know when we start to get to that point where the system starts rebalancing. But I want to emphasize, don't underestimate the type of volatility. It's going to be a really bumpy ride.
It's a roller coaster I don't want to get on. With Jeff Curry of Carlyle on the program a little bit earlier. The president just moments ago on social media asking when too late Jay Powell's going to cut interest rates. Based on the headlines coming out of the Middle East, not anytime soon. This is the latest from Axios. They're reporting the following. If you're just tuning in, welcome to the program. An important development in the last 40 minutes or so. According to a senior Israeli official from Axios, the Israeli Air Force struck the largest natural gas processing facility in Iran, located in the southwest of the country. The strike was carried out in coordination with and with the approval of the United States. As we get more information on those strikes, equities just pulling back from session highs and now just about unchanged on the S&P 500. Likewise on the NASDAQ, turning lower on the Russell. In the commodity market, Brent crude elevated, reclaiming 105, Lisa, on Brent this morning.
Yeah, a real question here about Brent, about WTI, but also liquefied natural gas. And over in Europe, you are seeing those futures rise on this, as this was the biggest exporter of Iranian natural gas. It did share this field with Qatar. And it goes to the question of at what point do you get something more than just storage facilities that are too full, storage facility, the actual production lines that have to be restarted, but then the extra layer of production facilities destroyed, production facilities rendered not in use anymore. And that, I think, is what's getting a lot of people concerned.
105, Brent says to me the market is starting to wake up, that actually less energy will be coming out of the Gulf, coming out of the Strait of Hormuz anytime soon. When energy facilities actually start getting hit, now you have to add in another risk premium. And there is the USS Tripoli on its way to the Gulf. This is an amphibious assault ship. Those men could potentially be used to take over Carg Island. Not saying they are, but now you can start to see if they're willing to hit energy facilities, potentially this could come next.
You wonder what the next steps are. So gas prices in Europe, European gas prices starting to climb higher as you get that bounce in energy, you get that pullback in stocks. That's the price action. Let's get you some morning calls. First up, Citi raising its price target on California resources to 67, calling it a, quote, prime beneficiary of surging crude prices. Your second call from Truist, raising its price target on Nvidia to 287, saying a growing backlog of demand suggests further upside. And your third and final call from TD Cowen, raising its price target on United Airlines to 140, saying higher fares will offset the spike in fuel prices. That name up again this morning by a third of 1%. Let's stick with energy. Oil majors hitting all-time highs as crude hovers near triple digits. Steve Richardson of Evercore writing, we continue to believe the market is underestimating the risk to global economic growth from this event and that this constitutes a regime change for energy equities. Steve joins us now for more. Steve, good morning.
Morning.
Good to see you. What's your reaction to those headlines we just read out coming out of the Middle East?
Well, you noted it's clearly a change, right? The question is going to be for the market is how much of this is supporting domestic infrastructure, domestic power generation, which will start to put pressure on the regime, versus what we see as kind of an intractable situation with Hormuz that the market is waking up to.
The market's only waking up to this now. Why is that?
Well, I think energy people have been staring at the screen for the last couple of days, a little bit dumbfounded by that, to be frank, right? I mean, that's been the tenor of our calls, right? And I think that, we see this dislocation between the physical and the paper market. We see, and I think it drives a certain complacency. As you mentioned, the major oils are on their highs already. And so people, struggle with, what am I doing from here? I think a little bit. But I think that this regime change is really important. You got to remember that we've kind of asked the U.S. producers to kind of slow production pretty ratably for the last 3 or 4 years. And this does, posit a significant change here.
If the U.S. is going to potentially waiver the Jones Act, export controls even, what does that mean in terms of what the price could be in the United States versus the rest of the world? Or is there no way from ring fencing America?
It's a sugar high, right? It's a short-term Band-Aid. It could bring down, certainly you could bring down product prices in parts of the country, and that's, obviously politically expedient. But, we're speculating. We don't know. We could definitely can tell you that investors are concerned about this and what it means. The question is, do you do crude and products? There's a precedent for crude. Products are really what you need. And it would have ripple effects through Latin America, right, where we export most of our product. So I think it's something that investors are asking about, but I do think it's one of those things that would have a short term. It's a global market. You're not going to be able to fix this in any sustainable way, but could you do something for 30 or 45 days that would take the pressure off domestically? Sure.
This market has been incredibly contradictory in a whole host of ways since the war has started in terms of how it's responded. In part, the response by oil major stocks, equities, they're up 4% since the end of February, even though arguably they could benefit dramatically, and it could be a regime change. Can you explain why the underperformance of some other aspects of even equity markets?
I mean, I think, so a couple of things, right? I mean, I think that if you looked at the stocks year to date, one of the things that we'd point out is that it was really index run. Right, we had this SaaS meltdown, and you had capital almost moving one-to-one into energy if you look at the indexes. And then if you run those indexes, it was relatively indiscriminate, that buying, largest to smallest within those indexes. I think now you're getting some differentiation. The question is as this shows some duration, we see people moving a little bit down cap towards the producers, a little bit into oil services, which has been an unloved area of the sub-index. You got to remember, we're still 4% of the S&P, energy is. That also seems unsustainable in this regime change that we're talking about.
I guess it matters also how long it lasts, so that some of these oil majors can make plans to bring rigs back online. A number of rigs have not been online because of how low energy prices were heading into this. I just wonder, what's sort of the duration of this conflict? What does it have to be before the Mike Wirths of the world come out and say, all right, we got to ramp it up, we got to start producing more?
Right. I do think that's the dominant logic in the market, is this idea that you sell geopolitical risk, right? You sell the peak, and because things start to normalize and we go back to normal. The question here is what have we destroyed in terms of supply chains? What has been exposed as being an untenable risk, certainly for Asian economies? I think the U.S. producers will need to see oil make a higher low, if that makes sense, and some sustainability. I do think the back of the curve holding in the upper 70s or the 80s is an interesting signal. Think about it, U.S. producers, smaller producers could go and hedge that today and drill into that and make really interesting returns. So I think it will take a while, and it'll take investors a little while to kind of accept this too. So we wouldn't be surprised if we saw the first inklings of this late, within the next couple of months. Certainly a lot of investors will be asking about it. I do think as the time you get into the summer, we'll start to see the U.S. rig count move up. And I think that'll be the sign that we're going to start, growing a little bit in the U.S. again.
Steve, forgive me, I've only got 40 seconds. So it's an important question, though. How we value assets in different places, how is that going to change now? That's a core piece of the work you're doing at the moment.
Right. Great question. I mean, I think the simple question is if we are in a more inflationary environment and a higher risk environment, it's back to these tangible assets that the market has been very skeptical of what terminal value, particularly in oil, has been for a long time. And I think this experience is going to highlight the durability and the value of a lot of fixed assets of this nature.
Steve, it's good to see you. Thanks for being here. Reacting in real time to some of the news coming out of the Middle East right now. Steve Richardson there of Evercore. Coming up on the program, we'll catch up with Aditya Bharve of Bank of America, reacting to breaking inflation data and another read on the labor market coming up tomorrow, going into a big Fed meeting later on this afternoon where Chairman Powell will do his best to avoid making any headlines whatsoever. So tune in for the decision at 2 p.m. and then tune in for that at 2:30 Eastern Time. Reacting to headlines out of the Middle East, the possibility, the potential of a new front in this war hits to energy assets. That conversation up next.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Inflation data just moments away. We'll get to that in a moment. Mike McKee's going to go through the details for you. I want to start with the price action. Equities were positive. They rolled over just about unchanged on the S&P 500. Crude getting a lift just moments ago. Check out Brent. Check out WTI. Brent crude looks like this so far this morning, approaching 106. 105.80, up by 2.3%, and yields at the front end of the curve turn higher as well. At the very front end, twos at the moment, around 370. The headlines coming out of Axios that a senior Israeli official has indicated the Israeli Air Force struck the largest natural gas processing facility in Iran, located in the southwest of the country. The strike carried out in coordination with and with the approval of the United States. Those headlines driving markets in the last hour.
Because now everyone realizes that, okay, energy infrastructure is going to be a potential target for the Israelis, which have been going after top brass of the regime, and the administration, which mostly has focused on military assets and facilities. So right now what you have is several phases of the South Pars gas field hit by this projectiles, and they were taken offline to prevent fires. So this is going to have not just supply chain effects in the future, but also questions are remaining. What is going to be next in terms of the willingness for this administration and the Israelis to hit?
Gas futures turning higher off the back of those headlines as well as we get PPI. And Mike McKee, PPI coming in a little bit hotter than expected.
Well, actually, a lot hotter than expected, John. And as they say in the space biz, Houston, we have a problem. PPI comes in up 0.7% on a headline basis, which puts the headline number at 3.4%, up from 2.9% in January. These are February numbers. The core comes in, ex-food and energy, up 0.5%. That's down a little bit from last month's 0.8, but it moves the headline core ex-food and energy up to 3.9%. Take out trade services, and you've got a move up also of 0.5%, and that puts that number at 3.5% on a year-over-year basis. The composition of the numbers is not good either. On a for prices for final demand goods increased 1.1%. Prices for final demand services up 0.5%. So a lot of inflationary numbers in the February PPI report. And what's important is this, of course, feeds into the PCE numbers that the Fed cares about. We got a light CPI last week, but the categories that feed into the PCE were high. And I would imagine that that is the same story here in the PPI. And we may be moving up from the 3.1% core PCE number we saw in January to a much higher number in February, and all of this before the war started.
Mike McKee, that's just February. March is going to be ugly based on some of these moves we're seeing in the commodity market. Mike breaking it down for us. Mike, thank you. Futures turning lower then. We're down by 0.2% on the S&P. Yield started to bounce to the front end of the curve going into this print. Bounce even higher now, up by 3 basis points, north of 370 on twos. That's the upper end of the range over the past few weeks. We did get around 375, but these levels are around the highest levels we've seen since last summer, which was going into a rate-cutting cycle from the Federal Reserve. In the bond market then, yields up across the curve, but particularly at the front on. And in the commodity market, not helping things, 106 on Brent, reclaiming a 106 handle just moments ago, higher by 2.6%. The headlines at the last hour, Lisa, uncomfortable for this Federal Reserve meeting later this afternoon.
Adding another element, another wrinkle to the energy shock that we're facing, given the fact that now we're having facilities being directly attacked. Taking a step back, it is difficult for this Federal Reserve to say that they are looking through the oil price shock when the benchmark core PCE and now PPI are coming in on an upward trajectory, when they're inflecting higher. So it is difficult to look through it when the underlying inflationary impulse running into this was already well beyond their 2% target. And that is going to be a very difficult message for them to really deliver later today.
We'll go back to Mike and get you some details in just a moment on the underlying numbers. Aditya Bharve joins us now, the head of US economics at Bank of America. Aditya, good to see you. Good morning.
Thanks for having me.
Your reaction to those numbers, how uncomfortable is that for this Federal Reserve?
So when it comes to the PPI, what markets focus on is the components that read through to PCE, which can sometimes be quite different from the headline figures. Still, Feb CPI, after that, market said, okay, PCE is going to be somewhere, core PCE is going to be somewhere between 40 and 45 basis points. So even if we land a little bit lower than that in the refined estimate after PPI, it's still, as Lisa said, a very elevated print. The last 3 months, Dec, Jan, Feb, you're probably going to annualize around 4.5% on the core PCE, maybe higher.
That's ugly.
That's ugly. You can explain some of it away with residual seasonality, idiosyncratic factors, but it's still way too high for the Fed. And as you said, it's before the energy shock in March.
Now, they've got to forecast what this is going to look like in months to come. As that inflation forecast comes up, most people assume it might a little bit later on this afternoon. What happens to the median dot?
The inflation forecast almost has to go up. I think the median dot, it's probably a bit too early for it to move, just because there's 9 months left in the year. We know that stagflationary shocks pose very, very bimodal risks to the economy. So near-term risk to inflation, but we understand that the labor market doesn't look so great either. If you think back to January, Powell told us the tension between the two mandates is decreasing. Since then, we've gotten this ugly inflation data, and at the same time, a weak Feb jobs report, and now yet another stagflationary shock, potentially a large one from energy. So I think their motto for the March meeting should be one battle after another.
What's the signal you're sending if you revise your inflation outlook higher and you leave the median dot unchanged?
I think the signal that you're sending is that this is a supply shock. So one thing they could do, for example, is raise their unemployment rate forecast. We don't expect them to. But what you're saying is this is a supply shock. We can look through some of it because we're also concerned about downside risks to growth and to, more importantly, the labor market. Also, just wait and see. I think that's going to be the message from Powell, as you were saying earlier. He's going to try and make this as boring as possible, and part of that is not moving the dots.
Well, the data is not making this boring, Bramo. PPI coming in hotter than expected. To Aditya's point, the labour market report came in much, much softer than expected. And in between, we've got a war in the Middle East, which is raging. The headlines are not encouraging this morning, and crude's elevated around 106 on Brent.
This is a terrible situation for a central bank. They're dealing with stagflation. They're dealing with a shock that is well out of their control. And it raises this issue of, do they signal an appreciation for past history, which is stagflationary trends can turn into a real downtrend for growth and eventually down the line for inflation? Do they balance out some of the hawkish talk with some of the disinflationary ramifications of higher energy prices?
Let's get back out to Mike McKee. Mike, I want to come back to you, sir. What are you seeing? What are you reading between the lines at the moment? Where is this higher move, this move higher, coming from?
Well, largely from goods prices up by the most since August of 2023. Prices for final demand goods up 1.1%, largely due to food prices rising. They were up 2.4%, led by a 48.9% jump in prices for fresh and dry vegetables. Now, there may be some tariff impact in there. But we also see in the goods prices a tariff drop for things like apparel and footwear. So there's a little bit of a cross purpose there, and we don't know what's going to happen once the IEEPA tariffs now are gone. But in terms of services, that's where the Fed is going to be concerned. They've been expecting that to start dropping, particularly because in the CPI, the housing numbers have been slowing. But in this case, 5.7% jump in services for travel accommodation accommodation, and that's the kind of stuff that does feed into the PCE. Also, brokerages and dealers on Wall Street, those prices are up, and that also feeds into the PCE. So we are seeing some problem areas for the Fed going forward, and it is, if you want to look at it this way, what would the Fed do if there weren't a war on? Right now, when you see these kind of prices, they might be considering at least mentioning the idea that rate increases could be down the road.
Mike McKee, thank you, sir. Mike McKee breaking down the inflation data. Aditya, your response to that. What would the Fed be doing if there wasn't a war right now?
If there wasn't a war right now, I still think they would be on hold. We didn't see a strong reason for them to cut, at least in March or April, just based on the underlying activity data having pretty solid momentum, fiscal stimulus kicking in, tariffs going down, and inflation still being somewhat sticky, as we discussed even before the war. So the outlook potentially changes in June, because then we'll have different leadership at the Fed. But until then, for this meeting and the next one, we feel pretty confident that with or without the war, they were not going to cut.
If they signal cutting rates later this year, do you think that that could send a real sell-off in the long end of the yield curve, given the fact that it might suggest that this Fed is disproportionately dovish in the face of not just an oil price shock, but the underlying inflation currently in the economy?
To be entirely honest, I think the market already understands that this Fed does tend to lean dovish, that a majority of voters on the FOMC right now are probably of the view that neutral rates are closer to 3 than 3.5%. So rates, they think, eventually do need to come down. And I honestly don't think markets paid that much attention to the dots as early as March.
You know, I like to benchmark to the extreme. It is not a good strategy in markets, but if one were to benchmark to the extreme, they start to look at the setup of supply disruptions, an oil price shock, and then already an economy in flux with heated inflation percolating up, you'd start to harken back to the 1970s, and you'd say, this does have some of the elements of what we saw back then. What's your pushback to that?
The big difference between now and the 1970s is that the U.S. is energy independent. We're a net exporter of energy, and the economy has also become a lot more energy efficient. So the share of energy goods and services, not just gas, but utilities and so on, in total consumer spending is much, much smaller than it was in the 70s. So if you look at the direct pass-through of oil prices to energy to headline inflation, it's actually quite small. The concern here is second-round effects. There's two ways in which that works out. One would be broader supply disruptions that you were talking about earlier. How will those affect core inflation? And the other will be what happens to the labor market. Do wages start to go up? That, I think, would be the other concern for the Fed. If not, then I think you can look through the inflation impact and focus more on the downside risk to growth.
Aditya, you're right. We're number one in crude. We're number one in a number of products. We're number one in natural liquefied gas, but it is traded on a global market. So prices continuously are going to be elevated, and we're seeing that already in gasoline and diesel prices. So I know it's a little bit different in the 70s in terms of the complex and the makeup of where the physical products are, but this is going to have still cascading effects.
Sure. So the difference is that the headwind to consumers, that's still there. But one, that headwind is smaller because consumers spend a smaller share of their wallet on energy goods and services. And secondly, that headwind is somewhat offset, at least partially, by a tailwind for producers, windfall profits from higher prices.
Aditya, it's good to see you. Thank you, sir. Aditya Bava there of Bank of America. In the last hour, the headlines have not been kind to risk assets, that's for sure. Headlines about strikes on energy assets in the Middle East, and then a much hotter than expected read on PPI as well. This is what it's doing to financial markets. Equity futures were positive, and now they're slightly negative on the S&P to unchanged, somewhere between the two. In the bond market, at the front end of the yield curve, yields are somewhat elevated. On a 2-year bond yield, they were slightly lower, now higher by 3 basis points at 370. Going into this Fed, we've got energy prices bouncing, Bramo, Brent around 106, gas prices inflecting higher as well.
It's all going to make it a lot more difficult for this Federal Reserve to take a dovish stance on any of this. I'm looking right now at Fed funds futures, and now we don't even have a full rate cut getting priced into the market by the end of this year. How exactly do you lower rates when faced with a benchmark inflation rate that is hotter than expected, as well as an oil price shock? Right now, this is the concern. If you get a Fed that pushes back, Does that start to inject some risk into credit markets and start to force the credit transmission to pressure growth even lower? And that, I think, is the concern of a lot of people in risk markets.
The concern I've got is this is February data. Wait for March.
Exactly.
This predates the big move we've had in crude and energy prices more broadly. Anne-Marie, the headlines keep coming.
Right. Israel's now saying that they are confirming to a source confirming to our colleagues that they carried out the strike in Iran's South Pars gas field. Iran is saying they're going to retaliate against the attack on energy infrastructure. You know, the president, when he talks about Iranian natural gas, when he talks about oil, he says Karg Island is the crown jewel. Well, South Pars isn't that far in terms of a crown jewel. This is the largest gas field in the world. And when it comes to domestic consumption in Iran, it accounts for 70% of their domestic concerns in Iran when it comes to natural gas. So this is a huge blow to the regime, but also you see that the energy markets are picking up the concern.
Brent up 106. WTI, the last time the Fed met that morning, WTI 62. This morning, just short of 97. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Israel striking the largest gas processing facility in Iran, Axios reporting, and as we just confirmed, Israel carried out the attack in the southwest of the country with the approval of the U.S. It marks the first time Iran's upstream oil and gas facilities have been targeted so far in the war. Brent crude up 3.3%. The U.S. Navy's most advanced aircraft carrier is retreating from the Middle East after a fire broke out in its laundry room. The incident left at least 2 of the USS Gerald R. Ford's crew members with non-life-threatening injuries. The ship is heading to Greece for repairs, leaving only 1 carrier to support U.S. forces in the waters around Iran. And Japan PM Sanae Takaichi warning she's facing a, quote, extremely difficult meeting with President Donald Trump tomorrow. Her comments coming after President Trump criticized Japan for rebuffing his demand for warships to help secure the Strait of Hormuz. That's your Bloomberg brief, John.
Hey, Yahira, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Kelly Kowalski of MassMutual, counting down to today's Fed decision. Yahira is going to have your morning movers in just a moment. Shares of Macy's rising after earnings despite caution from geopolitics. The geopolitics driving this market big time.
problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of your net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
You know what I wish the Fed would do? I wish they would put out a statement that said, folks, there are just some things that we can't solve. Not be hawkish or dovish, but be honest and say, folks, we just, you know, this is a problem created by geopolitics. All we can do is leave the rate right here and see how things unfold.
Ed, I'm with you. Cancel the meeting. Ed Yardeni, if you had any research, just call it off.
Yeah, you could have been
No
an
news
email.
conference, just let it go.
I'm sure that Jay Powell agrees with you.
He'd probably love that, wouldn't he?
He would absolutely 100% do that if he could.
This Federal Reserve is in a very uncomfortable spot right now, getting squeezed by the data and the headlines. PPI coming in hotter than expected about 20 minutes ago, and these headlines keep building. Signs and headlines, evidence of attacks on Iranian energy infrastructure, claims from Iran that they're vowing to retaliate and target energy infrastructure and energy assets elsewhere. A strong suggestion coming from the Iranian government that will happen. And this from Axios, which I think is really important. Not just the damage to Iranian infrastructure, but who did it and with cooperation with who. Executed by the Israelis, carried out in coordination with and with the approval of the United States. That is an escalation in the Middle East.
With the approval of is really something, because this means potentially other Iranian facilities like Kharg Island, which the president was very clear when he speaks about it, was not going after the energy facilities there, just the military installations there. Potentially this is going to be next to come. And potentially this is start of a new phase of this war. And that is why you're seeing gas futures higher, and that is why you're seeing Brent crude higher.
Brent 107, WTI 97, pair it with what we're seeing in the data, PPI coming in much hotter than expected. You've got yields at the front end of the curve higher by close to 4 basis points now at 371, and equities declining on the S&P, now down by 0.5%. All of that basically in the last hour. As we count you down to the opening bell, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. After a more than 500% surge in its market debut, shares of Swarmer are up another 25% in the pre-market. This is the company that makes the AI software that coordinates drone swarms used in combat. And with the Iran war front and center, you can see how investors are leaning into this theme of higher defense spending. Moving on to Macy's, who had earnings just earlier. Shares are up 6% off the highs, but it was a mixed report, but investors obviously leaning into the good parts of this report. It was a beat on both comparable sales and profits in the last quarter, but it struck a cautious outlook on the year ahead, calling it prudent, calling its outlook prudent, saying that macro and geopolitical risks will weigh on spending. And it's been the year of memory chip stocks with all these names of Micron and SanDisk higher. Western Digital now turning negative ahead of a big test later today. We do get Micron reporting after the bell, and with that stock up 60% year to date, it will be all about whether it can deliver. John?
Yahira, thank you. Appreciate it. Let's get straight to it. Kelly Kowalski of Mass Mutual joins us around the table. Kelly, good to see you. Your thoughts on what's happening with this Fed? Investors were already coming into the March meeting expecting a Fed on hold, and that hasn't changed post-Iran. If anything, there's less room for disappointment. Are things getting harder this morning?
I think so. Look, we're in the fog of war. I think the Fed's in the fog of war as well. You know, the last 2 days we've seen market strength, but we have to continue to expect this. The headlines are going to sort of drive short-term moves. And I think looking to today's Fed meeting, you know, at the end of last year, we had one cut in the dots coming into this year. We really don't expect that to change, just given how new everything is. And look, this crisis has been going on 2.5, now almost 3 weeks. So still very new, and we kind of expect that sort of more balanced approach from the Fed and not really committing, one way or the other in terms of inflation versus the labor market side of the mandate.
What's the argument against the Fed putting a rate hike back on the table, given the fact that when you take a look at PPI, without stripping out food and energy, it's at the highest level in about a year. You're seeing a lot of different inflationary metrics moving upward even before this oil price shock.
It's the other side of the mandate, right? There's the inflation side and there's the labor market side, and the labor market is fairly weak. So I think they really need to preserve that optionality, even though we are likely to see inflation prints. They're not going to say it's temporary, but if you look at the way markets have been, relatively resilient, markets are viewing it as if it's going to be temporary. But again, there's the risk of that, the demand destruction side, which I think the Fed has to sort of keep that on its mind.
When do you start recommending that people start thinking about the possibility of recession more than currently being priced into risk assets?
Well, look, we came into this year, data's been okay. We know the labor market's been weak, PMIs have been increasing, we've seen industrial production picking up. It's, again, a little bit premature for that, but the longer this, crisis, war drags out, the more we need to think about it, right? There's the first order effects of oil prices, but there's sort of the second and third order effects which build the more prolonged this is. Again, I don't think that's priced in, where there's definitely a longer tail if we think about it. The tails are fatter now. But again, markets are really not trading on that narrative.
As Lisa mentioned a few times in the last 24 hours, how much confidence can you take from what we're hearing from the airlines? That the business for the likes of Delta and American has been pretty decent, and they're projecting it to continue through the first quarter.
I think that speaks to the ongoing trend we're seeing of sort of the K-shaped economy, right? You're seeing a pull forward in demand. We're expecting airline fares to go up. So that gives us some confidence that the upper 20% spends less than 2% of its income on fuel. You go to the bottom 20%, it's 6 to 7 times that. So you're going to see more pressure on that lower end, but the question is, can this upper end withstand these higher fuel prices? Probably.
This is going to squeeze a lot of people. Kelly, it's good to see you. Thank you. Thanks for being here. Kelly Kowalski there of Mass Mutual. If you're just joining us, what a couple of hours on this program. This Fed is looking increasingly constrained by the headlines. Escalation in the Middle East, and going into the meeting, a much hotter than expected PPI print. Coming up later, 2 p.m. Eastern Time, your lineup for the surveillance special looks like this. The Fed decides. We'll be catching up with Bob Michael of JP Morgan, Subhadra Rajappa of SocGen, the former Fed Vice Chair Rich Clarida, Torsten Slok of Apollo. We'll see you later this afternoon from New York. This was Bloomberg Surveillance.
The tennis world moves on to the Miami Open. Arina Sabalenka is the defending champion, and the world #1 will be looking to become just the 5th woman to win the Sunshine Double following her victory at Indian Wells. On the men's side, Jannik Sinner lifted the trophy the last time he played at the Hard Rock Stadium. He'll be looking for his 26th career crown in the Sunshine State.
Good morning, this is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment, but I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
The belief for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
All right, futures turning lower. 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Brent spiking to over $108 a barrel as a strike on Iran's South Pars gas field escalates tensions.
And that happens on Fed Day. It's decision day at the Federal Reserve. Chair Powell may shed light on how the Iran war is reshaping the economic outlook.
Plus, PIMCO, 6th Street, and Bill Dudley join the chorus of warnings or calming messages on private credit. PIMCO President Christian Straka joins us this hour.
I'm not so sure Christian is going to calm us. He's been warning about bad underwriting.
No, but Dudley was like, it's cool.
Yes,
this is not 2008.
Okay, fair enough.
And I was there.
He was indeed there. So many worries for the market to be focused on, but maybe retail isn't one of them. I want to show you what Macy's is doing pre-market. Okay, not the biggest company, but it is a recognized name brand. Shares are up 7% in the pre-market, a better than feared outlook for sales and profit. And there was a lot of fear due to the uncertain impact of the Iran war and tariffs will have on spending. Plus, we heard from all the airlines earlier this week, too. Everyone's still buying airfare tickets, too. So it doesn't seem to be much problem for the consumer, at least yet.
Right. The consumer seems okay, although PPI was hot.
Yes, true.
And that could feed into even hotter CPI. Comments from NVIDIA CEO Jensen Huang comparing chatbot OpenClaw to OpenAI. We are looking at tech shares higher after that. Those related to OpenClaw, NVIDIA, you can see not moving itself. Separately, Alibaba and Baidu raised prices by as much as 30% for their AI products. So looking for that ROI, Danny.
Matt, I want to get back to what you mentioned with PPI data coming in. Prices paid to U.S. producers rising in February by double the amount estimated. Stocks fell on the news, but they also fell as developments in the Middle East and Iran warned of more attacks. Let's discuss the economic picture. Bloomberg International economics and policy correspondent Michael McKee, who's in Washington for the Federal Reserve's decision. Mike, what did the data look like?
Data are ugly, Danny. A 0.7% rise month over month in the producer price index for February puts the year-over-year number at 3.4%, up from 2.9%. The core, and there's two different cores with PPI, but we do the X-Trade one because of the way this is put together, up 0.4% in January, now up 0.5%, 3.5% rate on a year-over-year basis. And this tells the Fed that there's still still inflation pressure out there, particularly since goods prices went up 1.1%. Maybe that's tariffs, but service prices were up 0.5%. And these are February numbers. This is all before the war. And you have to ask today, if the Fed were meeting and there were no war, what would they be doing? What would they be talking about? Because the Fed looks at the PCE index, which is influenced by data that comes in from the PPI and from the CPI, both of which have been hot. And look at that blue line there. That is the PCE index that is the PPI index. The yellow line is the PCE, and it's been following the PPI higher. That is probably going to come in significantly higher, and the Fed is going to be in a position where it really can't say that it wants to cut interest rates. So when we look today at the dot plot, which is really the only new news we'll get, since the Fed's not going to raise or lower rates today, are they still pricing in any rate cuts this year? That's going to get a lot of interest. You can see there that they were, as of their last forecast in December, they were penciling in 1 for the year. And now, after the news from Iran and the news with the PPI, traders have priced out any for the year. So where's the Fed on this? 2 o'clock this afternoon.
Yeah, we'll be looking forward to that. You know, Priya Misra was on with you, on Bloomberg Surveillance with you earlier, Mike, and she said what she's looking for from the Fed is how they view higher oil prices and higher gas prices, working their way into core inflation, because, of course, the core doesn't include fuel or food prices. But what are those knock-on effects? What are those second-round effects?
The second-round effects are that there are fuel price pressures in all kinds of products, because basically any truck that moves this stuff or train has to use fuel to get there. So that increases prices. Plus, petroleum's used in plastics. Petroleum's used in pharmaceuticals. It's all over the place. It takes a while to work through that chain, but it does get into the into the prices of many goods in the United States and even services. It'll be something that the Fed is going to be watching at this point, because they have no idea how long all this is going to last. Their instinct, look through this. But if prices stay elevated for quite some time, then it does have second-round effects they may have to deal with.
All right, Mike McKee, Bloomberg's international policy and economics correspondent in Washington for the Fed meeting today. Don't miss our special coverage of the Fed decision that kicks off at 1:30 p.m. New York time with a special edition of Bloomberg Surveillance. Now, Brent crude, as we just saw, topping $108 a barrel after Iran said U.S. and Israeli airstrikes hit its giant South Pars gas field, escalating attacks on critical energy assets. Meanwhile, Tehran is showing no sign of backing down, vowing revenge for the killing of its security chief, or chiefs, maybe I should say plural. President Trump spoke yesterday.
We're not ready to leave yet, but we'll be leaving in the near future. We'll be leaving in pretty much the very near future. But right now they've been decimated from every standpoint. And again, we've had great support from countries in the Middle East, great support, but we've had no support from, essentially, no support from NATO.
Joining us now is Bloomberg Washington correspondent Tyler Kendall at the White House. And I think the president made 2 points there that we should discuss. One, no help from NATO, which he continues to press on that issue. The other is that we're going to leave very shortly, he said. What do you hear, Tyler, that the president and his colleagues want to see in Iran before they can leave? What do they need to see before they can say, mission accomplished?
Well, Matt, that's perhaps the biggest question, and why President Trump is repeatedly asked about his objectives and how the White House is ultimately measuring progress when it comes to the conflict in the Middle East. And as President Trump mentioned yesterday, confirming that the U.S. has already hit more than 7,000 Iranian military targets. Then the question becomes, what is going to happen next, as a senior Israeli defense official confirms to Bloomberg News that Israel did carry out the strike on Iran's largest natural gas field, marking the first time that the country's upstream oil and gas facilities have been hit during this war. Now, President Trump has said, as you are mentioning, that we could see an end to the war in the, quote, very near future, but that he's not quite ready to let the operations end just yet. He's talked about this idea that we could see the U.S. escalate its own targets when it comes to energy infrastructure in the region. As we report on this latest strike by Israel today, President Trump yesterday reiterated that the U.S. could go after oil depots on Karg Island, something that was a major oil export hub that was hit last Friday by the U.S., but really maintained that the U.S. went after military targets but left that energy infrastructure largely intact. This would be a major escalation. If you look at the data, just for context here, Karg Island exports nearly 9 out of every 10 barrels of Iranian crude, but the latest imagery analyzed by Bloomberg News shows that for the most part, those loadings have continued basically undisrupted. So it really appears that the Strait of Hormuz and getting that reopened has been the main focus of this White House recently. And as we get more and more threats that we could see energy infrastructure targeted, Matt and Danny, as you heard from the president there, he has been really criticizing our NATO allies, but it of course goes beyond NATO allies. Tomorrow we're going to have the Japanese Prime Minister Takaichi here at the White House. And I can say that I just caught up with the U.S. Trade Representative Jamison Greer within the last hour, who told me that trade negotiators made it very clear to China during trade talks earlier this week that it is in Beijing's best interest to get the Strait of Hormuz opened as quickly as possible.
It does seem insane, doesn't it, that we have hit over 7,000 targets, and yet we continue to allow them to load oil on cargo tankers that are raising resources, that are raising revenue for their retaliation.
Well, we had spoken with someone, I believe it was Ed Morris, this idea, Tyler, that you don't want to destroy the energy infrastructure in Iran, because if there is a regime change, you need some way for Iran to have an economy that's supported. You want oil to still be able to flow out of there if it does become a Venezuela where you have better relationships. But in the meantime, Tyler, you mentioned this, Donald Trump saying that we don't need allies today in a Truth Social, saying U.S. allies need to get a grip, step up, and help open the Strait of Hormuz. Is there any likelihood at all that that could happen?
Well, at this point, Danny, yesterday, President Trump, I think it's fair to say, sidestepped a question when asked directly which countries the U.S. is still in active talks with to reopen the Strait of Hormuz. And instead, he decided to tout bilateral relations between the U.S. and countries in the Middle East. But this has really been putting perhaps a finer point on what has long been strained relations between the U.S. and traditional allies when it comes to defense spending, as our own analysts at Bloomberg Economics say that our European allies in particular are constrained by capabilities and politics, but also this concern that the White House could disengage when it comes to the war in Ukraine if they don't step up when it comes to the war in Iran. And I just bring that up because yesterday, President Trump, unprompted multiple times, brought up the war in Ukraine, saying that the U.S. has helped in Ukraine, but our allies aren't helping when it comes to Iran. So that's another thread just to follow here. But you're exactly right. At this point, the president had indicated earlier this week that Secretary of State Marco Rubio could be putting out a coalition, but at this point we've heard from many allies that they're ultimately wary, including the French President Macron yesterday, who says there needs to be calmer situation in order for France to deploy assets to the strait.
Tyler, thank you very much. That's Bloomberg's Tyler Kendall at the White House, and you can find continuing coverage on the war in Iran. T-Live Go is where you want to head on your terminal with all the latest headlines that we will also continue to bring you on the show. Now, to AI, where shares of Asian tech companies popped after NVIDIA's Jensen Huang said the platform OpenClaw is the next ChatGPT. Huang also said that he's preparing for more business in China.
We've been licensed for many customers in China for H200. We have received purchase orders from many customers, and we're in the process of restarting our manufacturing.
Let's discuss with Bloomberg Tech Europe anchor Tom McKenzie. Tom, it feels to be the irony of these events for NVIDIA. It doesn't move NVIDIA shares, but it sure moves a whole heck of a lot of other companies. What did we hear from Jensen Huang?
Yeah, we saw the ripple effects, to your point, Danny, across Asia. South Korea, you saw the hardware names. You saw the likes of SK Hynix and Samsung putting in days where they saw gains of, 7-8% across the Kospi. That closed higher, that index by about 5%. That is on expectation that you will need more memory chips. Once again, HBM, high bandwidth memory, to go in to these platforms that are being offered by NVIDIA to power the kind of developments we're seeing in terms of large language models And in China, OpenClaw. So on China, very, very strong session, particularly for those AI names, because there is this massive rush for these OpenClaw or AI agents that some of the startups they were producing and some of the legacy names like Baidu and Tencent and Alibaba. To continue to do that, they're going to need access to those chips. So it's a bit of a sweet spot now for Jensen Huang. He says he does have those licenses. Reuters reporting that the Chinese government has signed off on multiple Chinese companies being allowed to buy those H200 AI accelerators that, of course, NVIDIA has designed specifically for the Chinese market, that up until this point, NVIDIA has not included in its revenue streams. Jensen Huang saying they are now starting the manufacturing of those H200s for the Chinese market, so potentially opening up another significant revenue stream for NVIDIA at a time where you're seeing just this massive demand for those AI agents as literally queues of people line up outside tech companies in places like Shenzhen, in Beijing, and Shanghai to have techies download these OpenClaw agents onto their phones and tablets.
All right, T-Mac, thanks very much for your reporting. Bloomberg Tech Europe anchor Tom McKenzie. By the way, the next episode of Bloomberg Tech Europe, which Tom anchors, will take a deep dive into the chip maker ARM, and catch that episode on April 10th. Here on Bloomberg TV. You can also watch it on the terminal and youtube.com, as well as our video hub at bloomberg.com/video. I'm trying to think, ARM, chip maker or designer?
Designer.
They design the
believe.
chips, right?
Yeah.
They don't actually make them.
Yeah. The one that the UK is very proud of because it was created there in Cambridge and then decided not to list in London.
Yeah, ARM Holdings. Not a chip maker, but an illustrator of sort. Coming up, Disney's Bob Iger is leaving after 2 decades leading the firm. We'll look at the challenges for incoming CEO Josh D'Amaro next. This is Bloomberg Open Interest.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersecci in Davos, Switzerland, and this is Bloomberg. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Take a look at the intraday trading chart of Brent crude, the global benchmark. It just continues to climb higher and higher. This leg higher here on news that the U.S. has attacked the U.S. and Israel together have attacked a big gas field in Iran. And then Iran says now everything's on the table. They will start to attack the energy infrastructure, or they feel that they are allowed to, of Gulf neighbors. So keep watching this space. 108.50 is the level on crude. Let's get now to high interest. Look at what else is making headlines around the world. Japan's Prime Minister Sanae Takaichi is heading to Washington, D.C. to meet with President Trump tomorrow, but she warns the meeting will be, quote, extremely difficult after rejecting his demand for warships in the Strait of Hormuz. Because Japan's laws prevent sending warships, she's expected to offer logistics support instead. Obviously, Japan uses that oil as well. Oaktree founder Howard Marks is warning that AI's power is making markets harder to predict. He spoke with Bloomberg's Lisa Abramowitz at the Capital Markets Industry Conference.
Well, I think most people are underestimating the impact of AI. Roughly 18 days ago, on a Friday, that a company called Block, which had 10,000 employees, announced that 4,000 of them were out. 40% of the workforce gone in one day because AI could do the work cheaper and faster.
Now, Disney's annual shareholder meeting today marks a formal passing of the baton as Parks chief Josh D'Amaro takes over as CEO from Bob Iger in his second term. The shift signals a future built on experiences and immersive tech, but with weak park outlooks, rising sports costs, and streaming pressures, D'Amaro must restore investor confidence. Danny?
And let's discuss that in the coming AGM with Bloomberg Tech co-host Caroline Hyde. Caroline, what sort of view are we expected to get into the new CEO?
Well, we need some sort of view, because he actually hasn't spoken to the press that often. Of course, he's done deep dives with ABC, which of course is part of the overall Disney mega business model. But we want to understand the context in which AI, AR, VR is going to be a technology he leans into. How is he going to really drive what it's analysts are clamoring for, some sort of return to double-digit revenue growth powered by streaming in particular? What is it that he can ask, therefore, of Dana Waldron, who's going to be heading up? Remember, she's the first ever chief creative officer. She's president. She's overseeing the streaming, the movies, basically that sort of side of IP. How are they going to ensure that streaming manages to tackle another juggernaut in the space when we're now seeing that indeed we have got that deal between Paramount and Warner Brothers? So HBO Max kind of teaming up with Paramount. What does that mean in terms of the 200 million subscribers they have, basically equivalent to Disney Plus? So how are they going to fend off that challenge? And how is he going to steer, of course, the in real life versions of us going to parks, us getting on all the new boats that they're getting, the new ships that are costing, what, it's a huge $60 billion investment plan. He's got his team in place, but Josh D'Amaro needs to tell us really what the IP is that he's going to lean on in the future.
You know, I just spent a week at Disney parks and then on a Disney cruise, and cheap. I came away thinking a little bit poorer for it, but thinking the economy is firing on all cylinders. It was packed. They were selling a lot of stuff, and I feel like Disney owns everything, but I don't understand why they can't cash in on ESPN and sports. I mean, that seems to be a nut that media just can't crack, right? Because nobody wants cable TV bills. Everybody's streaming everything, but you still can't see it all in one place. Like, why can't they make money,
and
much more money on this?
I mean, analysts have exactly to your point, being like, where does this fit? Rich Greenfield's been saying maybe you need to sell off ESPN and ABC because it seems to be a bit of a distraction, particularly when that distraction is really expensive. Just think of all the juggernauts who've come into play and want the latest rights to the latest, greatest sporting endeavors. Well, when you're up against Apple and Amazon, well, no wonder all the coffers are getting a little bit more expensive to dig in. So I think people are wondering, what is the ESPN focus? How are they going to think about just serving us and our clients, how they could charge us more for it as well? And I think all of this needs to come together. They need more of a visual aid as to how all of these different parts of the business work as one. What about Fortnite? What about Epic Games as well? That was the big risk. And I think this is what Josh D'Amaro is trying to lean into. This is a new era under him versus what he was inherited under Bob Iger. Now remember, he did 5 years at the helm of all the big parks. He's done 28 years at Disney, but he wants to make out that he's a risk taker, that this is a 100-year-old business that he can push into the next 100 years. What is he going going to do? Yes, he went to Abu Dhabi when everyone's currently worrying a little bit more about the Middle East. What are the key risks he's going to take? He did the Epic deal. What does Fortnite, what does that IP mean for the future of Disney?
All right, Caroline, thanks very much. Caroline Hyde, co-anchors Bloomberg Tech with Ed Ludlow. You can catch that program every day at 11, so just an hour and 40 minutes until it kicks off. Coming up, BNY Wealth's Alicia Levine discusses what's going on right now in terms of stocks, the reaction to oil as Brent crude climbs up over $108 a barrel. And we get a hotter PPI number, much worse inflation than the market had been anticipating. Don't miss Alicia Levine next and the opening bell. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Oil prices spiking this morning. We're now up 4.2% at 107, above $107 a barrel after the Iranians listing the various energy targets that are fair game from now, from Qatar to Saudi Arabia to the UAE. That follows strikes from Israel and the U.S. on more Iranian energy infrastructure. And Matt, add to that hotter PPI. It's not looking like a great day in market so far.
Yeah, certainly not if you're long right now. Less than 4 minutes until the opening bell, and we're looking at futures that have turned lower. They were up for most of the morning, even as Brent was trading at $102 a barrel. Now you see it trading at 108, and as a result, we're looking at a drop in equity index futures. The 10-year yield right now rising to about 422. There's a real concern, or a real tug of war, I should say, between growth concerns and inflation concerns. We got a hotter PPI number out this morning, and I think a tug of war as well between whether or not the U.S. hits energy infrastructure in Iran or protects it, because if we hurt that, we hurt them, but we also drive higher the price of oil. We are back in just 2 minutes' time with the opening bell. BNY Wealth's Alicia Levine joins us as the trading day kicks off. This is Bloomberg Open Interest.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up to the minute news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are now down. They had been up most of the morning, and we were looking at potentially another day of gains for stocks. Now futures, at least for now, in the red, 0.4% about on NASDAQ and S&P futures, almost double that on Russell 2000 futures, on concerns about oil and energy infrastructure in the Middle East as this war escalates. Farmer Mac ringing the opening bell at the New York Stock Exchange. A pretty diverse team over there, but look at this diversity, if you can call it that. Not one dude on the stage ringing the bell at the NASDAQ market site. And the cool thing is there is a Red Bull Racing Academy driver here with the chief commercial officer, I believe, of Rocked, and they're celebrating. Hopefully we see an opening up of Formula One. Hopefully we see rule changes, because it's awful to watch.
That is not what they're doing there.
The hybrid aspect is horrendous, and I hope that the women can make it better.
That's obviously not why they're there, Matt. But you know, opinion noted. It's fine. Formula One has been so good this season.
I can't.
The battles, Lewis Hamilton is back in there.
Somebody behind the winning driver all of a sudden has twice as much power, or the guy in front all of a sudden gets cut down to nothing.
Do you hate DRS too? Should they get rid of that?
Yes, absolutely.
Really?
Just naturally aspirated, big-inch motors that wail as fast as they can at every part of the track.
You and I vehemently disagree on this. I couldn't disagree more. Okay, anyway, let me show you what Macy's stock is doing, something completely different. Shares are up 6%. Look, we have fears about oil. Are consumers still going to be able to spend as much? What does geopolitics do to things? It's not having an impact right now. People are still spending, and Macy's had a much better outlook. We also heard from the airlines earlier this week, Matt. People are spending. Things look okay.
Yeah, it is pretty amazing to see that. I guess we haven't gotten to a point when gas prices are really catching anyone's eye. We're not at $4 as far as national average yet. I did see that California is over $5.50 right now. Here in New York, we're at a measly $3.60. Comments from NVIDIA CEO Jensen Huang comparing chatbot OpenClaw to ChatGPT are sending some tech stocks higher, although NVIDIA itself is down 0.5%. Separately, Alibaba and Baidu are raising prices by as much as 30% for their respective AI products. And so that is driving the ADRs of those two stocks higher. Let's bring in Alicia Levine, head of investment strategy and equities at BNY Wealth. And Alicia, let's talk about the consumer, because as Danny points out, we see stocks like Macy's reacting well. The consumer still spending, isn't yet bothered by gas price increases at the pump.
Look, it's interesting because the consumer sentiment has been wretched for a year, and actually last year, 6 of the 10 worst consumer sentiment numbers actually happened last year while spending was higher. And coming into this, the fear about the war, of course, is gas at the pump and what that's going to do to spending. It just so happens to be hitting right where we have elevated refunds from the IRS. And so you have a support here of sorts over the next few months into the consumer sector coming from the tax code while oil and gas prices are coming higher. So I think everything we heard from the airlines yesterday and from retail today is suggesting that the U.S. economy is coming into this from a position of strength. And if you just look at the asset classes, you know, before the open, the S&P was down 2.4% since the beginning of the war. Tech was actually up slightly. Yields now are up because of the fear about inflation, but gold is down 7% since the beginning of the war. So you have this really weird cross-asset mix of what the assets are telling us about how long this war is going to go on, and for now, the consumer is all in.
What do you do, though, when there's just so much volatility? Yes, stocks have been pretty muted, all things considered. I was looking, yesterday was the first day since March 5th that Brent didn't trade above a 5% range. We got it again today with the most recent headlines of Iran targeting more energy facilities. What do you do with that type of market volatility?
Look, I mean, we've expected volatility this year regardless, right? Because, you know, we came into markets, you know, with a high multiple, very high expectations of earnings. Pretty much all strategists out there were very bullish on the year. So that alone tells you you're probably going to have more volatility this year. And we saw it. We had a violently flat market coming into the war where you have massive rotation. It's a down cap, international, emerging markets, and tech actually down and underperforming since November 1st and continuing that. That made for a violently flat market where you had some sectors down 30% and others up 30%. So that is a difficult market. It's difficult for the top line. It is a stock picker's market. But here, I think you just have to watch what the asset classes are telling you, and it's telling you volatility now, stability later, and normalization later. And of course, the big question is, if that is wrong, none of this is being priced into the market. There is some complacency, and you don't really see the left tail risks being priced in yet, and that is the risk here.
Yeah, I mean, look, to that point, we heard indirectly John Zito say he thinks markets should have been down 10%. That was last month. Yesterday, Julian Emanuel said they would have thought 10 to 15, maybe 20% drops. This morning, Peter Cheer was talking about, or Jeff Curry, I should say, from Carlyle on Surveillance, was talking about the fact that oil should be much higher here, and other commodities, it hasn't even been priced into the ags. Where do you see mispricing that investors can take advantage of right now?
So, look, I think all of this is just being priced off the fact that the expectation is that this is over by the end of March or maybe a few weeks later. I think in the beginning it was like, okay, the market can handle 2 weeks of this. And then it was, okay, the market can handle 4 weeks of this. Now we're saying the market can handle 6 weeks of this, if you actually just look at futures pricing on this. To the extent that this keeps on going on, if you have 2-3 months of this, I would suspect that there is definitely mispricing in the equity markets as well as in the oil market as well. Right now, the market is telling you, you know what? We're going to wait and see, because what we know from history is that geopolitical shocks and oil shocks, unless they are systemic and last for a very long time, tend to be priced out of markets within 3 to 6 months. And so with that history, and you can see it, nobody wants to go short. Nobody wants to be underinvested. You have to hedge the volatility. I'd say that's where we are as also. You know, we're students of history here, and the market is telling us it can last for longer. Now, the Xi-Trump meeting was postponed from the end of March. That was like the first focal point of when this might be over. So now it's going to likely go longer. I mean, I think that's what the message of canceling that meeting was.
Is there a scenario, though, where we've realized Iran can control the Strait of Hormuz? They have this ability now. So oil just needs to be reset a little bit higher along the curve further out. Maybe not $100 a barrel, but at least higher than it had been in years past. How does that change your outlook if that's the outcome of this?
So I think you have to ask the question, what's the impact of systemically higher oil prices, right? So we're not going to go back to 65 on Brent and 60 on WTI. What's the impact of that? I think overall, the energy dependence, particularly of the U.S., is much lower than it was, and on the inflation side as well. I think markets can handle it. You're going to get about a 0.1 to 0.2 increase in inflation over, let's say, the forward several years if this is systemically higher. But overall, the fact that there hasn't been a crisis coming out of this, right, either on energy or on asset prices, just telling you the world is less susceptible. Friday, at market close, the fear was we were losing 20% of global oil supply because of what was happening in the Strait of Hormuz. So that was 20%, 20 million barrels a day. Turns out by Monday morning, the expectation was we're losing 10%, 10 million barrels a day, because it's made up through other ways, right? So Iran's still selling oil. We had Indian tankers get through. We have 4 to 5 million getting diverted through that Saudi pipeline. All of a sudden, it's not as bad as it looked on Friday. If you remember the conversation around tariffs, not as bad as it seemed is enough to stabilize markets.
I'm getting a viewer writing in with an interesting point right now. He is saying that the U.S. says when this is over that Iran cannot dictate how long it will last, which goes kind of contrary to what you hear. You know, everybody says it takes two to taco, and we won't have control over when the Strait of Hormuz is open. What do you think about that?
So I think ultimately we have a better environment for supply on the other end of this. I think it's virtually very difficult to say when that is, but you're in a world where you're going to have Venezuela coming back with supply, and you're likely to have who's ever, you know, the best outcome is that we can make a deal Venezuela-like with who's ever going to be governing Iran, and you've got just more supply in the world. And that's essentially what you're seeing in the, you know, you've got backwardation in the oil market. So I heard those Jeff Curry numbers this morning. They were eye-opening. So, but he also said the same thing, that it's in the short-term pricing, right? This is a trader's market on that, not necessarily for the long term.
Even longer term, though, futures are over $70 like a year out, right? So
right, but that's not 108. It's higher than the 65.
Right.
But again, as how that gets priced into inflation, different parts of the world respond differently. Look, yields in global bond markets are much higher than what happened with the U.S. 10-year, because the rest of the world is just much more dependent on what's coming out of the Straits and Brent, obviously, than we are on WTI. It's just a different world. The U.S. is less dependent, and the market is pricing it such.
Alicia, we're going to have to leave it there. Thank you so much for joining us this morning. Always a pleasure to have you on. Alicia Levine, Head of Investment Strategy and Equities at BNY Wealth. A quick check on your equity market. 10 minutes into your trading day, we are moving lower. The future session at one point was higher, but turned around after a hotter PPI and increased pressure on energy infrastructure in the Middle East. Some of the tech stocks doing well, as you'd expect. Energy is doing well. Exxon, one of the top gainers here, as are defense companies. RTX, that's also one of the best performers. Looking at the downside, it's a lot of safety kind of stocks. The healthcare equity is not doing well. Eli Lilly, AbbVie up there in the top. Some of the consumer staples, Philip Morris, P&G, Coca-Cola, and you'll see that reflected on the GRR screen too. The sectors that aren't doing well are some of the safety ones. This is a phenomenon we've been watching over the past week since the war started. Consumer staples is in the bottom. Healthcare is in the bottom. Materials, maybe that makes more sense as price of commodities go higher. And then you have energy up at the top of the pile. That's clearly a logical one, up 0.4%. For an overall equity market, Matt, that's down about 0.2 here, just moments after the open.
All right, coming up, PIMCO sounds the alarm on the private credit industry. President Christian Stracke joins us next to talk about these worries that have been debated hotly for weeks now, even months. This is Bloomberg Open Interest.
The problem we've got as an industry is when the government overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of your net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg.
Time now for our top calls. Some of the analysts' action in focus this morning. First up, Mizuho Securities is downgrading the fertilizer company CF Industries, saying the stock's recent rally from war-related supply fears is overhyped and may not last. The firm says most farmers already bought their fertilizer, so higher prices won't boost sales by as much as expected. Next up, Citi is starting coverage of Netflix again with a buy rating, saying the company will probably raise subscription prices in the U.S. and could also boost its future profit outlook while buying back more of its own stock. And finally, Truist Securities is upgrading Block, saying the company looks more attractive after cutting about 40% of its staff, a move that could boost profits and cash flow. The firm thinks the stock is now cheap compared to similar companies and could return more money to investors. Danny?
Private credit also getting some notable calls, as it has as of late. PIMCO saying that private credit markets are giving investors a reality check as questions arise about whether liquidity and whether risks are properly priced in. Sixth Street says BDCs are facing a reckoning, forcing an industry reset. Park Square Capital founder Robin Dumar told us that he's also concerned about BDCs.
A number of these retail-oriented structures will be frozen. They are not going to be making new investments. They're going to be prioritizing returning capital. What happens in a restructuring? Can you follow your money? Can you draw? Because that's how we protect ourselves ultimately in a restructuring, is to write everything down, follow our money, start over. Can these complexes do that? I think it's going to be more challenging.
Let's add another expert voice to the conversation. Pleased to say that joining us to discuss is PIMCO President Christian Strack. Christian, it's been far too long, my friend. Thank you so much for joining. And I have to say, you've been really far out in front. You've spoken on this program and to us earlier, saying that there are some issues in private credit, that there has been concerns around underwriting and specifically poor underwriting. Now it seems like the rest of the market has come around to your view. Where do we stand? Just how bad and how poor does this asset class look at the moment? I'm not sure if we have sound to Christian at this moment. We are just going to wait a second and see if we can clear that out. He might have been frozen, but hopefully we can get that back. We'll wait for the all clear. I think we have him, Christian. Thank you for joining us. Just want to make sure we have you. So where do we stand now? You've warned about underwriting. How poor does it look?
Sure. So I think what we're starting to see is just a normalization in this space. For far too long, there was lax underwriting standards in direct lending, and with too much leverage put on companies that really didn't need that much leverage on them. What we're seeing is not really a crisis, though. What we're seeing is a cooling in this market, and what we're seeing is a move in default rates from low single digits, call it, it was 1% to 2% a year, moving up to probably 4%, 5%, 6% a year, which brings your returns in this space from what it was as great years of 10, 11, 12%. Returns are going to be in the mid-single digits now. So it's not that necessarily things are hitting a wall and that there's an extreme crisis in direct lending. What there is, though, is a realization that returns are not going to be as perfect as they were for long. Now, of course, there are also the questions around what happens with some of those software exposures in direct. What happens with some of the related names if we do see a protracted crisis in the Middle East, and a realization there that things have to work really well for direct lending to deliver those high returns that they have over the last several years, and that's what the market is grappling with now.
Well, let's talk about the consequences of that, Christian. If some of that does come true, where you see issues around software, for example, what do the consequences look like for the industry?
Well, what's going to happen in software is going to be a very
The major systemic problem is if insurance companies have too much of this stuff and it starts to go bad.
Yeah, well, we always, over all credit cycles, you always have to look for leverage on leverage. That's, leverage is okay, borrowing is okay. It's where you borrow to make loans that can be difficult. And that was the hallmark of 2006, 2007, and going into 2008, is there was that leverage on leverage, especially short-term borrowing against longer-term assets. It's night and day different today in terms of the systemic risks that we saw in 06, 07. There is borrowing, there is leverage on leverage, and that's an important area of focus. Insurance companies, some insurance companies are exposed to that to some extent, but it is nothing like what we saw with the banks and with the securitization problems that we saw in 06, 07. That said, you could still have real second-order impact here from a credit tightening, and that credit tightening will come. There will be less and less growth in direct lending. There will be less and less growth in lending below investment grade, which has been the source of credit extension over the last several years as households have been paying down debt. Corporates have been levering up, particularly below investment grade corporates, whether it's private or public corporates. And that is going to slow. It's slowing already. It's going to continue to slow, and that credit tightening is going to trickle out into the rest of the economy. Now, it doesn't necessarily mean that it moves into a very serious shock to the economy by any means, but we have to be realistic that this has been the source of credit growth in the economy over the last several years, and it will be a source of credit tightening for the next years to come.
So there's some real economic consequences of this, Christian. I also just wonder, you've talked about this idea before that it's not just an image problem, it's a fundamental problem too, again, going back to the bad underwriting. But what you're also describing is a return to normalization and a credit cycle at the very point that everybody is trying to sell to retail investors. What happens if there's an erosion of trust?
Sure. Well, what happens if you play this forward is that, the default rate may not be that bad and the returns may not be that bad, but there will not be growth in the stock of investment in this space. That is slowing fast, and it may even be negative in some places. And that's just going to mean that it's going to be that much more difficult for troubled companies with maturities of their loans coming due to be able to renew those loans. And that's how this accelerates some of this normalization in default rates, and we'll keep this default rate in this kind of mid-single digits, not just last year and this year, but out into 2026 and 2027 and 2028 as well. So you're going to have this multi-year, not an extreme peak in defaults, but a multi-year process of burning through some of these weaker loans. And that will be driven, of course, because there's not going to be the net new buyer of these loans. If anything, there's going to be a retreat of capital from the space.
But actually, I was wondering about just Just that, Christian. I mean, aren't there opportunities here after, Boaz started offering 60 or 70 cents for some assets? We heard Robin Dumar yesterday. He was pretty excited about putting cash to work here. Said a lot of stuff looks very interesting lately. Do you see the same opportunities?
Well, a lot of the loans that are out for sale right now are pretty bad loans. So, we've seen some blocks of those, and they're not clearing at a price where we would be interested in buying them. This is becoming more of a stress-distress type of opportunity, and in those areas, you really need high teens type of returns to make them make sense. But what's interesting, I'd say, is that it has refocused the market on other opportunities, and a credit tightening somewhere will lead to a credit tightening everywhere. And what we're seeing is emerging opportunities in what's called asset-based finance. So this would be residential mortgages, this would be consumer lending, this would be aviation finance, things like that, where that's a much more resilient profile. There's been much less leverage. In fact, there's been deleveraging in those spaces for the last several years. But when the system as a whole has a credit tightening, that creates a higher cost of borrowing for the system as a whole and creates more interesting opportunities in those higher quality opportunities that are kind of babies getting thrown out with the bathwater. So that's really where we're looking for the most opportunities, rather than pivoting into distressed sectors and trying to guess which software company is going to be the survivor.
Christian, we only have a minute here, but I want to ask more about this tightening, because you've also seen in public credit markets and leveraged loans that there have been wobbles there. JP Morgan, for example, pulling back on debt that they were of Qualtrics that they were going to put into the market. What sort of mix does that create? And is there any degree where that could be a saving grace for private credit if more public and liquid markets start to pull back?
Well, it's really interesting. I mean, what we're seeing is a divergence in quality and performance, fundamental performance, between IG and high-yield bank loans direct lending. Most, if not all, IG software companies are going to do just fine through the AI shock. And so to the extent that this credit tightening drives spreads everywhere higher, including in investment grade, it creates that much more of an interesting opportunity in investment grade, where there isn't much real risk of fundamental impairment and defaults, the way that there really is in some of the more levered spaces in direct lending.
All right, Christian, great to get some time with you. Really appreciate you giving us your intel. Christian Strack there, president at PIMCO. Coming up the next hour, Goldman's chief U.S. economist David Miracle on the interest rate outlook. It is Fed Day. Plus, we talk M&A with Lazard's Mark McMaster and Martha Gimbel from the Yale Budget Lab on the economic costs of war. Plus, my old buddy Scott Cutler from Health Equity. This is Bloomberg Open Interest.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Bloomberg has learned that there are discussions around a potential all-cash offer for Warner's studio and streaming businesses.
For the past few years, we hadn't really seen any deals above $30 billion. And now we're seeing,
Warner Brothers, $80 billion, the big railroad deal. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal.
I would expect next year will be an even better year for M&A and IPOs.
That's just kind of what we do at Serena Ventures, is just kind of learn how we can fill in different gaps in different areas that are being missed. And by the way, these gaps tend to be really, really massive.
I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours?
I think we're going to see the return of large transactions, and I think they're going to avail themselves of both private credit options and public options.
There's a lot of merger talk. There's a lot of firepower.
You know, investors wanted to know at what price would this deal be, and now they answered that question at $70 a share.
So congratulations to Bloomberg's deals team for getting it first.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
CBS News on the Hour, sponsored by JTV.com.
I'm Deborah Rodriguez. President Trump's pick to become the nation's new Homeland Security Secretary is taking his lumps before lawmakers on Capitol Hill right now. Homeland Security Committee Chair Rand Paul has just called out fellow Republican Senator Markwayne Mullin for referring to him as a snake after a violent attack by a neighbor while he was mowing his lawn 9 years ago.
Tell the world why you believe I deserve to be assaulted from behind, have 6 ribs broken and a damaged lung. Tell me to my face why you think I deserved it. And while you're at it, explain to the American public why they should trust a man with anger issues to set the proper example for ICE and Border Patrol agents.
If approved, Mullin would replace Kristi Noem, who was dismissed over ICE operations in Minneapolis. As the war in the Middle East rages on, Israel says it's killed a 3rd top Iranian official in 2 days. Linda Gradstein from Jerusalem.
Israel announced that it killed Minister of Intelligence Ismail Khatib in an airstrike and said that all senior officials in Iran are targets for Israeli assassination.
Members of Iran's women's soccer team returned home today. Correspondent Cami McCormick.
Their bus crossed into Iran from Turkey. Australia had granted humanitarian visas to 6 of the players after they sought asylum. Their refusal to sing the national anthem at the Women's Asian Cup sparked Iran to label them wartime traitors. 5 of those who sought asylum eventually changed their minds and decided to return home. Iran said those who did so would be embraced. The 2 players still in Australia have been spotted training with a local club.
Lines are getting so long at U.S. airports, the acting TSA administrator is warning of possible closures. Adam Stahl is also defending the growing number of TSA workers who've been calling out sick because they're not getting paychecks during the partial government shutdown.
Our people are hurting every single day. We have individuals sleeping in their cars, drawing blood to afford to pay for gas to get to work. So the situation financially is dire for officers.
Everything's getting more expensive, and the Bureau of Labor Statistics reports wholesale prices were up a lot more than expected last month, 0.7%, to their highest rate in a year. The numbers released ahead of today's announcement on interest rates. CBS News business analyst Jill Schlesinger.
This is a meeting where the Fed is likely going to sit on its hands because prices are accelerating, and the Fed does not want to cut interest rates into that potential re-acceleration of the overall inflation rate.
Brent crude prices up 5%, Dow down 210. This is CBS News. British health officials are raising a red flag over a highly contagious infection.
2 people dead, and the number of suspected or confirmed cases of invasive meningitis now stands at 20 and rising rapidly. Most, but not all of the victims, students who visited the same Canterbury nightclub earlier this month. This woman's daughter caught the disease but survived.
How did this happen to all these children, for children to lose their lives?
That's the question being leveled at British health officials, but they say no one could have predicted just how rapidly this outbreak would spread. Vicky Barker, CBS News, London.
Party time in Caracas. Venezuela fans ecstatic after their team beat the U.S. 3-2 in Miami last night to win its first World Baseball Classic championship.
It's a very emotional time for Venezuela, and this is a great way to get excited about their country.
Eugenio Suarez RBI double broke a 2-all tie in the top of the 9th. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, and we are streaming live on Bloomberg.com, so you can check us out there. It is Fed Day. It is a day where the markets are on the move. We've got energy spiking here. Brent touched 109 a barrel earlier this morning, so we're going to break it all down for you. This is Scarlett Fu and Paul Sweeney. This is the Bloomberg Intelligence Program. Coming up, we're going to check out with Dan Williams. He's a reporter for Bloomberg News. He's based in Jerusalem. We'll get the latest out of the Middle East reporting there. Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth, get her market outlook as well. Unilever Foods, they are splitting. It's an option amid rising demand risk. And Diane Gomes, she's Bloomberg Intelligence Senior Equity Analyst. She'll break down what the options are for Unilever. And then Dennis Lockhart, former Atlanta Fed president, he's going to join us to preview the Fed's meeting this afternoon today, which again, Bloomberg Television and Radio will cover the Fed decides starting at 1:30 p.m. Wall Street time. So tune in, Bloomberg Radio and Bloomberg TV. Right now, let's kick it all off with John Tucker and Abe.
All right, guys, this report brought to you by IBKR. Will the U.S. Consumer Confidence Index be above 101 in March 2026? Turn your view into a trade at ibkr.com/forecast. Last trading day, March 22nd. Did just get some data. Factory orders will do this when you strip out transportation, up 0.4%. So that's a little better than the expectations. Durable goods orders, 0. And that was the expectation. Iran says some Gulf energy sites now targets. They were going to retaliate, they say, after part of the giant South Pars gas field in the Persian Gulf was hit in an airstrike. That has Brent crude up close to 5%, 108.33 on the international benchmark. Then earlier, we had data showing wholesale inflation unexpectedly accelerating in February. That reflected higher costs for goods and services. Put that all in your bag, mix it up, you got lower stocks and higher energy prices. And of course, this afternoon, the Fed policymakers expected to hold the line on rates. Constance Hunter with The Economist says the economic impact of the war on Iran has yet to be realized.
How far each military needs to go in order to get a capitulation on either side is going to determine the dent to GDP that we're going to take from this.
Right now, the S&P 500 down 16 points at 66.99. The Dow down 219 points. NASDAQ 100 40 points lower. And that is down 0.2%. Two-year yields, they are higher, up close to 4 basis points at 371. The 10s up 2 basis points at 421. Mortgage rates jumping to the highest level of the year. The contract rate on a 30-year rising to 6.30%. This according to the Mortgage Bankers Association. Affordability continues to be an issue. I mean, it's not shocking. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
Hey, JT, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. As John was just reporting, stocks selling off this morning here. Let's take a look at some of the stocks that are on the move. We can do that today with Isabel Lee from Bloomberg News. Isabel, what are you looking at?
CF Industries, ticker is CF. It's a fertilizer company, so very exciting. I think not a lot of people think about fertilizer, but they're vital to our vegetables and all the others. So we see shares dropping around 1.5%. We have Mizuho cutting its recommendation to underperform from neutral. So we saw the stock price really rally on expected growth in demand and prices after the Iran war. And now the analyst is saying that this is overdone. And he notes that other fertilizer stocks have already started to give up some of their gains. So the analyst said that they believe the impact could be less than expected because most U.S. farmers have already purchased or prepaid for their nitrogen needs for the upcoming planting season. So he lowered his price target from $100 to $95.
All right, and you're sticking with the analyst action. You've got another name for us.
Constellation Brands, ticker is STZ. This one is slightly in the green, up by 0.2%. So Constellation Brands is a beverage company. It produces beer, wine, and spirits. So Citi raised the recommendation to buy from neutral. Citi said that a beer top-line acceleration and a valuation that's below historical levels is expected, and the analyst expects a return to positive depletions in the fourth quarter after 4 quarters of negative depletions.
People are drinking less alcohol? Is that what's going on out there?
They're smoking more pot.
And doing the gummy thing, is that?
Yes.
Okay, so...
Not yesterday. The evidence yesterday was just the contrary, by the way.
Right,
Yes.
the St. Patrick's Day parade in Midtown Manhattan.
Right. Outer
Oh, I didn't get to walk around.
You didn't celebrate St. Patrick's Day yesterday?
No, I don't actually. Do you?
Sure, absolutely.
Oh.
He didn't go to the parade,
Sweetie.
mind you.
Yes.
He stayed far away from the Midtown
I would be
parade.
so happy to see Paul in a parade.
St. Stephen's Green, down there on the Jersey Shore, packed with a bunch
Really?
of Irish people. Good Irish band. It was a lot of fun. All right, give us one more here.
Duolingo is the last.
Okay.
Stock is down by 2.5%. Ticker
John, do you
is
know what Duolingo is?
DUOL.
No.
is
I
Wait,
don't.
are you serious?
See?
It's an app that you can use to learn languages. And I love
Why
talking
do
about this.
I already have. I already.
No.
This is a trap.
The logo is a bird that's green.
Yep.
And I love talking about this because my TL, Valdana Hyrick, is crazy. She has a 2,000-day streak for French.
So,
Can
but
she speak French?
That's my question.
Bonjour, maybe.
See, that's how the kids... talk about the success or the metric of Duolingo. How many days consecutively have you gone onto the app and done it? As opposed to, have you learned how to speak the language?
Yeah. Probably. My longest streak is 5 days. But so Argus Research downgraded the language learning software company to hold from buy because they're saying that the company is focusing on increasing its daily active users, to Paul's point, rather than monetization.
All right.
But yeah, 2,000 is
Well,
crazy.
maybe speaking the language would be the most effective way to show how
That would be nice,
good the product
actually.
is.
I failed miserably.
I feel like
in
if,
my life.
unless you move to the country or practice with
Immersion.
Yes, exactly. All right, Isabel Lee, thank you so much. We appreciate that. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. It's time to get the latest reporting out of the Middle East. We've seen headlines just flying left and right. Lots of rhetoric going back between both sides. Let's check in with Dan Williams, reporter for Bloomberg News. He's based in Jerusalem. Dan, we're seeing a lot of rhetoric on both sides, followed up by some expanded attacks on energy infrastructure in the region. What's the latest that you're following right now?
Yes, indeed. It appears that we've now entered a new phase of the U.S.-Israeli assault on Iran, a campaign that's almost 3 weeks old, with an attack claimed so far by Israel on a major gas field in Iran. This has incensed the Iranians, whose official media are now publishing lists of energy sites in neighboring Gulf Arab countries in what appears to be a clear telegraphing of a threat to strike those in retaliation. This has had the makings of an energy war for several days now, with Iranian attacks on energy facilities in some of its neighboring Gulf Arab countries. It appears now that this is officially a back and forth energy war, and the Iranians are prepared to escalate further.
And that is why we're seeing oil prices elevated, with Brent now above $109 a barrel. Of course, the Strait of Hormuz and whether it can be cleared so that oil shipments can go through is critical to the price of oil prices. So where are we with that? I know the president wants support and has not gotten it in trying to clear that waterway.
Indeed, and to judge from his most recent comments in Washington yesterday, he's pretty much written off many of America's traditional allies in disappointment, in scorn. And it would appear that the U.S. is going to figure out a way to do this itself. We did have signaling from the UAE that it, while a small power, nonetheless powerful by regional standards, might pitch in more actively to help with the Hormuz situation. Israel has also said it will. Obviously, it's a full partner in this war from the outset. The question is, what could it do? It doesn't have a blue water navy. It's on the other side of the region. It has been carrying out long-range aerial strikes and presumably covert activity. Not clear how that could be brought to bear in the Hormuz crisis. What we had overnight was an American airstrike, a 5,000-pound bunker buster bomb dropped, the U.S. says, on a site used to store missiles near there, presumably a site the Americans believe was going to be used to threaten shipping or to fire on ships in the Hormuz. That would appear that the Americans are now adapting their tactics, presumably focusing military firepower on that part of the world in the hope of destroying or deterring the Iranians from harassing ships.
Dan, you mentioned the Israelis, their strike on that Iranian field as an escalation. I assume that when Israel makes such a bold and aggressive move that they have the support and the agreement by the U.S. government and military. Do we know that to be a fact?
It's certainly something that's been stated routinely by the Israelis during this war and by the Americans. They describe themselves as being in lockstep operationally in terms of the objectives of this war. However, they do divvy up the targets. They don't attack the same targets. Obviously, that could cause or invite friendly fire, but it's also a function of geography. The Israelis are functioning from a very small country 1,000 miles to the west. The Americans have bases in the Gulf and a major naval contingent in Gulf waters. So they're coming from different directions. They also have different priorities, policy issues as well. The Americans, for example, said from the outset that they were interested in destroying the Iranian Navy in order to reduce threats to shipping. This wasn't something explicitly in the Israeli target set at any point during the war. But there's no question they're very closely coordinated. I think it's clear and a given that the Israelis would have cleared this in advance with the Americans, not least as about 10 days ago there was an Israeli strike on what Israel said was fuel depots used by the IRGC near Tehran. That sent up a spectacular fireball into the skies of the Iranian capital. It spooked oil traders, the energy markets.
Yeah.
It appears there was a reproach from the Americans over that. So I think definitely just by that experience, the Israelis would have exercised extra caution in what appears to be a resumption or turning to Iranian energy targets.
Very quickly, we've got about 30 seconds left. Israel has also stepped up its offensive in Lebanon. Do we know whether the U.S. would be doing anything in concert with that?
Very unlikely. The Americans have their hands full in the Gulf. Israel has waged war in Lebanon before. We have no evidence of active American involvement there. Diplomatic backing, yes. I think the Israelis are probably capable of handling Hezbollah themselves, not least as it's been degraded by the last 2.5 years of war, multi-front war, which began in Gaza and then spread to Lebanon when Hezbollah joined in on the side of Hamas.
All right, Dan Williams, thank you so much. Dan Williams is our man on the ground. He's a reporter for Bloomberg News based in Jerusalem on the latest out of the Middle East. The two sides, Israel and Iran, trading attacks essentially on energy infrastructure, which is why oil prices continue to stay high. Brent oil now above $109 a barrel, WTI above $98. And this as the Fed gets ready to decide on interest rates at 2 p.m. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Markets right now taking their cue from a spike in oil. You had Iran warning countries around the Persian Gulf that a number of energy assets now are legitimate targets. This comes after Israel attacked its South Pars gas field. We have WTI, West Texas Intermediate, 3% higher, 99.03 a barrel, and Brent up close to 6% at $109.46 a barrel. 9 of the 11 major industry groups in the S&P 500 are lower. You have consumer staples at the bottom, and not surprisingly, energy right now is in the lead. The S&P 500, 32 points lower. That's down 0.5% at 66.83 on the index. The Dow Jones Industrial Average down 352 points, and the Nasdaq 100, 103 points lower, and that is down 0.4%. Ahead of the Fed decision this afternoon, 2-year yields up 4 basis points. That's 371. The 10-year yield up close to 3 basis points, and that is at 423. Macy's shares, they are up right now 3.5%, reporting better than expected adjusted earnings. You also had sales results for the fourth quarter, and they gave guidance. It was better than some analysts had feared. Finally, CME Group, this is the largest derivatives exchange in the U.S., saying they're moving some of their markets to the cloud before the end of the year. And we check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker. That's your Bloomberg Business Flash. Paul and Scarlett.
All right, JT, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and at Bloomberg.com. It is Fed Day. The market would be forced on to focus on some of the fundamentals of this market here. So let's check in with somebody who is a professional at this stuff. Marianne Bartels, Chief Investment Strategist for Sanctuary Wealth. Marianne, given all the, I guess, crosswinds out there for investors to navigate, the most recent being the geopolitical issues coming out of Iran, what do you expect to hear from our Federal Reserve Chairman today?
Well, I'm not an expert on Fed speak, but I think in light of higher oil prices and a much higher PPI number, the Fed's going to stay on hold, and that's pretty much where the market is expecting the Fed to be. And many people are expecting that we won't get any change in Fed policy until we get our new Fed chair.
Right, and when those hearings will begin is anyone's guess at this point, because there's all sorts of political considerations to kind of wade through. Marianne, are you more concerned when it comes to the elevated oil prices about inflation or about a growth slowdown?
I've been more concerned about inflation. We've had inflation percolating in the economy, and you can see that now in the data, and certainly now with higher oil prices. But I don't think it's inflation that's really going to cramp the economy to the point where companies can't produce earnings. There's a good cycle to inflation, right? Higher prices, if companies can raise their pricing and they can pass that through to their customers, their earnings go up. So, having some inflation can actually be very good for an economy. What you don't want is systemic inflation. So what I mean by that is you don't want to have oil prices, sustainably higher for months and months and months, because then that's going to choke off earnings. You choke off earnings, that's going to hurt the market. It hurts the economy. And we're not at that juncture. In fact, I'm starting to ask myself, what happens if we get good news? Because it's been so bad. Every time we wake up, the news has just not been good. Well, what happens if we wind up getting good news?
Yeah, I mean, a lot of folks are saying, I think someday we're just going to wake up and in the next several days or weeks, and President Trump's going to decide, okay, we won, and it's time to go home. And that'll take the risk premium out of oil, and that'll push risk assets up, and we're back to normal. I'm not sure how that plays out. So, Marianne, given that backdrop, you're not sure how things are going to go. Every time you wake up here, what's the conversation you're having with your clients about maybe putting on some risk, maybe taking some risk off the table? What are those conversations like?
So we had already reduced risk. One of the things that we said in our year ahead coming into 2026, so we thought this year was going to be a reset. Certainly not this kind of reset, but we thought that, tech could correct. It's the midterm election year. You get a lot of volatility. You can have some deep corrections that resume and go on to all-time highs. So we were really telling clients to have some dry powder, expect some volatility. We didn't expect this kind of extreme volatility. So many of our clients were well positioned. Obviously, the headlines are a little uncomfortable for some clients. But when I'm meeting with clients, I've been able to reassure them that this is not going to be a sustainable event in the Mideast that's going to derail the secular bull market that we still believe is intact. So, having a little bit of cash on the sidelines, getting ready at some point to deploy that when we think the markets have a good bottom. And, markets are getting really oversold. If you look at some of the technical indicators on a daily and weekly basis, we're really starting to move into a good oversold condition. And that's why I asked the question, well, what happens if we get good news? Also, if you look at the CBOE put-to-call ratio, we're starting to see a lot of hedges be put on. That's a contrarian indicator that could be bullish. So if we can get some good news in the market, we're going to probably get a rally that's unexpected by most investors.
What about gold, Marianne? Where does gold stand? You would think, given the volatility, given the negative headlines, that it would be above $5,000. I know it's had this incredible run, especially in the fourth quarter and earlier this year, but it hasn't gotten much support since this month began.
So gold is very correlated to the U.S. dollar. And the U.S. dollar's become a safe haven and has had, I believe it's now about a 5% rally. So with the dollar going up, it's not uncommon to have gold go down. So I think that's why you're starting to see some of the metal areas, which have had an extraordinary run, kind of take a breather and take a break. I don't think their runs are over. I'm still very bullish the metal complex and the metal mining stocks. So if you have some dry powder, this is one of the areas that I would be looking to add to.
Marianne, thank you so much. Appreciate that. Marianne Bartels, Chief Investment Strategist, Sanctuary Wealth, joining us to get this sense of what we're doing with these markets here. Again, it is Fed Day, and Bloomberg will have complete coverage of that. Tom Keene, Lisa Bronwitz, and John Farrow. 1:30 p.m. Wall Street time. They'll walk you right up to the 2 p.m. announcement, and then the 2:30 press conference as well. So we'll stay on top of that for you. Let's get back to the market and talk about an individual name here, Unilever. What we've seen in the packaged goods sector is a lot of companies trying to figure out a way to jumpstart growth as inflation has eroded some of their pricing power and caused some challenges for their stocks. One of them is Unilever. We want to get the latest on what they may be thinking about in terms of maybe changing up the company strategies. We joined by Diana Gomes, Bloomberg Intelligence Senior Equity Analyst. Diana, what can you tell us about Unilever? I mean, we kind of know the brands. There's a million brands underneath the Unilever umbrella, but what are they doing to think about juicing growth at that company?
Yes, thank you for having me. So Unilever is really coming through a few years of transformation where they split the Magnum ice cream, for instance, to really focus more in their core business, which is personal care and beauty as central stage. That's where the company has been really refocusing their premium and innovation and really getting the marketing machine behind that segment in order to get to that 4 to 6% organic sales growth target in the medium term. However, we see some challenges, especially in the near term, to get there, and the guidance for 2026 was already quite cautious, partly because the foods business has been seeing quite weak demand, particularly in Europe, even though they have very strong brands. So almonds and Knorr are the leading stars in that unit, but obviously with the geopolitics uncertainty, that has some level of additional risk.
Right. And when it comes to its food business, Unilever has been consistently reducing its exposure. It sold off its spreads business, the part of the business that contains, I can't believe it's not butter. Last year, it spun off its ice cream division into Magnum Ice Cream and still holds a 20% stake, but is steadily selling that down. Is the goal here to shrink foods into something that's not meaningful because the CEO is, at the end of the day, really a beauty and wellness guy rather than a foods guy?
That's an interesting question. When asked about it, Unilever keeps defending that they are very behind the main brands of the foods business. But obviously, they are in the middle of that program to divest about 1.5 billion euros in what they call non-core brands, foods brands. This would include some European local brands where probably the effort to really pull up that growth is seen as too much for the return, and it can be distracting for management as well. But this food business is still quite margin accretive for the whole Unilever group, now without Magnum ice cream, also cash accretive. So it still makes sense to have it in the portfolio to some extent, but I do see why, especially in this background, why there could be some a vision to try and accelerate that split and considering different options as they have been saying that they are, but just a reiteration of that in the last day or so.
So I look at the ANR function, Diana, for Unilever, and I see 11 buys, 11 holds, and 4 sells. It shows to me the street has no idea what to do with this stock. What do you think the bulls want out of Unilever today?
So it is about where people would be, I guess, in terms of not wanting to put words into their mouths, but the way I look at it is it depends where we see the journey to get to accelerate that growth further. The main goal is really to drive volume growth, and Unilever already showed that they can get to the 2%, at least 2% mark in the fourth Q results, in the back of some of the fixes they had been doing also in emerging markets. So it is about, I would say, where people's confidence is in terms of where it goes from here versus where it's already, and the drive really is on the premium innovation and that focus. And we saw already a lot of the transformation bringing in benefits already in last year in 2025. So it's, can they do better in the near term?
All right, very good, Diana.
Is the question.
Gomes. Thank you so much. Appreciate it, Diana Gomes. She's a senior equity research analyst for Bloomberg Intelligence. She's based in London. Looking at a red headline on the Bloomberg terminal, we'll bring it to you. Why not? Traders fully price 2 quarter-point ECB rate hikes in 2026. So it looks like the ECB is going to be cutting rates. What's the Fed going to do? We'll find out a little bit at 2 o'clock this afternoon. So stay on top of that. Again, Bloomberg's going to have full coverage of the Fed Decides. That starts at 1:30 p.m. Wall Street time. Tom Keene and the surveillance team will bring it. That's coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, we have the major averages all lower. S&P 500 down 45 points. That's a decline of 0.7%. Dow is 420 points lower. That's down about 0.9%. The NASDAQ 100, 167 points lower. That is down 0.7%. Oil surging as Iran listed energy assets it's going to target, it says, after the attack on its upstream energy assets by Israel. Then you had wholesale inflation of the U.S. unexpectedly accelerating in February, reflecting higher costs for goods and services prior to the war in Iran. The only major industry group in the S&P 500 higher right now, not surprisingly, that is energy. Meantime, Dan Pickering at Pickering Energy Partners says rerouting oil shipments around the Strait of Hormuz, that can only be so effective.
At some point, price is going to have to solve the supply-demand equation, and that price isn't where we're at today with WTI near 100. It's going to be 20 or 30% higher.
Brent crude right now up over 6% at 109.82. American crude, West Texas, just under 100. Still up 3%, 99.09. Ahead of the Fed meeting today, the rate decision, 2-year yield, 4 basis points higher. It's at 3.71. The 10-year, 3 basis points higher at 4.22. Traders now fully pricing in 2-quarter-point ECB rate hikes for this year. Meantime, a growing number of Americans looking to retire abroad. The percentage of people older than 55 who want to leave the country more than quadrupling since 1974. This according to a survey from Gallup and Monmouth University. Cost, a major concern. A lot of countries offer a high living standard for far less money than the U.S. France, Spain, Costa Rica, Panama, some of the hot spots for retirees.
And if you're over 55, maybe you're not drawing a salary, so you, while you have to file income taxes, you may not have to pay as much. You get an $80,000 deduction, I think, for the first $80,000.
Listen, it looks you've got this all planned out.
I've lived abroad.
Where's she headed?
I don't know.
Who knows? We check the markets all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Paul and Scarlett. Don't go. We'll miss you.
I'm not going anywhere. Don't worry. You mentioned the ECB and how traders are fully pricing in 2-quarter-point hikes in 2026. The ECB, of course, meets tomorrow. The Fed is meeting right now. It began its 2-day meeting yesterday and will come out with its decision at 2 p.m. Eastern Time. I'm pleased to welcome Dennis Lockhart. He's the former Atlanta Fed president, to join us and talk a little bit about what we can anticipate. And Dennis, how much are we going to have this statement and the press conference really colored by the events in Iran, which at this point no one can predict? It's a one big ball of uncertainty.
Yeah, you're absolutely right, Scarlett. I think that they can't ignore the Iranian development. It certainly escalates the uncertainty that the committee is always facing, and it may sort of develop into a stagflationary dilemma in the coming meetings. I don't expect any action in this meeting, but in coming meetings, the committee could be facing price pressures because of the oil effect in Iran or with Iran, as well as a weakening economy. So it'll be a dilemma for them policy-wise.
So typically, Dennis, how does, when the Fed folks get together and discuss kind of policy, how do they typically factor in global geopolitics? Because it certainly impacts and whipsaws the markets, but how does the Fed typically deal with that?
They're always focused on what is a spillover from developments around the world to the domestic economy. So their focus is very much the domestic economy. We are somewhat insulated, at least in terms of oil supply from the Iranian conflict, because we are the leading producer, I guess, in the world. But they're looking for indications in the data that the geopolitical events are having some kind of effect on Main Street in the United States. probably a little too early to tell in that respect. So I suspect in the statement and in the press conference, they'll simply acknowledge the heightened uncertainty and the events in the Middle East, but not say a lot about economic effects.
Dennis, when you look at the elevated oil prices, are you more concerned about the trickle through to inflation and core inflation specifically, or are you more concerned about a slowdown in growth?
I would prioritize inflation at this point, and it depends a great deal on how long the conflict lasts and how persistent the higher oil prices are. However, it's a close call because we've got a lot of history of recessions being triggered by oil price spikes. And so you have to be concerned about whether the economy is going to slow down or not. But at the moment, I would focus mostly, and I think the committee, for the most part, will focus on the inflation side of the mandate.
So, Dennis, we still do not have Mr. Warsh approved for the Fed chairmanship. What's the status of that? How does Fed Chairman Jay Powell address that? When does this become a problem that we haven't had hearings?
Well, much depends on the Department of Justice and whether the Department of Justice concludes its investigation of Jay Powell and, at least from my perspective, drops the case. If that happens, then Senator Tillis would probably give a green light to moving Kevin Warsh to full confirmation. But in the meantime, my understanding is that Kevin Warsh is making his rounds on Capitol Hill, but the hearings are not going on, and it could be delayed because of this investigation of Powell. If that is resolved, then I would think Kevin Warsh is very easily confirmed and will likely move ahead in the coming weeks and take over the position as scheduled. But if this really lasts longer than expected, then there could be a delay.
Will Jay Powell have a message for investors, for those who will be listening to today's meeting? I know that there's a lot he can't say, and there's a lot he has said already about how he feels the administration has been pressuring him to cut interest rates and how he might be punished for not doing so far. But what do you think he wants to get across?
I think he would probably be a little cautious about proactively saying anything to the markets. It's pretty clear where the committee stands. They're on hold for the time being, waiting for greater clarity. That was the case before the Iran war broke, and now with the Iran war, clearly they're going to wait and see. And I think he'll simply reiterate that the committee believes that their stance of policy is very well positioned for almost any contingency, and that they'll simply wait for greater clarity of how things are going to develop as the year goes on.
Dennis, thank you so much for joining us. Really appreciate it. Dennis Lockhart, former Atlanta Fed president, joining us from the land of Peachtree streets. That would be Atlanta, where every other street in that city is either Peachtree Road, Peachtree Street, Peachtree Boulevard, Peachtree Street Northeast, Southwest. It's just crazy.
You sounded like Forrest Gump with shrimp.
Exactly. So that's when I think of Atlanta, I think of Peachtree Street and how I got lost there like a million times before there was GPS. Again, Brent crude oil pushing up 110 a barrel, 109.90 here for Brent crude. So as we've seen, as goes oil, the inverse is what happens in the stock market. So you got oil surging here, and you got stocks selling off here with the S&P off about 0.75%, and the NASDAQ off about 0.75%. So.
I have so far resisted filling up my car just yet. I mean, I'm like on a quarter tank right now. I'm hoping like with each day that goes by.
What do you drive, like 5 miles a year?
No, well, to the train station, back and whatnot, you know.
So my
500 a week over here.
I know, back and forth. He goes on the turnpike and the parkway. He's done it for a couple of years now, so he's starting to get used to it. Exactly. More coming up. This is Bloomberg.
is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube, streaming live now on Bloomberg.com/video. You'll find us there. Lululemon, stock's up 3.2% today. That's the good news. The bad news, it's down 20% year to date. It's down 50% over the trailing 12 months. I understand they don't have a CEO either, so I'm not sure what's going on there. Big fan of Lululemon, don't get me wrong, but I think there's a little bit of a...
What was the last Lululemon item you bought?
Not one, but I'm a big admirer.
Okay.
Yep. Poonam Goyal, Senior U.S. E-commerce and Retail Analyst for Bloomberg Intelligence, joins us from Princeton. Poonam, I know Lululemon reported some results here. A, what did you see in the results? And B, what's the latest on their CEO search?
So the latest on their CEO search is that it's still undergoing and we don't know where they are. As far as the results are concerned, they posted respectable 4Q numbers last night. A 1% increase in revenue was better than the 1% roughly decline that we expected. So a little better. The concern was really the guidance. The outlook for the next quarter, which is 1Q, and the full year was still very light. Now, I don't know if it's that they're being conservative because clearly the turnaround hasn't begun to take hold, or that things are still soft as they continue to mark down product to get rid of some of that inventory and bring in new product. So I'd say mixed results overall, still cautious on the turnaround. We're not confident that it's beginning to take hold just yet, but we can somewhat say that, maybe we've hit the bottom.
Okay, I have a $75 credit at Lululemon every quarter because I have an American Express Platinum card.
Of course you do.
And this is one of the benefits of it.
Yep.
But I struggle to use it because I haven't found anything that I want to spend it on. And I go on Reddit and a lot of people feel this way. They did talk about having a new designer and some new product, but that has not made its way into stores just yet. What is the latest in terms of just innovation, new design, freshening up their lineup, Poonam?
Yeah, so you're starting to see some of that trickle through. We were just at stores last week and we did see some new styles come through. I'd say the bulk of it, though, will be in the spring and summer. So that is when you will start to see some of the new product flow through and hopefully more exciting lineups that you will feel excited to spend your $75 credit on. I'd say on the women's side, that's where most of the work is needed. For men's, though, they've done really, really well. Their men's lineup is pretty solid. They're doing really well internationally. I do agree that in women's, in North America specifically, they need to show more and deliver more. And we expect to see some of that in spring, summer, and we'll know more if they'll resonate to see if the turnaround can actually take hold.
So the other thing that Lululemon has to contend with is Chip Wilson, the founder. As far as I know, he doesn't actually have an operating role in the company. He's not on the board, but he is kind of in the peanut gallery agitating for changes, overhauls. What kind of influence does this have on the existing board and on investors' expectations?
Yeah, he's been advocating for change for quite some time now. We did see some change come through just recently where they did appoint a new board of director and one of the current board of directors will not be renewing. So you're starting to see some shakeup. I think he's still calling for more. Rightfully so. Lululemon has definitely lost its mojo over the last 3 years. And it's given up a lot of the upside to competition. So I think change is coming, especially as we wait for the new incoming CEO to see who that will be. I think that'll be the key inflection point to say, can this new person bring Lululemon back on board? Can it reignite the double-digit gains that we're used to? Because quite frankly, a low single-digit increase is not what you expect to see out of Lululemon.
So I'm looking at the ANR function on the Bloomberg terminal for Lululemon. I got 3 buys, 1 sell, and 30 holds. What are those 30 analysts waiting for, Poonam?
A new CEO, new direction.
Well, how hard
we want to see the new
CEO?
product.
I mean, I could go out there and go to LinkedIn and find them somebody.
Well, Paul, you're applying. It has to be the right person, right? You have to get the right person. We need to make sure that we get a person who understands the DNA of Lululemon, who understands the athletic wear space, and really is a product-led person. Like for me, it's important to see that someone comes through who understands that Retail 101 is about the product first and everything else after.
Okay, but Calvin McDonald, the CEO who has just left and who has come under pressure because things started to kind of slide at the end of his tenure, he was that person initially because when he first joined, sales took off and he came over from Sephora, so he clearly has a merchandising background.
He does, but it's in beauty. If you remember, as soon as he came on, I think the first big pushes he had was, let's launch a skincare line, you know, the deodorants and some of the lotions, etc. That didn't go too well. It was a nice idea, very high gross margins, 80%. So in theory, sounded great, but it didn't really resonate and get Lululemon anywhere. I think what we need is someone who understands the apparel and the athleisure space, someone who knows that you need style with performance, because that is what this brand demands, and constant newness. Like Lululemon has to outshine the broader competition, and that's become harder with just technologies being almost available to everyone right now.
Yeah, Alo, Vori, they're all stealing Lululemon's market share.
And that's what I've heard from like Alex Deal and everybody else who comes in here and says, I love the Lululemon product. But
Too expensive.
But they got to have that premium.
You know,
image
actually, I have two pairs of leggings from Lululemon, and I bought them years ago, and they're still in great shape.
Still good. That's another thing I've heard. So, all right, Poonam, thank you so much. Appreciate that as always. Poonam Goyal, Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence. The first analyst I hired at Bloomberg Intelligence was Poonam Goyal, so she always gets special treatment there. For our listeners in the U.S., a reminder, you listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metal. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now with the S&P down 37 points. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Wednesday morning from the Bloomberg Interactive Brokers studio. This is Bloomberg Intelligence with Paul Sweeney, John Tucker, and Scarlett Fu. We're looking at the ongoing war in Iran, translating into higher oil prices yet again today, and that is putting pressure on stocks and, of course, creating more uncertainty. So we're going to tackle all of that, including the latest company news as well. Mary Ross Gilbert of Bloomberg Intelligence, our senior equity analyst covering retail, will join us on the latest earnings out of Macy's and how the consumer is doing on that front. Tarek Mansour is the CEO of Kalshi, one of the two prediction markets that has really taken over a lot of our conversations, and he's going to be speaking with Tim Stanovic of Bloomberg Business Week. After that, we will check in with William Lee, Chief Economist and Managing Director at Global Economic Advisors, as the Federal Reserve gets ready to announce its decision on interest rates at 2 p.m. As well, we'll speak with Lindsay Dutch, our Bloomberg Intelligence Consumer Hardline Senior Analyst, on earnings out of Williams-Sonoma. But first, let's bring in John Tucker for our Bloomberg Business Flash.
All right, guys, the war jitters, again, getting more intense, and that's, as you mentioned, sending oil higher, stocks lower. Iran says it's going to retaliate against energy facilities in the Gulf after Israel targeted Iran's biggest gas field. Now, ahead of the Fed rate decision this afternoon, wholesale inflation unexpectedly accelerated in the month of February. In the meantime, Ed Yardeni Research says uncertainty that remains the biggest risk when it comes to the war against Iran.
The problem here is who's in charge, who's in control, who can respond to this latest Middle East crisis, and the answer is nobody. It's kind of ambiguous about how this thing gets resolved.
Right now, Brent crude up over 5%, 108.86 a barrel. The Dow Jones Industrial Average down 382 points. The S&P 500 38 points lower. That's down 0.6%. 66.77 on the index. The Nasdaq 100 right now down 139 points. That's down just about 0.6%. The yields are pushing higher. The 2-year up 3 basis points, 370. 10-year let's call 3 basis points higher. Right now that is at 4.22. So Bloomberg Economics expects the FOMC to hold rates steady and also signal an extended pause ahead. Amazon rolling out even faster delivery options for shoppers, introducing 1-hour and 3-hour options for more than 90,000 products. And then Meta Platforms opening its first flagship store in Manhattan on 5th Avenue, right by the Regis Hotel, the St. Regis, that is.
What are they selling?
So you can go my question exactly. What do they sell? Meta's artificial intelligence. You can go in and try on the glasses.
Okay.
The AI glasses, and then the headset, the virtual reality headset. And then walk out of the store and get hit by a cab. No, I'm kidding. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Be safe with those, virtual
Have you seen
reality.
anyone with those Meta glasses?
No.
One of our producers walks around with them.
Well, I'm talking about the headset, the virtual reality headsets.
No, that's a different level. I'm talking about just the regular glasses, but she's kind of what looks like she's talking to herself, but she's actually talking to someone just through her glasses.
We think she's doing it. Okay, very good. John Tucker.
Maybe she is talking to herself.
Maybe she's talking to John Tucker there. Appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. As John was just reporting, stocks selling off here. Let's get a sense of kind of what's moving out there on the individual stock level. We can do that today with Bloomberg's Natalia Kenyajevic. Natalia, what are you looking at today?
Hi, guys. Of course, retail is in focus today. Let's start with Lululemon. The ticker is LULU. Shares are up by 3%. So the company reported net revenue for the Americas, which was down by 4%. Then net revenue forecast for the full year actually came way below expectations. Bloomberg Intelligence is saying that this is basically reflects difficulties for the company to reset its U.S. business. However, international sales were strong, specifically China. But as many analysts pointed out, that's not enough to counter the U.S. weakness. And of course, everyone wants to see a new CEO. Some analysts expected that this new announcement would come today, but it didn't happen. And many analysts, including Jefferies, are saying that without a credible permanent CEO, convictions stays low, and the stock looks like, quote, dead money.
Yeah, it's just kind of rudderless. And, at least for now, when you go into the stores, not a whole lot of selection. All right, Natalia, you're also looking at a company whose stock looks like is up 70% so far this year, LyondellBasell.
Yes, so this is a company that produces plastic chemical fuel products. This is such a hot topic right now, considering the Middle Eastern crisis. So the stock is up by 3% today. The ticker is LYB. So we saw that UBS upgraded the chemical company to neutral from sell. They also increased price target to $73 from $42. So that's a pretty big move. So they say that overall, as of now, they still see some kind of oversupply in petrochemical business. But if this conflict in the Middle East stays for longer, we may see really tight supplies for much of this year. As a result, they expect excess free cash flow for the company for 2026. And many analysts are just saying that the scale of supply shock in chemicals market is just underestimated right now. So I hope you guys will book this company for your show. I think it could be a really interesting conversation.
Stocks up 70% year to date. So it's really moving hard there. All right, one more, of course, crypto.
We look at company Gemini Space Station. The ticker is GEMI. Shares are down by 15% today. Citigroup analysts cut recommendation to the crypto exchange to sell from neutral. Price target was lowered to $550 from 13. Again, it's a pretty big downgrade. So they say that they see increased concerns about companies' profitability. They say that expected revenue for 2026 can be lower. Volumes are down due to crypto prices. But what I found also really interesting that Citi lowered 12-month Bitcoin price to 112,000 from 130 of 43,000, which is still really optimistic considering where crypto is now.
Yep. Yeah,
Exactly.
71,000 for Bitcoin at the moment.
Yep.
Natalia, thank you so much. Natalia Knežević of Bloomberg News covering our market movers. And for more conversations like this, be sure to subscribe to our Stock Movers Reports. That's 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, it is still earnings season, believe it or not, and the retailers are reporting results. We heard about Lululemon earlier. Let's talk about Macy's. The stock is up about 5% in this morning's trade. Mary Ross Gilbert is our senior equity analyst covering retail, and she joins us now. Mary, what did we learn from Macy's?
What we learned from Macy's is that Macy's has inflected to positive comp sales. They were looking to achieve sustainable growth. We think they're there. And for this year, they're providing, I think, very tepid guidance. They want to kind of budget where, do higher gas prices have an impact? But overall, the consumer is very resilient, and they're attracting more of the middle income to higher income consumer, across their brands, primarily, the Macy's nameplate. So they're expecting comp sales, though, they're guiding to be down 0.5% to up 0.5%, but we think they'll easily beat that. And of course, for the first quarter, they're already seeing strong traction, and at the high end, they're guiding for comp sales to rise 1.5%. So what we're seeing is that the nameplate looks like it has inflected to positive comps, and we certainly see the changes when we go in the store.
What do you see when you go in the store, Mary, that's different or maybe positive in general?
Yeah, so what we're seeing is the stores are constantly evolving. I mean, every time I go in there, I'm seeing something new. So I'm seeing new brands. And what the company reported on the call is they've added 60 brands. So when I go in there, and I'm, obviously focused on women's wear, but I did kind of take a look and I saw Rod and Gun in our local store. So that was kind of a nice addition. And the stores are just, the merchandising is so strong, and the salespeople. This has been the best encounter that I've had with sales associates when I went in the store just yesterday. I encountered at least 3 associates. They were well appointed, absolutely charming and engaging. And because they have some of these new labels, I actually tried something on. I'm really a Bloomingdale's person. I really love the premium brands, but I did see some really good brands in there. My favorite is Avec La Fille, and I tried on some of those jeans, and they were amazing, absolutely amazing. So I really think that Macy's has come back. They're bringing in all the brands that consumers care about. They're attracting younger consumers. So I really see very good execution here with the company.
What about execution at Bloomingdale's? And I bring this up particularly with Saks' issues. Saks, of course, in bankruptcy protection right now and trying to find a way to get through all of its debt problems.
That's all been a benefit for Bloomingdale's. So Bloomingdale's has been executing, for the last few years, and it's an ongoing process. So just in our local store, just opened, was the Christian Louboutin shoe boutique. And of course, these are licensed businesses, but it doesn't matter. They're not reporting comp sales on all these different bases. It's just comp sales. So it does include the benefit of licensed brands. But so they now have a Chanel boutique, and they now have the Christian Louboutin. But they're always, if you go to ready to wear, you're seeing constant, new labels coming in. So it's very exciting. I love Bloomingdale's, and that explains why their comp sales were up 10% essentially in the fourth quarter. I think part of that is some of the gains coming from Saks and Neiman Marcus customers, given the bankruptcy, lack of product during that time. So they're the beneficiary, and that's why they really emphasized how they're focused on expanding the chain this year. And the company, one of the executives did indicate probably a month ago that they would look at some of the stores that might be closing if it's relevant. So they're looking to see what opportunities are out there, because they're only in 14 markets. So there's a great, I think, expansion opportunity too with Bloomingdale's.
Right. Well, Scarlett, Mary, she shops in only the best locations. Westfield, Century City. That's where she goes to the Macy's there. And that, you think the Short Hills Mall is nice. The Westfield Century City Mall is spectacular. And by the way, Bloomberg's offices are right there.
Oh,
so that's how it works. Just go down to lunch and go down to the mall, and that's how it works. Hey, Mary, what's Macy's saying about their store count in general here? Because there was a decade or more of the department store industry really reducing store count.
Yeah, so they're closing 14 stores. It's probably mostly closed at this point. And then going forward, there's about 65 more to go. And those will close through 2028. They're not in a hurry to close them. They want to make sure they maximize the real estate value. And it's okay because those stores are profitable. But the go-forward store base continues to be the 350 stores. And so they will get there. Like I said, by 2028, they'll have gotten rid of the last of the 65 stores they plan to close. So I think, once we move past that, the overall top line should look good.
Mary, really appreciate your joining us. Mary Ross Gilbert is Senior Equity Analyst covering retail for Bloomberg Intelligence. Let's join now BTV anchor Tim Stanovic speaking with the CEO of Kalshi, Tarek Mansour.
Charges.
Look, I mean, these charges have nothing to do with gambling or the merits. If it was about gambling or the merits, they would let the judicial process run its course in the federal courts. 5 days ago on Thursday, Kalshi filed suit against Arizona in federal courts on the merits on whether Kalshi is subject to exclusive jurisdiction of the CFTC. We're confident in our position and wanted to let the court process play out. And instead of letting that happen, the Arizona Attorney General decided to subvert the judicial process and weaponize it and go to state court and file these criminal charges, which we view as meritless and baseless. We see this as a total overstep, and we look forward to fighting it in court.
Well, experts are saying this could be the first of many charges such as these from other states too. How does it change your legal strategy?
Well, this is the whole point of federal preemption. So this is not about gambling. The charges that the Attorney General filed are not about gambling. They're not even about sports only. They're about prediction markets writ large. It's just, attacking the entire business model. And nothing prevents from the same Attorney General or others from filing the same criminal charges against derivatives markets writ large. They could file the same exact charges under the same analysis against CME or ICE or NASDAQ. And that's the whole point of federal regulation of these financial exchanges, is to prevent this sort of chaos and these sort of attacks on these businesses that could be political in nature or other. And that's a very important distinction.
Well, I read the charging document from the Attorney General. It has 20 charges. They're mostly about betting and wagering when it comes to sports. There's some election stuff in there. Would you ever consider limiting your business in Arizona or other states to things that these AGs don't seem to have problems with, like economic data, the price of Bitcoin, what markets are going to do, predictions around those things?
Look, I mean, the AG also claimed that we have war markets, which is incorrect. It's either flat out a lie or it's misinformed take, which is unfortunate for someone that's, filing criminal charges against the company. What's more important here, again, is this is not about the merits. If it's about the merits, let's let the judicial process run its course in federal courts. This is about something other than the merits, which is what I'm focused on. I don't know what the AG is focused on, but she is up for re-election. They did some press. It does seem to be making some buzz. But what I'm really focused on is building a great product for our millions of customers, out of which close to 400,000 are in Arizona, and fighting any of these baseless cases in courts, which we're going to continue doing.
So you're fighting the cases. As I mentioned, Arizona is not the only state to take issue with your business. What happens ultimately if courts do side with states? What does it mean for the future of your company?
We believe in the rule of law, right? We will always abide by court decisions. The law applies to us, but it also applies to the government, including state governments. And that's a very important thing, right? This is really not about our business model. Again, if it was about our business model, we would be focused on the federal courts and the lawsuit about the merits. This is a broader attack, and many states have sided with us and have granted us a preliminary injunction agreeing with our legal analysis. We have spent 4 years getting regulated by the federal government, and we have a federal government in the CFTC that is coming strongly in favor of our position. Filing these charges is a total overstep and an overreach from an AG that's up for re-election. And we find that unfortunate, but we will stay focused on what we do best, which is building a great product.
So certainly the CFTC, we know where the CFTC stands, and we know where Mike Selig stands on this. We don't know where courts stand on this. And I'm wondering if if we see a state like Nevada, for example, block access to your business, what will you do? Will you continue to operate, or will you say, okay, we're not going to operate in Nevada?
Well, first of all, let's get to that point, and we'll have to make a decision as a company what we do. What I can reiterate is we will 100% abide by the law. That's what we will do as a company. It's always been our position. That's why we spent 4 years getting regulated up front, regulatory first as a company, and always abide by the law. But what I always say, the law applies to us as much as it applies to the government. And when government oversteps the law and goes out of bound, we're going to fight that in court, which we look forward to.
How long does that process take? Because it seems like there's a regulatory limbo happening. It's almost like your legal team is going to have to play whack-a-mole with all these states that are filing suit or bringing criminal charges. How long is this going to take?
And gladly, we have a legal team to handle these types of things, and that's what they're going to be focused on. And maybe it's a question for them. I mean, look, whatever long it takes, we're going to fight for prediction markets. I spent 8 years building this company, half of which are getting regulated up front. I really believe in this marketplace. I'm very excited about the growth that we're seeing. It's one of the fastest growing companies in America right now. And so what I'm going to be focused on is keep building a great product. And that's what's sort of most important for me. The more important sort of question is, when it comes to, this is not really about, whether this is gambling or not. It's not really about state versus federal, which are both coexisting and both growing, both models. This really is turning into sort of some special interest that, like the status quo. The status quo is working very well for monopolies, but not for the consumers that are flocking to prediction markets right now, which we're going to keep fighting for.
Tarek, there is this perception, though, that people think this is gambling. An Ipsos survey from just a few weeks ago, for example, shows 61% of adults say prediction market trading is closer to gambling. 8% say it's closer to investing. So there is this public perception that doesn't necessarily match with what you say the platform is. How do you respond to that, and how do you battle that? Like, how is this not gambling?
I haven't really looked at these polls. The thing I will say is there's always been a battle of whether financial derivatives are gambling. Grain futures were called gambling in the 1800s, and there was a Supreme Court decision that said even though there is speculation, these products have are structured as the financial markets, and thus are going to fall under financial market jurisdiction. So I always say this: whether something feels and looks like gambling doesn't necessarily make it gambling. Speculation exists in all financial markets. If we're going to take a line that speculation is gambling, then the stock market with retail participation is gambling. Then buying options for retail or 0 days expiry options is gambling. Then retail buying crypto is gambling. The more important line, and the historical line that we've been taking under the law, but also, as we think about it societally, is the business model a gambling business model, which is a model where the revenue of the business and the profits are equal to the customer's losses, in which case the incentive is to promote more losses and block the winners? Or is it an open, free, and fair marketplace where people can enter in and out freely and transparently, which is a financial exchange, which Kalshi falls under?
Tarek Mansour, Kalshi co-founder and CEO. Tarek, always good to speak with you. Thanks so much for joining us.
All right, that was Tarek Mansour, Kalshi CEO, speaking with Bloomberg's anchor Tim Stenovic. Again, when I think about these markets, they're just growing like crazy. Poly market, Kalshi, the whole prediction market. But there's a lot of legal issues out there that they need to resolve before it seems like both companies move forward.
Yeah, Arizona being the latest to file these criminal charges against Kalshi for operating what it calls an illegal gambling business, citing misdemeanors that carry less serious penalties than felonies.
Interesting. All right, we'll stay on top of that, but that was great reporting and great interview with Bloomberg television anchor Tim Stenovic. Right now, let's get a reset of these markets. We can do that with Mr. John Hunter.
All right, guys, we check the markets for you all day long right here on Bloomberg, and this flash brought to you by Golden Crest Metals. Inflation, tariffs, volatility have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Right now, the S&P 500, 42 points lower, down 0.6%. We're at 6674. The Dow down 432 points at 46,564. The NASDAQ 100, 137 points lower. Brent crude up over 5.5% right now, 109.14. Iran warning both countries that a number of energy assets are now legitimate targets after Israel attacked its South Pars gas field. And again, Brent pushing higher. Oil prices actually have soared almost 50% since the U.S. and Israel began the war. And in the run-up to the Federal Reserve decision, Treasury yields rising as the Producer Price Index unexpectedly accelerating. And traders right now reducing bets on even a single interest rate cut from the Fed for all of 2026. At Walt Disney's annual shareholder meeting today, it also marks a formal passing of the baton from Bob Iger to Josh D'Amaro, and he certainly has a big laundry list of to-do things for him. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett Paul.
All right, very good, JT. Appreciate that. Scarlett Fu and Paul Sweeney. We're live here in our Bloomberg Interactive Brokers Studio. We're streaming live on YouTube and at Bloomberg.com. It is Fed Day. Interesting to see and to hear from Fed Chairman Jay Powell. There's been a lot of economic data. We had some PPI data today. Came in a little bit hot, I would say, on the margin. Then, of course, you have to deal with the geopolitical risk coming out of Iran. Bill Lee, he's a chief economist and managing director at Global Economic Advisors, joining us from the City of Angels there. Hey, Bill, what do you expect to hear from Jay Powell today? Because, boy, he's got a lot of balls up in the air as it relates to thinking about his dual mandate.
You're right. There are so many balls up in the air, and it's unfortunate that the Fed right now is still obsessed with getting rid of the last vestiges of inflation and bring it down to 2% target, despite the fact that we have robust GDP growth that's being spurred by high productivity growth, and the downside of that is that there's not a lot of job creation. So the second part of their mandate, which is maximum employment, is something the Fed is clearly willing to ignore for fear of any kind of rising inflation expectations. Now, there is some evidence that the break-evens, the 5-year break-evens, are starting to push up again. They're probably at their highest level for the year. But if you look at the 5 years, which is the expectations beyond 5 years within the next 10 years, that stuff is falling. So markets are really pretty settled in terms of long-term inflation expectations, which is what the Fed is really concerned with. And I think the Fed is going to be making a policy mistake by focusing so much on this obsession with keeping prices from spiking, that we're going to be missing the ball on the most important part of their mandate, which I think is to maintain maximum employment in order that consumers, especially those at the low end, are going to have enough income to spend.
The Federal Reserve bill says it is data dependent, which is backwards looking in the best of times. Now that you have the Iran war and you have the impact of that conflict on market prices like oil prices, and certainly raising concerns among consumers about inflation and AI out there, how much can the Fed cling to data points as the basis for making their decisions on what happens next?
That's a great point. In fact, Kevin Warsh, one of the things that he's obsessed with is trying to break the Fed free from being locked in by the historical data progression as we start to see it releasing government data. And the other thing is also to break the Fed from being locked in by its forward guidance. That how many times have you and everyone else referred to the dot plot? And FOMC members are reluctant to change from their dot plot projections unless there's a real massive change in the circumstances, whether it's actual data or the war or something. And I think we might start to see a new regime come in when Kevin Warsh starts to at least argue for using more up-to-date data, different types of data, and higher frequency data to enrich the package of data dependency and unlock forward guidance.
Bill, you mentioned incoming Chairman Warsh. When is it going to become a problem that we haven't had hearings yet? When does that become a problem for the Fed and maybe for the markets?
Well, Paul, that's absolutely the issue I think that is worrying. We have a senator that's absolutely obsessed with holding up all nominations until we get this issue of the court legislation of the court case for the Fed out of the way. And I think that's going to bring a lot of harm to the Fed because, it freezes decisions at the Fed. It puts Powell in a lame duck position. And markets, I think the one thing that we certainly hate would be the uncertainty about when the new leadership takes place. But what we know is that the doctrines that Kevin Warsh is going to be bringing in is going to be at least in the background of the discussions. So I think there is going to be some progress made, but certainly not enough.
Bill, there was a great story yesterday about the K-shaped economy and how it's really a debate because there's some economists who see evidence of it. Others say that it's been exaggerated or is fiction. Where do you fall on that debate?
You know, Scarlett, I think the people who argue that the K-shaped economy is a fiction are the ones flying in business class because their stock portfolios are giving them enough capital gains and wealth effect in order to keep their expenditures up. And quite frankly, the aggregate data show consumption is still fairly strong. But certainly the affordability crisis that's being expressed day by day by working people, 80% of the population do not own equities or a substantial amount of equities. 20% of the population own 90-some-odd% of all the equities out there. So I think that kind of putting your head in the ground ostrich approach toward accepting the fact that we have an affordability issue among 80% of the population is something that will start to bite people in the rear end as soon as the midterm elections come in.
All right, Bill, thank you so much. Appreciate that. Bill Lee, Chief Economist and Managing Director at Global Economic Advisors, is joining us from LA via that Zoom thing. Down in Washington, D.C., Michael McKee is there manning the fort down there. He will be at the press release and press conference for Fed Chairman Jay Powell this afternoon. Michael McKee covers all the economic stuff for Bloomberg. Hey, Mike, what are you going to be listening for from Jay Powell this meeting here? Anything unusual? Because, boy, there's a lot of unusual stuff going on out there in the world.
For more than a year, Paul, so it's hard to know what's more unusual or what would get people's attention. I think there's two things that people are going to be listening for today. One is what the Fed does about any kind of guidance going forward. Does it retain the one cut in the dot plot for 2026? Does it say that oil prices are a bigger danger than they might otherwise be because the Fed tends to look through oil price shocks? What is their outlook and what is the likelihood that they could pick up again with their rate-cutting regime? The other side of the question is what happens with Jay Powell? He is this is his second to last meeting. He's got one more in May after that, and then he is done as chair of the Fed. Does he stay on as a governor? And if Kevin Warsh is not confirmed in time, does he stay on as the Open Market Committee chair? A couple of different threads to follow today.
Absolutely. And I guess he will be, I mean, in the past, we've always observed that a successful press conference for Jay Powell is one where he doesn't make a lot of commitments, doesn't give a lot of ground on anything, doesn't say a lot. In this instance, I mean, especially when it comes to forecasts, it holds more true than ever because there's so much uncertainty clouding everything out there for him.
Yeah, I think he's going to stick to kind of tried and true verities about the Fed, that they're going to remain vigilant, that they're going to keep an eye on both sides of their mandate, what's happening with unemployment, what's happening with prices, and that it is always, as always, the most important thing in the world is to get inflation down to the 2% target. But beyond that, I don't expect much in the way of specifics. This is a press conference this afternoon that could be interrupted at any time by a Trump tweet or a headline from Iran that would make anything that Jay Powell was saying irrelevant. So the best thing for him to do is to be careful and try to get out without making a lot of news.
So is there a chance that this could be a very short press conference here and maybe a short, comments from the Fed chair?
I suppose it could be. I mean, the Fed tries to be fair and allow most, if not all, of the reporters there to get a question in. But you might be right about the length of his answers not being very long, so we could see it move more quickly. In the past, he has well, just in this January meeting, it kind of got very repetitious hearing him say essentially the same thing over and over again. It was funny, Ed Yardeni yesterday said on Bloomberg Television, Powell should just come out and say, with all the uncertainty out here, I don't have anything to say. So the news conference is canceled.
No luck there, I'm sure.
Yeah. So when you think about the kinds of other things that could crop up in this news conference, Mike, any surprises that, might pop up that, kind of stump the chairman?
Well, there's always something that seems to. Beyond the questions about his own future, I think questions about the Fed's future. Kevin Warsh wants to do a number of reforms to the organization. He'd like to go back to a very small balance sheet and maybe go back to scarce reserves as the way they do monetary policy. And it's certainly possible that Powell will be asked about those kinds of things. The surprise would be is if he gives much of an answer. He's going to be, I think, very circumspect about Warsh coming in and what he might want to do, and say things like, I'll leave that to Kevin to decide. But those are the areas where you might see something. The area of monetary policy isn't much for them to say at this point because there is so much uncertainty.
Mike, we did get some inflation data this morning with the PPI data coming in higher than expected here. What did you make of it, and what do you think the Fed's going to make of it?
Well, it was quite a surprise. I mean, we've had tariff-related inflation. Some of that, some categories, like in apparel, went down, but others were strong enough to push up goods prices by 1.1%. Now, of course, the Fed says we're going to look through that. And then the services prices are up 0.5% again. And so there's still inflation on both sides in the producer price index that could feed into the CPI and definitely will feed into the PCE. So it is not the narrative that the Fed wants. This is still a question of what's the tariff impact and how long does it last? And obviously now we're going to add into it the oil impact. Both of those are things the Fed wants to essentially ignore, but they can't ignore inflation in other areas of these reports. And if that's what we're getting, then it's something to keep an eye on because, as I said, their main goal, they say, is to get inflation down to the 2% target.
Hey, Mike, we've all seen on the news long lines at airports, TSA backups, TSA cancellations. Tell me you took the Acela train down to D.C. this time and not flying.
I was actually in Arizona, Paul, so I had to fly. Train would have been a little slow, and I had a flight canceled. So the only flight I could get yesterday morning was at 5:30 in the morning. So there were no lines in Phoenix at that time of day. When I come back up, we'll see.
Yeah, I would highly
He's not
recommend
committing to taking the train.
I cannot get him to become an Acela person to Washington, which I think is the preferred way to go. But what do I know? He's old dog, new tricks, that whole thing. Mike McKee, international economics and policy correspondent for Bloomberg News. He's down there in D.C. reporting live. This is
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Got to head back to oil. Surging. Iran listed energy assets in the region that it's going to target. It says it will target in response to the U.S. and Israeli attack on its upstream industry. That's sending stocks lower. Energy, the best performing industry group in the S&P 500 right now. No surprise there. In fact, it's the only sector that's positive. You have WTI, American crude up 2.8%, 98.98 a barrel. Brent up over 5%, 109.02 on the international benchmark. Dow Jones Industrial Average down 396 points. The S&P 500 33 points lower, and the Nasdaq 100 down 104 points right now. Seema Shah, principal global investor, says investors do remain focused on the duration of the war.
In terms of the growth impact for the US, it's actually quite contained. And the inflation impact, provided inflation expectations don't take off, which they certainly haven't so far, then it's something that the Fed could look through.
Unilever, maker of Hellmann's mayonnaise, in the early stages of considering a separation of its food assets. Company trying to grow its beauty, personal care, and well-being brands, so a transaction would likely value the Unilever food brands at tens of billions of dollars. And then you have best performing stock right now in the S&P 500. Williams-Sonoma up 5%. This is the home furnishings retailer reporting fourth quarter adjusted earnings per share that came in ahead of consensus estimates. Those do the kitchenware, right? Williams-Sonoma. I bought
pricey kitchenware.
There was a gift. I didn't buy it for myself, but a cutting board there. You could land an aircraft on that. I think I had to take out a second mortgage for it. Anyway.
How do you wash that thing then? It's got to be heavy and big.
It was a gift, not my problem. We checked the markets for you right here. Yeah, you could sacrifice something on that. Right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Scarlett and Paul.
All right, thank you so much, John Tucker. Today's big take is a really interesting one, and it goes to the heart of something I've been really curious about, which is the man who heads up the Federal Communications Commission, the FCC chair, is one person named Brendan Carr. He wields a lot of power. He speaks on behalf of the president. He threatens networks that say things that the president doesn't like. And our Kelsey Griffiths, who is our telecom reporter, has been writing about him and has profiled him in her latest Big Take. And Kelsey now joins us from Washington. Kelsey, great to speak with you. And this is a deep dive into who Brendan Carr is, because he kind of rose from a bureaucrat within the bowels of the FCC to become, it feels like President Trump's biggest and most vocal enforcer, especially when it comes to going after networks that he says are peddling fake news. Tell us what surprised you the most in your conversations with Brendan Carr and what you learned about Brendan Carr.
Well, Scarlett, I think Brendan Carr is a really interesting figure, like you just said. We have been hearing a lot about him over the last year or so, but like you noted, he's been part of the federal government for a very long time. I think what surprised me the most in sitting down with him for more than 2 hours of conversations over the last few months is that he is so soft-spoken in person, and it is in such a great contrast to the persona that he kind of wields on the internet or wields a little more publicly. So there's sort of this dichotomy of he is a quiet, soft-spoken, very measured lawyer by trade, but he's been able to step into this role in the Trump administration as this prime MAGA flamethrower, and I think that's gotten the president's attention.
Kelsey, in my earlier career covering the media industry, I spent a lot of time at the FCC, a lot of bureaucrats there, but they get stuff done here. But each chairman of the FCC has his or her own kind of agenda for how they envision the FCC. Should it be pro-business, pro-regulation? Where is this FCC with Mr. Carr?
So it's interesting that you point that out, because I asked the chairman about that. You know, is media one of your top priorities? And while it has consumed the most oxygen perhaps in Washington recently, that is not the thing that he sees as being most important to his chairmanship. I think it's something that does get the president's attention, but what Carr told me is that he is really focused on the mobile space economy. He's really excited about kind of clearing the way for some of these big satellite constellation launches so that mobile carriers can provide more coverage from space to fill in those gaps. So I think that's something that he's really excited about, but it's something that gets a little bit less airtime.
I think one thing that bewilders a lot of people is he seems to have come from out of nowhere to become such a vocal and outspoken person on behalf of the administration, on behalf of the president, maybe to get his attention, maybe something more. And you dug into his background. He was a big sports fan growing up, and you point out that he was kind of a malleable sports fan. Walk us through what that has meant for his career.
That's right. Brendan Carr has this uncanny ability to sort of pick the winning team and stick to rooting for that team while they're on top. I think we saw that in him being an Orioles fan until he was invited to throw out the first pitch by the Yankees last year. And since then, he's been rooting for the Yankees. He has rooted for Super Bowl teams that tend to do pretty well. So yes, I think he has really demonstrated that he's able to choose that winning team and show the loyalty there. And I think that's what he's done with President Trump.
How about the FCC is one of those federal agencies that I think was founded on and prized its political independence. Is that still the case today, do you think?
According to Chairman Carr, no. There's been sort of this shift in interpretation in how independent agencies operate and whether they serve at the will of the president or whether they are, appointed by Congress and can serve in an independent capacity. Chairman Carr recently told Congress that the FCC chairman and commissioners serve at the will of the president and that the president should be able to fire them unilaterally at any time. So the FCC has actually recently removed some language on its website that states its independence.
He's been at the FCC for a long time after graduating from law school. Now he's the head of the FCC. Do we have a sense of what he wants to do next? How is he going to cash in his political chips?
I asked him about that, and he told me he is just trying to hit the ground running, keep doing what he sees as the best job possible, kind of maximizing this position and platform that he's been given. He, so far has really been an FCC lifer. He told me he doesn't have any political ambitions, and he's just trying to kind of finish the job for President Trump.
Kelsey, in your reporting, have you seen anything of how the president feels about Mr. Carr? Has he made any statements about the FCC or Brendan Carr?
Yes, the president has on multiple occasions been very complimentary publicly of Brendan Carr. And he's particularly happy about how Carr has pulled no punches in calling out the quote-unquote fake media, the media coverage that is less than positive for Trump. I think we most recently saw that happen on X when Brendan Carr boosted something that Trump said over the weekend about coverage of the Iran war. And Carr said that he thinks the news networks need to pay attention and do a better job of covering that conflict from both sides.
All right, Kelsey, really appreciate your joining us and fantastic reporting here. Kelsey Griffith is our Bloomberg Telecom reporter in Washington. On her profile of Brendan Carr, the chair of the FCC, the story is called How a Deep State Bureaucrat Became Trump's Fake News Enforcer. Some fantastic details in here.
Yeah, absolutely. And, the way the FCC is set up, there's 5 members, and the current administration gets to appoint 3.
Mm-hmm.
So the administration will have, definitely a sway on the FCC. That's the political angle of it. But again, from a policy perspective, I always found them to be pretty cut and dry, kind of bland, just here are the rules, that kind of thing. It was really always a question of how supportive would they be of consolidation of certain issues, whether it's telecom or media. And so that's been kind of.
And as Kelsey put it, he's been a lifer at the FCC. He's served under Democratic presidents and under Republican presidents, and up until recently was not someone that necessarily was someone you paid a lot of attention to or was even seen as divisive in any way.
Yeah, and there are some big M&A transactions in front of the FCC as we speak that need FCC approval to transfer the licenses. say, of radio or TV stations from one owner to the next, and that requires the FCC approval.
So, position of influence for Brendan Carr. This is Bloomberg Intelligence on Bloomberg Radio. Keep it right here. We have the S&P lower by 0.6%.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube. We're also streaming live now on Bloomberg.com/video, and that's where you'll find us there. We still got some retailers and consumer products companies reporting earnings. Today was General Mills. They reported results for the last quarter that missed Wall Street expectations, weighed down by lower prices and weaker demand from consumers facing more economic stress. Let's get to the details there. Diana Rosero-Pena, consumer staples analyst for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio. General Mills Cheerios, right?
Yes.
That's how I start my day, with a bowl of Cheerios. What happened with General Mills? What did they report?
So basically, it was mixed. Results were mixed compared to consensus. They seem to be doing better. Obviously, there were some puts and takes, some headwinds, but they seem to be a little bit more quarter dense rather than something that we can extrapolate into next quarter. So, yeah, I mean, obviously, I think the stock is down, and it's because, while volume, underlying volume is improving, it's still weak, and to get volume growth, it's still very expensive.
Just looking at the PGEO function that breaks down kind of where they get their revenue. Boy, they break it down pretty finely. Baking mixes and ingredients, dough, super premium ice cream, cereal, convenient meals, snacks, yogurt, pet, other. Boy, they break it down. So are there certain segments that are doing better than others? Are they one of these consumer products companies that are saying, hey, if something's not working, we'll sell it and we'll try to invest in the areas that are growing?
That is, all of these companies have done some portfolio reshaping. Yogurt has been a headwind because they spin it off. So that is obviously one of the things, the latest, spin-offs that they have done. But yeah, they are very sharp in terms of their portfolio, reshaping, but it seems that now they're investing more on making the brands that they have grow. And some of them are growing and some of them are not.
Stock is year-to-date down about 17%, hit a 52-week low today here. How are the General Mills of the world, the Procter & Gamble's, how are they dealing with the consumer facing, particularly the bottom end of the K-shaped economy facing economic pressures, and now it's more money to fill up your car with gas? How are they dealing with that?
Yes, so this company in particular, General Mills, they actually reduced guidance during CAGNY last month, and it was basically because volume growth is just not there. And they're trying to increase marketing. They're not necessarily trying to rely on price cuts, but it seems that that is going to have to start happening. More competition. They're seeing, for example, for snacking, they seem to be a little bit more competitive than the category used to be. Dog seems to be still a little bit of a headwind for them. So we're seeing, there seems to be a little bit more of cautionary tale for the consumer, and definitely with prices spiking for gas, it's not necessarily helping.
I don't know if it's just me, but I mean, when I go into a supermarket now, I see many more store brands in more categories, and they're also getting better placement in the shelves, which I know is important for you guys.
Yes.
Talk to us about just the competitive landscape of brands, name brands versus kind of the store brands.
Yes, so basically retailers have been investing on their private label portfolio. It's about a quarter of their revenue at this point. They're trying to obviously navigate. They don't necessarily want to anger the national brands, but they tend to fill out certain white spaces that are not necessarily catered by these national brands. And at some point, sometimes they're more competitive. They have tiers of pricing for this private label, and some people actually go to these stores to buy their private label.
We're now, I guess, roughly a year into these tariffs. What are the consumer products companies, what are they saying these days about tariffs and passing it along versus taking it in their margin? Where are we now on that?
Yes, so a lot of it has gone through the P&L. They're very hesitant about increasing prices. Again, they're thinking it's more on the price competition. They're going to be more price competitive going forward. So we're seeing headwinds on the margins rather than just passing through.
I'm looking at this company, General Mills, and they have a 6.3% dividend yield. That's pretty good.
Yes.
How safe is that? How are they committed? What's their policy on all that?
Well, they usually try to grow it at the same rate of earnings. So we don't necessarily see them as being a little bit, increasing share repurchases or probably like spiking the dividend. We're probably going to see a lot of the same, just dividend growing at the same pace of earnings.
Gotcha. Okay, very good. General Mills stock is, again, down just fractionally today. They reported some earnings a little bit lighter than expected. Diana Rosetta Pena, consumer staples analyst for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker studio. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. We have red on the screen as we've had most of the morning. The S&P's down 34 points. That's a half of 1%. The Dow's a little worse, off 400 points. That's almost 0.9%. And the NASDAQ down 112 points. That's a half of 1%, in part due to a spike in oil today. We've been calling out Brent crude oil. It's up 5.1% today, about just under $109 per barrel.
This is CBS News on the Hour, your home for original reporting.
Tammy McCormick, Oklahoma Senator Markwayne Mullin is appearing before senators today for his confirmation hearing to replace Kristi Noem as Homeland Security Secretary. He faced some tough questioning from Senator Rand Paul for a remark Mullin made after Paul was severely assaulted in 2017.
I'm not apologizing for pointing out your character. Good. So you're jolly well fine, and you want the American public and the people up here to vote, that may or may not vote for you, to know that you supported the felonious, violent attack on me from behind. I did not say I supported it. I said I understood it.
Administration officials are answering lawmakers' questions about the threat from Iran. Director of National Intelligence Tulsi Gabbard testified about the ballistic missile threat from Tehran.
Iran has previously demonstrated space launch and other technology it could use to begin to develop a militarily viable ICBM before 2035.
The White House still reacting to the resignation yesterday of Joe Kent as the head of the National Counterterrorism Center. Olivia Rinaldi has that.
The president, again, saying that he thought Joe Kent was a nice guy, but that he was really not involved in these high-level meetings. We also heard this morning from Caroline Leavitt.
The president feels it's deeply disappointing that after the president gave him an opportunity in this administration to serve the American people, that he would resign it with a letter filled with falsehoods.
Kent said he was stepping down because he didn't support the war in Iran. Officials are warning some airports could shut down if TSA agents aren't paid soon. Chris Van Cleve reports on the impact at the nation's airports.
Thousands are calling out sick every day. Hundreds have quit altogether. That means longer lines for flyers at airports across the country. In some cases, mind-numbingly long, hours-long lines at airports. And some of this is kind of random because it depends on how many people call out sick at an airport, and that may vary by shift.
They're not being paid because of the partial government shutdown. Meteorologist Craig Allen monitoring dangerous heat in the west.
The heat is going to be extreme across California as well as the southwest states, and that is going to last into the weekend as well. This is going to be a long duration heat wave, at least through Saturday and Sunday for major cities, and it includes even Billings, Montana, and all the way on down to Albuquerque, New Mexico.
On Wall Street, stocks are lower today due to rising oil prices over concerns in the Middle East. The Dow Jones Industrials currently off 462 points. This is CBS News. A lot of TV viewers snubbed their noses at the Oscars parade of movie stars.
Not even Conan O'Brien could save the Oscars.
What's the plan?
I'm going to turn at this gas station, I'm going to slow down, and you talk and roll.
What are you talking about? I've had both hips replaced.
The numbers from Nielsen show about 17.9 million viewers tuned in to Sunday night's Academy Awards on ABC. That's down about 9% from 2025 and marks the first audience drop after 4 years of steady increases. Analysts analysts blame younger viewers who prefer to watch the highlights on social media instead of sitting through all 3+ hours. A lot of baseball fans tuned into the World Classic. Deborah Rodriguez, CBS News.
At Live Nation's antitrust trial in New York, a ticketing employee testified yesterday it was immature of him to have called customers stupid. 30 states are suing the company, arguing it's driven up ticket prices. I'm Cammie McCormick, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
The warning from Iran. Energy assets are now legitimate targets. Welcome to the Wednesday edition as Tehran responds to an attack by Israel against its giant South Pars gas field. This is developing right now with oil prices surging again and WTI approaching triple digits. We've been here recently, and we'll get the latest from the White House. We'll be checking with Bloomberg's Tyler Kendall. She's on the North Lawn right now. Fireworks underway on Capitol Hill with Senator Mark Wayne Mullin sitting for his confirmation hearing. Nathan Dean will have more from Bloomberg Intelligence as we track anger management from the chair all the way down to the witness. With analysis today from our political panel, Rick Davis and Jeannie Shanzano are with us. Let's get started with another man we want to hear from. That's Charlie Pellet. He's got his eyes on the markets at World Headquarters in New York. And Charlie, I'm trying to find the silver lining here. What's going on?
Well, what's going on? Stocks lower, oil higher, and Joe Matthew, all of this on a Fed Wednesday, no less. We got you covered. Just under 2 hours to go until we hear from the Federal Reserve. S&P right now down 0.6%. Energy, however, the big story. We're all focused on crude coming out of the Middle East, specifically the Strait of Hormuz. Let us begin with the latest Brent quote. Right now up 5%, 108.62 for a barrel of Brent crude. West Texas Intermediate crude, 98.35 a barrel. WTI up now by about 2.3%. Bottom line here, Wall Street does remain on edge as strikes on Persian Gulf facilities lift oil prices, stocks and bonds falling on fears that an escalation of the war could trigger more energy disruptions and fuel inflation. S&P down 39 now at 66.77, a drop there of 0.6%. So the S&P in retreat after 2 days of gains. We got the Dow down 452, down 1%. The Nasdaq Composite Index right now down 125, down by about 7%. The VIX holding just above 23 with a 10-year 4.22%, the 2-year 3.70%. Gold down 135 now to 48.70, down 2.7%, and Bitcoin down 4.3%, 71,320 on Bitcoin. Again, under 2 hours away from the latest Fed decision, Jay Powell's news conference at 2:30 p.m. Wall Street time. And by the way, our coverage will kick off at 1:30 p.m. Wall Street time. Officials are widely expected to hold rates steady. Stuart Kaiser is head of U.S. equity trading at Citigroup Global Markets.
You know, I think people are assuming the Fed's going to try to make this a non-event and keep it pretty close to the vest, right? I mean, they have to acknowledge the weak labor market report. They have to acknowledge the upside risk to inflation. But I think they'll probably try to downplay both of those in the sense that the labor market was good. We got 1 weak report. We're not going to make policy off of one report. And on the inflation side, look, it's been a 2 or 3 week disruption, and I think they're going to kind of focus on the short-term nature of that, but obviously flag the risks if this continues. But I think Chair Powell would like this to be as much of a non-event as possible.
Citigroup's Stuart Kaiser, and by the way, the Bank of Canada, they held rates steady and said it would look through the Middle East war's immediate inflation impact. Energy stocks higher today. ExxonMobil among the oil majors gaining 0.1%. Chevron up by 0.9%. ConocoPhillips up 0.8%. Bottom line here, oil is rallying. WTI, West Texas Intermediate, 98 a barrel up 1.9%. S&P down by 0.6%. Lots going on. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, we thank you. Not a lot of great stuff happening in this market today. It has a lot to do with what's coming out of Washington, of course, and as Charlie mentioned, the Persian Gulf. Connecting the dots here on Balance of Power every day, and this Wednesday edition included. Thanks for joining us on Bloomberg Radio. Streaming live on YouTube. Search Bloomberg Business News Live, unless you're already dialed into Bloomberg Originals. Get a grip, says the President of the United States. Our headline today is U.S. allies, he says, need to get a grip, step up and help open the Strait of Hormuz. This is just a One of several posts on Truth Social that we have seen from the President of the United States this morning, only to face a redhead just as we come to air here at high noon. It happens like that a lot. Enter the Vice President, who's in Michigan today talking about affordability. What will he say to oil executives when they meet? Yeah, that's the news. J.D. Vance to meet American Petroleum Institute board members on Thursday. He's going to huddle with the API. We look forward to convening key officials, says the Vice President. Energy Secretary Wright, bipartisan leaders in Congress and governors are going to have a big confab on the role of American oil and natural gas in supporting reliable energy amid global volatility. Yeah, you heard what Charlie said. Take a look. WTI, 98. We're above $98 a barrel. Remembering we almost kissed $120 at the outset of this whole experience. Brent crude has been in triple-digit territory for some time. It's above $108, up 5%. WTI is up 2%. I mentioned J.D. Vance in Michigan. He's actually talking right now. This is part of the affordability tour. Right there he is. If you're with us on YouTube, he's at the podium, and he's, I guess, going to have to get around to oil and gas prices, which in Michigan are up significantly since the start of this operation, as is the case around the country. I say operation, President's still calling it excursion. And we have a lot of news here, by the way. I'll get to what's going on Capitol Hill in a little bit. Half the cabinet seems to be sitting in testimony today, but we've had some pretty big developments in this excursion. The Pentagon says U.S. forces used 5,000-pound deep penetrator munitions on Iranian missile sites along the strait that, quote, posed a risk to international shipping, unquote. That clearly didn't make anybody feel any better. We also have news, and this is more the concern for the oil patch. Iran warned Gulf countries after Israel attacked its South Pars gas field that energy assets are now on the table. We can come blow yours up too, and that's why we're seeing this reaction here in the energy market, in the oil market. Listen to the way the president termed this last evening as he was presented with the Shamrock Bowl. Remember, it was Taoiseach Day yesterday. It's like a distant moment in the past now. The president talking about Iran at the White House. Listen.
We did a little excursion, and we're way ahead of schedule, as you probably noticed. And we've had, we knocked out their Navy, their Air Force, their anti-aircraft equipment, their radar, and their leaders. It's been amazing militarily, but it's something that had to be done.
Yet the strait is still closed, even as the president has repeatedly suggested that we've already won. Another post on Truth Social, and this one's got us wondering. Well, the president's wondering himself. He says, Tyler, I'm sure read this. We'll read it together here, Tyler. I wonder what would happen if we finished off what's left of the Iranian terror state and let the countries that use it, we don't, be responsible for the so-called strait. So-called. That would get some of our non-responsive allies in gear and fast. 3 exclamation points. Our Washington correspondent is on the North Lawn listening to me run through all of this right now, and she's back with us. Tyler Kendall, boy, I'm not actually sure where to begin today. Maybe we should note the fact that the president is leaving the bubble here to go witness the dignified transfer at Dover. What can you tell us?
Well, Joe, if we start with that, we're expecting President Trump to take off on Marine One shortly. You might be able to actually hear the helicopter whirring around us. He's scheduled 1:25 p.m. Eastern. That's when that dignified transfer is going to happen at Dover as we await those 6 service members who have been killed in Iran. As you all know, this happened last Thursday where we saw that refueling aircraft crash in Iraq. It included 3 U.S. Air Force personnel and 3 National Guard members. So that's going to take up the bulk of the president's schedule today. And as he leaves here, this is likely the only time that we're going to see him publicly besides for welcoming those service members back home. We heard from the White House Press Secretary Caroline Leavitt earlier today saying that this is going to be the focus of the president's attention. But of course, as you mentioned, we have also been getting some messages from him out on Truth Social reiterating the idea that the Strait of Hormuz is really the sole focal point at the moment when it comes to these ongoing operations in Iran.
Yeah, interesting. The president obviously is not happy with our NATO allies specifically, although he's isolated and pointed out Japan, South Korea, and others, Tyler, for not taking part in a coalition, international coalition, to help open the Strait of Hormuz. Remember back in the Bush days, it was the coalition of the willing. Well, there aren't many willing, if any, willing parties right now, Tyler. But the president has also indicated that we do not need them. What's the latest on this? He suggested that he wants an answer by Friday?
Right. So this came in a post from the president earlier today. He seems to be going back and forth between retreating off of his demand for allies to help secure the Strait of Hormuz, but also saying that ultimately we don't need them. Yesterday, he was asked directly which countries the U.S. was in talks with in terms of forming a coalition, after he had signaled earlier this week that one could be announced by Secretary of State Marco Rubio. And I think it's fair to say that he sidestepped the question and instead touted bilateral relations between the U.S. and Middle East countries. And as we've discussed about before, this is really highlighting what at this point has been long-strained tensions between the Trump administration and traditional allies when it comes to defense spending. There also appears to be this concern among our allies that if the U.S. if they don't act in the conflict with Iran, then we could see this White House disengage when it comes to the conflict in Ukraine. And I bring that up only because yesterday President Trump brought it up a lot, actually pretty unprompted, saying at one point, quote, "We've helped them in Ukraine, but they will not help us in Iran." So that's just another thread that we should be watching really closely here. But we've heard from a flurry of leaders and allies in the NATO alliance who have been wary at best of meeting the president's demand for naval escorts. It appears that that threshold to actually get involved and send assets is going to be a ceasefire, actually, Joe, for then maybe we'll see a coalition put into place to then ensure that that ceasefire would hold if we get to that point. But it's not just NATO allies, as you mentioned, others. I would say tomorrow's meeting with the Japanese Prime Minister, expected here at the White House, comes at quite the time. This meeting, of course, was announced well before the conflict started. And then also on China, if I could just quickly add, I did catch up with the U.S. Trade Representative Jameson Greer earlier today. Nearly 38% of the oil that flows through the Strait of Hormuz goes to Beijing. He told me that at trade talks earlier this week, U.S. negotiators made it very clear to China that it would be in Beijing's best interest if they get the Strait of Hormuz opened as quickly as possible.
Tyler reminding us she doesn't just talk to me while she's on the lawn. She's actually talking with members of the administration. And that's a full story. You can read on the terminal and online with Tyler's byline alongside Skylar Woodhouse. This is an important moment as Jameson Greer points to China. And you do wonder, Tyler, if that's going to be the message from this White House on a go forward here in the coming weeks. Like, hey, you guys use the strait, not us, so maybe you'll keep it open. The president seems to be indicating that on Truth Social. We'll see if there is some break in this standoff at some point soon. Tyler, thank you. Great reporting, as always. Tyler Kendall live from the White House. We're just getting started here. That's one end of Pennsylvania Avenue. You should see the anger management exercise that's taking place on the other. Mark Wayne Mullen before the Homeland Security Committee. This could be Secretary Mullen at the front of DHS. It looks like he has the votes, but not without some pain first. This is Bloomberg.
Wall Street, we do check markets all day long here at Bloomberg. Sources tell Bloomberg Vice President J.D. Vance and other key Trump administration officials plan to meet tomorrow with oil executives as the White House looks for ways to tame surging fuel prices after the U.S. attack on Iran. Those sources say the meeting will take place at the American Petroleum Institute and involve members of the Oil and Gas Trade Group's board. The Dow, the S&P, NASDAQ are all declining. This is crude oil advances. West Texas Intermediate crude right now trading higher by 1.5%, 97.63 on WTI. Barrel of Brent, though, above 108. Brent crude up now by 4.5%. So Wall Street remains on edge. The Dow, the S&P, NASDAQ all in the red. S&P at 66.82, down 0.5%. The Dow down 390, a decline there of 0.8%. NASDAQ is down 119 for the NASDAQ Composite Index, a drop now of 0.5%. The 10-year at 4.22% with a 2-year ahead of the Fed meeting coming up at 2 o'clock Wall Street time. That's when we get the actual decision. Jay Powell's news conference, 2:30 p.m. Again, the 10-year, 4.22% with a 2-year 3.70%. Gold down 2.6%, 48.77 the ounce. West Texas Intermediate crude 97.70 right now. Brent 108.19. That is an advance of just about 4.6%. After earnings, we do have Macy's shares down now by 2.5%. And Meta Platforms plans to open its first flagship store in Manhattan, expanding its push into physical retail. Shares of Meta Platforms down today by 0.4%. Again, recapping, S&P down 0.5. Balance of Power continues now. Back we go to Washington. Once again, your host. Here he is, Joe Matthew.
Hey, Charlie, thanks. We'll have more from Charlie Pellet watching the markets for us in about 20 minutes' time here on Balance of Power. Part of our program every day, live from Washington. Thank you for being part of it as well. You made it to Wednesday, and we have a lot to talk about. As the president prepares to leave the White House, we may actually be about to hear from him. I will let you know that the press corps has been gathered on the south driveway, right outside the south portico, for the president's departure to go witness the dignified transfer. This is the second time he has done this in this second term and since the strikes against Iran have begun. The president today will be in Delaware when the remains of 6 American service members arrive. These are the 6 who lost their lives in the KC-135 tanker crash just days ago, the refueling plane that went down over western Iraq, and it brought the U.S. death toll in Operation Epic Fury now to 13. Nearly 200 American service members have been injured, some of them very seriously. And so this is something that we obviously take great care to cover. And if you're the president of the United States, to witness and then meet with the family members. This is a very difficult day, I'm sure, that he and other dignitaries have ahead. And we'll be tracking his movements for you. Beginning with right now, we've got our eyes on the Rose Garden. It's a cold and windy day at the Rose Garden Club. The president will emerge from the Oval Office, maybe take some questions. We don't know. If he just strides across the grass and gets on the helicopter, we will move on, because we're watching as well what's happening today on Capitol Hill. The chairman is wavering, according to Senator Josh Hawley. He's talking about Rand Paul, who brought his not-friend Mark Wayne Mullen up to the committee today. The Department of Homeland Security is, of course, leaderless right now, and Mark Wayne Mullen, the senator from Oklahoma, is the president's pick to replace Kristi Noem. Rand Paul is in charge of the committee that will be, of course, dispatching this exercise. And you know they have some bad blood. I talked about this with Senator Paul on the program last week, remembering that Mark Wayne Mullen referred to him as a snake. There was another word in there that I can't use on the air because of his difficulty as a member, I guess if you ask Mullen, as a member of the Republican-led Senate. He's frequently a no vote. They don't get along. And I guess, you know, at that point, Mullen had even suggested that he understood why Rand Paul's neighbor attacked him, assaulted him while he was mowing his lawn a couple of years ago. So obviously there was going to be some fireworks here, and the senator promised that. Well, he was pretty coy about it when we asked him. He said, you will want to go to the hearing to find out for yourself. And here's how it went at the outset of this conversation. Listen.
You told the media that I was a freaking snake and that you completely understood why I had been assaulted I just wonder if someone who applauds violence against their political opponents is the right person to lead an agency that has struggled to accept limits to the proper use of force.
As far as my terms, the snake in the grass, sir, I work around this room to try to fix problems. I've worked with many people in this room. Seems like you fight Republicans more than you work with us. I did address those remarks. I did explain your gimmicks by the amendment you put forth. And as far as me saying that I invoke violence, I don't think anybody should be hit by surprise.
In fact, he was hit from behind. Boy, I guess, everyone just says that. I guess should have just said the quote. Rand Paul got to it. That was the beginning, by the way. It did not get better. And when Gary Peters, the ranking member, started his questioning, you start realizing, wait, Democrats and Republicans have a problem here. Unless your name is John Fetterman, he's voting yes. And it's funny, this is Washington. Everyone knows he's going to get confirmed, but we have to go through this exercise first. Hold on to that thought. It may have just gotten more complicated. This is a really remarkable development here. A reporter at Punchbowl posting a segment of this hearing, because, again, it's still underway here. Markwayne Mullen's trip to Afghanistan, which has been written about in most of the tip sheets and in a couple of papers ahead of the confirmation testimony this morning. Nobody knows what he did over there. He's talked about smelling the smell of war, that he's seen things he can't talk about. Gary Peters, again, ranking member, asks him if he'd go to the SCIF today to disclose details. Mullen says he can't because it's classified. They are now questioning why it's classified and pushing for details. Rand Paul says, I'm still willing to have the vote tomorrow, but I can cancel it. So like everything around here lately, it's getting more complicated as we go. Nathan Dean is watching this whole thing, so you don't have to. Of course, senior policy analyst at Bloomberg Intelligence. Nathan, what do we make of this? Could this vote go off the rails?
So at this point, I don't think so. I mean, obviously, we don't know what the situation is. We don't know what is actually going on in terms of what happened in that trip that Senator Peters is referring to. But, because the Senate Homeland Security Committee is 8-7, when Senator Paul says he's going to vote no, Senator Fetterman says he's going to vote aye, that puts it out of the committee. So that's where I think this is going. I don't think that Senator Mullen's nomination hearing, nomination is at risk here, but, it just goes to delay further work. And that's what we're seeing, especially with the Save America Act and what's going on at the floor at the moment. There's a lot of stuff that's happening in the Senate, but a lot of it is just being delayed by this type of political theater that you're seeing at the moment.
Mm-hmm. Is that all it is? I mean, if you're Rand Paul, it's pretty personal, isn't it?
Yeah, no, that's true. I mean, obviously, Senator Paul has a much more personal opinion here. And obviously, I think that, if they were to, get into a room, they would use other words that we can't use here on television. But what I would say is that Senator Paul is also a politician. And Senator Paul also understands that, this is not something that the Republican Party needs to have a fight over. I mean, if you look at President Trump's approval ratings and you just look at the prediction markets of where the elections are headed this moment, it's not good for the Republicans. So as long as this fight continues, it just puts up a picture for the Republican Party that this intra-fighting, if you will, sort of supports the narrative that there are challenges for this party going into the midterm. So even though both of those individuals, again, probably don't like each other and they're not sharing holiday cards, I do think that Senator Paul does see the benefit of trying to move this forward if that's where eventually this is headed. Because let's remember, even if it's blocked at committee, there are steps that the Senate can do to discharge it and put it directly on the floor, but it just takes a lot of time and a lot of effort, and that's effort that Senator Thune does not want to use at the moment.
Do we know anything about what this security work he was doing in the Middle East? He was in multiple war zones, apparently, before running for Congress in 2012. This is after he sold the plumbing business. There's been some reporting that he was working as a missionary. Nathan, do you have any idea what we're talking about?
I actually don't. I mean, Senator Peters' question was, outside of vacations, have you traveled anywhere abroad? And Senator Mullen said no. And then, Senator Peters came back and said, well, the FBI report said you had been to Georgia and Azerbaijan, and that you had been some work. And so then that's what started this rolling thing, this questioning here. But I'm definitely interested to see what our Bloomberg News colleagues come up with, because there seems to be something here.
There's apparently no public I said Afghanistan, but that's not what we're talking about here. Like he was careful not to mention his service I don't know. I guess there could be multiple theaters here involved, but I guess if it's classified, we'll never know, right?
Well, I mean, look, obviously, we'll see what the reporters come up with. I mean, obviously, you know, there's obviously some interesting reporting that it's going to come out from this. But at the end of the day, you know, I think this just really is another indication of delaying what is coming down. I mean, if you have like a DHS shutdown, you have a crypto bill, you have a housing bill, there's a lot of work here that Congress needs to do. And just when you get into this type of confirmation hearing and you push things off even further and you push votes off even further, it just delays. And because let's remember, we have this election coming up in November. So there is going to be a point, I always like telling my clients, it's around April or May, where all 435 members of the House and 1/3 of the Senate are like, get me out of this town because I need to go home and campaign for this election. And so if these delays add up, it's just going to make it even more difficult to pass legislation.
President Trump is concerned about more than this right now. He's concerned about I got to be careful, the Save America Act. Did you see him on Truth Social? He says, for all the fake news out there, is he talking about me? It's called the Save America Act, not the SAVE Act. Nobody knows what the SAVE Act means. Triple exclamation point. The first version was called the SAVE Act, right? If I lost my mind, the president says he will not sign. This is the priority. No legislation until this is passed, Nathan. Last time we talked a week ago, there were not the votes to pass it in the Senate. How about now?
Still not the votes. I mean, we had a client call in this morning and say, is there any way that the Republicans can get the votes here? And no, unless you are agreed to do away with the filibuster and you get a majority vote in the Senate, the votes aren't there, and we don't see the filibuster going away anytime soon. So again, what we're seeing here is Senator Thune is in a pickle. He needs to figure out a way to show that he's fighting for this for President Trump, but it's going to offer up multiple days of debates. I really feel for the senators right now because they have to stay close to the chamber in case there's a quorum called or anything like that. So there's going to be a lot of debates here and a lot of questions, but ultimately this is not going to go forward. And like I said before, every day they're spending on this, they're not working on something else. And especially when it comes to the DHS shutdown, I would just say is that, you know, we have a 2-week recess coming up. So if there's no movement on the DHS shutdown by next week, the Senate and the House, they're scheduled to be gone for 2 weeks. So, you know, there's a lot of work that needs to be done here. But again, the Save America Act is just not going anywhere.
You getting phone calls? You could tell me if I'm wrong. I'm guessing that people aren't calling a lot about the Save America Act, but maybe about DHS, so waiting in line at TSA. We have about 30 seconds. Nathan, what are people upset about when they call you?
Honestly, they ask if they should be getting on a plane or how early they should be going to the airport. And I say, it's not my area, but I can help you out there. But what I'll say is that, look, we saw both sides are blaming each other. And we saw a couple of instances, but I'm not sure if they're going to get this done next week.
Wowee. It's great to have you, as always, Nathan Dean, who's, by the way, part of this family at Balance of Power, not just on the program, but you can listen to Nathan's weekly Washington Policy Pulse call by subscribing to the Balance of Power podcast. We're all in the same boat here in the newsroom, and we thank Nathan Dean as ever for his insights. Our panel's on the way next. We've got Jeannie and Rick with us today, and we're going to talk more about what's happening here in Washington and the day after the Illinois primary. I'm Joe Matthew in Washington. This is Bloomberg.
6:40 on Wall Street. We do check markets all day long here at Bloomberg. Just over an hour away from the latest Fed decision. Jay Powell's news conference is at 2:30 p.m. Wall Street time. Officials are widely expected to hold rates steady. The Dow, the S&P, NASDAQ all in the red. Wall Street remains on edge as strikes on Persian Gulf facilities lift oil prices. West Texas Intermediate crude at 98.01 a barrel. WTI up now by 1.9%. We are seeing a bigger move in Brent crude, up almost 5%, 108.45 right now for a barrel of Brent. S&P down 41 to 66.74, drop there of 0.6%. The Dow Jones Industrial Average down 444 points, down 1%. NASDAQ is down 0.7%. The VIX at 23, the 10-year 4.22%, and the 2-year 3.71%. Gold is down 2.6%, 48.77 the ounce, and again, West Texas Intermediate crude, 97.89 a barrel, up by 1.8%. Getting word that Saudi Arabia has ramped up its oil exports to more than half of normal levels, despite the disruptions from the Iran war. Well, geopolitical concerns, specifically higher energy prices, certainly one major concern for the Fed. But what about the broader economic backdrop heading into today's meeting? Peter Cheer is head of macro strategy at Academy Securities.
So if you start seeing companies not get access to credit, you got to slow down there. I think individuals, we're seeing some of that again as well, where we've been talking about this for a little while, but the working poor, there seems to be an increasing number of people who have jobs and are still struggling to make ends meet. And that's a very unique situation. We've never really had a recession kind of caused by that. So I think these things are all adding together. And if I'm the Fed, I'm going to try and be more dovish. I don't think they will be, but I think there's risks from all sorts of things that are hitting us right now.
Academy's Peter Cheer interviewed this morning on surveillance. The Bank of Canada today held rates steady and said it will look through the Middle East war's immediate inflation impact. Again, West Texas Intermediate crude 97.87 a barrel, up 1.7%. Oil majors higher. ExxonMobil up 0.5%. Chevron up 1.1%. ConocoPhillips up by 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington as Balance of Power continues. Once again, your host, here he is, Joe Matthew.
All right, Charlie, we thank you. Charlie, we'll be back at the top of the hour as we count down to the Fed. 1 p.m. Eastern time. We'll have the latest as we welcome our global television audience here to Balance of Power. And indeed, less than an hour from now, our special coverage begins on this Fed Day in Washington. There's so much going on that the chairman is actually competing for attention today. Not from the president, of course. Donald Trump on Truth Social. When is too late, Powell lowering interest rates? That's all it says. DJT. Interesting as well, this break in gold that Charlie points to. Breaking recent support around $5,000 an ounce. The miners are following lower. We've seen some big declines. Agnico Eagle's down like 5% right now. Barrick, Newmont, all lower. With Scotiabank analysts saying that defensive price action is suggestive here of some fear heading into the Fed. So we're going to have a lot to listen to when Jay Powell, of course, reaches the podium. Statement at 2, you know the drill, news conference to follow. You'll hear and see it all right here on Bloomberg, on the radio, on YouTube, on TV, if you're near one. Get used to the name, Juliana Stratton. She is likely to become the next senator from Illinois. It was a primary night last night, and we talked a lot about this. Beat Raja Krishnamurthy by nearly 7 points and beat Robin Kelly by even more, winning the Democratic primary that is basically the equivalent of winning the general election, because we're talking about, well, Illinois. And we want to get through some of this. There was a lot of spending on these races and some down balance as well that got our attention. And so we assemble our political panel. Bloomberg Politics contributors Jeannie Shanzano, Democracy Visiting Fellow at Harvard Kennedy School's Ash Center, and Rick Davis, partner at Stone Court Capital, our Republican strategist, with us now. Jeannie, what do you think? This is kind of amazing, by the way. The lines like this jump off the page in 2026. Stratton would become only the 6th black woman to have ever served in the chamber. Will she?
She absolutely will. I mean, it is, for Democrats, a celebratory reality. But of course, for people who love democracy, love the government, love elections, it's a little bit troubling that in a lot of these very blue and very red states, we don't have general elections that decide who's going to go to DC. These things are decided in primaries. But it is, she ran an incredible campaign. She came well from behind, according to some of the polls. She had an amazing debate a few months ago. She's also somebody who speaks her mind. And I think Chuck Schumer, my state senator, has got to be a little concerned because this is somebody who said she wouldn't support him for leader. So she is somebody who comes to the Senate, and she will come to the Senate, I'm fairly certain, next year. And she is going to be thinking about changing a Washington, D.C. that she feels like, in a Democratic Party that she feels like has become too embedded. And I think that's why you saw the support she got from a very enthusiastic Democratic base.
Well, and a Democratic governor in this case. Stratton, of course, lieutenant governor, and it's J.B. Pritzker, Rick Davis, who's getting a lot of credit for giving her such a good run. Tammy Duckworth as well. And I'm just wondering if you're buying into this narrative this morning of the Pritzker effect, knowing that he's got his eyes on 2028. Is there such a thing?
Yeah, I mean, it's a bit of a risk to take if you're J.B. Pritzker, who's got his eye, as you say, on running for president, to sort of stick your neck out in a competitive primary. And what is he really going to get out of it? Well, he gets an ally in the state, and Illinois is not insignificant when it comes to the Democratic Party politics. But two, he shows some muscle to be able to sort of take his brand of Democratic Party politics and create a successor. And let me tell you, I know it just doesn't seem realistic, but like there are very few governors, very few senators who have successful efforts at placing a successor in their job. And he has found one to go into the Senate who's going to carry a Pritzker moniker into that caucus with Democrats in the Senate, some others of whom are also looking to run for president. So it's a gamble, but it paid off in this instance. But it also shows you that J.B. Pritzker is willing to stick his neck out, put his money where his mouth is. He's virtually funded this entire campaign with his own dollars. And now he gets to reap the benefits of that.
Well, is he a front runner for 2028, Jeannie, or was it too early for this conversation? Because we were talking about him in the last election.
Yeah, it's never too early, Joe Matthew, to have a good conversation about the next presidential election in the United States. Of course, we are in an invisible primary. We have seen so many people coming forward, whether it's publishing books, testing the waters. And yeah, J.B. Pritzker is, in the top of that group with a real shot. He has, of course, unlimited amounts of money. He's got enormous name recognition. I don't know if you have the clip of what he had to say last night about Dear Mr. President, but he was clearly out last night on his victory lap, trying to take it directly to Donald Trump, as he has been for months. So he is in the upper part of this group. And for Democrats, following along on Texas, there's a couple things about last night that are really striking, but top among them was the enthusiasm amongst Democrats continued. By some counts, they say the turnout amongst Democrats was similar to the last contentious Democratic primary in 2020. Those are big numbers, and that's, of course, why Donald Trump pushing for the Save a Vote Act and trying to take away mail-in balloting and speaking out against the sanctity of the election is so problematic for Republicans, because the enthusiasm is front and center on the Democratic side, and we've seen it now in 2 successive primaries.
We talked quite a bit yesterday about the massive spending that AIPAC was putting behind several congressional races. There were 4 of them, 4 primaries in Illinois. They got 2 out of 4. And but look no further than Evanston, north of Chicago, the affluent suburb where Mayor Daniel Biss managed to pull out a win here over a 26-year-old social media star and a state senator, despite the fact that AIPAC threw lots of money at this race. AIPAC spent, I believe, $21 million in total. And when the mayor got to the podium last evening, Rick, it was quite a moment. He said, "Enough about AIPAC. May tonight be the last time I utter their name. This victory belongs to J Street." And this is something that you've pointed us to here. We actually had someone from J Street on the program yesterday. And the incredible tension between these two groups, Rick, what does the race in Evanston tell you about AIPAC versus J Street?
Yeah, well, I mean, it is the definition of competing alliances as it relates to a common goal. Both J Street and AIPAC are firm believers in Israel being a reliable ally of the United States. They happen to disagree with the leadership, in Israel in the approach. And yet they have tapped into enormous amounts of political funding from people across the United States who believe that they should be supported because members of Congress who support Israel make America stronger. I buy that. And the fact that AIPAC has got an acid test on the kinds of pro-Israel supporters that they're willing to fund, as well as the opposite being in the J Street, makes for incredibly good political watching. I mean, these are folks spending tens of millions of dollars in these states. I think AIPAC spent $20 million across the board in these 4 races in Illinois. And that means it's having a significant impact on the outcome of these races. As you pointed out, they don't win them all, but they're definitely influencing all of them. And J Street, probably slightly less well-funded, but equally active in these states, are less of an acid test for candidates. And at this time, in this environment, they're finding a lot of uptick. So it's going to be a fascinating primary to watch these guys duke it out state by state.
What do you think about this, Jeannie, to the extent that we learned anything last evening? There was more than $30 million dropped in these 4 congressional primaries. AIPAC, as we've established, was responsible for more than 20 million of it.
Yeah, the numbers are utterly astounding when you think about it. And that race you were just talking about in the 9th was fascinating for so many reasons, including AIPAC's role. Because when their favored candidate didn't seem to be pulling, the numbers that they would have wanted to see, they turned and started pouring money into a candidate to keep and I'm going to butcher her name, Joe. How do you say it? Abba-Gazella? Off
sure.
I'm giving it a shot, off of the podium. And of course, then you had the former Evanston mayor, Daniel Biss, who himself is no, real moderate, win, but he might not have won, and we might have seen her win. And she is quite an interesting candidate from so many perspectives. She's young, she's media savvy, but think about the amount of money that was going in against her. So, AIPAC certainly had a huge impact. They are crowing about their successes, but of course, it's important to note that what they did was they kept somebody, they didn't really get their candidate, they kept somebody that they found objectionable from winning. And in another case, they got their candidate. And I also think it's noteworthy that they have been quieter about showing where their money is going, although, of course, Bloomberg has been able to tease it out, because we've seen support for not Israel, but the Netanyahu administration taking a hit in the United States for some time now. And they have to respond to that, which is where I think the sort of interview you did with the J Street head yesterday and the sort of differences between these organizations is so fascinating in these races.
Yeah, it really is. As we spend time with Jeannie Shanzino and Rick Davis, our great panel today, Bloomberg Politics contributors, the President of the United States getting on Air Force One. He did not, we should note, he did not take questions at the White House before he got on the chopper, and just now he's not taking questions at Andrews either. Up the staircase to Air Force One, they will move on to Dover for the dignified transfer. We're going to have a lot more, of course, in our next hour with our panel, and we're going to have the latest on the situation in Iran, including our conversation with Congresswoman Haley Stevens, the Democrat from Michigan, who's a candidate for U.S. Senate. Rick, I just want to touch on this really quickly with you, if you can forgive the change of topic. How important is it for the Commander-in-Chief to be present for these at Dover?
Oh, I think it's incredibly important. First of all, America has always highly treasured its service personnel. When we talk about expending blood and treasure, it is not an insignificant thing that we put people in harm's way to preserve the life that we live and the influence we have around the world. So when we do take losses, it's incumbent upon our leadership to honor those as they would honor anything else.
Well, I appreciate your saying that, Rick. These are the 6 who lost their lives when the KC-135 air-to-air refueler went down over western Iraq last week, and we'll have much more on that and the situation in Iran coming up in our second hour with our great panel, only here on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Counting down to the Fed against the backdrop of war. Welcome to the Wednesday edition, 1 hour from the announcement on interest rates. I'm Joe Matthew alongside Kaylee Lines in Washington. Kaylee, we're waiting for this news as Iran now threatens to target energy assets in the Middle East, of course, after Israel did the same, hitting Iran's South Pars gas field. This is why we're seeing crude oil on fire today.
Yeah, well above triple digits on Brent. We're now about $108 a barrel. And of course, when we look at what the Fed is going to be looking at as they make their decision today, We saw producer price inflation already this morning, hotter than expected. And that was before you saw what's happening in energy. So the question is going to be how this energy supply shock filters through into a wider inflation. And frankly, is the central bank poised to do anything about it from a monetary policy perspective?
Absolutely.
Can policy respond to it at all? The administration certainly is trying, as President Trump is now waiving, at least temporarily, the Jones Act.
That's correct, and also calling out the chair while he's at it, asking on Truth Social, when is too late Powell lowering interest rates? Apparently it's not going to be today, Kaylee, and that's going to make for an interesting news conference. We just saw Michael McKee making his way over to Fed headquarters, and he's got his questions handy as well.
Yeah, of course, Chairman Powell's not going to have to answer those kind of questions in this particular forum, at least for much longer, knowing his term is about to expire, but it's still unclear as whether Kevin Warsh is going to be able to be confirmed for the job, as Senator Tom Tillis is still willing to hold things up in that chamber over the investigation into Chairman Powell.
Good thing nothing complicated going on here. It does, of course, bring us back to the fact that gas prices keep rising. It's not just crude oil in the futures market here. We're looking at a national average above $3.80. It's $3.86 in Michigan, where J.D. Vance is today talking affordability, and where, of course, Congresswoman Haley Stevens is from. We're going to be talking with the Democrat in just a moment here on Bloomberg.
Yep, that's coming up shortly, but let's begin with a check on those oil, gas prices, everything else across the board as we turn to Charlie Pellet with the markets up in New York. Hey, Charlie.
Thank you very much. Indeed, 59 minutes to go until we get the latest Fed decision. Jay Powell's news conference, 2:30 p.m. Wall Street time. As you both mentioned, officials widely expected to hold rates steady. Oil, a major story. West Texas Intermediate crude now up 2.2%, 98.30 a barrel. Brent, 108.83, up 5.2%. Crude is rallying after Iran said some of its energy facilities had come under attack and is also threatening retaliation on oil and gas facilities in neighboring countries. Iran has listed energy assets in the region that it will target in response to a U.S. and Israeli attack on its upstream industry. Right now, the S&P is down 47, a drop there of 0.7%. We do have the Dow down 0.9%. The Nasdaq Composite Index down 188 for Nasdaq, a drop there of 0.8%. The VIX at 23, the 10-year ahead of the Fed decision, 4.22%, and the 2-year 3.71%. A retreat for gold amidst all of this, down 2.4%, 48.85 the ounce, but crude WTI 98.29 a barrel right now, up 2.2%. Brent up 5%, 108.84. Oil majors pushing higher. ExxonMobil up 0.5%. Chevron up 1.3%. ConocoPhillips up by 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back we go to Washington, and once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. Watching the markets for us as they wait with bated breath for maybe not the Federal Reserve decision, but certainly the news conference that follows and how Chairman Powell is going to speak around the potential inflationary shock that could be emanating from the Middle East as the war with Iran is now in day 19. The Strait of Hormuz still effectively closed, and therefore global energy markets, at least about a fifth of that global energy trade, is at somewhat of a standstill. Of course, much of what happens next will depend on how long this war continues, what the time horizon is. I'm sure we'll hear something similar from Chairman Powell this afternoon. And on that time horizon, President Trump has repeatedly suggested it could be a matter of weeks, but the U.S. is ahead of schedule. He again said so just yesterday.
We did a little excursion, and we're way ahead of schedule, as you probably noticed. And we've had, we knocked out their Navy, their Air Force, their anti-aircraft equipment, their radar, and their leaders. It's been amazing militarily, but it's something that had to be done.
President speaking at the White House yesterday. He's now wheels up to Dover, as we have been mentioning. The President of the United States on his way to Dover to witness the dignified transfer of 6 Americans who lost their lives in a tanker crash, a KC-135 air-to-air refueler that went down over western Iraq last week. We bring in the voice of Congresswoman Haley Stevens. The Democrat from Michigan is with us here. Michigan's 11th and a candidate for U.S. Senate. Congresswoman, it's great to see you. Welcome back to Bloomberg TV and radio. Just for starters, because we haven't had a chance to compare notes with you in some time, this excursion, as the president describes it, is something you support?
No, it's a war that he started on his own. Michiganders don't want this. They're paying for it. We have 200 injured. It's hitting us at the gas pump. It's hitting us in our pocketbooks. And it's something that the president began without the consultation of the American people and certainly of Congress. So I voted for war powers, and I continue to stand with the Michiganders who want something much better than what they're getting from this administration right now.
Well, of course, the administration, while it didn't ask for authorization for these combat operations, Congresswoman, may still yet come to you and your colleagues with a supplemental funding request in order to keep paying for these operations. Now, I'm not sure whether, given what you just said, you would be supportive of a supplemental, but if the alternative Republicans could pursue is budget reconciliation, a package that could theoretically include far more than just funding for the war with Iran, is that potentially a worst case scenario?
Well, I'll tell you who they're going to come to for funding. They're going to come to Michiganders who, $1 billion a day that is costing us. They're cutting food assistance, health care, education programs. We've dealt with reckless and chaotic tariffs that have threatened our manufacturing sector. Our economy has been rocked as a result of this. And now, those gas prices that are coming down on Michiganders who are just trying to get to their job, to pick up their kids from school, go to the store and get what they need to get, it's just another strangulation. It's not acceptable. It's not working for us. This is an overreach. There's no plan. There's no strategy. And I'm not going to go along with it.
Congresswoman, not mincing words today, as the average price for gasoline hits $3.86. It's almost $3.87 in the state of Michigan specifically, which, by the way, is slightly above the national average. Congresswoman, you sit on the China Select Committee, which steers our conversations pretty frequently when we talk here on Bloomberg. It's been suggested that China, if not Russia, but China, is the biggest winner from this action right now. Do you agree?
Well, we certainly see our allies going to our adversaries for energy. We've got this challenge with the Strait of Hormuz, as you've just mentioned, our own energy considerations now being challenged. And I want the world to see what we do in Michigan. That's where I'm always going to stand. We've got, the vice president bopping around my district today, going to a manufacturing shop. I've spent years, being with these manufacturers, advocating for them at the lawmaking table, and we've got to win the race against China from the place that I call home. But that race is not going to be won if we're pushing our allies into the arms of, the adversaries here, particularly on the energy costs and on trade. And so I've got a lot of concerns. I also have got plans. I've got bills that I've helped pass and bills to come on lessening our dependence on China for our supply chain, lowering costs, creating jobs. We've done that on chips. I want to do that for critical minerals. I want to secure our supply chain from the place that I'm so proud to call home. We're the best manufacturing economy in the world, and our state needs a champion. That's what I'm advocating for each and every single day here.
Well, you mentioned that the vice president is in your state of Michigan today. His remarks have concluded, but in part, he says, and this is a quote, "In November, it's going to be very simple. Do we support the people who made us hundreds and hundreds of dollars richer or the people who made us hundreds and hundreds of dollars poorer?" Referencing in part this administration's efforts on taxes, as tax returns are larger, at least at this point on average, than they were prior to the big beautiful bill being passed. What do you say to a Michigander who does have more money coming into their wallet in that regard right now? Should they not be glad that that policy exists?
Look, I'm going to tell you something. This administration is one big grift. They're the ones getting rich. They're the ones profiting off of cuts to programs that benefit so many Michiganders. To the fully paralyzed veteran who reached out to me last year asking if he was still going to get his benefit check because of Elon Musk prancing around a stage with a chainsaw. I just authored a bill called Stop Enrichment in the Congress. People here, we got to stop that stock trading in the House of Representatives, the Senate, and also in the executive office. And that's what my bill does. no sitting on corporate boards. Stop the grift here. And so we're all paying that price. I want to see tax fairness. It needs to go further for working Michiganders. They need more money in their pocketbook, not to continue to pay at a higher marginal rate than the corporations or in some cases the billionaires.
Congresswoman, you mentioned J.D. Vance. He is in your backyard today. Auburn Hills at a company called Engineering Design Services, which is involved in robotics, engineering, and design. This is something that the administration, this type of technology, has tried to harness, and it's something that you've been involved with as well, with your background in the auto sector going back to the Obama administration. I'm old enough to remember this. I wonder what your advice would be for J.D. Vance when he speaks to the workers at Engineering Design Services, what he should know about Auburn Hills today.
Yeah, well, look, the voice of our manufacturers and our manufacturing workers needs to be heard at the lawmaking table. We've got to ask in terms of what they're paying for erratic tariffs, what they have paid, what that's cost them, what policies need to come into place to secure our state and our workers to go and win the future. I've spent a ton of time in Auburn Hills visiting manufacturers from FEV to Borg Warner and on, people who were standing up during the COVID crisis to meet our supply chain disruptions and considerations, to make sure that Michiganders got masks and ventilators. There's so much incredible innovation going on in Auburn Hills, Michigan. And of course, what's going on with Canada? Is J.D. Vance going to say that we're going to open up that bridge, the Gordie Howe, that President Trump is shuttering? Because that impacts us too. That impacts trade. We've got in my congressional district, the second busiest airport in Michigan because of the freight that just goes on, between our trade partners. And yet those relationships have been diminished and impacted by some of these policies. So yeah, listen to our manufacturers and then do something.
All right, Congresswoman, thank you so much for joining us. Democratic Congresswoman Haley Stevens of Michigan, of course, also a Senate candidate for Michigan. Thank you for being here on Bloomberg TV and radio. And we want to play this conversation now to our political panel who is joining us. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano, Rick Stonecourt Capital Partner and Republican strategist. Jeannie, our Democratic analyst and senior democracy visiting fellow at Harvard Kennedy School's Ash Center. As we talk about J.D. Vance's affordability messaging, which the Congresswoman was just talking about, Rick, it's also worth pointing out that he did face questions in Michigan today about the war in Iran, what they're doing, what it is doing to gas prices, also about the resignation of Joe Kent, who until yesterday was the counterterrorism chief. Vance said, this is a quote, "Nobody likes war. I guarantee the President of the United States is not interested in getting us into the kind of long-term quagmires that we've seen in years past." It seems, Rick, that he's just trying to cast this as this is a different president, which is why I feel differently about something like this compared to how I always have historically. Is he doing a good enough job walking the line here?
I don't know if he's doing a good enough job walking the line. There's a pretty big split in MAGA over the incursion into Iran, and I know it's got to be difficult for him to try to please both the non-interventionists with those who are much more muscular on foreign policy. He's going to lose that fight. There's no such thing as being both. And I'd say he's probably already pretty well defined as someone who was very much in the America First line and has now sort of sacrificed that, which will weaken his prospects in the future if he plans to run for national office again. So I do think it's a political problem for J.D. Vance.
I don't know what Joe Kent is thinking about this right now, Jeannie, but a day after his resignation over the war in Iran, suggesting that there was no imminent threat. This is the head of our counter-terror agency. He's going to be on the Tucker Carlson program later on today. To what extent could he further exacerbate this divide within MAGA?
Oh, I think he's going to underscore it. And, Joe and Kaylee, I was listening, and I know you guys were, to the hearing going on today with Tulsi Gabbard, What a day on Capitol Hill for hearings. And one of the big questions that she was asked repeatedly had to do with this question of an imminent threat, because of course the intelligence community's assessment was that Iran did not pose an imminent threat. She was asked repeatedly to confirm that, because of course the president is saying they did. And she said that it is up to the president to determine what is an imminent threat and what isn't. And so this question, one also Carolyn Levitt has been asked repeatedly about what is an imminent threat, what is not. Is it up to the president to determine that? That is all the rage. And of course, as Rick was just talking about, it has split the MAGA base terribly. And Joe Kent, Megyn Kelly, Joe Rogan, I mean, the list goes on and on. Certainly Tucker Carlson are taking one side of this. And this is starting to look a little bit like the sort of fall off we found with George Bush.
Well, and it's incredible as we consider Gabbard's spoken testimony. She actually omitted something that was included in her written opening statement. She was going to say Iran's nuclear enrichment program was obliterated in Operation Midnight Hammer back last June, and that there, quote, has been no effort since then to try to rebuild their enrichment capability. But she did not say that out loud ultimately in her opening statement. Rick, what do you make of that?
Well, I mean, she would have been contradicting the President of the United States, who made a point that part of the concerns they had was that the Iranians could reproduce their enrichment program and come out with a potential bomb, nuclear bomb, sometime in the very near future, which has helped precipitate the attack on Iran. I would say, just as a point on this MAGA split, even though there is a fight in MAGA over this, it has not actually inured to the weakness of the president. He is still getting 90% of Republican support for his efforts in Iran. And so even though there is this fight at a sort of policy level, if you want to call it that, it hasn't risen to the political level yet.
Wow, how come that is, Rick? What do you make of that? And could that change if, you know, this becomes a weeks, if not months-long endeavor and oil prices keep rising?
I mean, the reality from my perspective is Donald Trump is seen as a powerful, you know, aggressive fighter. And these characteristics are what the MAGA Republican Party like about him. They're much less concerned about specific issues. And if President Trump says, we're going to take a U-turn and go in a different direction, I believe at least for a while, he'll have the command of that party behind him. The question is, and this is, I guess, the point that J.D. Vance was trying to make, is how long is that patience going to last and when does it run out? Because I think that's on the question of everybody's lips right now. What are we in for here?
What are we in for here? Great question that we will keep asking with the help of our panel. Thanks to both of you. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano, our great panel on Balance of Power. As we count down to the Fed, but we will have more on Iran coming up here on Bloomberg TV and radio as Clayton Siegel from CSIS joins us with the latest from the Strait of Hormuz, which largely remains closed. WTI West Texas Intermediate ever closer to triple digits. This is Bloomberg.
1:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks lower, oil higher, Wall Street on edge. Our Fed coverage minutes away. Right now, we're at the lows of the day with the Dow down 46 to 66.69. That is a drop there of 0.7%. The Dow down 425, down 0.9%. NASDAQ right now down 0.8%. The VIX at 23 with a 10-year, 4.22%. Gold down 2.3%, 48.89 the ounce. And West Texas Intermediate crude 98.06 a barrel. Brent 108.38, up now by 4.8%. Macy's after earnings up 5%. Micron after the bell up 0.8%. And that is a Bloomberg Business Flash.
All right, Charlie Pellet at World Headquarters in New York. We thank you as ever, and Charlie will have more, of course, helping us set the baseline on the markets before, during, and after the Fed. Our special coverage begins less than 10 minutes from now. I'm Joe Matthew alongside Kaylee Lyons here in Washington with our eyes on Iran. More specifically, the Strait of Hormuz, which remains largely closed, save for a couple of vessels that managed to get through over the past couple of days. And that is why we're seeing West Texas Intermediate closer to 100 and Brent closer to 109 this afternoon. We heard about this earlier today on Bloomberg TV and radio in conversation with Jeff Curry, Chief Strategy Officer of Energy Pathways at Carlyle. Here's his take.
The type of oil consumption that's left in the global economy is critical. And so if you pull those barrels out of the system, the rippling effect or the cascading effect through global supply chains is going to be significant. You go from gas to urea, urea to fertilizers, fertilizers to the dinner table.
And to our table here in Washington with Clayton Siegel, who's Senior Fellow at the Center for Strategic and International Studies. We have the voice of another expert. Clayton, it's great to see you, and welcome back to Bloomberg TV and radio. We're talking weeks, maybe months. How much worse could this get?
Well, it could get considerably worse. The oil market is always trying to price both the duration and the volume of a disruption. And for the past almost, let's say several weeks, we've seen almost no oil and gas cargoes coming out of the Gulf. As you said, Iran is playing a bit of a gatekeeper function right now, deciding which of a few handfuls of ships have been able to get out, maybe get to China with some oil. But for the most part, the Gulf is still paralyzed to oil and gas traffic.
Well, and of course, the traffic is one thing, but there's also the question of the actual infrastructure that produces it in the first place. And Iran is now declaring that that infrastructure is fair game to be targeted, actually sending out a list of targets that could be aimed at for retaliation for Israel striking its South Pars gas field. This kind of escalation, is this the worst case scenario for the global energy market?
It really is among them, Kaylee. We looked at some scenarios like this for escalation before the war started, and one of them was about the two sides not just blocking each other's exports and shipping, but actually destroying offshore facilities and even onshore facilities that could take a really long time to repair and keep this supply offline for longer. And then you start to get to pricing in the oil market that's really around demand curtailment. And I think back to 2022, when the national average price of gasoline in the United States hit a record $5 per gallon. I hope we're not heading in that direction, but there are signs that we may be, especially in Asia, in the physical market. That's different than what we see on the ticker here, where it's only around 100. Up there, refined product prices are closer to 200 in some cases.
Wow. Well, you know, the administration's playing all the greatest hits when you get into this territory. We've already had a release approved from the SPR. A president today waiving the Jones Act, which is something that we saw coming. It allows foreign flag vessels to carry goods between U.S. ports, and it gives a 60-day window. Will that make any difference?
By itself, in isolation, it might not make that much of a difference in terms of pump prices. It allows the Gulf Coast to supply the East Coast a little bit more easily and at slightly lower cost to the midstream companies. But it's not really going to put a dent in $4 a gallon gasoline, $5 a gallon gasoline, if that's where we're headed. To do that, you really need those supplies, which are critical for world demand, to be resumed from the Middle East Gulf. There's really no substitute. And all of these policy accommodations that we're talking about here in town can really just buy us more time to get to that ultimate outcome.
Okay, so basically there is no policy fix for this particular problem, despite what the administration might wish. So what does that mean as we're now half an hour or so away from a Fed decision about what the monetary response is is likely to be. As you talk about the idea that you need demand destruction come in, can higher interest rates fix the supply shortage problem realistically?
I don't think so, Kaylee. I think that in this environment, the number one concern is a return of general inflation. And we've fought a lot of battles in recent years to tame inflation. Monetary policy is a huge part of that. And the question now is, does the Fed have room to further cut rates if we're worried about a resurgence in inflation that comes not only from the direct effects of higher oil prices, but Joe, as you said before the segment, the cascading effects through the economy, which go to agriculture, they go to the paralyzed nature of shipping around the world and not enough capacity to move stuff around. All of this is macroeconomic risk.
Even helium is being held up, which doesn't have to do with party balloons, but in fact the creation of high-end AI chips is being used to cool these data centers. It's amazing how many tentacles there are coming out of the Strait of Hormuz. The president likes to talk about the pipes. He says, I call them the pipes. He's referring to the gas pipelines on Karg Island, which he chose not to bomb when we struck Karg Island a couple of days ago. What would happen if we did?
Well, in the scenarios we looked at, there's 3 levers that we could play with Karg Island, which is so important because that's where the Iranian crude exports originate. We could destroy it, but as the president pointed out, that would really be doing a disservice to the Iranian people. We're supposed to be going in to rescue them, help them with the future after this regime. We could try seizing it. We could land troops on Karg Island and get our hands on the spigot, but our troops could come under fire there. I think that that's a big risk to consider. I think that we could accomplish what we want to do if we repeat the success story from Venezuela, a naval quarantine that blocks ships carrying Iranian oil from getting to market. That would maybe level the playing field a little bit with Tehran at less risk to our servicemen and women.
If we hadn't gone into Venezuela and have the accessibility of that oil now in the global market, how much worse could this have been? What difference really is it making?
I'm afraid to say it's not making a difference at all. The extra oil from Venezuela is maybe just a couple 100,000 barrels per day. There's still around 1 million barrels per day in a 100 million barrel per day market. Yeah. It's a drop in the bucket compared to missing 10 or 15 million barrels a day from the Gulf.
Interesting. The idea of committing troops or special ops commandos, whatever we call them, to a place like Karg Island, or, for instance, to seize the enriched uranium that we've still not located. Would that be a market-moving headline to the extent that we're seeing now? Would we see further gains in oil on such a thing that many folks think is inevitable?
Well, we have a split market right now between futures, which are generally sanguine about risk, and the physical market, which is getting ready for shortages. So I think we would see price effects in both markets, and they would read it in the way that they want to read it to validate their position. So I think some people on the futures market may say, hey, it's almost over now that the U.S. is intervening on the ground. But in the physical market, they'd be worried about those supplies.
Well, as we consider that the U.S. is considering at least sending even more personnel and assets in, the president has also asked the same of allies like Europeans, who he argues, and he's right, are more exposed to this particular energy story. If you're Europe, already cut off from Russian natural gas by and large, you now have a major problem if you also can't get LNG and the like out of the Middle East. Knowing that European central banks have decisions to make this week, the ECB and the BOE on deck tomorrow, how much worse is this going to be for Europe in particular when it comes to the energy story?
It will be worse for Europe in certain fuels markets, like the middle distillate grouping, which is things like diesel, close to jet fuel. You know, Europe will have problems supplying if there's a real outage, but the number one region for concern of running shortages by far is Asia. Japan gets 78% of their supplies from the Gulf, South Korea 62%, and China, which needs 11 million barrels per day to run the show, gets about half from the Gulf. The overarching problem here is that Iran basically now controls not just the Strait of Hormuz, so we don't want to over-index there, but the whole Middle East Gulf. Until that situation changes, we are at risk of real supply shortage.
The $5 diesel was a big headline yesterday, the fact that it's used for so much global shipping. What would continue increases in diesel mean for not just the energy market, but the global economy?
That's what we worry about in terms of the transference into the macroeconomic story and GDP. Because if it costs more, so diesel is the fuel of the 18-wheeler. It takes everything that we buy from market or port to stores and ultimately our doorsteps. And if they have to start working in higher prices for deliveries and transportation, prices for everything are going to go up.
All right, Clayton Siegel, Senior Fellow at the Center for Strategic and International Studies. Thank you so much. Prices for everything going up, exactly what the Federal Reserve does not want to be hearing or considering right now, is they're still above their inflation target.
And Chair Powell probably will hear that when reporters start asking questions. We'll have the decision for you at 2 o'clock, the news conference that follows, and special coverage that starts just moments from now. Alongside Kaylee Lyons, I'm Joe Matthew in Washington. We'll meet you on the late edition of Balance of Power here on Bloomberg.
In case you missed it on the opening trade.
This time last year was too optimistic on all counts. So I think, yes, the market's asking for the hyperscalers to show a little bit more proof in the pudding. Last year it was, oh, wow, you've raised your CapEx numbers. You're convinced. I must be convinced. Now investors are saying, I need to see the ROI on this CapEx before I want you to do more.
Don't miss the opening trade, live every weekday.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
Live on Bloomberg TV and radio, counting down to another Fed rate decision, 27 minutes away. Hearts and minds in the Middle East. The pressure building on Chairman Powell. That decision just around the corner.
Yeah, a real question here, how this Federal Reserve positions themselves after not having a chance to really address the oil shock taking place in the Middle East, higher prices, and the fact that you already have inflation running hotter than they would like to see in core PCE, as well as the PPI that we got earlier this week.
Robert Kaplan calling this a medium war in Foreign Affairs magazine. Has the Federal Reserve System ever dealt with a medium war? I don't think so.
What's changed for this committee? The last time they met that morning, crude was 62. Crude this afternoon is $30 higher. Plus, that's a big change for this committee to think about.
Do they say we are going to look through this? Are they going to say that typically oil price shocks are transitory, if you have to use that word, and that they will look through it and focus instead on weakness in the jobs market? Or are they going to say we are very concerned about inflation, we have remained above our target for too long, and we need to take action?
John, a headline here off of Bloomberg. Patrick Sykes in Istanbul, Dan Williams in Tel Aviv. U.S. aims to curb soaring oil prices. Is this more than we've ever seen? The central banker to the world.
What options do they have? We've seen escalation in the Middle East throughout today already. It looks like we have a new front for this war and its energy assets, and Iran is vowing to retaliate. That's where the pressure's coming from this afternoon for this committee, attempting to provide forecasts at 2 p.m. Eastern time. Good luck to them.
Really just get a dartboard, get some darts, and start throwing, because that's essentially as good as they could potentially get. In the meantime, we are seeing an escalation here with a focus not just on storage bins filling up, but actually some of the production facilities are actually being taken offline. Again, is this inflationary or is this deflationary down the line? Ultimately, economists can debate that. The Fed doesn't have that luxury based on the numbers they have.
So let's get the scores going into this one. We'll start with stocks. We'll go to commodities. We'll finish on bonds. The equity market this afternoon shaping up as follows, declining across the board on the S&P 500, down by 0.7%. On the NASDAQ, just off session lows, down by 0.7. Also in the commodity market, very close to 110 a little bit earlier on in the session. 108.40 right now, higher by close to 5%. And that sets the tone for this, the bond market. What a round trip this fixed income market has been on. 10s were down 30 basis points in February. Then all of a sudden, a round trip for the first few weeks of March.
Yeah, and whether we opine on where it's going to go matters less than who we have coming up shortly. JP Morgan's Bob Michael, Kathy Jones of Charles Schwab, and Satyen Subhadrajapa. They will be taking us up to that Fed rate decision at 2 p.m. Eastern. Then we get immediate reaction from former Fed Vice Chair Rich Clarida, Stephanie Roth of Wolfe Research, and Diane Swank of KPMG. And finally, breaking down Chair Powell's news conference, which he hopes to make as boring as possible, but I guarantee it will not be. Apollo's Torsten Slok and BlackRock's Jeff Rosenberg.
Does he do an 8-minute press conference? Is it going to be like when we were at Jackson Hole?
I said earlier on this morning, TK, I was like, look, it's Operation Epic Fury in the Middle East. It's Operation Make It Boring at 2:30 Eastern time.
If he doesn't say something in response to whether he's going to stay on, if he doesn't say something about whether this is inflationary or disinflationary, ultimately it will be news. You can't make non-boring boring.
Chris Condon in Washington says this is a big deal. Is that really a focus here?
I think it's got to be a focus. You have to ask the question directly of the chairman, where are you going to be after May? Is this your penultimate meeting? Is the next meeting your last one?
If you can't tell that, what exactly are you doing with forward guidance? How do you give forward guidance if you don't know the people in the seat, especially if there are dissents and the different people have very different views?
Bob Michael of JP Morgan Asset Management, charged with answering some questions. He joins us now. Bob, good afternoon. Good to see you.
Happy to be here.
Let's get to it. Three-part act: statement, projections, news conference. What are you expecting?
Well, first, I think this is the most mesmerizing FOMC meeting since COVID, and I mean that. The three things we're going to look at, as you laid them out, we're going to look at the post-meeting statement. We're going to see how the Federal Reserve characterizes the impact to risk on both sides of its mandate, full employment and price stability. They should say they're elevated. Secondly, you've got to go to the summary of economic projections and see how they reflect them in there. They can't just say, oh my goodness, we don't know, we can't do anything. They can't keep their head in the sand. Even if it's only decorative, they should raise PCE by a couple tenths, they should raise core by a tenth, and then also they should probably tilt unemployment higher by a tenth to reflect the elevated risk to both sides of their mandate. I think when you look at potential rate cuts, they should leave one rate cut in for this year and one rate cut, leave one rate cut in for this year and one rate cut for next year. The third part of this is the dissents. To us, that's the most critical thing. For sure, you can write in pen that Myron will dissent for a 25 basis point rate cut. But will Waller and or Bowman follow him? If they do, that tips the Fed's hand onto what they should be more worried about, the impact to price stability or the impact to the labor market.
What's the likelihood that with this two-sided risk, they introduce or reintroduce the idea of rate hikes over the next 12 months?
I think pretty much zero. I don't see that probability, and I know there's a tremendous amount of conversation on the ECB, for example, that they're a single mandate policy, price stability, so they should be hiking rates. But let's not forget, even there, Christine Lagarde is the chair of the ECB. She was the finance minister of France back in 2008. And after the ECB hiked rates in 2008, she came out very publicly to criticize it, as did President Sarkozy. So I think central banks have learned from 2008 and also the ECB from 2011 that when you have this sort of geopolitical orthogonal shock to the system, it's going to tighten financial conditions somewhere. You don't pile on by hiking rates unless you see it passing through to core prices and then ultimately to wages. We're a long way away from that. I don't think they'll open that can of worms.
Let's avoid right now the 5-year, 7-year, 10-year certitude of private credit. Let's go the other way to the short-term market. What does JP Morgan see in the plumbing of our financial system into this meeting?
Well, there's the bank lenders and the non-bank lenders. And the bank lenders are heavily regulated. The public markets are heavily regulated. The non-bank lenders, not so much. I think that's where you've seen some of the volatility in the private credit markets. And of course, there is that concern when you see that kind of volatility and when you see a lot of holders try to head for the exit. But the system seems to be working. There are 5% redemption clauses. Those are being exercised. That's fine. I think the big concern to everyone in the markets is private credit hasn't been through a shakeout yet. It's been chugging along for the last 15, 18 years. It's a post-GFC. Recessions create the ultimate shakeout.
John, do we agree that if we didn't have a war, private credit would be the #1 topic?
Without a doubt. Lisa's been talking about the same thing. I'd say that. I'd say AI disruption. And those two issues are still percolating. It's the accumulation of risk, I think, over the last 2 months, Bob, that gets everybody's attention. Is that a headwind to this market?
Do you know what's so funny is I pulled up financial indicators, financial condition indicators. You pull up Bloomberg's, it's gone nowhere. You look at market pricing, it's gone nowhere. I think that's a question for Jay Powell. How do they interpret financial conditions indicators, is there a sense of complacency across the market? Yeah, there are all these concerns out there, but perhaps there's so much liquidity in the system, it just overwhelms the concerns for now.
We've certainly repriced energy. You've seen that in the price of crude across the futures curve. We've repriced interest rates. You've seen that in the Federal Reserve and the ECB looking out 12 months. What's curious to me is the extent to which we haven't repriced economic growth for this economy and for elsewhere.
Stagflation is a terrible recipe. It's a terrible recipe for growth. And if you have an increase in oil prices that go beyond this current level that you see, you start to wonder when credit's going to pick up on that, beyond just the disruption. If you add to that some sort of shock that will potentially suppress growth.
We're super lucky that capital markets are still wide open.
Correct.
We've talked about this a million times. Markets can shape the events they anticipate. The fact that we've still got credit spreads that are still pretty tight. The fact that this month alone, we had the biggest single day of US IG supply, and it was met with tremendous demand, is good news. Whether you think it's complacent or not, it could be a whole lot worse if those things weren't happening.
And it raises the specter of how fragile they are. And that's really, I think, what people are gauging. Is there something that Fed Chair Jay Powell could say that could potentially disrupt that complacency or that openness that we're seeing in capital markets?
Do you want to announce a Mag 7 bond offering on the show today?
Do you want some 100-year alphabet?
Yeah,
Can we pitch some 100-year alphabet?
You know what? We work with these companies when the issue. The reality is they see a lot of demand out there, and they've got to build the capacity to get that demand monetized. So it's real for now.
Is this a sales call? I think
it's good to see you, Bob. You're going to be sticking with us, I'm pleased to say. Bob Michael of JP Morgan. Up next on the program, we'll catch up with Kathy Jones of Charles Schwab, Subhadra Japa of SocGen. That conversation just around the corner. Heading into this, a Fed decision just moments away.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I believe that talent is equally distributed, but opportunity isn't. But education can give everybody the opportunities that they deserve to fulfill their potential. That's why I got involved in politics and why I got involved in the Labour Party.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism. This week, the Fed's reaction to the Iran war with Randy Quarles, former Fed vice chair, how Australia's attempt to limit social media for young people is working out, and a different view on AI. What if, after all, it's simply a normal technology and not the revolution some predict?
Let's look at reliability separately from capability. Capability is not enough.
Watch Wall Street Week. More than what you need to know, it's what you need to think about.
We're in the fog of war. I think the Fed's in the fog of war as well.
The pressure's there, right? It could complicate from an inflation picture.
We have the greater risk of a stagflationary scenario, and that is problematic for the Fed.
There's much more concern about the stagflation risk.
That now puts them in a very, very difficult position.
Not just inflation shock.
This is creating a bit of a growth shock.
The Fed is going to be cautious.
I think the Federal Reserve should just stay on hold here.
On hold here. It is on hold. On hold.
On hold.
Wait and see. We hear wait, careful. We hear a lot of words like that.
It's a wait and see game.
I don't think that the Fed will be as dovish as they have been.
So I wish they just, not be hawkish or dovish, but be honest.
When oil prices go up, headline inflation goes up.
The big piece of this is how long this energy shock lasts.
The Fed will have to increasingly acknowledge the two-sided risk from this.
This divided Fed is going to look even more divided.
Certainly the politics are swirling around.
Their motto for the March meeting should be one battle after another.
Live from New York City this afternoon. Good afternoon, good afternoon. That Fed decision, 15 minutes away. The scores into it look like this. Equities declining by 0.7% on the S&P 500, down by 0.6 on the NASDAQ, sending a tone for financial markets worldwide. These moves in the commodity market, Brent and WTI, a major rally over the past few weeks, just short of 110 on Brent and up by close to 4% on the session, and a big move at the front and long end of the curve over the past few weeks. Twos around 370, tens still through 420.
Right now, Fed funds futures have priced out a full rate cut for the remainder of 2026 as they see some of the increases in inflation. Does the Fed now lean into that and confirm that and say, look, we don't plan on making a move?
Let's get to Kathy Jones at Charles Schwab. Kathy, welcome to the program. We've had the energy shock. Now the Federal Reserve needs to provide some forecasts. What does this mean for inflation, for growth, and ultimately, what does it mean for policy? What are you expecting?
Well, I think there'll be a lot of confusion. I'm not really taking the SEP or the dots very seriously this time around because I have to be like throwing darts right now. Given that we don't know how long this lasts, it's already lasted longer than the consensus, and therefore, when they're making these forecasts, I think it's just really a guess on the part of the various members. If you remember during COVID, they actually suspended the dots because of the uncertainty. I don't think they'll do it this time around, but I think it would be really, really difficult for anybody to pin down a really precise estimate. But I'm going to be interested anyway to see the dispersion of the dots, to see what they do with their estimates. I'm assuming the estimate for inflation goes up and estimate for unemployment goes up just to reflect reality on the ground. But in terms of what the Fed really probably is concerned about right now is inflation expectations. So when I'm looking at those break-evens in the TIPS market, they're just continue to move up and move up, but they've really focused on inflation expectations many times in the past. So I think that may be a real concern for them as they look towards setting policy down the road.
Do you agree with Bob Michael, who just said that this is probably the most interesting Fed meeting since the pandemic era where they had to decide what to do and when they did suspend those dots?
Yeah, I agree with Bob. It's just very difficult situation for any investor and certainly for the Fed. How do you make a forecast when every 12 hours something new happens, right? But I will say, having maybe experienced oil shocks in my past, I think the one thing that probably the Fed that will resonate with the Powell and other members of the Fed is they don't want to make the mistakes that were made in the past, even if it's a bit different today. And there's differences in supply. The 1970s were, a disaster because the Fed was too late to address the inflation coming from the oil price shock. So I think that that's a mistake they really want to avoid.
Bob, with this uncertainty, you're the only one I know who read the 1,100 pages of Febosi. Are the dynamics of the full faith and credit bond market working right now? Describe what your pros see, the nuances of the bond market given this new uncertainty.
I think they are. And I know we can sit here and say, over this period of time, rates have risen 30 basis points. But I look at them and I come on, 370 on the 2-year. The Fed funds rate is 3 5/8. That's flat to the Fed funds rates. That's where it's supposed to be. A little steepness out to the 10-year. This is all within sort of the range that it's been in. What we're hearing from clients is they're looking for an opportunity to get into the bond market. They feel underallocated to it. They sense there's a little bit of a backup here. Is this the time to get in, and where do they get in? I also want to remind people that the Fed went into this Iran war concerned about the labor market. It was no hire, no fire, for good reason. Businesses didn't know what the shape of tariffs would look like, and everyone was concerned about AI. You didn't want to hire somebody today. You might have to fire 18 months from now. Now you pile on top of that, businesses and households are facing attacks from higher energy prices. So businesses for sure don't feel like doing any hiring now. I think they're going into this meeting even more concerned about the labor market than the pass-through of this orthogonal oil shock.
How many times have we heard that this week, that all roads lead to buying bonds? that if the shock continues in the Middle East, buy bonds, it's going to hit growth. If it goes away, buy bonds, yields are backed up too much. Just buy bonds seems to be the conclusion.
Well, I know one bank CEO who would take the other side of that.
That's
and
fair.
I heard that yesterday.
Well, I will say the counter argument to that is if the Fed actually is overly dovish, do you start to see a huge sell-off and an increasing possibility of there being a 1970s style shock where wage growth follows some of the increases that we're seeing in commodity prices?
So, Kathy, let's come to you on that. The assessment of second-order effects, the potential for pass-through to core good prices, pass-through to other prices in the economy.
Yeah, I think it's a real risk to the economy that we're going to see some pass-through. You know, consumer demand has been resilient despite all the problems that we're having, say, in the labor market and elsewhere. And if that continues, then the ability to pass through the price increases will be there. I do think that that is, again, a risk that the Fed has to deal with. Even if the labor market weakens from here, how much weight do they put on that if we're seeing core goods prices continue to go up? And they have been above the Fed's target for now, 4 years? And not making any progress towards their target. So it's really a difficult position for them to be in. Yes, if the unemployment rate really starts to ramp up, then that means demand destruction. That means the Fed will ease. But until I think that dynamic starts to happen, the focus is going to be on trying to contain the inflation pressure passing through from oil prices.
Kathy, just a final question for you. The Fed chair, his last scheduled meeting should be April 29th. Do you think he's going to be there June 17th?
It's looking more likely all the time. Can't handicap it real well, but it's looking more likely all the time.
I can tell you, break exclusive, is that what you call it, TK? Break exclusive?
Yes.
Kathy won't be there. Kathy won't be there because Kathy is retiring. Kathy, can I just say on behalf of us all, thank you so much for your contribution to this program over the years and how lucky we've been to catch up with you every single Fed meeting. Kathy, before you go, a word of wisdom on fixed income. What's the biggest lesson in your career? What can you pass on to a new generation?
Oh, you know, I think fixed income is wildly underappreciated and not well understood by most investors. I would say, you know, do your homework. It's a great place to invest.
Is that shade on Liz Ann Saunders?
No, absolutely not.
Every fixed income pro, even when they're exiting, throw some shade at equity strategies. Every single time.
Well, you know, it's a smarter asset class, so there we are, you know.
Hey,
Swan song.
Kathy's a class act. Wishing you the best in retirement,
Absolutely.
Kathy.
Hear, hear.
Thank you. And thank you to all of you at Bloomberg for having me on so many times. It's really been a great honor. You always make everybody feel comfortable and able to speak freely. So I really have appreciated it.
Kathy, we're the lucky ones. Thank you so much. Best of luck. Kathy Jones there of Charles Schwab. Bob, throw me shade at equity guys all the time, right? It's just a fixed income religion.
Well, you know, I'm backing off of them now. I know they're down there
you're kind to them.
They're down there at the bottom of the capital structure, absorbing all of this volatility. You have to have some sympathy for the junior securities guys.
There you go. Nothing changes, right? Nothing changes. Subhadra Jaffer of SocGen joins us now. Subhadra, welcome to the show. Decision about 6 minutes away. What are you expecting to see at 2 p.m. Eastern Time?
You know, I mean, congratulations to Kathy. I think it's fantastic. And I completely agree with her sentiment that people don't pay as much attention to the bond market as they should, because you get a lot of very, very useful signals in the bond market, including what you're seeing right now heading into the Fed meeting. I mean, the front end is starting to push higher. The market's pushing back on the possibility that the Fed will be able to cut this year. You know, in fact, we're pricing in for no cuts for this year. And I also agree with Bob. I think that the market is, you know, with the 10-year yields and 2-year yields, for the most part, within that range that we've had for the last 6 months, bonds are still the place where you want to put your money to work because of the fact that even if the Fed doesn't hike rates, and the front end of the yield curve is going to be pegged somewhat, I think investors are going to flock to you know, the belly of the curve, given the fact that as the Fed stays on hold for longer, your risk is that they might have to cut more in the future, and that might impact growth. So to us, it feels like the belly is going to continue to outperform. As for the Fed meeting, I think I'm expecting, you know, this to be more of a placeholder meeting. I'd probably expect more of a bearish bias, or a hawkish bias, I should say, for the Fed. The changes to the summary of economic projections are going to be quite interesting. I'm expecting them to push up their expectations for headline and core inflation and perhaps bring down their expectations for growth for this year.
Subhadra, have we seen the peak in the yield curve so far? We've seen now the 2-10 spread now at the tightest going back to November of last year as people price in the Fed remaining on hold for longer and lower long-term growth projections. Is that trend going to continue?
I think that the 2-10 curve does look very flat. I don't really see the prospects for the Fed switching from an easing bias to a tightening or a hiking bias, just like what we're seeing perhaps with the ECB and other global central banks. I think that the Fed stays on hold for longer at best, and that should keep the 2-year yield somewhat within the current range or slightly higher perhaps. Unless we shift towards a hike, I don't see 2-year yields really starting to rise. But that said, I think that, like I was saying earlier, I think the growth prospects and the potential for a meaningful slowdown in growth next year would mean that the yield curve is going to have to remain somewhat flat. So the investors are going to continue to buy the belly.
Subhadra, communication is key. And in this news conference, the chairman is bound to be asked about its future. If he commits to staying on, because Kevin Walsh won't have time to be confirmed. In your mind, I'm interested in your individual perspective on this, your judgment as a market participant. Does staying on provide consistency or invite controversy?
I think it definitely provides consistency. What the market's looking for is a steady hand from the Fed and the committee at large. I mean, what we don't want to see is kind of a temporary Fed coming in and not knowing what the direction of policy is going to be. So to me, I think the best way to transition would be from Powell to the next Fed chair in an orderly fashion, as opposed to having somebody interim and then having to switch back to Powell. So that's kind of what I'm hoping for.
Subhadra, good to see you. Thank you. Subhadra Jappa there of SocGen. Bob, just to turn to you, same question. Do you agree with that?
I think him staying on creates stability. Personally, I believe he'll stay on past the midterm elections.
Past the midterms?
Past the midterm
Why will he stay on?
Because he'll want to ensure that the market sees the independence of the Fed, that he's already been there for 14 years, he's a stabilizing force, and they can't be politically influenced.
Will he stay on as Fed chair or as governor or both?
I think after the midterms, he will no longer be Fed chair, but I think at the May meeting and perhaps the July meeting, he will be still the Fed chair. It all comes down to what Tom Tillis decides, what the courts decide on Lisa Cook and the suit against Jay Powell. All of that resides with Tom Tillis.
This show used to be simple.
Right? It's got complicated, hasn't it?
It's just unreal.
The Fed's got complicated. Neil Datta of Renmag writing in, Walsh, no matter what, will walk into the Eccles building as the weakest Fed chair in recent memory. He's limping in. The opinion of Neil Datta just moments ago.
In part because of skepticism by the market, but also in part because this is just a difficult economic time. There isn't a consensus to be had on exactly how you grapple with stagflation.
This is not a small matter on real and also nominal GDP. And all the distractions we've got now. Now I want to talk to Claret about that when he shows up. But to me, the weaker economy is a really interesting trend.
We're 60 seconds away from a decision. And a lot of people in this market will be looking for dissent. A dissent from some governors, in particular, who are worried about the labour market. And on the same committee, the very same committee at the very same meeting, there's a collection of officials on this committee who are worried about overshooting the inflation target for the past 5 years. That's how divided that committee is right now.
How do you deal with a paradigm shift with an oil shock thrown in, where you have AI creating real questions about productivity at the same time that you do have inflation, but you also have the potential for more efficiency?
Crude has gone from in the 60s when the Fed last met, the morning of the last Fed meeting at the end of January, to in the 90s, off the back of a shock in the Middle East and a major rally over the past 2 weeks plus. The scores heading into this decision look like this. Equity markets this afternoon on the S&P declining by 0.6% in the bond market. We're looking at 2s, 10s and 30s shaping up as follows. Yields on a 2-year at 3.71. With that Fed decision, here's Mike McKee.
No change in rates, no change in dots, one dissent, but some big changes in inflation expectations. Fed officials see one cut still in 2006 at some point, even though their statement notes that uncertainty about the economic outlook remains elevated. 3 members who favored no cuts in this year moved their dots down to 1. The statement goes on to say, the implication of developments in the Middle East for the U.S. economy are uncertain, and the committee remains attentive to risks to both sides of their mandate. They still see one more cut in 2027. Stephen Myron, the only dissenter, he wanted a quarter-point cut this time, and from the dots, we discern that he still wants 100 basis points at some point this year. The language about future moves remains the same. They still talk about the extent and timing of additional adjustments to the target range. It's the summary of economic projections in which we see a lot of changes. PCE inflation this year is forecast at 2.7%, up from 2.4% in December. Core is also seen at 2.7%, up from 2.5%. Both dropped to 2.2% next year, up from 2.4% in the December SEP. Core is seen at 2.7% this year. Both drop back, as I mentioned, next year to 2% in 2028. GDP marked up 1/10 in both years, both of the next 2 years, to 2.4% this year and 2.3% next year. The unemployment forecast remains 4.4% in 2026, dropping to 4.3% next year. That's up from 4.2% in December. And the longer run estimate for Fed funds, seen as the proxy for the neutral rate, rises a tick to 3.1%. Guys?
Mike McKee, thank you, sir. We'll catch up with you a little bit later. Let's start with the price action. We'll go equities, then bonds. We'll have a sneak peek of what's happening in the commodity market because we're tracking that throughout the day here at Bloomberg. Equity markets, looking at the S&P 500, off session lows, but still negative by 0.5%. In the bond market, yields slightly higher on a 2-year by 2 basis points, basically as you were at 370 on 2s, on 10s at about 421, which is basically where we were going into this decision. So this is what we're doing. You go into the projections. We'll ignore the statement just for a while. We'll go into the statement and we'll look at the projections and compare what they were projecting back in December and have a look at what they're projecting now. So let's just go through 2026 for GDP, revised slightly higher. That's some good news. 27 as well. Same thing, by the way. So they revised GDP higher, they've revised inflation higher, and they've kept the projection, the implied projection for interest rates, exactly where it was for December. Those kind of moves should be music to the ears of bullish market participants.
This is an incredibly dovish hold, just by virtue of the fact that only one person dissented, and it was Governor Myron. That alone. But these projections highlighting a tolerance for higher inflation and still the belief that it will come down by 2027 to that 2% level without hiking rates and continuing with rate cuts gives you a sense of where this Fed's mind is at. This seems like more of a consensus than I expected, than a lot of people expected, and it is more to looking through any kind of oil price shock.
In honor of Alan Greenspan's 100th birthday, it was a Greenspan decision. Everybody got on board with the chairman. That's all there is to it.
And the out years, the good news on the inflation front, you decide whether this is good. The Fed is still basically forecasting the same inflation glide path as they were before, even with this lift to 2026.
How do you say transitory without saying transitory?
Right? It's in there in the forecast.
And that's the reason why you're seeing the yield curve steepen. And on the margins, you're seeing 10-year yields higher on this because ultimately this is a Fed that is willing to stay on hold and look through an oil price shock, look through the fact that even core PCE has been higher than expected and is expected to stay that way. Because ultimately, they do think the labor market is showing signs of cracks, even though they don't necessarily see unemployment rate ticking up. And they do want to err on the side of being more accommodative.
One official I'd like to speak to, just briefly, get him on the phone. Governor Waller.
I was about to say, Chris.
Okay, no dissent. He said it was a coin flip. It would come down to the labour market report, and that labour market report was overwhelmingly soft. So what does he see in the outlook for inflation that's kept him on the sidelines?
Governor Waller, please join us. If you want to call in, we'll take you. I mean, ultimately, that is one of the key players because he is a pillar of the swing vote, if you will. And a lot of people are looking to him for some sort of guidance about what exactly is driving his decision.
But at Washington State, he was expert on game theory. And when there's a war, there's a different game theory.
This is a major shock we're working through. Bob Michael at JP Morgan Asset Management still with us around the table. Bob, do you have any thoughts off the back of this one?
I do. They're telling us, don't worry about it. There's a little bit of a near-term inflation shock. They added 1/10 more than we did, but it's fine. The economy is going to use that to accelerate. So they increased GDP. That I don't get. And they left unemployment where it is. And it also doesn't sync with the dots. I heard Mike McKee say that 3 members who previously voted for no cut changed their view. And went to a cut.
The median dot 3.4, December projection, the median dot 3.4. Joining us now to discuss is the former Fed Vice Chair, Richard Clarida. Now, Rich, I know the word transitory is banned and they can't use it anymore, particularly in the news conference, but does this scream transitory?
Well, it certainly screams we need a synonym for it. Temporary, not long-lived. You know, they could justify it perhaps by looking at the oil futures, which still show this as dissipating over time. But the short answer is nobody, including the Fed, knows. This is very elevated geopolitical risk, and there are risks on both sides. But the baseline, I agree with your panel, is dovish constructive.
Rich, I'm just wondering how much this is just AI written all over it, how much this is a Fed that is basing their entire assumption on a productivity boom tied to artificial intelligence and the deployment of it through the economy, and frankly, disinflation on its heels.
I think there's an element of that, perhaps more so with the incoming chair than some other members. I think it's also a statement, however, that AI is a support to demand in the economy that to some extent, along with those big, beautiful bill tax cuts, is probably going to offset some of what the drag would be from the oil price increases. But again, this is a modal or a baseline, and I think certainly internally we'll hear that there was a discussion of the risk cases as well.
Professor Clarida, when you were at Columbia herding cats, Xavier Sala Martin taught the acclaimed principles of economics. Talk to us about the risk of a demand destruction here. To me, it's extraordinary, whether it's war, short-term, or a more permanent demand destruction. Should that be a legitimate concern of the Fed?
Well, the demand destruction comes simply from the fact that not only oil prices, but energy prices and goods that are intensive in oil and energy will go up, and that will tend to reduce the real incomes for millions and tens of millions of households. Now, on the other side of that, you have the AI boom, but there is no doubt that this is going to squeeze real aggregate demand the longer the oil shock persists.
Check out the price action. Let's go to equities. We're still down by 0.6%, unmoved by what on the surface of things looks like a dovish decision from the central bank. Check out the bond market, similar story, no big moves off the back of this. The only takeaway, this can change, but the only takeaway for me is there is nothing this institution can do to drive this market in the face of the shock elsewhere. Jeff Curry of Carlyle said it really well earlier this morning on Bloomberg TV, when Jeff turned around and said there's nothing the central bank can do about this, you cannot print barrels. This market is still at the mercy of what happens in the commodity market, and the Fed is not the circuit breaker anymore, because this Fed decision, I would sit here and argue, is fairly dovish, with the exception of the absence of a dissent coming from Governor Waller, is fairly dovish. To come out and say the outlook for growth is better, we've revised higher the outlook for inflation, and the median dot is exactly the same, screams dovish, and yet here we are. No big moves in financial markets. I think that's notable.
The Fed is playing dodgeball without the ball. They're not the pitcher in a game. And right now, what they're dealing with is shock after shock without necessarily historic precedent. Yes, there are historic precedents for oil shocks, but not for the AI shock and what that does to the overall economy. So they might remain on hold, and that might be bullish, but not in this moment, because right now, if another oil or natural gas plant gets bombed, people are going to be watching that much more than anything coming out of Jay Powell.
You know, Vice Chairman Clarida, the thing I would point out here, Damien Sassower at Bloomberg is very cautious on EM suddenly here. In this meeting and in this press conference, more than ever, is this the central banker to the world?
Well, sure it is, and I think that the Fed is aware of that. And I think one thing this episode is reminding folks. We've seen it in the dollar, obviously, is, since the Iran hostilities commenced, the price of gold is down, the price of the dollar is up. So I think there is that element as well. But, broadly, the Fed is reacting to events. I think Lisa said it well. First and foremost, this is a major geopolitical and economic shock. The dodgeball analogy, I think, is a good one. So I think, yes, the Fed is the central banker to the world, but it's not the main attraction right now.
Bob Michael with us with J.P. Morgan as well. What is with the tentacles of J.P. Morgan around the world, how is EM doing? I see Philippine peso almost out to 60. You saw Australia raising rates in
whoa. We're calling Australia EM.
No, I'm not calling Australia EM.
Get you in trouble, TK.
No, I'm not calling. I am watching Aussie yen, though, which is a life of its own.
Sydney watching.
What's
the Swissy?
Their early morning. Deeply unhappy with that.
But I read all the Neville Shute, including Town Like Alice. I want to know, as a central banker of the world, the sensitivities he faces. What does J.P. Morgan see on the reaction in the currency markets, the reaction in fixed income of EM as the chairman speaks?
I think there are a couple things. One, we felt going through this that the dollar would be the safe haven bid, and we're seeing a lot of that. We also felt for those who wanted to diversify away from dollar, emerging market FX was the place to go. The central banks in those regions seem to be on top of things, and you had a split between those who are energy importers and those who are energy exporters, those that are sitting on rare earth minerals and other minerals, and those who aren't. And I think we're seeing all of that play out. But I will tell you, our client base still feels underallocated to emerging markets, both equity and fixed income. We're seeing those allocations continue to come in. I think there's a good tailwind there.
He just went along Australia.
There you go. Back-to-back hikes at the Emerging Markets Central Bank over at the RBA. See that? Honestly, there's some offended people down under right now.
I'm not wearing it on this one. But I will say that tomorrow will be really interesting with the BOE and the ECB.
There you go. You tell them, Bramo.
All right.
Rich Cloud is still with us. Rich, I want to come to you on an important topic to wrap things up. A really serious one. The future for Chairman Powell. This is not how usually these things play out. Typically, how this plays out, the chairman knows when his term finishes, he gets a great send-off, he walks away, and he does a $1 million speech in about 12 months' time and has a happy retirement. This feels so different, Rich. Kevin Warsh is ultimately being nominated. We have no idea when the confirmation hearing is going to be. Bob Michaels sat here a little bit earlier and said he thinks the chairman, Jay Powell, is still going to be there by the time you get to the midterms. Rich, how do you think this process is going to play out in the next several months?
Well, you're absolutely correct. This is unprecedented, unusual. That the handoff is usually pretty smooth and very well telegraphed. And the difference, of course, now is several fold. One, of course, is the the DOJ investigation of Powell that the Fed is pushing back on. In addition, of course, even Warsh getting a hearing is now up in the air. I certainly do expect Jay Powell will stay on. And perhaps a meeting or two after Warsh finally arrives. Whether or not that's after the midterms, I'm not sure. I think Jay Powell will move on once Warsh is in place to his future life. But his real focus is on maintaining the independence of the institution. And I think he will be in place until Warsh is confirmed, and perhaps a meeting or two thereafter.
Rich, appreciate your insight on the topic. Thank you, sir. Rich Clarida there, the former Fed Vice Chair on this Fed decision and the Chairman's future. If you are just joining us on the program, welcome to the show. So unchanged, the policy rate at the Federal Reserve about 15 minutes ago. Some dissent, the vote 11-1. That dissent came from an obvious place. Governor Myron voting for an interest rate reduction for the projections. Big focus on what was happening with inflation. They've lifted their outlook for inflation for this year, at least, but left the median dot ultimately unchanged, implying one rate cut from this Federal Reserve for 2026.
To me, the most interesting takeaway is what you said, which is this market doesn't seem to care, even though this is very much a dovish hold. This actually is news in Fedland, and yet the market doesn't pay attention because there's another game in town, and it's everything else in the world. And some people might say, oh no, the adults can't control this. They can't step in and save us. And the other people will say, we haven't had a free market in a long time, and this is what it looks like. And guess what? It's a welcome exercise. And so those two sides of the debate are playing out in markets today.
You think we've got a free market?
Well, I mean, that's the whole thing. Ultimately,
don't get too excited.
Well, I'm kind of excited about this. I mean, that's kind of a nice thing, not to have the thumb on the scale all the time and the same story over and over again.
It's a change.
All right.
It's a change.
I'll get off
Stephanie Roth of Wolf Research, I can see how excited you are. You're not alone. I've been waiting for that moment for a long, long time. Major moves, 5% away from all-time highs.
Even the Japanese market, it's now exciting. Who knew?
They're actually trading the benchmark in Japan now.
There's actually traders.
Stephanie, I'm sorry. Stephanie Roth of Wolf Research joins us now for more. Stephanie, we need your reaction to the decision and where you expect the emphasis to be in this news conference.
Yeah, I mean, the emphasis is going to be on the reaction function, provided that energy prices end up staying longer. The question is, are they going to end up looking through this, or do they ultimately end up having to be dovish as a result because growth will end up slowing? And our own view is that because the economy is so different today versus 2022, they'll ultimately have to be more dovish as a result of the war in Iran rather than the opposite. Otherwise, it tells you a story of productivity and that growth is actually going to be higher in the future years, but then, you know, nothing else changes. And the one thing that we didn't talk about, or that wasn't talked about yet, was the longer run dot shifting up a little bit.
Well, this to me, Stephanie, that I'm really wondering about is how much does a more dovish Fed enable something that looks more like 1970s or more like 2022 and what we saw with inflation and the read-through? Is that something of a concern for you?
No, because the backdrop is so different today versus, say, 2022. If you look at 2022, the unemployment rate was 3.7 heading to 3.5. Today it's 4.4. Payroll gains was growing at 600,000. Today they're somewhere between 0 and 50,000 on average. The inflation backdrop was different. Core inflation was 5.5. Today it's 3. So the idea that we're going to have a repeat of 2022 seems like a very low likelihood event, and therefore that's not something I would expect the Fed to react in that way, because the data probably won't support a reflationary type of environment.
Stephanie, given a war, given what oil's doing, John mentions it's 60 to 100 or even higher, we're still slaves to the job market. And the answer is the unemployment rate hasn't broken. With the war, with the distractions, how exposed is this Fed into the summer?
Yeah, I mean, I think they're going to be in an environment over the summer where base case is the unemployment rate is probably steady, but they're going to be looking at this most closely. That's going to be the deciding factor between whether they're able to cut, probably not at Warsh's first meeting, maybe in September or December.
Right.
And it's going to all come down to the unemployment rate. Is it notably above 4.5, in which case they have a window to be able to ease? And if not, then it's going to be tough for Warsh to get the rest of the members on board.
Bob, synthesize Michael Feroli's work on this then. The fact is the labor market hasn't cracked yet. They have to wait, don't they?
I think that's part of it. I'm still gobsmacked by the Fed's decision. They're basically saying all of this going on in the Middle East is a speed bump. That, yeah, inflation will tick up, you know, 0.3 and 0.2 here and there, but the economy will accelerate, unemployment will stay stable, and it's off to the races. I just don't see that. I think there is a real impact to inflation and then ultimately to the economy and the labor market.
This is the heart of the matter, John. This is the absolute heart of the matter, and everybody has to recalibrate their x-axis to how long is this going to go on, and then you get to demand destruction.
We mentioned this earlier, and I think it's important to keep going over it. We've repriced a lot in this market. We've repriced energy, had a big move from the 60s out to triple digits. We've repriced interest rates. We've taken out a lot of easing for the Federal Reserve, and we've priced in hikes in places like the ECB, 2 of them, I think, for this year now. Yet we haven't repriced growth, and the Fed hasn't either. And I'm not just talking about where spot is trading or the front month on the futures curve. If you go out to December and look at where December is traded right now, we're close to 80. So we've gone from the 60s to close to 80s on the December contract, and the Federal Reserve has lifted the outlook for growth. What's driving that?
I wonder how much momentum they think is in the economy, how much AI and data center spending is going on. Were they surprised by the Delta earnings and that, you know, sales are at a high despite higher energy prices? I think the reality is when you've had close to a 50% hike in energy prices, it's a tax on businesses and households, and they will respond by cutting back some of their consumption.
We have the smartest viewers, and I just want to point that out.
Sure.
One of the viewers just wrote in. We do. And pointed out that among the members, the actual dots might say one thing, but the risk to GDP downside included 14 members versus 8 prior at the December meeting. The risk to the upside was 16 members for core PCE, as well as the unemployment rate, that it was up from 12 and 13 members respectively. So that stagflationary outcome still in the back minds of so many of these Fed members. They just aren't making this their base case. So I don't understand, Bob, and I guess that this is my question. Is the reaction function essentially they will hold pat even in this scenario? Or do you have a sense of what the reaction function is to true stagflation?
Well, the bottom line is the market is just looking through the Fed right here and saying, doesn't make sense, don't get it, don't know what they were thinking. The projections don't make sense to me, but I know where we are. There's a lot of tension still in the Middle East. It's yet to completely play out. I think where we are now is about fair. It can go either way from here. So it's completely dismissive of the FOMC statement.
Hey, Stephanie, before you go, what's the #1 question for Chairman Powell into this news conference?
Yeah, I mean, the biggest question is going to be, provided energy prices are elevated through much of the summer, how are you going to think about the balance of risk? Is this going to be something that you're going to, look through, and do you expect that growth is going to be lower as a result? Or is this something that you're worried about, more similar to 2022? And what are the balance of risks in your mind in terms of how this could play out?
Stephanie, good to see you. As always, thanks for jumping on. Stephanie Roth there of Wolf Research. To build on the conversation, Diane Swonk of KPMG. Diane, I'm going to use a quote of yours to ask you the question. A dual mandate or a dueling mandate? What have we got?
A dueling mandate, and I think that's a real problem. I think the Fed is this dovish sort of numbers don't add up. I think I agree with that completely. A dovish pause is not what I would expect. I would have expected some people to actually put in rate hikes in this meeting, and they didn't. And I think there's a real issue about, we saw rate cuts in late 2024 to shore up the labor market. We didn't get any jobs. We saw rate cuts in late 2025 to shore up the labor market. I don't think we're going to get a lot of jobs from those. That brings up the issue is the problem in the labor market more structural and systemic, something that rate cuts alone cannot cure and spur the demand for workers on? If that's the case, if you cut rates further, you're risking a more persistent bout of inflation, or worse, a stagflationary scenario. And I think the devil in the detail is in that stagflation scenario. Also important is that they raise their non-inflationary rate. That is reflecting, yes, productivity growth and the idea that the economy can grow more robustly without having inflation, but that also means higher non-inflationary rate, which is an important marker to put down before Kevin Warsh takes on as Fed chair, since he has argued that productivity growth should lower that non-inflationary rate. That is not what the Fed is saying, and I think that's very important. But I am very concerned about, we're 5 years in, we've got consumers expecting more inflation than they did in late 2024. And those expectations are going to rise, especially with salient prices like prices at the pump going up. And there's already a long tail due to the problems in the Middle East. Production idled is not easily brought back online. It's weeks to months, and we're rolling supply chains the world over. You create scarcities that go below the destruction in demand. That gives you stagflation.
Diane, is this the Fed meeting where forward guidance just died?
Absolutely. We didn't have a lot of forward guidance to begin with, but absolutely. And I think, what really will be interesting in the chairman's comments is what was the debate in terms of growth, what went into these numbers, how did the debate fall out. I think the devil in the details here is that there is a bit of a stagflationary concern out there, and there should be.
Diane, there's we suffer from 3 zip code scenario here in New York City. You've got a much greater national perspective. I take real issue with a narrow part of America being affected by $5 a gallon gas. How much of America is going to be flat on their back from some of these shocks?
Well, unfortunately or fortunately, we do have fiscal stimulus right now, and that fiscal stimulus will help absorb the shock instead of going into other kinds of spending, and that will help households. Tax refunds are showing up in consumer bank accounts right now, but the combination of fiscal stimulus with remember, inflation is accelerating right now. We saw PCE accelerate. We saw the PPI numbers today. The translation of the PPI and the CPI for PCE for the month of February, hotter, especially on core services. That's aside from what's going on in terms of tariff-based inflation. That is important right now, and I think that's getting lost in translation, but it does show up in the devil in the details of those dots and how the forecasts show up. You could have had one very strong forecast push up the GDP number within the group. There are people who believe within the administration that we'll get 5 to 6% growth this year. That was their forecast going in. If Steve Moran wrote down a number like that, that would have raised the overall growth figure when in fact the rest of the committee is seeing a more stagflationary scenario. I do think it's a dovish pause. That is a bit disappointing right now, given where we're at, even though I'm very worried about the labor market. I just don't think the Fed can cure what ails it.
So, Diane, what do you think the emphasis, where do you think the emphasis will be in this news conference with Chairman Powell in about 5 minutes' time?
I think the emphasis is going to be on uncertainty and wait and see, and that will just sort of be where they are right now, and that they don't know where the next rate move is actually going to be, and I think that's the right way to play it.
Diane Swonk. Diane, always good to catch up with you. Thanks for being with us. Diane Swonk, they're breaking down the Fed decision. If you are just joining us, welcome to the program. The news conference about 4 minutes away with the chairman of the Federal Reserve down in Washington, D.C. In any other time, at any other moment, we'd be talking about the penultimate meeting of the Federal Reserve Chair, but we have not spoken to a single person today who thinks this is the penultimate meeting of the Federal Reserve Chair. And most believe Chairman Powell, including the former Fed Vice Chair, is going to be sticking around for at least a few more months.
Partly because we don't know when the confirmation of the next Fed Chair is going to be, and that ultimately lies with the man from North Carolina, Tom Tillis. Ultimately, though, there is this question about credibility for the Fed, continuity. I just wonder if he gets up there and he says, what we do doesn't matter right now. As long as we don't hike and as long as we don't cut that much, we're not in the driver's seat. I mean, ultimately, this is their pass to say, this is an economy that's moved on from us. We are not in control. We are watching it just like you.
Unspoken, John, will be the idea of the recent election results, including yesterday in Illinois. And I also point out a set of allies saying no to the president on this war, and that Mr. Powell, representing the institution, will stay around more so than the last meeting.
A big piece of this bull case for this economy and for this market has been tax refunds. We hear that phrase get bandied around all the time on this program, tax refunds, tax refunds. How big are these tax refunds actually going to be? And how are attitudes towards the economy changing given the shock of the past few weeks? Where will that money actually go?
Well, we're seeing it now when we look at Chase deposit accounts. We're seeing particularly the bottom couple quintiles of earners see their deposit balances start to go up a bit. But the uncomfortable truth is they're now paying that out again at the pump. And we can't forget that businesses and households were already paying a higher tax because of tariffs on prices, and now energy prices are going to create yet another tax on their disposable income.
Grandma, the squeeze is real. The energy bills are severe, and they were high already, and now they're getting higher.
You know, Delta and American were perfect examples of how the economy is doing pretty well and people are still spending. The difference is that the costs are getting that much higher. And so the room that people have and that companies have to do okay is getting narrower and narrower, and the Fed's watching this, and they don't have the silver bullet to really make this a better situation.
I did scientific surveillance research today.
Here we go.
EWR to Charles de Gaulle was popping the two of us. You could easily do it for $7,000, and you're enjoying it this morning just under $11,000.
Are you pretending you don't fly business class?
Over three. That's well,
is
that's
that what you're doing?
No, it's not premier. We're not doing the first class thing, but business class, I'm going to suggest is up at least 20% instantly. instantly.
Is that Polaris? Is that United Business Class? Is that the front of the plane?
I actually
United?
don't even know. Yes, actually
Yes,
I do. I remember
right.
going to
Okay.
something, a demonstration about it, not actually, not
Yes, of
exactly
course.
experiencing it.
Of course.
I remember seeing
For everybody to know,
sort of-
We live in different worlds.
for everybody to know, out in the
100%.
world, John and I are in steerage, and you're on the Gulfstream
that
450.
is such a load of.
Nice one, TK. Hey, Bob, before you go, just a final word. About a minute away from this news conference. What are you looking for?
I'm looking for a couple things. I want to understand how they're thinking about the war and the elevated risk to both sides of their mandate. And then secondly, I want to know how they got to their forecast numbers. I think Diane's right. There needs to be some explanation there, and the explanation could be quite simple. It could be, well, one member put in a 6% growth rate. Okay, well, let us know that.
Well, let's get into it in just a moment. The chairman of the Federal Reserve entering the room after leaving interest rates unchanged. Let's take a listen to the chairman of the Federal Reserve.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? I'm just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so, there are 19 people, and so 19 reasons, 19 individual submissions, and if you notice, the median didn't change, but there was actually some movement a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid. And inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing, pretty well. It's just we don't know what the effects of this will be, and really no one does.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, your question was?
What the staff is saying about, and has said in the past.
So there'll be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period of time, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that. Very important.
Nick. Nick Tamaros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now is just kind of on that borderline, the higher borderline of restrictive versus not restrictive. We feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Thanks, Chappelle. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September, so that tells you that. Inflation, you can. We're at 3.0% core inflation, 2.8% headline. So we've been well above the 2%. That amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time, and that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero. But nonetheless, it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So. We looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility, rather, that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens. And it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth. No. But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. And your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth.
Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves. With what happens in the Middle East, that's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023, when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year. They should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I think the theory is probably right. But as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. And so I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history. And then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision, but the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber.
Hi, thank you. Chris Rugaber, Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction, and so I just think we do it. And I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt because subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way, everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and what it does for us is makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, you know, the cost of food and other goods that really rely on it to
so
move
I think
across the country.
it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it. But you know, we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. You know, it may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. You know, we actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of, you know, generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think the economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side. And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
The chairman of the Federal Reserve. If there was a good meeting to scrap the forecast, then this one was probably it. The chairman de-emphasizing the projections, re-emphasizing the uncertainty, focused on the shock in the Middle East. We had one question: how would they respond to it? Would they look through it? The answer: it's not that simple. Equities in response negative. Near session lows right now, down 1% on the S&P 500. Likewise on the Nasdaq. In the bond market, 2s, 10s and 30s, yields higher, particularly at the front end of the yield curve, up by 7 basis points on a 2-year, 375. If you, like me, thought this would be boring, this was not a snooze. The Federal Reserve Chair asked about succession. Take a listen to what he had to say.
If my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
3 points from the chairman of the Federal Reserve. Let's go through them individually. Point 1, I will stay on as chair until a successor is confirmed. Point 2, I have no intention of leaving the Fed while the DOJ investigation is ongoing. And point 3, even after that is complete, I haven't made a decision on how long I'll stay on. A big headline in that news conference.
He actually engaged with the question. We all were wondering whether he would give some sort of clarity, and we've got it. He is going to be the Fed chair until Kevin Warsh is in the seat. There's this question of what is well and truly over in terms of the investigation actually mean. A lot of people are going to be wondering that. And the fact that he hasn't made a decision yet. What is going to tip the scales for him to understand when he can make the decision? Either way, this wasn't a boring news conference in any way, shape, or form.
If we can bring up just an intraday chart, the front end of the yield curve, so bring up the 2-year intraday, and just have a look where things started to pick up. The Fed chair throughout this news conference was leaning into anchoring inflation expectations. That was notable. But we started to really bounce out to session highs when he started to lean into that question about his future. And I just wonder, Bremo, we can have that conversation with guests over the next 15 minutes or so, whether those two things are connected to some extent.
On the margins, this market seems to be treating a Kevin Warsh Fed as being more dovish simply because we have President Trump tweeting or Truth Socialing every single day saying, too late, Powell needs to lower rates. Right now you see there is no full rate cut getting priced into the Fed funds futures until June of next year. So that's how far we've pushed it on. There was a 1-2 punch. Fed Chair Jay Powell also said it's too soon to know the full economic effects from the Middle East. And then he said he would stay on, and we have known this is a pretty balanced Fed. They're weighing the risks, and clearly the specter of 2022 hangs over his Fed chairmanship.
Okay, you'll go out to the specter of it and the view forward. I like what Liz Ann Saunders does, retweeting Claudia Sahm. Finally, Powell throws the SEP under the bus. Skip it. Thank you, Dr. Sahm, for that. My observation, John, is it's 10:21 p.m. in Doha. And I'm looking at the headlines while the chairman's speaking, and I get the Warsh view forward and the crystal ball gazing out 6 months. I think we got to gaze out 24 hours right now. That's the tension I see in the Iran headlines that we get out of Tel Aviv and we're getting out of Dubai right now from Bloomberg.
This is why it makes it so difficult to provide forecasts in a moment like this one. And the chairman quite rightly talked about the need for humility, the duration of this shock.
Yes.
Energy assets are in play in the minds of some people now after the strikes we saw on Iranian energy assets just earlier this morning. Crude at the moment at 109 on Brent, WTI around 98. The chairman is well aware that they've missed their inflation target for the previous 5 years, overwhelmed by a series of shocks, and this is another one. Now, you may still believe ultimately this Federal Reserve will look through this shock, but that wasn't a chairman that wanted to make that point in this specific news conference.
He didn't want to say the T word, even though essentially this forecast would suggest transitory. He tried to play the part of an oil expert. He tried to play the part of a generative AI expert, but nonetheless, he said it is too soon to say so many times over again that we lost count. They are facing off with a series of shocks with the backward view of what happened in the post-pandemic era where you had inflation that creeped up to 9%. He will not want to continue that, especially with core PCE creeping higher in the wrong direction before even getting this oil.
The headline to me, John, I know we got to get to Dr. Sluck, but the headline to me was a lack of dissent. I mean, this was very Greenspan-y and everybody on the same page supporting this chairman.
The standout here, TK, and for our listeners and our audience worldwide just tuning in, the decision dropped about an hour and a half ago. The interest rate remained unchanged. The median dot still implied one cut for this year. Lots of noise, though, beneath those headlines. The outlook for growth was better. The outlook for inflation was higher. But that single dissent was Governor Myron. And Governor Waller was expected to dissent. He sat around this table only a week, 2 weeks ago, and said it depends on the next jobs report. An hour later, the jobs report came in way weaker than expected. And we all thought, we know what the governor's going to do. He's going to vote for an interest rate reduction. And then he didn't. And that's off the back of the shock in the Middle East, and that's more than notable.
Governor Chris Waller, I think, is arguably the most interesting person on the Fed right now in terms of what his decision actually was driven by. I'm curious if he comes out and says he is getting spooked by the direction of core PCE. He's getting spooked by the component of what oil prices do to that. And we talk about wage inflation. Wage inflation is still running above where it was in the pre-pandemic period.
Hey, John, I was looking at F1 in Japan here, and you said do something serious. So I looked at the price of oil here, as you mentioned earlier. Brent crude up 81% from whatever the bottom was. Saudi light, Persian Gulf,
the physical market,
145%. Same number.
This is
80%, 145.
It's the point that Jeff Carey of Carlisle was making a little bit earlier on this morning. There's a big gap right now between the physical market, where spot is trading, and the paper market, and he thinks it needs to close. He thinks the paper market needs to wake up to the real risk emerging in the Middle East. That's one opinion, one view. Other people aren't as concerned, but ultimately, that's his opinion.
Every oil strategist that comes on says, why is everybody else so complacent? What we're seeing is really a different scenario than we've ever seen before. And a lot of people say, yeah, you guys always get it wrong. And so ultimately, this debate will continue to play
What did we say a few weeks ago? If you want to make a fool of someone on Wall Street, ask for a crude forecast. That's always been the way. It's the hardest thing to forecast. Torsten Slock is not a fool. He joins us from Apollo. Torsten, good afternoon. Good to see you.
Good to see you.
You've had some time to go through this one. Your big reaction, please.
Well, I think one interesting thing here is that if we begin to describe everything as another shock, there's another shock, there's another shock, and we're looking through that, it almost makes it sound like, well, I don't really have to react to anything because I've identified, well, now there's just another shock coming along in oil prices. There was another shock from trade war. There was another shock from COVID. It makes it sound like that you should never do anything as a central banker. So now we have a shock that is very serious, and it's very, very clear that they decided to just basically completely ignore the Middle Eastern shock that we're facing here. So from that perspective, it is quite interesting, as Lisa is saying, why was it that Waller suddenly changed his mind? Because it must be that he did put more weight on the Middle Eastern and the Iranian shock than what the average committee member did here.
Do you think that you can infer anything from the price action as John was laying out, the idea that 2-year yields and 10-year yields inflected upward, as Fed Chair Jay Powell said that he planned to stay on should there not be another Fed chair nominated and in the seat by the time his term expired?
Absolutely. Let's just talk about it the way it is. At the last meeting, there were 10 people voting for interest rates to stay unchanged. At this meeting, there were now 11 people voting for interest rates to stay unchanged. It's very clear Steve Iran at both meetings voted for rates being lower. But at this instance, when he suddenly now says, I may be staying on until this is well and truly investigated and complete, the risk is beginning to rise that, well, maybe we'll have another hawkish member sitting for a longer period. And assuming, therefore, that Trump will appoint a more dovish member, that does, of course, lean more towards that we will have a more hawkish Fed if he does stay on for a longer period.
But he's not hawkish. Why is he considered hawkish?
Well, he's hawkish relative to the alternative of a more dovish member coming along.
You were weaned at Deutsche Bank under Folkets Landau with Adam Szyminski and Paul Sankey. Their back of the report Excel spreadsheet was absolutely definitive about the supply and demand of hydrocarbons. Take that experience now, and how do you apply that at Apollo when you look at the American economy?
Well, it's very clear when you think about demand and supply in oil that the supply equation just changed quite dramatically now that we suddenly have much less supply because of the Strait of Hormuz being closed and because all the cascade of effects that are likely to come along if this does continue for a longer period. So on the supply side, we will likely continue to have the very important question, namely how long time is it going to last before we get supply up to the levels where demand is. And if that's going to take a longer time, then the risk is that energy prices and oil prices are going to stay more elevated. It's also fuel prices, of course, that are, of course, going to jet fuel. It's also, of course, fuel prices that are marine fuel. All these parts of energy complex are absolutely seeing some upward lift, and the longer the shock lasts, the more we will see energy prices stay more elevated.
When does this get real for you? At the start of this crisis, and we can call it that, people came on Bloomberg surveillance, on Bloomberg TV, and made the point that if it's days, not weeks, it's okay. And here we are more than 2 weeks into this, and now we hear if it's weeks and not months, it's okay? When is it not okay?
Well, the next one will probably be people saying if it's months, it's not quarters, then we will also have a change. So you're absolutely right. The fear is, of course, that if it does continue at the Fed level, if you put this into FERPAS, the Fed's model of the U.S. economy, it has to last at least 1 quarter, because that's the only way you can get a real serious shock to begin to feed through. If it begins to last, of course, several quarters, then it's a much more serious effect. But it is ultimately about that duration question, and that's what the market is trying to figure out. And the Fed very clearly told you today that they do not think that this is going to last a long time.
Mike McKee in the news conference. He's run back out for us. Mike, welcome back to the program. Some key headlines in that news conference. What jumped out for you?
Well, I think two things, John. One, there was a sort of more humble aspect to what Jay Powell was saying. When it came to tariff price inflation, he was conceding that it wasn't doing what they thought it would do, lasting longer than they had anticipated. And now layer on top of that inflation that will come into the energy markets and perhaps others because of oil. And so he was less saying the idea that, well, we're prepared to go either way depending on what happens with the economy, as he was saying, we've been fooled. And we're not going to put ourselves in that position. We're going to sit back and wait so that we don't react wrong because we've been wrong. The other thing, of course, was what Powell said about whether he's staying on or not, because he's refused to talk about that so far. He did acknowledge what his lawyers told the Department of Justice in their deposition. But the most interesting thing was he said he's staying as chairman pro tem, and that's the law. Well, there's a presidential counsel's office memorandum that says, no, it's the president who can appoint somebody as the chair pro tem. So we could be looking at another big legal fight down the road if they don't get Kevin Warsh in there by May 15th.
Yeah, Mike, this is where the problems arise with the chairman really engaging in this topic this afternoon. Does it provide consistency or just introduce even more controversy?
Well, he's trying to provide consistency, I suppose, by saying not much is going to change until my successor gets here. But whether or not that's a shot at the president or some sort of way to push back on the pressure he's been getting, we don't really know. But at this point, you have to think the White House is going to disagree with that interpretation of who's chairman pro tem. Now, it's important to realize, too, that the chairman pro tem of the Board of Governors is largely irrelevant for a short period of time until they get Kevin Warsh confirmed. It's staying as chair of the Open Market Committee that would really bother the president, because as Torsten was just saying, leaves somebody who's more hawkish, more likely to vote for a hold on the board.
Mike McKee with the latest. Thank you, sir. Appreciate it. Great job as always. Mike there at the Federal Reserve down in Washington, D.C. Torsten, can you answer that question? We've touched on it briefly with you. Just expand on it. Does it provide consistency or introduce controversy?
Well, it would definitely be a lot cleaner if you have a Fed chair and then that Fed chair walks out and a new Fed chair sits down and then we continue with the new Fed chair.
That's how it usually works.
That's how it normally is. That's how we want a Greenspan, I've wanted on a Yellen, on the Bernanke. But now that you suddenly have this issue that the existing Fed chair, either he may stay on the committee, which is also a huge issue, or we may not have Kevin Warsh in the seat. And as Mike was just saying, that will raise all these other legal issues around, well, is this something that you can do or not do? And that, of course, begins to just raise a lot more uncertainty about Fed independence and what is the institution making of decisions.
Do you think that it's leading market participants to not take into account some of the forward guidance or some of the discussions on the Fed, that there is less credibility as a result of some of the increasing political rhetoric around this institution?
Well, I think that we are moving towards a Fed where the focus will be at the extreme on dissents. Today we had 11 versus 1. That was very clear. But going forward, we are likely going to have, especially over the next several quarters, as other FOMC members might be leaving, we will have much more scrutiny of what are the existing members saying, what's the differences in speeches, what's the differences in footnotes between someone who was dovish, someone who was hawkish. We are entering an era of Fed watching where things are getting much more complicated because it has this political dimension of why is this person saying this? Is this person staying on the committee for political reasons? It just opens up a whole different dimension to Fed watching than what we've been used to for a long time.
Fed parlor game, but you're expert at this. On a global basis, this central banker to the world, to borrow from Bill Rhodes, Jerome Powell has to look at the varying energy intensities with Brent crude at nearly 110 a gallon. We've gone 106 to 109 here right now off headlines on the Bloomberg. When you look at the way EM is crushed by these prices, food, energy, and the rest that you're expert at, Torsten, does the dialogue just shift from the conventional parlor game?
Well, there's been discussion about the swap lines. There's been discussion about, in the broader context of things, what is the Fed's mandate? And is the Fed's mandate to take care of the U.S. economy and the people who live within the U.S., 50 states? Or is this someone who is supposed to take care of the global economy? And it's very clear that the trend of travel here certainly seems to be that we're moving towards that the Fed should really be caring mainly about the U.S. economic outlook.
Is it expressive currency? Is that what we're not seeing in the Q2?
Well, given that foreigners own roughly around 20% of treasuries, 20% of credit, and roughly a third, of course, also of equities, we still have a situation where foreigners do play a very important role in U.S. financial markets. So that key issue of what is the goal of the Fed becomes very, very important.
I'm just struck by how historic this is. The last person to stay on at the Federal Reserve as Fed chair after his term was Mariner Eccles. This was in 1948 when his term was up, and he stayed on because he was concerned about the post-Bretton Woods order and an economy that was torn from the war that we had just seen, and he wanted that consistency. That was the last time this happened, and I just am struck by the historical parallel at a time when we are questioning geopolitical alliances, when we're questioning how exactly some of these monetary policies are going to work in an inflationary world at a time of increased government debt. It is interesting that we're dealing with the same discussions, and I think it can't be forgotten, these sort of echoes that we feel from 1948.
I think it's easy to introduce one's opinion into this situation, so I'll just allow the market to guide us. Clearly, the chairman is concerned about a threat to independence. Is he right to be? Look at inflation expectations right now. Market-based inflation expectations have remained really well anchored throughout all of this. So whether you're concerned about the chairman's attack on the institution or not, let's just focus on the markets. Markets have decided it's not a credible threat. So does the chairman actually have a role here that he needs to play? Is this a card he needs to hold? I don't really understand that. I'm struggling with that. That's something I'm wrestling with. My opinion doesn't really matter. The market's telling me there isn't a concern with central bank independence. The market is telling me there isn't a concern with inflation expectations, and the data is telling me that the rest of the world's not worried either, because when I look at foreign ownership of US assets, they are rock solid, and for treasuries, I think they're at all-time highs at the last data point I saw, Torsten. So is there a problem here that the chairman even needs to address?
Well, that's why the key question becomes, what does confidence mean? Is it confidence by Jay Powell? Is it confidence by foreigners? Is it confidence by markets? It does become a very important debate. That's why this discussion around who will be the next Fed chair, now we know it's Kevin Walsh. There was around that time also a lot of discussion around it could have been someone else who might not have been perceived as credible as Kevin is. So for that reason, I completely agree. Who is the judge ultimately of what Fed credibility is, and where do we look, and where does the market look for evidence whether Fed credibility is being threatened?
And look how many establishment figures came out when Kevin Walsh was nominated by the president. How many establishment figures? And forgive me if you're insulted by being establishment. Gita Gopinath, formerly of the IMF, I don't think it gets more establishment than that, endorsing Kevin Walsh and saying he'd make a great Fed chair. Mark Carney of Canada, the former governor of the Bank of England and now Prime Minister, endorsing Kevin Walsh as a future Fed chair. What exactly is the chairman defending here when it is standard protocol to leave once your term is up?
Well, I think that that's a fair question, and ultimately, my personal opinion doesn't matter. And frankly, I don't know what my personal opinion is. I just think that there is a sense right now in markets, to the point that Fed Chair Jay Powell made, that even on Congress's level, they have confidence and they would like to see Fed independence continue. And that's you see in Tom Tillis's move. So what would make him stay on? I guess that's one of the questions. What would change his mind to actually remain on as governor past his term as Fed chair if Kevin Walsh were in the seat that would make him feel like he needed to uphold this Fed independence?
Jeff Rosenberg of BlackRock joins us now for more. Jeff, I imagine you want to avoid this topic altogether. So I'll ask you about the substance of the news conference, the shock from the Middle East, and whether it threatens to upend the outlook for this economy.
Yeah, I mean, look, the conclusion here on the substance really pivoted on that moment. I would argue, though, that the pivot was less about the conversation about whether he was staying on and that part of the conversation, and really his answer to the question that occurred right before that. That was the question about, hey, aren't you more worried about the employment outlook? And he definitively said no to that, and then pivoted to the challenge on inflation. And from my reckoning in the meeting, that was the point at which the meeting turned hawkish, because the majority of the discussion around the meeting is around inflation, whether it was the tariff inflation not coming down as much as expected, the unknown impact of energy prices on future inflation. So you have this kind of backdrop of forces that are pushing up inflation and disappointing the expectations for inflation to decline in the backdrop of stable unemployment rates. And so that really, I think, pivoted the market reaction to, this Fed is much more hawkish, the front end flattening, the equity markets responding. And that was the moment in the meeting where this moved from what had started out as a kind of dovish statement interpretation, holding the Waller dissent to the side for a second, into a definitively hawkish press conference.
Jeff, I'm looking right now, and we've completely priced out a rate cut for 2026. The first rate cut now isn't priced in until July of 2027. Does that matter for risk assets? Does that matter in any way, shape, or form, or has the Fed been totally sidelined by other events?
Well, I think it does matter, because that's what you're seeing in the markets, right? Risk assets are going down, and I think they're going down because of a pricing in of a more hawkish Fed. This is a risk asset market that has benefited for a very long time from a highly accommodative Fed, both in terms of price and quantity when you think about the impact of the balance sheet. So as we debate what the future Fed looks like, there's both a price and quantity uncertainty there, but both of those in the past have been highly supportive. When you challenge that immediately reprices, the Fed's near-term expectations, which you're talking about, but also the degree to which that liquidity and price and quantity is supported, and will have the outlook continuing to support risky assets.
Jeff, John and I were going back and forth during a press conference about what the flight to Monza is going to be the first week of September. It's already up 60%. It's moved 60% to Milan.
You want an F1
already
as well?
Up as well. Jeff, where are we going to be, to both of you? Let me start with Jeff Rosenberg here. Demand destruction to me is tangible when you see a given fancy plane ticket go up 60% or a gallon of gas. What does BlackRock say about demand destruction?
Well, it's interesting, because the last question in the press conference, the premise was, if you remember it, how high do energy prices have to go before you'll consider hiking rates? And that just misses this whole point about demand destruction, because the scenario where this goes on longer and is more disruptive to oil prices is a scenario where you shift the focus from inflation, which is today's and really the last couple of weeks' story, to a growth story. And it's not how high do oil prices go before you hike, but how high and for how long do oil prices get before you cut. Precisely. And I think that's the swing there.
Torsten, that's exactly where I am, is that this is a GDP story of constructing GDP under massive price stress.
Absolutely, because now we'll begin to watch on the weekly data, on the monthly data. We have data for how many miles are driven in the U.S. We have data for how much money is spent on gas at the pump. We also have data for airfares and how much people are spending on buying airline tickets. So for that reason, if those things begin to come out, especially even the anecdotal evidence of this slowing down, this should begin to be more worrying.
John, close the loop with you. Utility prices in the United Kingdom, it's the same thing. We're not, I think Jerome Powell's aware of this, frankly, but the zeitgeist is not talking about the GDP demand.
You're going to get me in so much trouble with regards to the UK. They've got a problem over there, and his name's Ed Miliband. I'm going to leave it there, and you can sort that out yourselves, because I don't live there anymore. I'm going to talk about the shock with COVID and the inverse, the mirror image of what we see now, which is something Jeff Carey of Carlyle was talking about earlier on this morning on Bloomberg TV. In COVID, we had a massive demand shock, and it took negative prices to rebalance the market. The Hormuz crisis is the complete inverse of that. So you've got a massive supply shock that requires much, much higher prices to rebalance the market. So to your point, the question is whether $100 in the paper market and futures right now, and a futures curve going out to December that prices something in the high 70s, is sufficient enough to do that at the moment?
Well, that's why what's interesting about also what Tom is saying, if you look at the SEP, they revised inflation up. Let's just agree, that makes total sense. But they also revised GDP up, telling you that they're not assuming any demand destruction whatsoever. Is that in the textbook? So, well, the textbook would certainly tell you that an oil price shock is stagflation, you get higher prices and lower GDP, and there was no evidence of that in the SEP today.
Jeff, that's a big question. I think it's an important one. Where's the hit to growth from the higher inflation, from the higher outlook for energy prices?
Well, it's certainly not in their forecasts, and that's the clear kind of takeaway is that the forecasts are basically talking about a temporary, transitory, to use that word, impact. So that's not in the forecast. I don't think we want to take too much away from that, because if you look at page 16 of the SEP, it talks about the uncertainty in the forecast. The uncertainty in these forecasts is greater than the mean, and so that really tells you there's not a huge amount of forecast accuracy here. So let's kind of put aside that these are actual forecasts of where we're going to go. For what is really important here is it kind of tells us about the tone and the consideration of the committee. And that is basically, and Powell talked about this, a little bit of upgrading. The longer term upgrade to growth, I think, is the message. The little bit of the longer term upgrade to the Fed funds terminal rate going up. And it's a little bit of a productivity story, but that is ignoring any kind of short-term impact becoming bigger issue for 2026 in the economic outlook from the oil price shock.
Hey, Jeff, it's good to see you. It's great to catch up. Jeff Rosenberg there of BlackRock, breaking down some of these moves with Brent crude TK getting closer and closer again to 110.
Well, it's just under 106, and we're popping up 109.38. A set of headlines coming off of our Dubai desk through T-Live, and I'm sorry, there's miselection here. It's 10:43 at night. It starts for another evening in the Persian Gulf.
Would you like the F1 rant now, since you brought up Formula One and Monza in September?
You and I are going back and forth.
Got a few minutes left.
I mean, you know, we've both been medicated, but I'm sorry. It's just, it's not good.
$1 billion Mario Kart. Seriously.
I
like watching a computer game.
I love the Apple coverage, and it's tragic they have to deal with the truly, as Verstappen would say, the shattering of the sport.
It's not racing if the racing driver is going through the corner, slowing down to harvest battery power.
Can they fix it now, or is this going to take a committee meeting 1 year out?
I hope they can. I have doubts they won't. There's going to be a lot of pressure on them if the fans start to depart. For me, this is for the tourists, not for the purists. And if Max Verstappen steps away from a sport he loves, imagine any other sport where the biggest star in that sport is thinking about a sabbatical. And right now it sounds like he's thinking about a sabbatical.
Again, it's exciting. Now, they canceled the 2 races in Bahrain, in Saudi.
Because of this crisis.
And, you know, life will go on. But, you know, it's, again, the unexpected, just like we faced here today.
Going to park the F1 now.
I think it's fine.
Grandma's going to start throwing stuff at us.
Oh, no, I'm enjoying this. I honestly was going down a rabbit hole that no one needs to go down.
I can't afford to fly to Milan now.
Oh, come on. You and the fam?
Goodness.
Over to Monza, September 6th?
Absolutely. I'd love to.
Bramo can do the unemployment report.
I'm not going to make that happen anytime
I'll be here
soon.
like, the world is falling.
Torsten, it's good to see you. Torsten Slok there of Apollo. I thought that would be a boring news conference. It was not a boring news conference, and this is a story that's going to run for a while now. Succession planning at the most important central bank on the planet, arguably the most important financial institution on the planet, has totally broken down. That's a problem.
That's a problem, but also this is a Fed that's not going to come in and rescue equity markets with this concern of exactly how this is going to settle out. And equity markets are taking notice.
Because they can't. Crude right now, Brent, close to 110. Coming up tomorrow on Bloomberg TV, we'll catch up with Krishna Gua of Evercore and a whole lot more. From New York City this afternoon, good afternoon. This was Bloomberg Surveillance.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:46 on Wall Street. We do check markets all day long here at Bloomberg. Fed Wednesday. Stocks are at session lows as oil surges. No change today from the Federal Reserve, with policymakers leaving interest rates unchanged.
Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain.
Fed Chair Jay Powell from the statement also saying higher energy prices will push up overall inflation. Powell also saying he plans to stay at the central bank until after the Justice Department's investigation is complete. His comments mark the first time that Powell has given any public indication that he intends to continue serving his term as a governor, which runs until 2028. Stocks right now, as I mentioned, lows of the day with the S&P down 90, 66.25 where we stand, drop right now of 1.3%. The Dow now down by 795 points, down 1.7%. NASDAQ down 1.4%, with the VIX now at 24. The 10-year 4.2